Kit question 46, cloud. Analysis section still. 49 minutes, P2, December 2015, amended. Part A, IAS 1 presentation of financial statements defines profit or loss and other comprehensive income. The purpose of the statement of profit or loss and other comprehensive income, OCI, is to show the entity's financial performance in a way which is useful to a wide range of users, so that may attempt to assess the future net cash inflows of any entity. The statement should be classified and arranged in a manner which makes it understandable and comparable. However, the International Integrated Reporting Council, IIRC, is calling for a shift in thinking more to the long term, to think beyond what can be measured in quantitative terms, and to think how about the entity creates value for its owners. Historical financial statements are essential in corporate reporting, particularly for compliance purposes, but it can be argued that they do not provide meaningful information. Preparers of financial statements seem to be unclear about the interaction between profit or loss and OCI, especially regarding the notion of reclassification, but are equally uncertain about whether the IIRC's International Integrated Reporting Framework, IR framework, constitutes suitable criteria for report preparation. Required, Roman numeral 1. Describe the current presentation requirements relating to the statement of profit or loss and OCI, and discuss the issues surrounding the conceptual basis for the distinction between profit or loss and OCI. Your answer should refer to the requirements of IAS 1 and the conceptual framework, 6 marks. Roman numeral 2. Discuss with examples the nature of reclassification adjustment, any issues surrounding the conceptual basis for reclassification, and arguments for and against allowing reclassification of items from OCI to profit or loss. Your answer should refer to the conceptual framework, 5 marks. Roman numeral 3. Discuss the principles and key components of the IIRC's International Integrated Reporting Framework and any concerns which could question the IR framework's suitability for assessing the prospects of an entity. Part B. Cloud, a public limited company, regularly purchases steel from a foreign supplier and designates a future purchase of steel as hedged item in a cash flow hedge. The steel was purchased on the 1st of May X4, and at that date a cumulative gain on the hedging instrument of 3 million has been credited to other comprehensive income. At the year end 30th of April X5, the carrying amount of the steel was 8 million and its net realisable value was 6 million. The steel was finally sold on the 3rd of June X5 for 6.2 million. On a separate issue, Cloud purchased an item of property, plant and equipment for 10 million on the 1st of May X3. The asset is depreciated over 5 years on a straight line basis with no residual value. At 30th of April X4, the asset was revalued to 12 million. At April X5, the asset's value had fallen to 4 million. The entity makes a transfer from revaluation surplus to retained earnings for excess depreciation at the asset as the asset is used. Required. Show how the above transaction would be dealt with in the financial statements of Cloud from the date of the purchase of the asset. Note, ignore any deferred taxation effect, 6 marks. Right, here's the answer to 46, Cloud. Workbook references, top tips and easy marks box. Workbook references. Integrated reporting and other aspects of performance reporting are covered in Chapter 18 of the workbook. The conceptual framework is covered in Chapter 1. Hedge accounting is covered in Chapter 8. And transfer from revaluation surplus are covered in Chapter 4. Top tips. Part A of the question covered 2 topics: the issue of recognition of income and expenses in profit or loss versus other comprehensive income, reclassification between the two, and integrated reporting. Because the question is fairly open-ended, our answer is longer than would be needed in the exam, where only some of the points would need to be made in order to get the marks. Part B requires an application of Part A in terms of determining which elements of the profit or loss should be reported in OCI and which elements in profit or loss. Easy marks. Describing the principles and key components of the IR framework is straightforward textbook knowledge. Other than hedge accounting, Part B on the measurement of assets should be relatively easy. Marking scheme, 1 mark per point to a maximum of the marks. Part A, Roman numeral 1, current presentation requirements. IAS 1 requires the presentation of either one combined statement of profit or loss and other comprehensive income, SPLOCI for short, or two separate statements, the statement of profit or loss, SPL, and the statement of comprehensive income. Separate disclosure is required of those items of the other comprehensive income, OCI, which would be reclassified to profit or loss, and those items of OCI which would never be reclassified to profit or loss, along with the related tax effects of each category. Conceptual basis. The conceptual basis for what should be classified as OCI is not clear. This has led to the inconsistent use of OCI in IFRS. Opinions vary, but there is a feeling that OCI has become the home of anything controversial because of the lack of clear definition of what should be included in the statement. Many users are thought to ignore OCI as the changes reported are not caused by the operating flows used for predictive purposes. It is also difficult for users to understand the concept of OCI as opposed to profit or loss, which, although subject to accounting standards, is an easier notion to grasp. The definition of profit or loss and OCI in IAS 1 are not particularly helpful in understanding the conceptual basis. Bullet point 1. Profit or loss is the total of all of the income and expenses except those included, those items of income or expense which are recognised in OCI. Bullet point 2. OCI comprises items of income and expenditure that are not recognised in profit or loss as required or permitted by other IFRSs. The IASB has been asked to define what financial performance is, clarify the meaning and importance of OCI, and how the distinction between profit or loss and OCI should be made in practice. Many stakeholders were hoping that the conceptual framework, as revised in 2018, would answer these questions, but the matter has not been adequately addressed. The revised conceptual framework identifies the SPL as the primary source of information about the entity's performance and states that in principle, therefore, all income and expenditure are included in it. However, it goes on to say that developing IFRS, the IASB may include income or expenses arising from a change in the current value of the asset or liability as OCI when they determine it provides more relevant information or more faithful representation. So although there is more guidance on what constitutes OCI, the conceptual basis for it is still not clear. Roman numeral 2, reclassification adjustments. Reclassification adjustments are amounts reclassified to the profit or loss in the current period which were recognised in OCI in the current or previous periods. Items which may be reclassified include foreign currency gains on the disposal of foreign operations and realised gains or losses on cash flow hedges. Items which may not be reclassified and are charges in the revaluation surplus under IAS 16 property, plant and equipment, and actuarial gains and losses on the defined benefit plan under IAS 19 employee benefits. However, the notion of reclassification and when or which OCI items should be reclassified is not clear. The revised conceptual framework 2018 states that in principle OCI is recycled to profit or loss in the future period when doing so results in the provision of more relevant information and more faithful representation. Whilst providing more guidance than the previous conceptual framework, the conceptual basis for the OCI should be reclassified is not clear. When OCI should be reclassified is not clear. Arguments for and against reclassification. It is argued that reclassification protects the integrity of profit or loss and provides users with relevant information about the transaction which occurred in the period. Additionally, it can improve comparability where IFRS permits similar items to be recognised in either profit or loss or OCI. Those against reclassification argue that recycled amounts add to the complexity of finance reporting, may lead to earnings management, and the reclassification adjustment may not meet the definitions of income and expenditure in the period, as change in the asset or liability may have occurred in previous period. Roman numeral 3, integrated reporting. The IR framework establishes principles and concepts that govern the overall concept of integrated report. This enables each company to set out its own integrated report rather than adjusting a checklist approach. The integrated report aims to provide an insight into the company's resources and relationships, known as capitals in brackets, and how the company interacts with the external environment and the capitals to create value. These capitals can be financial, manufactured, intellectual, human, social, and relationship, and natural capital, but companies need not adopt these classifications. Integrated reporting is built around the following key components. 1. Organisational overview and external environment under which it operates. 2. Governance structure and how this supports its ability to create value. 3. Business model. 4. Risks and opportunities and how they are dealing with them and how they affect the company's ability to create value. 5. Strategy and resource allocation. 6. Performance and achievement of strategic objectives for the period and outcome. 7. Outlook and challenges facing the company and their implications. 8. The basis of presentation needed to determine including what matters are to be included in the integrated report and how the elements are quantified or evaluated. An integrated report should provide insight into the nature and quality of the organisation's relationship with its key stakeholders, including how and to what extent the organisation understands, takes into account, and responds to their needs and interests. The report should be consistent over time to enable comparison with other entities. Value depends upon the individual company's own perspective. It can be shown through movement of capital and can be defined as value created for the company or for others. An integrated report should not attempt to quantify value, as assessment of value are kept to those using the report. An integrated report does not contain a statement from those charged with governance, acknowledging their responsibility for the integrated report. This may undermine the reliability and credibility of the integrated report. There has been discussion about whether the IR framework constitutes suitable criteria for report preparation and for assurance. There is a degree of uncertainty as to the measurement standards to be issued for the information reporting and how a preparer can ascertain the completeness of the report. The IIRC has stated that the prescription of specific measurement methods is beyond the scope of a principle-based framework. The IR framework contains information on the principle-based approach and indicates that there is a need to include quantitative indicators whenever practicable and possible. Additionally, consistency of measurement methods across different reports is of paramount importance. There is outline guidance on the selection of suitable quantitative indicators. There are additional concerns over the ability to assess future disclosures, and there may be a need for confidence intervals to be disclosed. The preparation of an integrated report requires judgment, but there is a requirement for the report to describe its basis of preparation and presentation, including the significant frameworks and methods used to quantify and evaluate material matters. Also included is the disclosure of a summary of how the company determines the materiality limits and the description of the reporting boundaries. A company should consider how to describe the disclosure without causing a significant loss of competitive advantage. The entity will consider what advantage a competitor could actually gain from information in the integrated report, and will balance this against the need for disclosure. Part B. At the 30th of April X5, Cloud should write down the steel in accordance with IAS 2 inventories to its net realisable value of $6 million, therefore reducing its profit by $2 million. Cloud could reclassify the equivalent amount of $2 million from equity to profit or loss. Thus, there is no net impact on profit or loss from the write-down of inventory. The gain remaining in equity of $1 million will affect profit or loss when the steel is sold. Therefore, on the 3rd of June X5, the gain on the sale of 0.2 million will be recognised in profit or loss, and the remaining gain of 1 million will be transferred to profit and loss from equity. As regard the property, plant and equipment at 30th of April X4, there is a revaluation surplus of 4 million, being the difference between the carrying amount of 8 million, 10 million minus 2 million, and the revalued amount of 12 million. This revaluation surplus is recognised in other comprehensive income. At 30th of April X5, the asset's value has fallen to 4 million and the carrying amount of the asset is 9 million, 12 million minus 3 million. The entity will be transferring 1 million from the revaluation surplus to retained earnings, being the difference between historical cost depreciation of 2 million and the depreciation of the revalued amount of 3 million. The revaluation loss of 5 million will be charged first against the revaluation surplus remaining in equity of brackets 4 million minus 1 million, i.e. 3 million, and the balance of 2 million will be charged against profit or loss. IAS 1 requires the entity present a separate statement of changes in equity, showing amongst other items total comprehensive income for the period, reconciliations between the carrying amount at the beginning and at the end of the period of each component of equity, and analysis of other comprehensive income. 47, question 47, Allsop. Part A is adapted from P2 June 2014, P2 and P2 September December 15. Part B is adapted from P2 March June 16, and this is 49 minutes. Allsop. Allsop, a public limited company which reports under IFRS, has some overseas operations. Allsop's functional currency is the dollar, and it has an accounting year of 30th of November X5. Allsop has a foreign branch which also has a dollar for its functional currency. The foreign branch's taxable profits are determined in dinars. On the 1st of September X4, the foreign branch acquired a property for 6 million dinars. The property had an expected useful life of 12 years with zero residual value. The asset is written off for tax purposes over 8 years. The tax rate in Allsop's jurisdiction is 30% and the foreign branch jurisdiction is 20%. The foreign branch uses the cost model for valuing its property and measures its tax base at the exchange rate at the reporting date. Exchange rates: 1 dinar, 1st of December X4, $5. This is dollars to dinars. 5. 30th of November X5 is 6. Average exchange rate for year ended 30th of November X5 is 5.68 marks. Allsop enters into a contract on the 1st of December X4 to construct a machine on a customer's premises for the promised consideration of $1.5 million, with a bonus of $100,000 if the construction is completed within 24 hours of the contract commencement. At the inception of the contract, Allsop's correctly accounted for the promised bundle of goods and services as a single performance obligation in accordance with IFRS 15. At that date, Allsop expected to incur costs associated with the contract of $800,000 and concluded that it was highly probable that a significant reversal in the amount of cumulative revenue recognised would occur. Completion of the machine was highly susceptible to factors outside of Allsop's influence, mainly issues with supply of components. At 30th of November X5, Allsop had satisfied 65% of the importance of the performance obligation on the basis of costs incurred to date and concluded that variable consideration was still constrained in accordance with IFRS 15. However, on the 4th of December X5, the contract was modified with the result that the fixed consideration and expected costs increased by 110,000 and 60,000 respectively. The time allowed for achieving the bonus was extended by 6 months. As a result, Allsop concluded it was highly probable the bonus would be achieved and that it would not result in significant reversal of the revenue recognised. The contract remained a single performance obligation after the modification. 7 marks. Required. Part A. Explain to the directors of Allsop, Roman numeral 1, why deferred tax charge relating to foreign branch property arises in the group financial statements for the year ended 30th of November X5 and the impact on the financial statements if the tax base had not been translated at the historical rate. Your explanation should include calculations. Part 2. How the contract for construction of the machine should be accounted for. Your advice should include the accounting treatment up to 4th December X5. Note, the mark allocation is shown against each of the items above. Part B. The directors of Allsop have been reviewing the International Integrated Reporting Council framework for integrated reporting. The directors believe that IFRS are already extensive and provide stakeholders with a comprehensive understanding of its entity's financial position and performance for the year. In particular, statements of cash flow enable stakeholders to access the liquidity, solvency and financial adaptability of the business. They are concerned that any additional disclosure could be excessive and obscure the most useful information within the financial statements. They are therefore unsure as to the rationale for the implementation of the separate or combined integrated report. Required. Discuss the extent to which statements of cash flow provide stakeholders with useful information about the entity and whether the information would be improved by the entity introducing its integrated report. 8 marks. Professional marks will be awarded in Part B for the equality of the discussion. 2 marks. Total of 25 marks. Right, answer 49. Allsop. Workbook references, top tips and easy marks box. Workbook references. Revenue recognition is covered in Chapter 3, deferred tax is covered in Chapter 7 and foreign currency transactions are covered in Chapter 16. Integrated reporting is covered in Chapter 18. Top tips. Part A of the question is difficult and contains 2 challenging situations. Make sure that you do not spend all of your time on this part of the question and miss out on all the marks available for discussion in Part B. You should aim to generate 1 point per mark in Part B. Remember that you will gain marks for any valid point, not just those shown in the suggested solution below. In the discussion question like Part B, it is helpful to consider both benefits and limitations, then come to a conclusion at the end of your answer. Easy marks. There are easy marks you could pick up in Part B for presenting the benefits and limitations of the integrated report. So, marking scheme. Part A, Roman numeral 1, explanation, calculation, explanations, historical rate. Roman numeral 2, bonus is variable consideration. Exclude bonus from transactions price at contract inception end of first year. Satisfactory performance obligation over time, so recognise revenue over time. Recognise 65% of fixed consideration as revenue in first year. 4th of December X5 contract modified, include bonus in transaction price. Not an adjusting event after reporting period, account for it in the second year. Update percentage complete and estimates of revenue and cost. Part B. Usefulness of statement of cash flow and the integrated report. Discussion 1 mark per point to a maximum of 8 marks. Points may include usefulness of statement of cash flow, liquidity, solvency, financial adaptability, comparison of cash flow and profit, predictive value, link to the rest of financial statements. Integrated reports, limitations of financial statements, aim of integrated reporting, benefits of integrated reporting, problems with integrated reporting. Professional marks 2. Answer. Part A, Roman numeral 1, deferred tax charge. Investments in foreign branches, brackets, or subsidiaries, associated or joint arrangements, close brackets, are affected by changes in foreign exchange rates. In this case, the branch's taxable profits are reported in dinars, and changes in the dinar/dollar exchange rate may give rise to temporary differences. These differences can arise where the carrying amount of a non-monetary asset, such as property, are translated at historical rates and that the tax base of those assets are translated at the closing rate. The closing rate may be issued to translate the tax base because the resulting figure is an accurate measure of the amount that will be deductible in future periods. The deferred tax is charged or credited to profit or loss. The deferred tax arising will be calculated using the tax rate in the foreign branch's jurisdiction, that is 20%. So there's property, 3 columns, property, dinars, exchange rate and dollars. Carrying amount, cost is 6,000 dinars, exchange rate 5, so that's $1,200. Depreciation for the year, brackets 500, equals $100. Carrying amount 5,500 dinars, and that's $1,100. Tax base, cost 6,000 dinars. Tax depreciation, bracket 750. Tax base 5250. At an exchange rate of 6 is 875. Temporary tax difference is 225. Deferred tax liability at 20% is 45. The deferred tax charge in profit or loss will be therefore increased by $45,000. If the tax base has been translated at historical rate, the tax base would have been 5.25 million divided by 5 million equals 105 million. This gives taxable temporary difference of 1.1 million. 105 million minus $50,000. Therefore, tax at deferred tax liability of 50,000 times 20% is 10,000. This is considerably lower than when the closing rate is used. Part A, Roman numeral 2, contract to construct machine. Allsop should account for the promised bundle of goods and services as a single performance obligation satisfied over time in accordance with IFRS 15. At the inception of the contract, Allsop expects the following: transaction price $1.5 million, expected cost $800,000, expected profit 46.7% is $700,000. The $100,000 bonus is variable consideration under IFRS 15. At the contract inception, Allsop should exclude the $100,000 bonus from the transaction price because it cannot conclude that it is highly probable that a significant reversal in the amount of cumulative revenue recognition will not occur. Completion of the construction of the machine is highly susceptible to factors outside the entity's influence. This is a contract in which Allsop satisfies its performance obligation over time. Therefore, revenue should also be recognised over time by measuring the progress towards complete satisfaction of the performance obligation. By the end of the first year, Allsop has satisfied 65% of the performance obligation on the basis of the costs incurred to date. Costs incurred to date are therefore 520,000 brackets 800,000 times 65%. Allsop reassures the variable consideration of 100,000 and concluded that the amount was still constrained, which means that it may not yet be recognised. Therefore, 30th of November X5, only the portion of the fixed consideration of $1.5 million related to progress to date may be recognised as revenue. The results of revenue of 975,000 is 1.5 million times 65%. In brackets, the following amount should therefore be included in the statement of profit or loss. Revenue 975,000, cost 520,000, gross profit $455,000. Those are all dollars. However, on the 4th of December X5, the contract was modified. As a result, the fixed consideration and expected cost incurred by 110,000 and 60,000 respectively. This increased the fixed consideration to 1.61 million, which is 1.5 million plus 110,000, and the expected cost of 860,000, which is brackets 800,000 plus $60,000. The total potential consideration after the modification of 1.71 million, which is 1.61 million fixed consideration plus 100 million completion bonus, as in brackets, As Allsop concluded that receipt of the bonus was highly probable and that included the bonus in the transaction price, would not result in significant reversal in the amount of cumulative revenue recognition in accordance with IFRS 15. Allsop also concluded that the contract remains a single performance obligation. Thus, Allsop should account for the contract modification as if it were part of the original contract. Therefore, Allsop should update its estimates of costs and revenues as follows. Allsop has satisfied 60.5% of the performance obligation (520,000) actual costs incurred compared to 860,000 total expected costs. It should recognise additional revenue of 59550, 60.5% of 1.71 million, and 975,000 revenue recognised to date at the date of the modification as a cumulative catch-up adjustment. As a contract amendment took place after the year end, the additional revenue would not be treated as an adjusting event after the reporting period. Therefore, it should be accounted for in the year ended 30th of November X6 rather than the adjustment in the year ended 30th of November X5. Part C. Usefulness of statement of cash flows. Liquidity, solvency and financial adaptability. Statements of cash flows provide valuable information to stakeholders on the entity's liquidity (brackets, its ability to pay short-term obligations), solvency (brackets, its ability to meet the long-term financial commitments), and financial adaptability (brackets, its ability to take effective action to alter the amount of and timing of its cash flows to respond to unexpected needs or opportunities). Do you get that? Its ability to take effective action to alter the amount and timing of its cash flows to respond to unexpected needs and opportunities, close brackets. Information about the cash flows helps stakeholders to understand the entity's operations and evaluate its investing and financial activities. Comparison of cash flow and profit. Cash flow are objective and verifiable and so are more easily understood than profit. Profit can be manipulated through the use of judgment or by the choice of a particular accounting policy. Accounting cash flows are therefore useful for highlighting the differences between cash and profits. The cash generated from operations is a useful indication of the quality of its profits generated by the business. Good quality profits will generate cash and increase the financial adaptability of an entity. Predictive value. The cash flow information will also have some predictive value. Information about the entity's cash flow during a period can help users to assess the entity's ability to generate future net cash inflows. Therefore, it may assist stakeholders in making judgments on an amount, timing and degree of certainty of future cash flows. Link to rest of financial statements. Cash flow information should be used in conjunction with the rest of the financial statements. The adjustment of non-cash items within operating activities may not be easily understood. The classification of cash flows can be manipulated between operating, investing and financing activities. Often to present the cash flow from operating activities favourably. It is important, therefore, not to examine the cash flow information in isolation. It is only through the analysis of the statement of financial position, statement of comprehensive income and notes, together with the cash flow, that a more comprehensive picture of the entity's position and performance develops. Integrated reports. Limitations of financial statements. It is true that IFRS are extensive and their required disclosures very comprehensive. This has led to criticism that the usefulness of financial statements may be limited where the most relevant information is obscured by immaterial disclosures. The IASB has sought to address this through the issue of IFRS Practice Statement 2, making materiality judgments. An entity should apply judgments when preparing its financial statements. Disclosure is not required if the information provided by the disclosure is not material. Aim of integrated reporting. Integrated reporting is designed to cover a wider message on organisational performance, covering all of the entity's resource and how it uses these capitals to create value over the short term, short, medium, and long term, not only in the financial resources. Not only its financial resources. Blimey, I didn't read that very well today. I'm going to read that again. Integrated reporting is designed to cover a wider message on organisational performance, covering all of an entity's resources and how it uses these capitals to create value over the short, medium, and long term, not only its financial resources. It's a very long sentence in my defence. Benefits of integrated reporting. Integrated reporting will provide stakeholders with valuable information which would not be immediately accessible from the entity's financial statements. Financial statements are based on historical information and may lack predictive value. They are essential in corporate reporting, particularly for compliance purposes, but do not provide meaningful information regarding business value. The primary purpose of an integrated report is to explain the provider of capital, how the organisation generates value over time. This is summarised through an examination of the key activities and outputs of the organisation, whether they are financial, manufacturing, intellectual, human, or social and natural. An integrated report seeks to examine the external environment which the entity operates within and to provide the insight into the entity's resources and relationships to generate value. It is principled based and should be driven by materiality, including how and to what extent the entity understands and responds to the needs of its stakeholders. This would include an analysis of how the entity has performed within the business environment, together with the depreciation and prospects of challenges for the future. It is this strategic direction which is lacking from the traditional set of financial statements and will be invaluable to stakeholders to make a more informed assessment of the organisation and its prospects. Problems with integrated reporting. An integrated reporting system would increase disclosure as well as imposing additional time and cost constraints on the reporting entity. It may require changes to IT systems in order to capture the data, as well as initial uses of an external consultancy to design the report. Conclusion. Arguably, an integrated report may give improved information to stakeholders and therefore provide a coherent story about the business which goes above and beyond that provided by a statement of cash flows regarding liquidity, solvency, and the financial adaptability of the business. It may help to the entity to think holistically about its strategy and manage key risks, as well as information as make informed decision and build investor confidence. However, the entity must assess whether it believes those benefits outweigh the potential disadvantages of an extra cost and administration it may incur as a result of as the report remains voluntary. Question 48, Kiki, 49 marks from SBR Specimen Exam 2. Part A. Kiki is a public limited entity. It designs and manufactures children's toys. It has a reporting date of the 31st of December X7 and prepares its financial statements in accordance with international financial reporting standards. The directors require advice about the following situations. Roman numeral 1. Kiki sells $50 gift cards. These can be used when purchasing any of Kiki's products through its website. The gift cards expire after 12 months. Based on significant past experience, Kiki estimates that its customers will redeem 70% of the value of the gift card and that 30% of the value will expire unused. Kiki has no requirement to remit any unused funds to the customer when the gift card expires unused. The directors are unsure about how the gift card should be accounted for. 6 marks. Roman numeral 2. Kiki's best-selling range of toys is called Scarimon. In X6 colour, another listed company entered into a contract with Kiki for the rights to use Scarimon characters and imagery in monthly comic books. The contract term states that Colour must pay Kiki a royalty fee for every issue of the comic book which is sold. Before signing the contract, Kiki determined that Colour had a stronger credit rating. Throughout X6, Colour provided Kiki with monthly sales figures and paid all amounts due in the agreed upon period. At the beginning of X7, Colour experienced cash flow problems. These were expected to be short term. Colour made nominal payments to Kiki in relation to comic sales for the first half of the year. At the beginning of July X7, Colour lost access to credit facilities and several major customers. Colour continued to sell Scarimon comics and online through specialist retailers but made no further payments to Kiki. The directors are unsure how to deal with the above issues in the financial statements for the year ended 31st of December X7, 6 marks. Required. Advise the accountants on the matters set out above with reference to international financial reporting standards. Note the split of marks allocation is shown against each of the 2 issues above. Part B. As a result of rising property prices, Kiki purchased 5 buildings during the current period in order to benefit from further capital appreciation. Kiki has never owned an investment property before. In accordance with IAS 40 investment properties, the directors are aware that they can measure the buildings using either the fair value model or the cost model. However, they are concerned about the impact that this choice will have on the analysis of Kiki's financial performance, position and cash flow by current and potential investors. Required. Discuss the potential impact which this choice in accounting policy will have on investors. An analysis of Kiki's financial statements. Your answer should refer to the key financial performance ratios. 11 marks. Professional marks will be awarded in Part B for clarity and quality of preparation. 2 marks. 25 marks in total. Right, answer 48. Kiki. Marking scheme, 1 mark per point in Part A, Roman numeral 1 and 2, and Part B, 1 mark per point. 2. Part A, Roman numeral 1, gift cards. IFRS 15, revenue from contracts with customers, says that revenue should be recognised when or as a performance obligation is satisfied by transferring the promised good or service to the customer. When a customer buys a gift card, they are prepaying for the product. Revenue cannot be recognised because the entity has not yet transferred control over the asset and so has not satisfied a performance obligation. As such, cash received in respect of gift cards should be internally recognised as a contract liability. IFRS 15 refers to a customer's unexercised right as breakage. The guidance for variable consideration is followed when estimating breakage. In other words, the expected breakage is included in the the transaction price if it is highly probable that the significant reversal in the amount of cumulative revenue recognised will not occur once the uncertainty is subsequently resolved. This means that if the company is unable to reliably estimate the breakage amount, then revenue for the unused portion of the gift card is recognised when the likelihood of the customer exercising that remaining right becomes remote. However, if an entity is able to reliably estimate the breakage amount, then it recognises the expected breakage amount as revenue in proportion to the pattern of rights exercised by the customer. In relation to Kiki, it appears that the amount of breakage can be reliably determined, and so this should be recognised in revenue as the gift card is redeemed. For every $1 redeemed, Kiki should recognise $1.43 $1 times 100 over 70 in revenue. Part A, Roman numeral 2, royalty. According to IFRS 15, an entity should only account for revenue for a contract with the customer when it meets the following criteria. Bullet point, and there's 4 bullet points. Bullet point 1, the contract has been approved. Bullet point 2, rights regarding goods and services can be identified. Bullet point 3, payment terms can be identified. Bullet point 4, it is probable that seller will collect the consideration it is entitled to. At inception of the agreement, Kiki and Colour entered in an explicit contract with specific payment terms and conditions. Moreover, Colour had a strong credit rating and so payment was probable. As such, it would seem that the above criteria are met. IFRS 15 says that revenue from usage-based royalty should be recognised as usage occurs. Whether the contract with a customer meets the above criteria is only reassessed if there is a significant change in the fact and circumstance. In July X7, Colour lost major customers and sources of finance. As such, it was no longer probable that Kiki would collect the consideration it was entitled to. From July X7, no further revenue from the contract should be recognised. According to IFRS 9 financial instruments, non-payment is an indicator that outstanding receivables are credit impaired. A loss allowance should be recognised equivalent to the difference between the gross carrying amount of the receivables and the present value of the expected future cash flows receivable from Colour. Any increase or decrease in the loss allowance is charged to the profit or loss. Part B, investment properties. In accordance with IAS 40 investment property, the building should be initially measured at cost. If the cost model is applied, then the buildings will be recognised at cost less accumulated depreciation and impairment losses. If the fair value model is applied, then the building will be remeasured to fair value at their reported date. Gains and losses on remeasurement are recognised in the statement of profit or loss. No depreciation is charged. Statement of financial position. Assuming that property prices rise, the fair value model will lead to an increase in reported assets on a statement of financial position. In contrast, investment properties measured using the cost model is depreciated, which reduces the carrying amount. This means that the fair value model may make Kiki appear that and more asset rich. Some stakeholders may place importance on an entity's asset base, as it can be used as security for obtaining new finance. However, the reporting higher assets can sometimes be perceived negatively. For example, asset turnover ratios will deteriorate, and so Kiki may appear less efficient. If assets increase, the equity also increases. As such, the fair value model may lead to Kiki's reporting a more optimistic gearing ratio. This may reduce the perception of risk, encouraging further investment. Statement of profit or loss. In times of rising prices, the use of fair value model will lead to gains being reported in the statement of profit or loss. This will increase profits for the period. In contrast, the depreciation charged under the cost model can reduce profits for the period. Therefore, earnings per share, a key stock market and investor ratio, is likely to be higher if the fair value model is adopted. However, it should be noted that fair values are volatile. In some years, fair value gains are much larger than in other years. In property price decline, there is fair value model. Then the fair value model will result in losses. As such, reported profits are subject to more volatility if the fair value model is adopted. This may increase stakeholders' perception of risk. In contrast, the depreciation expense recorded in accordance with the cost model will be much more predictable, meaning that investors will be better able to predict Kiki's future results. Many entities now present alternative performance measures, APMs, such as EBITDA, earnings before interest, tax, depreciation and amortization. Other entities present underlying profit indicators which strip out the impact of non-operating or non-recurring gains or losses, brackets, such as the remeasurement of investment properties, close brackets. Although the use of alternative performance measures has been criticised, Kiki may consider them to be useful in helping investors to assess underlying business performance through the eyes of management and to eliminate the impact of certain accounting policy choices. Statement of cash flows. Accounting policy choices have no impact on operating, investing or financing cash flows reported in the statement of cash flow. Disclosure. It should be noted that entities using the cost model for investment properties are required to disclose the fair value. Such disclosures enable better comparisons to be drawn between entities which account for investment properties under different models. Question 49, holes, 49 minutes, from SBR December 18. Part A. IFRS Practice Statement 1, Management Commentary, provides a broad, non-binding framework for the presentation of management commentary which relates to financial statements which have been prepared in accordance with IFRS. The management commentary is within the scope of conceptual framework, and therefore the qualitative characteristics will be applied to both the financial statements and the management commentary. Required, Roman numeral 1. Discuss briefly the arrangements for and against issuing IFRS Practice Statement 1 management commentary as a non-binding framework or as an IFRS, 4 marks. Roman numeral 2. Discuss how the qualitative characteristics of understandability, relevance and comparability should be applied to the preparation of the management commentary, 5 marks. Part B. Holes Group is preparing its financial statements for the year ended 30th of November X7. The directors of Holes have been asked by an investor to explain the accounting for taxation in the financial statements. The group operates in several tax jurisdictions and is subject to annual tax audits, which can result in amendments to the amount of tax to be paid. The profit for continuing operations was $300 million in the year ending 30th of November X7, and the reported tax charge was $87 million. The investor was confused as to why the tax charge was not the tax rate multiplied by the profit from continuing operations. The directors have prepared a reconciliation of the notional tax charge on profits as compared with the actual tax charge for the period. Right, so there's a list, a calculation. Profit from continuing operations before tax. This is all in millions of dollars. Profit from continued operations before tax, 300 million. Notional charge at local corporate tax rate of 22%, 66 million. Differences in overseas tax rates, 10. Tax relating to non-taxable gains on disposal of business, brackets 12. Tax relating to the impairment of brands, 9. Other tax adjustments, 14. Tax charge for the year, total of 87. The amount of income tax paid as shown in the statement of cash flow is 95 million, but there is no current explanation of the tax effect of the above items in the financial statement. The tax rate applicable to Holes for the year ended 30th of November X7 is 22%. There is a proposal in the local tax legislation that a new tax rate of 25% will apply from the 1st of January X8. In the country where Holes is domiciled, tax laws and rate changes are enacted when the government approves the legislation. The government approved the legislation on the 12th of November X7. The current weighted average tax rate for the group is 27%. Holes does not currently disclose its opinion of how the tax rate may alter in the future, but the government is likely to change with the result that a new government will almost certainly increase the corporate tax rate. At 30th of November X7, Holes is deductible temporary difference of 4.5 million, which are expected to reverse in the next year. In addition, Holes also has taxable temporary differences of 5 million, which relate to the same taxable company and the tax authority. Holes expects 3 million of these taxable temporary differences to reverse in X8 and the remaining 2 million to reverse in X9. Prior to the current year, Holes has made significant losses. Required. With reference to the above information, explain to the investor the nature of accounting for taxation in financial statements. Note, your answer should explain the tax reconciliation, discuss the implications of current and future tax rates, and provide explanation of accounting for deferred taxation in accordance with relevant IFRS, 14 marks. Professional marks will be awarded in B for clarity and quality of discussion, 2 marks. Total of 25 marks for the whole question. Right, answer for 49 holes. Marking scheme. Part A, Roman numeral 1. Arguments for and against the non-binding framework. Roman numeral 2, bullet point 1. A discussion of understandability, relevance and comparability. Bullet point 2, application of the above characteristics to MC. Part B, the explanation of why taxable profits are different from accounting profit. Application of the following explanations to the scenario. Bullet point 1, tax reconciliation. Point 2, tax rates. Point 3, deferred taxation. So here's the answer. Part A, Roman numeral 1. The IFRS practice statement management commentary provides a broad non-binding framework for the presentation of management commentary. The practice statement is not an IFRS. Consequently, entities applying IFRSs are not required to comply with the practice statement unless specifically required by their jurisdiction. Furthermore, non-compliance with the practice statement will not prevent an entity's financial statements from complying with IFRS. It can be arranged that the International Accounting Standards Board objective of enhancing consistency and comparability may not be achieved if the framework is not mandatory. A statement is more likely to guarantee a consistent application of the principles and practices behind the management commentary, MC. However, it is difficult to create a standard on the management commentary. It gives the letters here, MC, but I'm going to fill in the names. Management commentary, which is sufficiently detailed to cover the business models of every entity or be consistent with all IFRSs. Some jurisdictions take little notice of non-management guidance, but the practice statement provides regulators with a framework to develop more authoritative requirements. The practice statement allows companies to adapt the information provided to particular aspects of their business. This flexible approach could help generate more meaningful disclosures about resources, risks and relationships, which can affect an entity's value and how these resources are managed. It provides management with an opportunity to add context to the published financial statements and to explain their future strategy and objectives without being restricted by the constraints of the standard. If the MC management commentary were a full IFRS, the integrating of management commentaries and the information produced in accordance with IFRS could be challenged on technical grounds as well as a practical merits. In addition, there could be jurisdictional concerns that any form of integration might not be accepted by local regulators. Part A, Roman numeral 2. The framework states that an essential quality of information provided in financial statements is that it is readily understandable by users. The management commentary should be written in plain language and a style appropriate to users' needs. The primary users of the management commentary are those identified in the conceptual framework. The form and content of the management commentary will vary between entities, reflecting the nature of the business and strategies adopted and the regulatory environment in which they operate. Users should be able to locate information relevant to their needs. Information has a quality of relevance when it has the capacity to influence the economic decisions of users by helping them evaluate past, present and future events or confirming or correcting their past evaluations. Relevant financial information, if capable of making a difference to the decision made by users. In order to make a difference, financial information has predictive value, confirmatory value, or both. The onus is on management to determine what information is important enough to be included in the management commentary to ensure users to understand the financial statement and meet the objectives of the management commentary. If the entity provides too much information, it could reduce the relevance and understandability. If material events or uncertainties are not disclosed, then the users may have insufficient information to meet their needs. However, unnecessary detail may obscure important information, especially if entities adopt a boilerplate approach. If management presents too much information about, for example, all the risks facing an organisation, this will conflict with the relevance objective. There is no single optimal number of disclosures, but it is useful to convey their relevant importance in a meaningful way. Comparability is the qualitative characteristic which enables users to identify and understand similarities and differences among items. It is important for users to be able to compare information over time and between entities. Comparability between entities is problematic as the management commentary is designed to reflect the perspective of management and the circumstances of individual entities. Thus, entities in the same industry may have different perceptions of what is important and how they measure and report it. There are some precedents on how to determine and calculate non-financial measurements and financial measures, which are not produced in accordance with IFRS, but there are inconsistencies in the definition and calculation of these measures. It is sometimes suggested that effectiveness of the overall report may be enhanced by strengthening the links between financial statements and the MC, management commentary. However, such suggestions raise concerns about maintaining a clear distinction between the financial statements information and other information. An entity should ensure consistency in terms of wording, definitions, segments, disclosures, and between the financial statements and the management commentary to improve the understanding of financial performance. Part B. Current tax is based on taxable profit for the year. Taxable profit is the difference from accounting profit due to temporary differences between accounting and tax treatment and due to items which are never taxable or tax deductible. Tax benefits such as tax credits are not recognised unless it is probable that the tax positions are sustainable. The group is required to estimate the corporate tax in each of the many jurisdictions in which it operates. The group is subject to tax audits in many jurisdictions. As a result, the group may be required to make adjustment in the subsequent period, which could have material impact on the group's profit for the year. The heading Tax Reconciliation. The tax rate reconciliation is important for understanding the tax charge reported in the financial statement and why the effective tax rate differs from the statutory rate. Most companies will reconcile the group's annual tax expense in the statutory rate in the country in which the parent is based. Hence, the rate 22% is used in the tax reconciliation. It is important that the reconciliation explains the reason for the differences between the effective rate and the statutory rate. There should be minimal use of the other category. In this case, the other category is quite significant, brackets 14 million, and there is no explanation of what other constitutes. One-off unusual items can have significant effect on the effective tax rate, but financial statements and notes often do not include a detailed discussion of them. For example, the brand impairment and disposals of business should be explained to investors as they are probable material items. The explanation should include any potential reversal of the treatment. Some profits recognised in the financial statements are non-taxable, such as the tax relating to the non-taxable gains on disposals of business, and in some jurisdictions taxation relief on the impairment losses will not be allowable for taxation. The reasons for these items not being allowed for taxation should be explained to investors. Tax rates. As the group is operating in multiple countries, the actual tax rate applicable to profits in those countries are different from the local tax rate. The overseas tax rates are higher than local rates, hence the increase in the taxation charge of $10 million. The local rate is different from the weighted average tax, 27% of the group based on the different jurisdiction in which it operates. Investors may feel that using the weighted tax rate in the reconciliation gives a more meaningful number because it is a better estimate of the tax rate the group expects to pay over the long term. Investors will wish to understand the company's expected long-term sustainable tax rate so they can prepare their cash flow for profit forecast. Information about the sustainability of the tax rate over the long term is more important than whether the rate is high or low compared to other jurisdictions. An adjustment can be made to an investor's financial model for long-term sustainable rates, but not for the volatile rate where there is no certainty over future performance. For modelling purposes, an understanding of the actual cash taxes paid is critical, and the cash paid of 95 million can be found in the statement of cash flow. Deferred taxation. Provision for deferred tax is made for temporary differences between a carrying amount of the assets and liabilities for financial reporting purposes and their value for tax purposes. The amount of deferred tax reflects the expected recoverable amount and is based on the on the expected manner of recovery or settlement of the carrying amount of assets and liabilities using the basis of taxation enacted or substantively enacted by the financial statement date. Deferred taxed assets are not recognised where it is more likely that the asset will not be realised in the future, and reference to IAS 37 provisions, contingent liabilities and contingent assets is useful in this regard. The evaluation of deferred taxed assets recoverability requires judgments to be made regarding the availability of future taxable income. Management assesses the available evidence to estimate its sufficient future taxable income will be generated to use the existing deferred taxed asset. A significant piece of objective negative evidence evaluated was the loss incurred in the period prior to the period ended 30th of November X7. Such objective evidence may limit the ability to consider other subjective evidence such as projections for future growth. Deferred taxes are one of the most difficult areas of the financial statements for investors and to understand. Thus, there is a need for a clear explanation of deferred tax balances and analysis of the expected timing of reversals. This would help investors see the time period over which deferred taxed assets arising from the losses might reverse. It would be helpful if a company provided a breakdown of what reversals would have a cash tax impact and which would not. As the proposed tax law was approved, it is considered to be enacted. Therefore, the rate of 25% should be used to calculate the deferred tax liability associated with the relevant items which affect deferred taxation. At 30th of November X7, Holes has deducted temporary differences of 4.5 million, which are expected to reverse in the next year. In addition, Holes also has taxable temporary differences of 5 million which relate to the same taxable company and the tax authority. Holes expects 3 million of those taxable temporary differences to reverse in X8 and the remaining 2 million to reverse in X9. Thus, the deferred tax liability of 1.25 million, 5 million times 25%, should be recognised, and as 3 million of the taxable temporary differences are expected to reverse in the year in which the deductible temporary differences reverse, Holes can also recognise a deferred tax asset of 0.75 million, which is 3 million times 25%. The recognition of a deferred tax asset for the rest of the deductible temporary differences will depend on whether future taxable profits sufficient to cover the reversal of the deductible temporary difference are expected to arise. Deferred tax assets and liability must be recognised gross in the statement of financial position. However, it may be possible to offset the deferred tax assets and the deferred tax liability if there is a legally enforceable right to offset the current income tax asset against current income tax liability, as the amounts relate to income tax levied by the same taxation authority on the same taxable entity. After the enforcement of the new tax law, when material, Holes should consider disclosing the anticipated current and future impact of the results of operations, financial position, liquidity and capital resources. In addition, Holes should consider disclosure in the critical accounting estimate section of the management commentary to the extent the charges could materially affect existing assumptions used in making estimates of tax-related balances. Changes in the tax laws and rates may affect recorded deferred tax assets and liabilities and the effective tax rate in the future. Financial reporting issues is the section. The next section, question 50, KT, Kayte. 49 minutes. Part A is from SBR December 18 amended, and Part B is amended from P2 December 14. Part A. The 2010 conceptual framework for financial reporting includes a probability criterion which specifies that in order for an asset or liability to qualify for recognition, it must be probable that any future economic benefit associated with an asset or liability will flow to or from an entity. Some current accounting standards which were developed under 2010 conceptual framework, have been criticised for not necessarily applying probability criterion relating to future economic benefits on a consistent basis. The IASB issued a significantly revised conceptual framework in 2018. The recognition criteria in 2018 conceptual framework no longer include a probability criterion. Required. Explain how the probability criterion in the 2010 conceptual framework has not been applied consistently across accounting standards, illustrating your answer with reference to any inconsistencies with measurement of assets held for sale, provisions and contingent consideration, and discuss how the revised 2018 conceptual framework may address this issue. 6 marks. Part B, Roman numeral 1. Katie has a year-end 31st of May. It operates in the shipping industry and owns vessels for transportation. Katie's vessels constitute a material part of its total assets. The economic life of the vessels, it's estimated to be 30 years, but the useful life of some of the vessels is only 10 years because Katie's policy is to sell these vessels when they are 10 years old. Katie estimated the residual value of these vessels at sale to be half of the acquisition cost, and this value was assumed to be constant during their useful life. Katie argued that the estimates of residual value used were conservative in view of an immature market with a high degree of uncertainty and pressure, and presented documentation which indicates some vessels were being sold for a price considerably above carrying amount. Broker valuations of the residual value were considerably higher than those used by Katie. Katie argued against broker valuations on the grounds that it would result in a greater volatility in reporting. Katie keeps some of the vessels for the whole 30 years, and these vessels are required to undergo an engine overhaul in dry dock every 10 years to restore their service potential, hence the reason why some of the vessels are sold. The residual value of the vessels kept for 30 years is based upon the steel value of the vessel at the end of its economic life. At the time of purchase, the service potential which will be required to be restored by the engine overhaul is measured based on the cost as if it had been performed at the time of the purchase of the vessel. Normally, engines last for 30 years total life of overhaul every 10 years. Additionally, one type of vessel was having its funnels replaced after 15 years, but the funnels had been depreciated separately. 12 marks. Part B, Roman numeral 2. On the 1st of June X1, Katie acquired a property for $5 million and annual depreciation of $500,000 is required on a straight line basis with no residual value. At 31st of May X3, when accumulated depreciation was $1 million, an impairment loss of $350,000 was recognised, which resulted in the property being valued at its estimated value in use. On the 1st of October X3, as a consequence of the proposed move to new premises, the property was classified as held for sale. At the time of classification as held for sale, the fair value less cost to sell was $3.4 million. At the date of the published interim financial statements, 30th November X3, the property market had improved and the fair value less cost to sell was reassessed at $3.52 million, and at the year end on 31st of May X4, it had improved even further, so that the fair value less the costs to sell was $3.95 million. The property was sold on the 5th of June X4 for $4 million. 7 marks. Required. Discuss the accounting treatments of the above transaction in the financial statements of Katie. The mark allocation is above. Right, that's the question. Right, answer 50 Katie. Workbook references, top tips and easy marks box. Workbook references. The conceptual framework and interim financial reporting are covered in Chapter 1. IAS 16 is covered in Chapter 4 and IFRS 5 is covered in Chapter 13. Top tips. Part A requires you to discuss the probability recognition criteria in 2010 conceptual framework. Don't be put off by the fact the 2010 conceptual framework, as the relevant part of it has been given in the question. The question told you which standard to discuss. Make sure that you address what is asked for. Part B, Roman numeral 1, covers the application of IAS 16 and was demanding indicative of what could be asked in SBR exam on topics covered in your earlier studies. Easy marks. There were some easy marks available in Part A for stating the recognition criteria in the 2010 conceptual framework. In Part B, Roman numeral 2, you should have been able to apply the IFRS 5 accounting treatment for non-current assets held for sale, even if you were unfamiliar with IAS 34. Marking scheme. Part A. Inconsistent application of the probability criterion, 1 mark per point. Changes to the recognition criteria of 2018 conceptual framework. Part B, Roman numeral 1, vessels sold after 10 years, vessels kept for 30 years, and funnels. Part C, interim follow same accounting policies for annual financial statements. Measure asset at lower of carrying amount and fair value less cost to sell. First to the 10th X3 recognise impairment loss of 100,000. First to the 12th X4 reverse impairment loss of 120,000 and as less than cumulative impairment losses to date of 45,000. 31st of May X4 can only recognise 330,000 of the 430,000 increased in fair value less cost to sell. Brackets up to remaining cumulative impairment losses to date. 5 points. No, the 5th of the 6th X4 recognise gain on disposal. Gain on disposal is non-adjusting event after the reporting period. So that was the marking scheme. I don't tell you the marking points because I can't be bothered. Part A, probability criterion. Answer A. Different accounting standards use different levels of probability to discuss when assets and liabilities should be recognised in the financial statements. For example, bullet point 1. Economic benefits from property, plant and equipment and intangible assets need to be probable to be recognised, but to be classified as held for sale, the sale has to be highly probable. Bullet point 2. Under IAS 37, provisions, contingent liabilities and contingent assets, a provision should be probable to be recognised, but uncertain assets, on the other hand, would have to be virtually certain to be disclosed. This could lead to a situation where two sides of the same court case have two different accounting treatments, despite the likelihood of payout being identical for both parties. Bullet point 3. Contingent consideration is recognised in the financial statements regardless of the level of probability. Rather, the fair value is adjusted to reflect the level of uncertainty of a contingent consideration. The 2018 conceptual framework requires an item to be recognised in the financial statements if Part A, the item meets the definition of an element, brackets asset, liability, income, expense or equity, and Part B, recognition of that element provides users of the financial statements with information that is useful, i.e. with bullet point 1, relevant information about the element, bullet point 2, a faithful representation of the element. Whilst this will not remove the inconsistencies in recognition criteria that currently exist across IFRS standard, it does provide a basis for IASB to consider when developing new standards and revising existing standards. Furthermore, the new criteria may mean that more assets and liabilities with a low probability of inflow or outflow of economic resources are likely to be recognised. The criteria also allows the standards to contain recognition criteria that may be considered inconsistent, but this may be a necessary consequence of providing the more useful information. Part B, Roman numeral 1, vessels. Vessels sold at 10 years old. Katie's estimate of residual life of these vessels is based on acquisition cost. This is unacceptable under IAS 16 property, plant and equipment. IAS 16 defines residual value as the estimated amount that an entity would currently obtain from disposal of an asset under deducting the estimated cost of disposal if the asset were already part of the age and its condition expected at the end of its useful life. Paragraph 6. IAS 16 requires that property, plant and equipment must be depreciated so that its depreciable amount is allocated on a systematic basis over its useful life. Depreciable amount is the cost of an asset less the residual value. IAS 16 stipulates that the residual value must be reviewed at least each financial year, and if expectations differ from previous estimates, any change in accounting for prospectively as a change in estimate under IAS 8 accounting policies, changing in accounting estimates and errors. Katie's model implies that the residual value of the vessel remain constant through the vessel's useful life. However, the residual value should be adjusted particularly as the date of sale approaches and the residual value approaches proceeds of disposal less costs of disposal at the end of the asset's useful life. Following IAS 16, if the residual value is greater than the asset's carrying amount, the depreciation charge is zero until such time as the residual value subsequently decreases to an amount below the asset's carrying amount. The residual value should be the value at the reporting date, as if the vessel were already of age and condition expected at the end of its useful life. Depreciable amount is affected by an increase in the residual value of an asset because of past events, but not by expectation of changes in future events, other than expected effects of wear and tear. The useful life of a vessel (brackets 10 years) is shorter than the total life (brackets 30 years). So it is the residual value at the end of the 10-year useful life that must be established. Vessels kept for 30 years. Katie correctly uses a residual value for these vessels based upon the scrap value of steel. The depreciable amount of the vessel is therefore the cost less the scrap value of steel, and the vessel less the vessel should be depreciated over a 30-year period. The engine is a significant part of the asset and should be depreciated separately over its useful life of 10 years until the date of the next overhaul. The cost of the overhaul should be capitalised (brackets). A necessary overhaul is not considered a day-to-day servicing cost (close brackets). And any carrying amount relating to the engine before overhaul should be derecognised. Generally, however, the depreciation of the original amount capitalised in respect of the engine will be calculated to have a carrying amount of nil when the overhaul is undertaken. Funnels. The funnel should be identified as significant part of the asset and depreciated across their useful life in 15 years. As this has not occurred, it will be necessary to determine what the carrying amount would have been had the funnels been initially separately identified. The initial cost of the funnels can be determined by reference to replacement cost, and the associated depreciation charge determined using the rate of the vessels over 30 years. There will therefore be a significant carrying amount to be written off at the time the replacement funnels are capitalised. Roman numeral 2. Property. IAS 34 requirement. In accordance with IAS 34 interim financial reporting, an entity must apply the same accounting policies in its interim financial statements as in its annual financial statements. Measurements should be made on a year-to-date basis. Katie's interim financial statements are for 6 months to 30th of November X3. Katie must apply the provisions of IFRS 5 non-current assets held for sale and discontinued operations to the valuation of the property. Application of IFRS 5. In accordance with IFRS 5, an asset held for sale should be measured at the lower of the carrying amount and the fair value less cost to sell. Immediately before classification of the asset as held for sale, the entity must recognise the impairment in accordance with applicable IFRS. Any impairment loss is generally recognised in profit or loss, but if the asset has been measured at the revalued amount under IAS 16 and IAS 38, the impairment will be treated as a revaluation decrease. Once the asset has been classified as held for sale, an impairment loss will be based on the difference between the adjusted carrying amounts and the fair value less cost to sell. The impairment loss, if any, will be recognised in the profit or loss. A subsequent increase in fair value less cost to sell may be recognised in profit or loss only to the extent of any impairment previously recognised. To summarise, Step 1. Calculate carrying amount under the applicable accounting standard here, IAS 16. Depreciation of $500,000 per year implies a useful life of 10 years, and which 8 years are remaining in the 1st of June X3. Depreciation must then be charged for the 4 months to the 1st of October X3, the date of classification as held for sale in calculating on the carrying amount, net of the impairment loss incurred on the 31st of May X3 over the remaining useful life of 8 years. $5 million, so there's a calculation here, $5 million cost minus 1 million accumulated depreciation minus 35 million impairment over 8 years remaining useful life times 4/12 equals 152,083 rounded to 15 million. Rounded to 0.15 million. So the carrying amount at 1st of October X3 is 5 million minus 1 million less 0.35 million less 0.15 million and 3.5 million. Step 2. Classified as held for sale, compare the carrying amount, 3.5 million, with fair value less cost to sell, brackets 3.5 million, measured at the lower of the carrying amount and fair value less cost to sell, here 3.4 million, giving an initial write-down of 100,000, cease depreciation. Step 3. Determine fair value less cost to sell at the date of the interim financial statement, 1st of October X3, here given as 3.52 million, and compare with carrying amount of 3.4 million. This gives a gain of 120,000. The impairment previously recognised is 350,000 plus 100,000 equals 450,000. The gain of 120,000 is less than this and may therefore be credited to profit loss, and the property is carried at 3.52 million. Step 4. On the 31st of May X4, fair value less cost to sell is 3.95 million. The change in the value less cost to sell is recognised, but the gain recognised cannot exceed any impairment loss to date. Impairment loss to date are 350,000 plus 100,000 minus 120,000 equals 330,000, and this is less than the change in the fair value less cost to sell of 430,000, brackets 3.95 million less to 3.52 million. The restricted gain of 330,000 is recognised and the property is carried at 3.85 million, brackets 3.52 plus 330,000. That's the end of the question. Okay, Kit. Question 51. Financial reporting issues. Phil. FILL. 49 minutes. SBR December 18. This is the question. Part A. Phil is a coal mining company, not a coal mining company. It's a coal mining company. No, it's not. Phil is a coal mining company that sells its coal on the spot and futures markets. On the spot market, the commodity is trading for immediate delivery, and on the forward market, the commodity is trading for future delivery. The inventory is divided into different grades of coal. One of the categories included in inventories at 30th of November X6 is coal with low carbon content that is of low quality. Phil will not process this low quality coal until all of the other coal has been extracted from the mine, which is likely to be 3 years' time, based on market information. Phil has calculated that the 3-year forecast price of coal will be 20% lower than the current spot price. The director of Phil would like advice on 2 matters. Roman numeral 1. Whether the conceptual framework affects the valuation of inventories. Roman numeral 2. How to calculate the net realisable value of the coal inventory, including the low quality coal. 7 marks. Part B. At the 30th of November X6, the directors of Phil estimate that a piece of mining equipment needs to be reconditioned every 2 years. They estimate that the costs will amount to 2 million for the parts and 1 million for the labour costs of their own employees. The directors are proposed to create a provision for next reconditioning, which is due in 2 years' time, in X8, along with essential maintenance costs. There is no legal obligation to maintain the mining equipment. As explained above, it is expected that there will be future reductions in the selling price of the coal, which will affect the forward market being signed over to the next 2 years by Phil. The director of Phil requires advice on how to treat the reconditioning costs and whether the decline in the price of coal is an important indicator. 8 marks. Part C. Phil also jointly controls coal mines with other entities. The Theta mine is owned by 4 participants. Phil owns 28% and the other 3 participants own 24% of the mine. The operating agreement requires any major decisions to be approved by parties representing 72% of the interest in the mine. Phil is considering purchase one of the participants' interest of 24%. The director of Phil wish advice on whether the revised conceptual framework will affect the decision as to whether Phil controls the mine. The directors are also wondering whether the acquisition of the interest would be considered a business combination under IFRS. 10 marks. Required. Advise the directors of Phil on how the above transactions would be dealt with within the financial statements with reference to IFRSs and the conceptual framework where indicated. The split, the allocation of marks is mentioned in the question. That's a total of 25 marks. So 51 answer, Phil. Marking scheme. Part A, a discussion of potential measurement basis, net realisable value and relevant standards, application of IAS 2 to the scenario. Part B, a discussion of IAS 16 and application to the scenario. A discussion of IAS 36 and application to the scenario. Part C, a discussion of control in the conceptual framework and other relevant standards. A discussion of business combinations per IFRS 3. Application of the above discussions to the scenario. Part A. Right, Part A, Roman numeral 1. Inventories should be valued at the lower of cost and net realisable value. The conceptual framework acknowledges a variety of measurement basis, including historical cost, current cost, value in use and fair value. Historical cost is consistent with the cost valuation in IAS 2. However, value in use and fair value are not. Bullet point 1, value in use requires the use of present value of future cash flows. Bullet point 2, fair value is a market-based measurement, not an entity-specific measurement. When determining fair value, the assumptions used are those that the market participants would use when pricing an asset. This would not take into consideration entity-specific factors like the cost needed to complete an asset and sell it. The conceptual framework is not a standard and does not override the requirements of a standard. Therefore, in order to determine net realisable value, the directors would need to refer to IAS 2 inventories. So, Part A, Roman numeral 2. IAS 2 defines net realisable value as the estimate selling price in ordinary course of business, less the costs of completion and costs of sale. Net realisable value is an entity-specific measure which should be determined on the basis of conditions which exist at the date of the statement of financial position. To estimate net realisable value, Phil should take into consideration future price movements if they provide information about the condition and at the reporting date. However, normally these movements would reflect changes in the market conditions after the date and therefore would not affect the calculation of net realisable value. The net realisable value will be based upon the most reliable estimate of the amount which will be realised for the coal. Phil should calculate the net realisable value of low carbon coal using the forecast market price based upon when the inventory is expected to be processed and realised. The forecast market price should be adjusted for the time value of money, where this brackets where this is material, and for processing and selling costs is to give a reasonable estimate of net realisable value. Future changes in the forecast market price of the processing and sale of the low carbon coal may result in adjustments to the net realisable value, as these adjustments are changes in the estimates. IAS 8, accounting policies changing in accounting estimates and errors, will apply, with the results that such gains and losses will be recognised in the statement of profit or loss in the period in which they arise. Tutorial note in a box. The year-end spot price will provide good evidence of the realisable value of the inventories at the year-end. The forward contract price may be appropriate if the company has an executory contract to sell coal at a future date. However, if the company does not have an executory contract, but instead of financial instruments under IFRS 9, financial investments, or an onerous contract recognised as a provision under IAS 37, provisions, contingent liabilities and contingent assets, the forward contract price is unlikely to be used to calculate net realisable value. Part B. IAS 16, Property, Plant and Equipment, PPE, requires an entity to recognise in the carrying amount of property, plant and equipment the cost of replacing part of such an item. When each major inspection is performed, its cost is recognised in the carrying amount of the item of property, plant and equipment as a replacement if the recognition criteria are satisfied. Any remaining carrying amount of the cost of a previous inspection is derecognised. The cost of performing a major reconditioning are capitalised if it gives access to future economic benefits. Such costs will include the labour and material costs brackets 3 million of performing the reconditioning. However, costs which do not relate to the replacement of components or the installation of new assets, such as routine maintenance costs, should be expensed as incurred. It is not acceptable to accrue the costs of reconditioning equipment, as there is no legal apparent constructive obligation to undertake the reconditioning. As set out above, the cost of the reconditioning should be identified as a separate component of the mine asset at initial recognition and depreciated over the period of 2 years. This will result in the same amount of expense being recognised as the proposal to create a provision. IAS 36 impairment of assets says that at the end of each reporting period, an entity requires to assess whether there is any indication that an asset may be impaired. IAS 36 has a list of external and internal indicators of impairment. If there is an indication that the asset may be impaired, then the asset recoverable amount must be calculated. Past and future reductions in selling price may indicate that the future economic benefit which relates to the assets have been reduced. Mining assets should be tested for impairment whether indicators of impairment exist. Impairments are recognised if the mine's carrying amount exceeds its recoverable amount. However, the nature of mining assets is that they often have a long useful life. Commodity prices can be volatile, but downward price movements are more significant if they are likely to persist for longer periods. In this case, there is evidence of a decline in forward prices. If the decline in price is for a significant proportion of remaining expected life of the mine, this is more likely to be an impairment indicator. It appears that forward contract pricings for 2 years out of the 3 years of the mine's remaining life indicate a reduction in selling prices. Based on market information, Phil has also calculated that 3-year forecast price of coal will be 20% lower than the current spot price, part A of the question in brackets. Short-term market fluctuations may not be impairment indicators if prices are expected to return to higher levels. However, despite the difficulty in making such assessment, it would appear that the mining asset should be tested for impairment. Part C. The conceptual framework for financial reporting states that an entity controls an economic resource if it has the present ability to direct the use of economic resources and obtain the economic benefit that may flow from it. An entity has an ability to direct the use of an economic resource if it has the right to deploy that economic resource in its activities. Although the control of an economic resource usually arises from legal rights, it can also arise if an entity has the present ability to prevent all other parties from directing the use of it and obtaining the benefits from the economic resource. For an entity to control a resource, the economic benefit from the resource must flow to the entity instead of another party. Although the conceptual framework gives some guidance on the definition of control, existing IFRSs also provide help in determining whether Phil controls the mine and therefore should account for it in the business combinations as a business combination. Bullet point 1. IFRS 10 consolidated financial statement states that an investor controls an investee when it is exposed or has rights to variable returns from the involvement with the investee and has the ability to affect those returns through the power over the investee. IFRS 15, this is bullet point 2. IFRS 15, revenue from contracts with customers, lists indicators of the transfer of control of an asset to a customer. One of the indicators is that the customer has a significant risks and rewards of ownership of the asset, which is basically exposed to significant variations in the amount of economic benefit. A business combination is defined in IFRS 3 business combinations as a transaction or other event in which the acquirer obtains control of one or more business. A business is further defined as an integral set of activities and assets that is capable of being conducted and managed for the purpose of providing a return. Thus, the producing mine represents a business and Phil now owns the majority of the interest in the business. However, this is not a business combination, as Phil does not have the ability to affect decisions unless another participant agrees to vote with Phil. Although Phil will control 52% of the mine, it cannot direct the use of the economic resources unless one of the other participants agrees with an operating decision proposed by Phil and approval is given by 72% of the participants. However, Phil can prevent the other parties from directing the use of the mine if the purchase goes ahead, because the other two parties cannot make the operating decision without Phil's consent. Prior to the purchase of the additional investment, the approval of decisions requires agreement of 72% of the participating interests. A joint control situation existed between the entities. Following the additional purchase, there is still a joint control situation as Phil's interest does not meet the 72% threshold. Therefore, the transaction will be treated as an asset acquisition and no goodwill will arise on the acquisition. Question 52, Z Tech, 49 minutes, SBR, March-June 2019, amended. Part A. In the revised 2018 conceptual framework for financial reporting. Right, sorry, just read that again. Part A. In the revised 2018 conceptual framework for financial reporting (brackets the conceptual framework), the accounting model is built on the definitions and principles for the recognition of assets and liabilities. The 2010 conceptual framework specified 3 recognition criteria which apply to all assets and liabilities. Part A. The item meets the definition of an asset or a liability. Part B. It is probable that any future economic benefit associated with the asset or liability will flow to or from the entity. And Part C. The asset or liability has a cost or value which can be measured reliably. However, these definitions were not always consistently applied by the standard setters. The result is that many existing IFRSs are inconsistent with the 2010 conceptual framework. Required, Roman numeral 1. Discuss and contrast the criteria for recognition of assets and liabilities as set out in the 2018 conceptual framework and its predecessor, the 2010 conceptual framework, given above, 7 marks. Part 2. Part A, Roman numeral Part 2. Discuss how the recognition of assets and liabilities under IAS 12, income taxes, and IAS 37, provisions, contingent liabilities and contingent assets, are both inconsistent with the definitions of the 2010 conceptual framework and how certain items recognised in the business combination may not be recognised in the individual financial statements of the group companies. 6 marks. Part B. ZTech is a software development company which provides data hosting and other professional services. As part of the services, ZTech also securely hosts a range of inventory management software online, which allows business to manage inventory from anywhere in the world. It also sells hardware in certain circumstances. ZTech sells 2 distinct software packages. The first package, named Inventory, or Zero Inventory, gives the customer the option to buy the hardware, professional services and hosting services as separate and distinct contracts. Each element of the package can be purchased without affecting the performance of any other element. ZTech regularly sells each service separately and generally does not integrate the goods and service into a single contract. With the second package, Inventory X, the hardware is always sold along with the professional and hosting service, and the customer cannot use the hardware on its own. The hardware is integrated to the delivery of the hosted software. ZTech delivers the hardware first, followed by professional service, and finally the hosting service. However, the professional service can be sold on a standalone basis, as this is distinct service which ZTech can offer any customer. ZTech has decided to sell its services in a new region of the world which is suffering an economic downturn. The entity expects the economy to recover and feels that there is a scope for significant growth in future years. ZTech has entered into an arrangement with a customer in the region for promised consideration of $3 million. At contract inception, ZTech feels that it may not be able to collect the full amount from the customer and estimates that it might collect 80% of the consideration. Required. Roman numeral 1. Discuss the principle of IFRS 15, revenue from contracts to customers, which should be used by ZTech to determine the recognition of the above contracts. 5 marks. Roman numeral 2. Discuss how the above contracts should be recognised in the financial statements of ZTech under IFRS 15. 7 marks. Right, answer 52. ZTech, marking scheme. Part A, Roman numeral 1, discussion of recognition per current conceptual framework, discussion of ED's approach to recognition, comparison and contrast. Roman numeral 2, discussion of IAS 12 recognition criteria, discussion of IAS 37 recognition criteria, discussion of recognition in business combination. Part B, Roman numeral 1, discussion of collectability of consideration, discussion of performance obligation. Part 2, application of the above part principles to Zero Inventory and Inventory X. Collectability assessment. So that was the marking scheme. Here's the answer. Part A, Roman numeral 1. Existing IFRS did not consistently apply the recognition criteria included in the 2010 conceptual framework, and thus revised 2010 conceptual framework sets out the new principles for the recognition of the financial statements. The revised 2018 conceptual framework defines recognition as a process of capturing for inclusion in the financial statement an item which meets the definition of an element. Asset and liability are both elements of the financial statement along with equity, income and expenses. This approach requires recognition decisions to be made by reference to the qualitative characteristics of useful financial information. The revised 2018 conceptual framework requires that the element of financial statements should be recognised if it provides users of financial statements with information that is useful, i.e. with bullet point 1, relevant information about the element, bullet point 2, a faithful representation of the element. Recognition is subject to cost constraints. The benefit of the information provided by recognition an element should justify the cost of recognising that element. Recognition may not provide relevant information where it is uncertain whether an asset exists or is separately from goodwill, or whether a liability exists and where there is only a low probability that the inflow or outflow of economic benefits will occur. Additionally, if the level of measurement uncertainty is so high that the resulting information has little relevance, then recognition should not occur. The IASB decided that the revised 2018 conceptual framework should not contain a probability criterion, which means that there may be recognition of assets or liabilities with a low probability of an inflow or outflow of economic benefit. Roman numeral 2. According to IAS 12 income taxes, deferred tax liabilities are recognised for all taxable temporary differences with 3 exceptions. However, deferred taxed assets are only recognised to the extent that it is probable that taxable profit will be available against which the deductible temporary differences can be utilised. Thus, the standard applies a probability threshold to deferred taxed assets, but not to liabilities. Although the 2010 conceptual framework gave the same threshold for recognition of assets and liabilities, IAS 37 provisions contingent liabilities and contingent assets requires the recognition of assets when they are virtually certain, but for liabilities when they are probable, defined as more likely than not. IAS 37 also requires the recognition of liabilities for construction obligations. Thus, the definition of an obligation under IAS 37 can often be broader than in other standards. For example, IAS 32 financial instruments presentation. IAS 37 includes a probable outflow threshold for the recognition of provisions, but the recognition threshold does not apply to obligations which normally fall within the scope of IAS 37 when they are acquired as part of the business combination. IFRS 3 business combination requires recognition of contingent liabilities of subsidiary irrespective of their probability. IFRS 10 consolidated financial statements requires recognition at fair value of contingent consideration to be received for a business which is a disposal of, even if the inflow is not probable. Thus, these are recognised under IFRS 3, IFRS 10 when they arise from a business combination, whereas they are not recognised in a normal course of business. Part B, Roman numeral 1. IFRS 15, revenue from contracts with customers, states that an entity must first identify the contract with the customer as part of that identification, the entity has to determine whether it is probable that the consideration which the entity is entitled to in exchange for goods and services will be collected. An assessment of collectability is included as one of the criteria for determining whether the contract with the customer exists. IFRS 15 states that the entity must identify the performance obligation in the contract. Once an entity has identified the contract with a customer, it evaluates the contractual term and its customary business practices to identify all of the promised goods or services within the contract and determine which of those promised goods or services will be treated as separate performance obligation. An entity will have to decide whether the obligations are distinct or part of a series of distinct groups and services which are sustainably the same and have the same pattern of transfer to the customer. A good or service is distinct if the customer can benefit from the goods or service on its own. Part B, Roman numeral 2. Technology entities often enter into transactions involved the delivery of multiple goods and services. As regards zero inventory, it's the word inventory with a zero in front of it, with a numerical zero. It seems that all of the individual goods and services in the contract are distinct because the entity regularly shells each element of the contract separately and is not providing the significant service of integrating the goods and services. Also, as the customer could purchase each good and service without significantly affecting the other goods and service purchased, there is no dependence upon individual elements of the service. Thus, hardware professional services and hosting services should be accounted for as separate performance obligation. Regarding inventory X, the professional services are distinct because ZTech frequently sells those services on a standalone basis. However, the hardware is always sold in a combined contract with a professional and hosting service, and the customer cannot use the hardware on its own. As a result, the hardware is not distinct, and because the hardware is integral to the delivery of the hosted software, the hardware and hosting service should be accounted for as one performance obligation, whilst the professional service, which are distinct, would be a separate performance obligation. When performing the collectability assessment, ZTech only considers the customer's ability and intention to pay the expected consideration when due. ZTech has entered into an arrangement and does not expect to collect the full contractual amount, such that the contract contains an implied price concession. Therefore, ZTech needs to assess the collectability and amount to which it expects to be entitled, rather than stated contractual amount. ZTech assesses whether collectability is probable, whether the customer has the ability and intent to pay the estimated transaction price. ZTech will determine that the amount to which it expects to be entitled is 2.4 million and performs the collectability assessment based on that amount, rather than the contractual price of 3 million. Question 53, Royan, 49 minutes. Part A. Explain the guidance in IAS 37, provisions, contingent liabilities and contingent assets as regards the recognition and measurement of provisions, and discuss any shortcomings of the standard and any inconsistencies with conceptual framework. 12 marks. Part B. Royan, a public limited company, extracts oil and has a present obligation to dismantle an oil platform at the end of the platform's life, which is 10 years. Royan cannot cancel this obligation or transfer it. Royan intends to carry out the dismantling work itself and estimates the cost of the work to be $150 million in 10 years' time. The present value of the work is $105 million. A market exists for the dismantling of an oil platform, and Royan could hire a third-party contractor to carry out the work. The entity feels that if no risk or probability adjustment were needed, then the cost of the external contractor would be $180 million in 10 years' time. The present value of the cost is $129 million. If risk and probability are taken into account, then there is a probability of 40% that the present value will be $129 million and 60% probability that it would be $140 million, and there is a risk that costs may increase by $5 million. The directors of Royan are aware of the requirements of IAS 37. However, they propose that the costs to dismantle the oil platform described above are expensed as incurred at the end of the platform's life, and no entries or disclosure being made in the latest financial statements. They argue that application of IFRS's involved judgment, and although prudence is mentioned in the conceptual framework, it is only one among several ways of achieving faithful representation. Required, Roman numeral 1. Describe the accounting treatment in respect of the oil platform under IAS 37, 3 marks. Roman numeral 2. Discuss whether the directors are acting unethically in the above circumstances and what the group accountant's proposed course of action should be, 5 marks. Part C. Royan acquired another entity, Chrissy, on the 1st of May X3 at the time of the acquisition. Chrissy was being sued due to an alleged mis-selling case potentially implicating the entity. The claimants are suing for damages of $10 million. Royan estimates that a fair value of any contingent liability is $4 million, but feels that it is more likely than not that no payment will be required. Royan wishes to know how to account for its potential liability in Chrissy's entity's financial statements, and whether the treatment would be the same in the consolidated financial statement, 5 marks. Right, answer 53, Royan. Workbook references, top tips and easy marks box. Workbook references. Provisions and contingent liabilities are covered in Chapter 6 of your workbook. Ethics are covered in Chapter 2. Top tips. Part A of the question requires discussion and critique of the general requirements of IAS 37. Providing critique is difficult, but you could have scored reasonable credit for discussion of the basic guidance. For Part B, it is very important to read the scenario carefully, as there are clues in the question which are there to help you. In Part C, you should be aware that contingent liabilities are treated differently in individual and consolidated financial statements. For learning purposes, this question includes some discussion of ethical issues in the context of the scenario given. However, please note that the ethics will not feature in Section B questions in the real exam. Ethics will be examined only in Question 2 of the exam. Easy marks. There are some marks for simply spelling out correct current guidance, which is rote learning. Part B, Roman numeral 2, on ethics allows you to present both sides of the argument, gaining easy marks if you're able to use the information given in the question to discuss the ethical issues. Marking scheme, Part A, existing guidance and critique, 12 marks. Part B, Roman numeral 1, IAS 37 treatment. Part Roman numeral 2, ethics. And Part C, contingent liability. Part A, guidance in IAS 37. Under IAS 37, provision contingent liabilities and contingent assets, provisions must be recognised in the following circumstances. Roman numeral 1. There is a legal and constructive obligation to transfer benefits as a result of past events. Roman numeral 2. It is probable that an outflow of economic resources will be required to settle the obligation. Roman numeral 3. The obligation can be measured reliably. IAS 37 considers an outflow to be probable if the event is more likely than not to occur. If the company can avoid expenditure by its future action, no provision should be recognised. A legal or constructive obligation is one created by an obligating event. Constructive obligations arise when an entity is committed to certain expenditure because a pattern of behaviour which the public would expect to continue. IAS 37 states that the amount recognised should be the best estimate of an expenditure required to settle the obligation at the end of the reporting period. The estimate should take the various possible outcomes into account and should be the amount that an entity would rationally pay to settle the obligation at the reporting date or to transfer it to a third party, where there is a large population of items. For example, in the case of warranties, the provision will be made at a probability weighted expected value, taking into account the risks and uncertainties surrounding the underlying events. Where there is a single obligation, the individual most likely outcome may be the best estimate of the liability. The amount of the provision should be discounted to present value if the time value of money is material using a risk-adjusted rate. If some or all of the expenditure is expected to be reimbursed by a third party, the reimbursement should be recognised as a separate asset, but only if it is virtually certain that the reimbursement will be received. Shortcomings of IAS 37. IAS 37 is generally consistent with the conceptual framework. However, there are some issues that with IAS 37 that have led to it being criticised. Part Roman numeral I. IAS 37 requires recognition of the liability only if it is probable, that is more than 50% likely, that the obligation will result in an outflow of resources from the entity. This is inconsistent with other standards. For example, IFRS 3 business combinations and IFRS 9 financial instruments, which do not apply the probability criteria to liabilities. In addition, probability is not part of a conceptual framework definition of a liability, nor part of a conceptual framework recognition criteria. Roman numeral 2. There is an inconsistency with US GAAP as regards how to treat the cost of restructuring a business. US GAAP requires entities to recognise a liability for individual costs of restructuring only when the entity has incurred that particular cost, whilst IAS 37 requires recognition of the total costs of restructuring when the entity announces or starts to implement a restructuring plan. Roman numeral 2, but I should imagine that's 3, and it's a typo. Roman numeral 3, which is called Roman numeral 2. The measurement rules in IAS 37 are vague and unclear. In particular, best estimate could mean a number of things. The most likely outcome, the weighted average of all possible outcomes, or even the minimum maximum amount in a range of possible outcomes. IAS 37 does not clarify which costs need to be included in the measurement of a liability, and in practice different entities including different costs. It is also unclear if settle means cancel, transfer or fulfill the obligation. IAS 37 also requires provision to be discounted to present value, but gives no guidance on the non-performance risk that is the entity's own credit risk. Non-performance risk can have a lead to a significant reduction in non-current liabilities. I think that non-performance risk can have a lead to a significant reduction in non-current liabilities. Okay. Part B, Roman numeral 1, accounting treatment under IAS 37. The IAS 37 criteria for recognising provision have been met, as there is a present obligation to dismantle the oil platform, of which the present value has been measured at 105 million. Because Royan cannot operate the oil without incurring an obligation to pay dismantling cost at the end of 10 years, the expenditure also enables it to acquire economic benefit (income from oil extracted). Therefore, Royan should recognise an asset of 105 million (added to the oil platform in property, plant and equipment), and this should be depreciated over the life of the oil platform, which is 10 years. In addition, there will be an adjustment charged in profit or loss each year to the present value of the obligation for the unwinding of the discount. Roman numeral 2, ethical behaviour. The treatment proposed by the directors is not compliant with IAS 37. It could be due to a genuine error and a misunderstanding due to a lack of knowledge, with the directors really believing that the standard is not mandatory. There does not appear to be any motivation to maximise profit to benefit the directors in any way, for example, to increase bonuses or profit related to pay, though this could be a consideration. However, in this instance, it feels like a deliberate intention to contravene IAS 37 and include a misstatement in the financial statements rather than a genuine mistake. The directors cannot justify their decision not to apply IAS 37. If the situation is allowed to continue, one of ACCA's Code of Ethics and Conduct's fundamental principles will be breached, that of professional behaviour. Members should comply with relevant laws and regulations and should avoid any action that discredits the profession. In knowingly allowing the directors not to apply the requirements of an accounting standard, the accountant should not be acting diligently and in accordance with applicable guidance and would not be demonstrating professional competence and due care. Despite the potential conflict and likely strong or undue influence from the directors over a sole and more junior employee, the accountant must act with integrity and remain unbiased, recommending to the directors that IAS 37, as it is in issue, must be complied with, and processing the appropriate entries in the financial statements for the year ended 31st of July X6. A possible approach to achieve resolution may be to discuss the matter with the chairman or non-executive director, setting out the problem and exploring that the directors have a responsibility to ensure the financial statements are fair and accurate and comply with the relevant accounting standards. Part C, contingent liability. The legal form against Chrissy will be treated differently in Chrissy's individual financial statements as compared with the consolidated accounts of Royan Group. Chrissy's individual financial statements. The legal claim against Chrissy does not meet the definition of a provision under IAS 37 provisions, contingent liabilities and contingent assets. One of IAS 37's requirements for a provision is that the outflow of resources embodying economic benefit should be probable, and Royan believes that it is more likely than not that a payment will not be made, and therefore such an outflow will not occur. However, the possible payments does fall within the IAS 37 definition of contingent liability, which is bullet point 1, a possible obligation depending on whether some uncertain future event occurs, or bullet point 2, a present obligation but payment is not probable or the amount cannot be measured reliably. Therefore, as a contingent liability, the details of the claim and the $4 million estimated fair value of the contingent liability would be disclosed in the notes in the notes to the financial statement. Consolidated financial statements. Under IFRS 3, business combinations, an acquirer must allocate the cost of a business combination by recognising the acquiree's identifiable assets, liabilities and contingent liabilities that satisfy the recognition criteria at their fair values at the date of the acquisition. Contingent liabilities where there is only a possible obligation which under IAS 37 depends on the occurrence and non-occurrence of some certain events are not recognised under IFRS 3. However, the IAS 37 probability criteria does not apply under IFRS 3. A contingent liability is recognised whether or not it is probable that an outflow of economic benefits will take place. Where there is a present obligation and a fair value, and its fair value can be measured reliably. Consequently, Royan should recognise the contingent liability as part of the business combination at its fair value of $4 million. This will reduce the net asset at acquisition and therefore increase goodwill. Question 54, format. 49 minutes, Part A adapted from P2, September-December 17, Part B adapted from P2, December 9, 2009. Part A. On the 30th of November, X4 format loaned $8 million to the third party at the agreed interest rate. At the same time, it sold the third party loan to Widow, whereby, in exchange for immediate cash payment of $7 million, format agreed to pay Window the first $7 million plus interest collected from the third party loan. Format retained the right to $1 million plus interest. The 12 months expected credit loss are $300,000 and format has agreed to suffer all the credit loss. A receivable of $1 million has been recognised in the financial statements at the 30th of November X4. As a result of the agreement with Window, the director of format are unsure as to whether they should recognise any part of the interest-bearing loan of $8 million in the statement of financial position at the 30th of November X4. They understand that the conceptual framework mentions control as part of the definitions of the asset, but do not understand the interaction between the conceptual framework and IFRS 9 financial instrument as regard the recognition of the financial asset. Required. Advise the director of format on how the above arrangement should be dealt with in its financial statement with reference to relevant IFRS and conceptual framework 2018. 8 marks. Part B. Format has a subsidiary called Key, which has a significant amount of non-current assets. They are specific assets on which the directors of Key wish to seek advice. Roman numeral 1. Part B, Roman numeral 1. Key holds non-current assets which cost $3 million on the 1st of June X3 and are depreciated on a straight line basis over their useful life of 5 years. An impairment review was carried out on the 31st of May X4 and the projected cash flow related to the assets were as follows. Year 2 cash flow, 31st of May X5, 280, X6, it's all 31st of May, X6, 450, X7, 500, and X8 is 550. The company used a discount rate of 5%. At the 30th of November X4, the directors used used the same cash flow project and noticed that the resultant value in use was above the carrying amount of the asset and wished to reverse any impairment loss calculated at 31st of May X4. The government has indicated that it may compensate the company for any loss in the value of the asset up to 20% of the impairment loss. Roman numeral 2. Key holds a non-current asset which was purchased for $10 million on the 1st of December X1 and an expected useful life of 10 years. On the 1st of December X3, it was revalued to 8.8 million. At the 30th of November X4, the asset was reviewed for impairment and written down to its recoverable amount of 5.5 million. Roman numeral 3. Key committed itself at the beginning of the financial year to selling a property that is being underutilised following the economic downturn. As a result of the economic downturn, the property was not sold by the year end. The asset was actively marketed, but there were no reasonable offers to purchase the asset. Key is hoping that the economic downturn will change in the future and therefore has not reduced the price of the asset required. Discuss with suitable computations and reference that the principles of relevant IFRSs. Discuss with suitable computations and references to the principles of relevant IFRSs how to account for any potential impairment of the above non-current asset in Key's individual financial statements for the year ended 30th of November X4. 17 marks, and on the back is a note: the following 5% discount factors may be relevant. Year 1, 0.9524, year 2, 0.9070, but year 3, 0.8638, year 4, 0.8227, total 25 marks. Okay, here's the answer to format. Workbook references, top tips and easy marks box. Workbook references. The conceptual framework is considered in Chapter 1. Financial instruments are covered in Chapter 8. Impairments are covered in Chapter 4. Top tips. In Part A, you are asked to relate the answer to both IFRS and conceptual framework. Being able to relate and or critique an accounting treatment in the light of a conceptual framework is a key skill required for SBR. You must ensure your knowledge of the conceptual framework is up to date. In Part B, you must make sure that you explain the calculations you provide and the principles of the accounting standard on which they are based. Do not make the mistake of expecting the calculations to speak for themselves. SBR is a preparation for the accountant's role as advisor, and explanations will be just as important in this role as the computations, so ensure that the key issues are discussed in sufficient depth. Easy marks. These are available for calculations of value in use and recoverable amount in Part B. Marking scheme. Part A, financial assets discussion, 1 mark per point. Part B, non-current assets at cost, non-current assets at valuation, non-current assets held for sale. Total 25 marks. Right, answer Part A. The conceptual framework defines an asset as a present economic resource controlled by an entity as a result of past event. It goes on to say that the control links the economic resource to the entity, and that the assessing control helps to identify what economic resources the entity should account for. For example, if an entity has a proportionate share in a property without controlling the entire property, the entity's asset is its share in the property which it controls, not the property itself which it does not. An entity controls an economic resource if it has the present ability to direct the use of economic resource and obtain the economic benefit which may flow from it. However, risks and rewards can be helpful factors to consider when determining the transfer of control. The entity should consider whether the contractual rights to the cash flow from the asset have expired, as, if so, the asset should be derecognised. Secondly, if the contractual rights to the cash flow have not expired, as is the case with format, the entity should consider whether it has transferred the financial asset. When the entity transfers a financial asset, it should evaluate the extent to which it retains the risks and rewards. IFRS 9 Financial Instruments provides 3 examples of when an entity has transferred substantially all the risks and rewards of ownership. These are an unconditional sale of an asset, sale of a financial asset with an option to repurchase a financial asset at its fair value, and sale of a financial asset which is deeply out of the money. Thus, in this case, even though most of the cash flows which are derived from the loan are passed on to window (brackets up to a maximum of 7 million), Format is essentially still in control of the asset, as the risks and rewards have not been transferred because of the subordinated retained interest. Format's residual interest also absorbs the potential credit losses. If Format has neither retained nor transferred substantially all of the risks and rewards of ownership, the assessment of control is important. If control has been retained, the entity would continue to recognise the asset to the extent of its continuing involvement. However, as Format has retained the risks and rewards, it should recognise the financial asset in the statement of financial position and the 12 months expected credit loss. Part B. Principles of IAS 36 Impairment of Assets. The basic principles of IAS 36 is that an asset should be carried at no more than its recoverable amount. That is, the greater of amount to be recovered through use or sale of the asset. If the asset's carrying amount is higher than the recoverable amount, an impairment loss has occurred. The impairment loss should be written off against profit or loss for the year. An asset's recoverable amount is defined as the higher of 1. The asset's fair value less costs of disposal. This is the price that would be received to sell the asset in an orderly transaction between market participants at the measurement date under current market conditions net of costs of disposal. Part 2. The asset's value in use. This is the present value of estimated future cash flows, brackets inflows minus outflows, generated by the asset, included its estimated net disposal value, if any, brackets if any, at the end of its useful life. The number of factors must be reflected in the calculation of the value in use, brackets, variations, estimates of cash flow uncertainty, close brackets. But the most important is the time value of money, as the value of use. The value in use is based on the present value calculations. Part Roman numeral 1. This is part B. Assets recoverable amount defined as the higher of, number 2, and then Roman numeral 1. Sub Roman numeral 1 of number 2. Impairment loss at the 31st of May, X4. The carrying amount of the non-carrying assets is key at 31st of May, X4, is cost less accumulated depreciation. 3 million minus brackets 3 million divided by 5 equals 2.4 million. The need to be compared to value in use at 31st of May X4, which using a discount rate of 5% is calculated as year ended, and they're all 31st of May, and it's cash flow discount factor and discount cash flow rate, discounted cash flows. Cash flow X5 280, X6 450, X7 500, X8 550. Discount factor 0.9524 for X5, X6 9070, X7 8638, and X8 0.8227. Discount cash flow in thousands of dollars. X5 267, X6 408, X7 432 and X8 452, which is a total of 1559. The value in use of 1559,000 is below the carrying amount, so the carrying amount must be written down given rise to the impairment loss. 2.4 million minus 1559,000 equals 841,000. Value in use at 30th of November X4. The directors wish to reverse the impairment loss calculated at 31st of May X4 on the grounds that, using the same cash flow, the value in use of the non-current asset is now above the carrying amount. However, whilst IAS 36 requires an assessment at each reporting date of whether an impairment loss has decreased, this does not apply to the unwinding of the discount (brackets or goodwill). Since the same cash flow has been used, the increase in the value in use is due to the unwinding of the discount and so cannot be reversed. Government refurbishment. The treatment of compensation received in the form of reimbursements is governed by the IAS 37 provisions, contingent liabilities and contingent assets. Reimbursements from governmental indemnities are recorded as an asset and in the profit or loss for the year when and only when it is vitally certain that reimbursement will be received in the entity settles the obligation. In practice, this will be when the compensation becomes receivable and the receipt is treated as a separate economic event from the item it was intended to compensate for. In this particular case, receipt is by no means certain since the government has merely indicated that it may compensate. Thus, no credit can be taken for compensation of 20% of the impairment loss. Subpoint Roman numeral 2. This is B2, subpoint Roman numeral 2. Revalued asset. When an impairment loss occurs for a revalued asset and the impairment loss should be first be charged to other comprehensive income (brackets) that is treated as a revaluation decrease, any excess is then charged to profit or loss. The revaluation gain and impairment loss will be accounted for as follows. Revalued carrying amount. 1st of December x1, 10 million. Depreciation 10 times 2 divided by 10, brackets 2 million. Revaluation balancing figure 0.8. 1st of December x3, 8.8. Total depreciation first year 8.8 times 1/8 is brackets 1.1. Impairment loss balancing figure brackets 2.2. Recoverable amount at 30th of November x4 is 5.5. The impairment loss of 2.2 million is charged to other comprehensive income until the revaluation surplus has been eliminated and the rest of the charge to the profit or loss. Therefore, the impairment loss charged to other comprehensive income will be 0.8 million. The remainder 2.2 million minus 0.8 million equals 1.4 million will be charged to the profit or loss. It is impossible that the company would be transferring an amount from revaluation surplus to retained earnings to cover the excess depreciation brackets 0.1 of a million. If so, the impairment loss charged to OCI would be 0.8 minus 0.1 equals 0.7. Roman numeral 3, property to be sold. The fact that the management plans to sell the property because it is being underutilised may be an indicator of impairment. Such assets, brackets or cash generating units, must be tested for impairment when the decision to sell is made. IFRS 5 non-current assets held for sale and discontinued operations may apply in such cases, but the decision to sell the asset is generally made well before the IFRS criteria are met. IFRS requires an asset or disposal group to be classified as held for sale where it is available for impairment sale and its present condition subject only to terms that are useful and customary, and the sale is highly probable. For a sale to be highly probable, bullet point 1, management must be committed to the sale. Bullet point 2, an active program to locate a buyer must have been initiated. Bullet point 3, the market price must be reasonable in relation to the asset's current fair value. And bullet point 4, a sale must be expected to be completed within 1 year from the date of classification. An asset or disposal group that is held for sale should be measured at the lower of the carrying amount and the fair value less cost to sell. Immediately before classification of the asset as held for sale, the entity must update any impairment test carried out. Once the asset has been classified as held for sale, any impairment loss will be based on the difference between the adjusted carrying amount and the fair value less cost to sell. The impairment loss, brackets if any, will be recognised in profit or loss. A subsequent increase in fair value less costs of disposal may be recognised in the profit or loss only to the extent of any impairment previously recognised. In the case of the property held by Key, it is likely that IFRS 5 would not apply because not all of the criteria for highly probable sale have been met. Management is committed to sale and there is an active program to locate a buyer. However, Key has not reduced the price of the asset, which is in excess of its market value. One of the IFRS 5 criteria is that the market price must be reasonable in relation to the asset's current fair value. In addition, the asset has remained unsold for a year, so it cannot be assumed that the sale will be completed within 1 year of classification. The property does not meet the IFRS 5 criteria, so it cannot be classified as held for sale. However, an impairment has taken place, and in the circumstances, the recoverable amount would be fair less the cost to sell. 55 MC, 49 minutes. MC, spelled EMCEE. P2, March, June 2016, amended. MC, a public limited company, is a sports organisation which owns several football and baseball teams. It has a financial year end of 31st of May X6. Part A. MC needs a new stadium to host sporting events which will be included as part of MC's property, plant and equipment. MC commenced construction of a new stadium on the 1st of February X6, and this continued until the completion, which was after the year end of 31st of May X6. The direct costs were 20 million in February X6 and then 50 million in the month until the year end. MC has not taken out any specific borrowings to finance the construction of the stadium, but it has incurred finance costs on a general borrowing during the period, which could have been avoided if the stadium had not been constructed. MC has calculated that its weighted average cost of borrowing for the period to 1st of February to 31st of May X6 on an annual basis amounted to 9% per annum. MC needs advice on how to treat the borrowing costs in its financial statements for the year ending 31st of May X6, 6 marks. Part B. MC purchase and sells players' registrations on a regular basis. MC must purchase registrations for that player to play for the club. Player registrations are contractual obligations between the player and MC. The costs acquired player registration included transfer fees, legal fees, league fees, transfer fees, league levy fee, and player agent fee. Not legal fees, not at all. Ignore that. And player agent fee incurred by the club. Often, players former clubs are paid amounts which are contingent upon the performance of the player whilst they play for MC. For example, if a contracted baseball player scores an average of more than 20 points per game in a season, then the additional 5 million may become payable to his former club. Also, players' contracts can be extended, and this occurs additional costs for MC. At the end of every session, which also is the financial year end of MC, the club reviews its playing staff and makes decisions as to whether they wish to sell any players' registrations. These registrations are actively marketed by circulating other clubs with a list of players, registrations and their estimated selling price. Players' registrations are also sold during the season, often with performance conditions attached. Occasionally, it becomes clear that a player will not play for the club again because of, for example, a player sustained a career-threatening injury or being permanently removed from the playing squad for another reason. The player restrictions of certain players were sold after the year end for total proceeds net of association costs of 25 million. These regulations had a net book value of 7 million. MC would like to know the financial reporting treatment of the acquisitions, extensions, review and sale of players' registrations in the circumstances outlined above, 11 marks. Part C. MC uses the revaluation model to measure its stadiums. The directors have been offered 100 million from an airline for the property naming rights of the stadium for 3 years. There are 2 directors who are on the management boards of MC and the airline. Additionally, there are regulations in place by both football and baseball leagues which regulate the finance of the clubs. These regulations prevent capital contributions from relating party, which increases equity without payment in return. The aim of these regulations is to promote sustainable business models. Sanctions imposed by the regulator include fines and withholding of prize monies. MC wishes to know how to take account of the naming rights, of the valuations of the stadium, and the potential implications of the financial regulations imposed by the leagues. 8 marks. Required. Discuss how the above events would be shown in the financial statements of MC under International Finance Reporting Standards. Note, the mark allocation is shown against each of the 3 issues above. Right. Right. Workbook references, top tips and easy marks box. Workbook references: IAS 38 intangible assets, IAS 23 borrowing costs, IFRS 13 fair value measurement are covered in chapter 4, IFRS 5 non-current assets held for sale and discontinued operations is covered in chapter 14, and IAS 24 related party disclosure in chapter 2. Top tips: this is a multi-standard question in which the 3 parts are independent. You should scan read all parts of the question and attempt the part you feel most comfortable with first. The issues covered are borrowing costs, part A, intangible assets, non-current assets held for sale, and impairment of assets. Part B, and the fair value measurement and related party transactions. Part C, the recommended approach is to discuss the general principles of the relevant standards and then apply them to the scenario. Part B is broken down into 4 elements, so ensure you provide an answer to each. Easy marks. No parts of this question are particularly easy. The main way you get the marks is to break down the scenario into constituent parts and make sure you deal with the relevant standard. Marking scheme. Part A, discuss IAS 23 requirements and calculation of capital interest, 1 mark per point. Part B, discussion of IAS 38 recognition requirements, applicability of IFRS 5 and impairment under IAS 36, 1 mark per point. Part C, discuss of IFRS 13 and IAS 24, 1 mark per point. So 55. So the answer to 55 MC is part A. Borrowing costs. IAS 23 borrowing costs requires borrowing costs incurred on acquiring or constructing an asset to be capitalised if the asset takes a substantial period of time to be prepared for its intended use or sale. Borrowing costs should be capitalised during the construction and include the costs of general borrowing, which would have been avoided if the expenditure on the asset had not occurred. The general borrowing costs are determined by applying the weighted average of borrowing costs applicable to the general pool. The weighted average carrying amount of a stadium during the period is dollars. This is brackets 20 plus 70 plus 120 plus 170 close brackets million divided by 4, that is 95 million. The capitalisation rate of the borrowing of MC during the period of construction is 9% per annum. Therefore, a total amount of borrowing costs to be capitalised is the weighted average carrying amount of the stadium multiplied by the capitalisation rate. That is brackets 95 million times 9% times 4/12, 285 million. Part B, players' registrations. Acquisition. IAS 38 intangible assets states that an entity should recognise an intangible asset where it is probable that the future economic benefits will flow to the entity and the cost of the asset can be measured reliably. Therefore, the costs associated with the acquisition of players' registration should be capitalised at the fair value of consideration payable. Costs would include transfer fees, league levy fees, agent fees incurred by a club, and other directly attributable costs. Costs also include the fair value of any contingent consideration, which is primarily payable to the player's former club with associated league levy fees. Once payment becomes probable, subsequent remeasurement of the amount of contingent consideration payable would be also included in the cost of the player's registration. The estimate of the fair value of contingent consideration payable requires management to assess the likelihood of specific performance conditions being met, which would trigger the payment of the contingent consideration. The assessment would be carried out on an individual player basis. The additional amount of contingent consideration potentially payable in excess of the amounts included in the cost of players' registrations would be disclosed. Amounts capitalised would be fully amortised over the period covered by the player's contract. Extension. Where a playing contract is extended, any costs associated with securing the extension are added to the unamortised carrying amount at the date of the extension, and the revised carrying amount is amortised over the remaining revised contract life. Sale of registrations. Player registrations would be classified as assets held for sale under IFRS 5, non-current assets held for sale and discontinued operations, when their carrying amount is expected to be recovered principally through a sale. Transactions and a sale is considered to be highly probable. Additionally, the registration should be actively marketed by MC, which it appears that they are. It would appear that these circumstances that the management is committed to a plan to sell the registration, that the asset is available for immediate sale, and that the active programme to locate a buyer is initiated by circulating clubs. IFRS 5 requires that it is unlikely that a plan to sell the registrations will be significantly changed or withdrawn. In order to fulfil the last criteria of IFRS 5, it may be prudent to only class these registrations as held for sale where unconditional offers have been received prior to the period end. However, because of the subjectivity involved, in the case of player registration, these assets would be stated at the lower of the carrying amount and fair value less cost to sell at the carrying as the carrying amount will already have stated it's in accordance with IFRS. Gains and losses on disposal of players' registrations would be determined by comparing the fair value of the consideration received, net of any transaction costs, with the carrying amount, and would be recognised in profit or loss within profit on disposal of players' registrations. Where a part of the consideration receivable is contingent on specified performance conditions, the amount is recognised in profit or loss when the conditions are met. The players' registrations disposed of subsequent to the year end for 25 million and the associated net book value of 7 million would be disclosed as an event after the reporting date. Impairment review. IAS 36 impairment of assets states that the entity should annually test their assets for impairment. An asset is impaired if the carrying amount exceeds the recoverable amount, which is the higher of the asset's fair value less costs of disposal and the fair value in use. It is difficult to determine the value in use of the individual player in isolation as that player (brackets unless via the sale or insurance recovery) close brackets cannot generate cash flow on his own. Whilst any individual player cannot really be separate from a single cash generating unit (CGU), being the baseball or football team, there may be certain circumstances where a player is taken out of the CGU, where it becomes clear that they will not play for the club again. If such circumstances arise, the carrying amount of the player should be assessed against the best estimate of the player's fair value, lest any cost to sell and the impairment charge made in profit or loss, which reflects any loss arising. Part C. Valuation of stadiums. IFRS 13 fair value measurement would value the stadiums at price, which would be received to sell the asset in the orderly transaction between market participants at the measurement date. The price would be the one which maximises the value of the asset or the group of assets using the principle of the highest and best use. The price would essentially use level 2 inputs, which are inputs other than the quoted market prices included within level 1, which are observable for the asset or liability, either directly or indirectly. Property naming rights present complications when valuing property. The status of the property dictates its suitability for inviting sponsorship attached to its name. It has nothing to do with the property itself, but it can be worth a significant amount. Therefore, MC could include the property naming rights in the valuation of the stadium and write it off over 3 years. IAS 24 related party disclosure sets out the criteria for two entities to be treated as related parties. Such criteria include being members of the same group, or where a person or a close member of that personal family is related to a reporting entity, if that person has control or joint control over the reporting entity. IAS 24 deems that parties are not related simply because they have a director or a key manager in common. In this case, there are two directors in common, and it appears as though the entities are not related. However, the regulator will need to establish whether the sponsorship deal is a related party transaction, RPT, brackets, for the purpose of the finance control provisions. These would need to be demonstrated that the airline may be expected to influence or be influenced by the club or the related party of the club. If the deal is deemed to be RPT, the regulator will consider whether the sponsorship is a fair value. Right, 49-minute question. Question number 56, Scramble. P2 December 2011, amended. Scramble, a public limited company, is a developer of online computer games. Part A. At the 30th of November X1, 65% of Scramble's total assets were mainly represented by internally developed intangible assets comprising the capitalised cost of the development and production of online computer games. These games generate all of Scramble's revenue. The costs incurred in relation to maintaining the games at the same standard of performance are expensed to profit or loss for the year. The accounting policy note states that intangible assets are valued at historical costs. Scramble considers the game to have an indefinite useful life, which is reconsidered annually when the intangible assets are tested for impairment. Scramble determines value in use using an estimated future cost, which includes maintenance expense, capital expense incurred in developing different versions of the games, and the expected increase in revenue resulting from cash outflows mentioned above. Scramble does not conduct an analysis or investigation of differences between expected and actual cash flows. Tax effects were also taken into account. 7 marks. Part B. Scramble has two cash generating units, C bracket CGU, which hold 90% of the internally developed intangible assets. Scramble reported a consolidated net loss for the period and an impairment charge in respect of two CGUs representing 63% of consolidated tax and 29% of total assets in the period. The recoverable amount of CGUs is defined in this case as value in use. Specific discount rates are not directly available for the market, and Scramble estimates the discount rate using the weighted average cost of capital. In calculating the cost of debt as an input to determination of the discount rate, Scramble used the risk-free rate adjusted by the company's specific average credit spread of its outstanding debt, which has been raised 2 years previously. As Scramble did not have any need for additional financing and did not need to repay any of the existing loans before X4, Scramble did not see any reason for using a different discount rate. Scramble did not disclose either the events or circumstances that lead to the recognition of the impairment loss or the amount of the loss recognition in respect of each cash generating unit. Scramble felt that the events and circumstances that led to the recognition of a loss in respect to the first CGU were common knowledge in the market, and the events and circumstances that led to the recognition loss of the second CGU were not needed to be disclosed. 8 marks. Part C. Scramble wishes to diversify its operations and purchase a professional football club, Rashing. In Rashing's financial statements for the year ended 30th of November X1, it has proposed to include significant intangible assets which relate to acquired players' registration rights, comprising registration and agent fees. The agent's fees were paid by the club to players' agents either when a player is transferred to the club or when the contract of a player is extended. Scramble believes that the registration rights of the player are intangible assets, but the agent's fees do not meet the criteria to be recognised in intangible assets, as they are not directly attributable to the costs of players' contract. Additionally, Rashing has purchased the rights to 25% of the revenue from ticket sales generated by another football club, Santash, in a different league. Rashing does not sell these tickets nor has any discretion over the pricing of the tickets. Rashing wishes to show these rights as intangible assets in its financial statement. 10 marks. Required. Discuss the validity. Discuss the validity of the accounting treatments proposed by Scramble and in its financial statements for the year ended 30th of November X1. Note: the mark allocation is showed against each question. Workbook answer 56 then. Scramble. Workbook references. Intangible assets are impairment are covered in Chapter 4, IFRS financial statements. IFRS 9 financial instruments is covered in Chapter 8. Top tips. Part A and B were on impairment testing. You may have found Part B requiring determination of the discount rate to be used rather difficult, and you may have needed to draw on your financial management studies. Part C was an intangible asset (assets, fees on transfer of players to the club and extension of players' contracts) (close brackets). An IFRS 9 financial asset (right to ticket sales of another football club) (close brackets). Easy mark. There are no obvious easy marks in this question. Marking scheme. Part A, intangible assets, subjective assessment. Part B, cash generating units, subjective assessment. And Part C, intangible assets, subjective assessment. Assessment? Yeah, assessment. Right, here's the official answer. Part A, internally developed intangibles. IAS 38 intangible assets allows internally developed intangibles to be capitalised provided certain criteria (technologically feasibility, probable future benefits, intangible intent and ability to use or sell the software, resource to complete the software, and ability to measure the cost) are met. It is assumed that the absence of information to the contrary that they have accordingly. Scramble's treatment is correct in this respect. I'm going to read that criteria again because it's always good to remember. Technological feasibility, probable future benefits, intent and ability to use or sell the software, resources to complete the software, and ability to measure cost. That's the criteria for intangibles. Scramble is also correct in expensing the maintenance costs. These should not be capitalised as they do not enhance the value of the asset over and above the original benefits. As regards subsequent measurement, IAS 38 requires that an entity must choose either the cost model or the revaluation model for each class of intangible asset. Scramble has chosen cost, and this is acceptable as an accounting policy. Intangible assets may have a finite or an indefinite useful life. IAS 38 states that the entity may treat an intangible asset as having an indefinite useful life when having regard to all relevant factors. There is no feasible limit to the period over which the asset is expected to generate net cash inflows for the entity. Indefinite is not the same as infinite. Computer software is mentioned in IAS 38 as an intangible that is prone to technological obsolescence and whose life may therefore be short. It is its useful life should be reviewed each reporting period to determine whether events and circumstances continue to support an indefinite useful life assessment for that asset. If they do not, the change in the useful life assessment for indefinite to finite should be accounted for as a change in the accounting estimate. The asset should be assessed for impairment in accordance with IAS 36 impairment of assets. Specifically, the entity must test the intangible asset for impairment annually, and wherever there is an indication that the asset may be impaired, the asset is tested by comparing its recoverable amount with the carrying amount. The cash flow used by Scramble is determined the cash flows used by Scramble to determine value in use for the purpose of impairment testing do not comply with IAS 36. Scramble does not analyse or investigate the difference between expected and actual cash flows, but there is an important way of testing the reasonableness of assumptions about expected cash flow, and IAS 36 requires that such assumptions be reasonable and supported by evidence. Scramble is also incorrect to include in its estimation of future cash flows those expected to be incurred in improving the games and an expected increase in revenue resulting from that expense. IAS 36 requires cash flow projections to relate to the asset in the current condition. IAS 36 requires cash flow projections to relate to the asset in its current condition, nor should cash flows estimate include tax payments or receipts as here. Part B. Discount rate for impairment. Whilst the cash flow used in testing for impairment are specific to the entity, the discount rate is supposed to appropriately reflect the current market assessment of the time value of money and the risks specific to the asset or cash generating unit. When a specific rate for an asset or cash generating unit is not directly available from the market, which is usually the case, an estimated discount rate may be used instead. An estimate should be made of a pre-tax rate that reflects the current market assessment of the time value of money and the risks specific to the asset and have not been adjusted for in the estimate of future cash flows. According to IAS 36, this rate is the return that the investors would require if they chose an investment that would generate cash flows of amount, timing and risk profile equivalent to that the entity expects to derive from the assets. Rates that should be considered are the entity's weighted average cost of capital, the entity's incremental borrowing rate, or other market rates. The objective must be to obtain a rate which is sensible and justifiable. Scramble should not use a risk-free rate adjusted by the company-specific average credit spread of outstanding debt raised 2 years ago. Instead, the credit spread input applied should reflect the current market assessment of the credit spread at the time of impairment testing, even though Scramble does not intend raising any more finance. Disclosure. With regard to the impairment recognition in respect of each cash generating unit, IAS 36 requires disclosure of bullet point 1, the amount of the loss, bullet point 2, the event and circumstances that led to the loss, bullet point 3, a description of the impairment loss by class of asset. It is no defence to maintain that the information was common knowledge in the market. The disclosures are still needed. It should be noted that IAS 1 requires disclosure of material items, so this information needs to be disclosed if the loss are material, with materiality determined using a suitable measure such as percentage of profit before tax. Part C. Recognition of intangible assets. Recognition rights and agents' fees. The relevant standard here is IAS 38, intangible assets. An intangible asset may be recognised if it is controlled by an entity, brackets, it gives the entity the power to benefit from the asset. If it meets the identifiable criteria in IAS 38, if it's probable that future economic benefits attributable to the asset will flow to the entity, and if the fair value can be measured reliably, for an intangible asset to be identifiable, the asset must be separable, or it must arise from contractual or other legal rights. It appears that these criteria have been met. Roman numeral 1. The registration rights are contractual. Roman numeral 2. Scrabble has control because it may transfer or extend the rights. Roman numeral 3. Economic benefit will flow to Scrabble in the form of income it can earn when fans come to see the players play. IS 38 specifies the items that make up the cost are separately acquired assets. Roman numeral 1. Its purchase price included import duties and non-refundable purchase taxes after deduction, trade discounts and rebates. And Roman numeral 2. Any directly attributable cost of preparing the asset for its intended use. IS 38 specifically mentions as an example of directly attributable cost professional fees arising directly from bringing the asset to its working condition. In this business, the player's registration right meets the definition of intangible asset. In addition, Scramble is incorrect in believing that the agent's fees paid on extension of players' contracts do not meet the criteria to be recognised as intangible assets. The fees are incurred to service the player's registration rights and should therefore be capitalised as intangible assets. Rights to revenue from ticket sales. Whether Rashing can show these, Rashing the company is called Rashing. Whether Rashing can show these rights as intangible assets depending on whether the IAS 38 criteria have been met. Since Rashing has no discretion over the pricing of the tickets and cannot sell them, it cannot be said to control the asset. Accordingly, the rights cannot be treated as an intangible asset. The entity is only entitled to cash generating from ticket sales, so the issue is one of the contractual rights to reserve cash. The applicable standard is therefore not IAS 38 but IFRS 9 financial instruments, under which the right to ticket revenue represents a financial asset. IFRS 9 has two classifications for financial assets: amortised cost and fair value. Financial assets are classified as being amortised cost if both of the following apply. Roman numeral 1. The asset is held within a business model whose objective is to hold the asset to collect the contractual cash flow. Roman numeral 2. The contractual terms of the financial asset give rise on specified dates to cash flows that are solely payments of principal and interest of the principal outstanding. All of the financial assets are measured at fair value. Rashing's receipts are regular cash flows, but they are based on ticket revenues, which are determined by match attendance. Therefore, they are not solely payments of principal and interest and do not meet the criteria for classification at amortised cost. Consequently, the financial asset should be classified as being a fair value under IFRS 9. Question 57, sorry. Est Oil, 49 minutes, P2 December 14 amended. Part A, an assessment of accounting practices for asset impairments is especially important in the context of financial reporting quality, in that it requires the exercise of considerable management judgment and reporting discretion. The importance of the issue is heightened during periods of ongoing economic uncertainty as a result of the need for companies to reflect the loss of economic value in a timely fashion through the mechanism of asset write-downs. There are many factors which can affect the quality of impairment accounting and disclosure. These factors include changes in circumstances in the reporting period, the market capitalisation of the entity, and the allocation of goodwill in cash-generating units, valuation issues, and the nature of the disclosure. Required, discuss the importance and significance of the above factors when conducting an impairment test under IAS 36 impairment of assets, 15 marks. Part B, Roman numeral 1. S-Oil is an international company providing parts for the automotive industry. It operates in many different jurisdictions with different currencies. During X4, S-Oil experienced finance difficulties marked by a decline in revenue and a reorganisation and restructuring of the business, and it reported a loss for the year. An impairment test of the goodwill was performed, but no impairment was recognised. S-Oil applies one discount rate to all cash flows for cash generating units, CGUs, irrespective of the currency in which the cash flows would be generated. The discount rate used was a weighted average of cost of capital, WACC, and S-Oil used a 10-year government bond rate for its jurisdiction as a risk-free rate in the calculation. Additionally, S-Oil builds its model using the forecast denomination in the functional currency of the parent company. S-Oil felt that any other approach would require a level of detail which was unrealistic and impracticable. S-Oil argues that the different CGUs, cash generating units, represent different risk profiles in the short term, but over the longer business cycle there was no basis for claiming that the risk profiles were different. Roman numeral 2. Fariole specialises in communication sectors with three main CGUs. Goodwill, that was the next door's alarm. Goodwill was a significant component of total assets. Fariole performed an impairment test of the CGUs. The cash flow projections were based on the most recent financial budget approved by the management. The realised cash flow for CGUs are negative in X4 and for below budget cash flows for the period. The directors had significantly raised cash flows forecasts for X5 with little jurisdiction. The projected cash flow were calculated by adding back depreciation charges to the budgeted result for the period, with expected changes in working capital and capital expenditure not taken into account. Required, discuss the acceptability of the above accounting practices under IAS 36, impairment of assets, 10 marks. Right, 57 answer, S-Oil. Workbook references, impairment is covered in chapter 4 of the workbook. Top tips. IAS 36 is brought forward knowledge from earlier studies. However, SBR, the depth of discussion required is greater, and the scenario requires more thought. Part A requires a discussion of factors to take account of in conducting an impairment test. There are 5 factors provided in the question, and you should use these headings under which to structure your answer. The discussion required drew on your financial management knowledge, e.g. WACC. Easy marks. There are no obvious easy marks in this question. Marking scheme, changes in circumstances, market capitalisation, allocating goodwill, valuation issues, disclosures. Part B, that was part A. Part B, discount rate, cash flow forecast. Part A, entities must determine at each reporting date whether there are any indications that impairment has occurred. Indication of impairment may be internal or external. The following factors need to be considered when conducting an impairment test under IAS 36, impairment of asset. Roman numeral 1. So there's a number of tests here. Roman numeral 1. Changes in circumstances in the reporting period. Circumstances may change due to internal factors. For example, matters as physical damage, adverse changes to the methods of use of an asset, management restructuring and overestimation of cash flows, and external factors, such as adverse changes in the markets or business in which the asset is used, or adverse changes in the technological, economic or legal environment of the business. If such indicators come to light between the date of the impairment test and the end of the next reporting period, more than one impairment test may be required in the accounting period. In addition, tests for impairment of goodwill and some other intangible assets may be performed at any time during the accounting period, provided it is performed at the same time each year. Not all goodwill is tested at the year end. Some entities test it at the interim period. Should impairment indicators arise after the annual impairment test has been performed, it may be necessary to test goodwill for impairment against the year end. Test goodwill for impairment again at the year end. A possible indicator for impairment is volatility in the market. For example, sharp changes in commodity prices may cause the asset of mining and energy companies to be impaired. In such cases, the asset affected should be tested in the interim period. Roman numeral 2, market capitalisation. A strong indicator of impairment is when the carrying amount of an entity's asset exceeds its entity's market capitalisation, suggesting that the entity is overvalued. However, there may not be a direct correlation between the market capitalisation and the impairment loss arising from a lower return generated on the entity's asset. The market may have taken other factors into account. The discrepancy does, however, highlight the need for the entity to examine its cash generating unit and possibly to test goodwill for impairment. The reason for the shortfall must be examined and understood, even though IAS 36 does not require a formal reconciliation between the entity's market capitalisation, its fair value less cost to sell, and its value in use. Roman numeral 3, allocating goodwill to cash generating units. Goodwill arising on an acquisition is required to be allocated to each of the acquirer's cash generating units, CGU, or to the group of CGUs, cash generating units, that are expected to benefit from the synergies of the combination. If cash generating units are subsequently revised for operations disposed of, IAS 36 requires goodwill to be reallocated based on relative values to the units affected. The difficulty with this is that IAS 36 does not give guidance as to what is meant by relative value. Whilst fair value less cost to sell, FVLCS in brackets, could be used, this is not material by the standard. However, the entity may still need to carry out the valuation process on the parts retained. Value in use, brackets VIU, is a possibility, but the measure needs to be one that can be applied equally to both the parts retained and the parts disposed of. Value in use has the obvious problem that it will be much the same as the FLVS, fair value less cost to sell, for the operations disposed of, but there could be significant differences between value in use and fair value less cost to sell for the part retained. Alternatively, there could be reasonable ways of estimating relative value by using the appropriate industry or business surrogate. For example, revenue profits industry KPIs, key performance indicators. Roman numeral 4, valuation issues. The basic principle of IAS 36 is that the asset should be carried at no more than its recoverable amount. That is, the amount to be recovered through use and sale of the asset. If the asset's value is higher than the recoverable amount and impairment loss has occurred, the impairment loss should be written off against profit or loss for the year. The recoverable amount is defined as the higher of the asset's fair value less cost of disposal and the asset's value in use. Measuring both of these requires the use of estimates and assumptions, some of which may be problematic. Number 1, fair value less cost of disposal is defined as the price that would be received to sell the asset in an orderly transaction between market participants at the measurement date under current market conditions. Net of the cost of disposal, IAS 36 gives a hierarchy of evidence for this, with price in binding sale agreements at the top, only likely to be available if the asset is held for sale, and allowing, in the absence of any active market, estimates based on a discounted cash flow DCF model, which may not be reliable. Number 2. These are all sub-points of Roman numeral 4, by the way. I think, yeah. So number 2. Determining the types of future cash flow which should be included in the measurement of VI, value in use, can be difficult. Under IAS 36, an asset or cash generating unit must be tested in its current status, not the status that the management wishes to use the status the management wishes it was in, or hopes to get it into in the near future. Therefore, the standard requires value in use to be measured at the net present value of the future cash flow the entity expects to derive from the assets or cash generating unit in the current condition over the remaining useful life. This means that it is not appropriate to take account of management plans for enhancing the performance of the asset or cash generating unit, even though these may bring about an increase in value. Number 3. Whilst the cash flow used in testing for impairment are specific to the entity, the discount rate is supposed to appropriately reflect the current market assessment of the time value of money, and its risk specific to the asset or cash generating unit. When a specific rate for an asset or cash generating unit is not directly available from the market, which is usually the case, the discount rate to be used is a surrogate. An estimate should be made of the pre-tax rate that reflects the current market assessment of the time value of money and the risk specified to the asset that has not been adjusted for in the estimate of future cash flows. According to IAS 36, this rate is the return that the investors would require if they chose an investment that would generate cash flows of amounts, timing and risk profile equivalent to those the entity expects to derive from the asset. Rates that should be considered are the entity's weighted average cost of capital, WACC, the entity's incremental borrowing rate, or the other market rates. The objective must be to obtain a rate which is sensible or justifiable. Number 4, the test is further complicated by the impact of taxation. IAS 36 requires that value in use be measured using pre-tax cash flow and pre-tax discount rate. The WACC, which is the weighted average cost of capital, is a post-tax rate, as are most observable equity rates used by valuers. Number 5, there is a need for consistency in determining the recoverable amount and carrying amount which are being compared. For example, in the case of pensions, there are significant differences between the measurement basis of the pension asset or brackets more likely liability and cash flows that relate to pensions. Number 6, IAS 36 requires that corporate assets must be allocated to a cash generating unit on a reasonable and consistent basis, but does not expand on this. Roman numeral 5, disclosures. So those were 6 points under Roman numeral 4, which were valuation issues. So under Roman numeral 5, disclosures. With regard to the impairment loss recognised in respect of each cash generating unit, IAS 36 would disclose of, number 1, the amount of the loss, number 2, the event and circumstances that led to the loss, number 3, a description of the impairment loss by class of asset. It is no defence to maintain that the information was common knowledge in the market. The disclosures are still needed. Part B, Roman numeral 1, discount rate. SBR has not complied with IAS 36 impairment of assets in its use of one discount rate for all cash generating units, regardless of the currency of the country in which the cash flow are generated. IAS 36 requires the future cash flows must be estimated in the currency in which they will be generated and then discounted using a discount rate appropriate for the currency. The present value that calculated must be translated using the spot exchange rate at the date of the value in use calculation. The currency in which the estimated cash flows are denominated has an impact on many of the inputs to the weighted average cost of capital, WACC calculation, including the risk-free interest rate. SBR was incorrect in using the 10-year government bond rate for its own jurisdiction as a risk-free rate, because government bond rates differ between countries due to different expectations about future inflation, and so there may be a discrepancy between the expected inflation reflected in the estimate cash flow and the risk-free rate. IAS 36 requires that the discount rate should appropriately reflect the current market assessment of the time value of money and the risk specific to the asset or cash generating unit. Applying one discount rate for the CGU does not achieve this. The WACC, which is the weighted average cost of capital of the cash generated unit or of the company of which the cash generating unit is currently part, should generally be used to determine the discount rate. The company's weighted average cost of capital may only be used for all cash generating units if the risk associated with the individual's cash generating unit do not materially diverge from the remainder of the group, and this is not evident in the case of S-Style. Part B, Roman numeral 2, cash flow forecasts. IAS 36 requires that any cash flow projections are based upon reasonable and supportable assumptions over the maximum period of the 5 years, unless it can be proven that longer estimates are reliable. The assumptions should represent management's best estimate of the range of economic conditions expected to obtain over the remaining useful life of the asset. Management must also assess the reasonableness of the assumption by examining the reasons for any differences between past forecast cash flows and actual cash flows. The assumption that from the basis for current cash flow projections must be consistent with past actual outcomes. Fariole has failed to comply with the requirements of IAS 36 in the preparation of its cash flow forecasts. Although the relisted cash flow forecasts for X4 were negative, although the realised cash flow forecasts for X4 were negative and well below projected cash flows, the directors significantly increased budgeted cash flows for X5. The increase was not justified and cast doubts on Fariole's ability to budget realistically. IAS 36 requires estimates of future cash flows to include: number 1, projections of cash inflows from the continuing use of the asset; number 2, projection of cash outflows which are necessarily incurred to generate the cash inflows from continuing use of the asset; number 3, net cash flows to be received or paid in brackets for the disposal of the asset at the end of its useful life. Forecast cash outflows must include those relating to the day-to-day servicing of the asset. This will include future cash outflows needed to maintain the level of economic benefits expected to be generated by the asset in the current condition. Fariole, I think it is, has not taken into account expected changes in the working capital and capital expenditure, but it is very likely that investments in working capital and capital expenditure would be necessary to maintain the asset of the cash generating unit in the current condition. In conclusion, the cash flow forecasts used by Fariole are not in accordance with IAS 36. Question 58, Evolve, 49 minutes, P2, September, December 16, amended. Part A. Okay, Part A. Evolve is a real estate company which is listed on the stock exchange and has a year end of the 31st of August. On the 21st of August X6, Evolve undertook a scrip bonus issue where the shareholders of Evolve receive certain rights. The shareholders are able to choose between Roman numeral 1, receiving newly issued shares of Evolve, which could be traded at 30th of September X6, or Roman numeral 2, transferring their rights back to Evolve by the 10th of September X6 for a fixed cash price, which would be paid on the 30th of September X6. In the financial statements at 31st of August X6, Evolve believed that the criteria for the recognition of the financial liability as regards the second option were not met at the 31st of August X6 because it was impossible to reliably determine the full amount to be paid until the 10th of September X6. Evolve felt that the transferring of the rights back to Evolve was a put option on its own equity, which would lead to recording changes in fair value in profit or loss in the next financial year. Evolve disclosed the transaction as a non-adjusting event after the reporting period, 9 marks. Part B. At the 31st of August X6, Evolve controlled a wholly owned subsidiary, Resource, whose only assets were land and buildings, which were all measured in accordance with international financial reporting standards. On the 1st of August X6, Evolve published a statement stating that a binding offer for sale of Resource had been made and accepted at that date. At that date, the sale was expected to be completed by 31st of August X6. The non-current assets of Resource were measured at the lower of their carrying amount, or the fair value less cost to sell at the 31st of August X6, based on the selling price in the binding offer. This measure was in accordance with IFRS 5 non-current assets held for sale and discontinued operations. However, Evolve did not classify the non-current assets of Resource as held for sale in the financial statements at 31st of August X6 because there was uncertainties regarding the negotiations with the buyer and the risk that the agreement would not be finalised. There was no disclosure of these uncertainties and the original agreement was finalised on the 20th September X6, 10 marks. Part C. Evolve operates a jurisdiction with a specific tax regime for listed real estate companies. Upon adoption of the tax regime, the entity has to pay a single tax payment based on the unrealised gain of the investment properties. Evolve purchased Monk, whose only asset was an investment property, for 10 million. The purchase price of Monk was below the market value of the investment property, which was 14 million, and Evolve chose to account for the investment property under the cost model. However, Evolve considered that the transaction constituted a bargain purchase under IFRS 3 business combinations. As a result, Evolve accepted for the potential gain of 4 million in profit or loss and increased the cost of the investment property to 14 million. At the same time, Evolve adopted for specific tax regime investment property of 14 million. At the same time, Evolve opted for the specific tax regime for newly acquired investment properties and agreed to pay the corresponding tax of 1 million. Evolve considered that the tax payment qualifies as an expenditure necessary to bring the property to the condition necessary for its operations, and therefore was directly attributable to the acquisition of the property. Hence, the tax payment was capitalised and the value of the investment property was stated at 15 million, 6 marks. Required. Advise Evolve on how the above transactions would be correctly dealt with in the financial statements with reference to the relevant international financial reporting standards. Note, the mark allocation is shown against each question. Quite a big top tips section in this. Bigger than the answer. It's not a very big answer, but it's a big top tips question. Okay. So answer to Evolve. Workbook references. IAS 32 financial instruments presentation and IFRS 9 financial instruments are covered in chapter 8. IFRS 5 non-current assets held for sale and discontinued operations is covered in chapter 14. IAS 16 property, plant and equipment and IAS 40 investment property are covered in chapter 4 and IAS 12 income taxes in chapter 7. Top tips. Part A is tricky. It asks how the potential payments of cash in the future to equity shareholders should be classified. It has to be classified as a financial liability, and there was a contractual obligation to deliver cash as a result of a put option to sell the rights back to the company. An event after the reporting period provided additional evidence of the valuation and should therefore be treated as an adjusting event. Part B is more mainstream. The directors had not classified the asset of the subsidiaries held for sale, even though the IFRS 5 criteria were met, on the grounds that they did not have a binding agreement to sell. However, this is not required for a sale to be considered highly probable under IFRS 5, and so the asset should be classified as held for sale. Part C requires consideration of three issues. First, a gain arising where a subsidiary which was purchased at less than market value is a sole asset should be treated as a bargain purchase because this treatment is only available for the business combination, and the substance of the transaction was the purchase of the asset rather than the business combination. Second, the company wishes to use a cost model. The asset should have been recorded at cost even if it is less than the market value, so the potential gain should not have been recorded in the profit or loss and added to the cost of the asset. Third, the deferred tax liability arising on the difference from market value should not be capitalised, as it is not linked to bringing the asset to the condition necessary for its operations. Easy marks. There is no easy marks in this question. Marks are not difficult to earn, are not as difficult to earn in Part B as opposed to Part A and C. And the marking scheme is 1 mark per point to a maximum of the marks. Right. Part A. Obligations to purchase own equity instruments. A financial liability for the present value of maximum amount payable to shareholders should be recognised in the financial statements as of the 31st of August X6. At the 31st of August X6, the rights are equivalent to written put options because they represent for Evolve a purchase obligation which gives shareholders the right to sell the entity's own equity instruments for fixed price. The fundamental principles of IAS 32 financial instruments presentation is that a financial instrument should be classified as either a financial liability or an equity instrument according to the substance of the contract, not the legal form, and the definitions of financial liability and equity instrument. IAS 32 states that the contract, which contains an entity obligation to purchase its own equity instruments, gives rise to a financial liability which should be recognised at the present value of its redemption amount. IAS 32 also states that a contractual obligation for an entity to purchase its own equity instruments gives rise to a financial liability for the present value of the redemption amount, which even if the obligation is conditional on the counterparty exercising a right to redeem, as is the case with scrip issue of Evolve. Evolve has set up the conditions for the share capital increase in August X6, and therefore the contract gave rise to financial liabilities from the date, and Evolve should have recognised a financial liability for present value of the maximum amount payable to shareholders in its financial statements for the year ended 31st of August X6. A non-adjusting event under IAS 10, events after reporting period, is an event after the reporting period which is indicative of a condition which arose after the end of the reporting period. However, it could be argued that the transferring of free allocation rights back to Evolve is in fact an adjusting event, as it is an event after the reporting period which provides further evidence of conditions which existed at the end of the reporting period. Part B. Classification as held for sale. The non-current assets of resource should have been presented as held for sale in the financial statements, in accordance with IFRS 5, non-current assets held for sale and discontinued operations, as at the 31st of August X6. IFRS 5 states that the appropriate level of management must be committed to a plan to sell the assets for sale to be probable. Evolve's acceptance of a binding offer in August X6 and the publication of the information indicated a high probability of sale. Despite the uncertainty surrounding the sale, the transaction remained highly probable at 31st of August X6. IFRS 6 requires an entity to classify non-current assets as held for sale if the current amount will be recovered principally through a sale rather than through continuing use. IFRS 5 does not require the existence of a binding sale agreement in order to classify a non-current asset as held for sale, but only a high probability of its occurrence. The acceptance of an offer by Evolve indicates that the transaction met the criteria to be classified as held for sale at the 31st of August X6. The finalisation of the agreement on the 20th of September X6 only confirmed the situation existing at 31st of August X6. Further, Evolve cannot apply IFRS 5 measurement criteria without classifying the item as held for sale in its statement of financial position, particularly as profit or impairment may arise when using such criteria. IFRS 5 also states that immediately before the initial classification of the asset as held for sale, the carrying amount of the asset should be measured in accordance with the applicable IFRSs. This was already the case as regards the non-current asset of resource. Other criteria which indicate that the non-current asset should be shown as held for sale include the fact that the buyer for non-current asset has been found and the sale occurred within the 12 months of classification as held for sale. The asset was actively marketed for sale at a sales price which had been accepted, and despite the uncertainties at 31st August X6, events after the reporting period indicate that the contract was not significantly changed or withdrawn. The fact that the information regarding the uncertainties was not publicly disclosed is irrelevant. Thus, as the non-current asset met the criteria to be classified as held for sale, they should have measured and presented as such in the financial statements. Assets classified as held for sale must be presented separately on the face of the statement of financial position. Part C, investment property. IFRS 3 business combinations must be applied when accounting for business combinations, but does not apply where the acquisition is not of a business. In this case, the acquisition was essentially that of an asset, or therefore the measurement requirements of IFRS 3 would not apply. IAS 40 investment property states that the cost of an investment property comprises its purchase price and any directly attributable expenditure such as professional fees for legal services. IAS 16 property, plant and equipment states that the cost of an item of PPE comprises any cost directly attributable to bringing the asset to the condition necessary for it to be capable of operating in a manner intended by management. Hence, if Evolve wishes to use the cost basis for accounting for investment property, the potential gain should not have been recorded in profit or loss or added to the cost of the asset. Evolve should have recognised the tax payment as an expense in the statement of profit or loss and other comprehensive income. Administrative and other general overhead costs are not costs of an item of PPE according to IAS 16. The specific fiscal treatment and the tax to be paid were not linked to bringing the asset to condition necessary for its operations, as the asset would have been operational within the tax. As such, the tax is a cost linked to the activity of Evolve and should be accounted for as an expense in accordance with IAS 12 income taxes and included in the profit or loss for the period, unless that tax arises from the transaction recognised outside profit or loss. There you go. Quite a short question and answer. So, question 59, gas nature. 49 minutes, P2 to September, December 15 amended. Part A, gas nature is a public gas nature is a publicly traded entity. There you go. Right, gas nature is a publicly traded entity involved in the production and trading of natural gas and oil. Gas nature jointly owns the underground storage facility with another entity, GoGas. Both parties extract gas from offshore gas fields, which they own and operate independently from each other. Gas nature owns 55% of the underground facility and GoGas owns 45%. They have agreed to share the services and costs accordingly, with decisions regarding the storage facility requiring unanimous agreement of the parties. The underground facility is pressurised so that the gas is pushed out when extracted. When the gas pressure is reduced to a certain level, the remaining gas is irrecoverable and remains in the underground storage facility until it is decommissioned. Local legislation requires the decommissioning of storage facilities at the end of the useful life. Gas Nature wishes to know how to treat the agreement with Go Gas, including any obligation or possible obligation arising in the underground storage facility and accounting for the irrecoverable gas, 9 marks. Part B, Gas Nature has entered into a 10-year contract with ACCA for the purchase of natural gas. Gas Nature has made an advance payment to ACCA for an amount equal to the total quantity of gas contracted for 10 years, which has been calculated using the forecasting price of gas. The advance carries an interest of 6% per annum, which is settled by way of supply of extra gas. Fixed quantities of gas have to be supplied each month, and there is a price adjustment mechanism in the contract whereby the difference between the forecasted price of gas and the prevailing market price is settled in cash monthly. If ACCA does not deliver gas as agreed, Gas Nature has the right to claim compensation at the current market price of gas. Gas Nature wishes to know whether the contract with ACCA should be accounted for under IFRS 9 financial instruments. 6 marks. Part C. Additionally, Gas Nature is financing its financial statements for the year ended 30th. No, it's finalising its financial years for the financial statements for the year ended 31st of August X5 and has the following issues. Roman numeral 1. Gas Nature purchased a major refinery in the 1st of January X5 and the directors estimate that the major overhaul is required every 2 years. The cost of the overhaul are approximately 5 million, which comprises 3 million for parts and equipment and 2 million for labour. The directors propose to accrue the cost of the overhaul over the 2 years of operations up to that date and create a provision for the expenditure. 5 marks. Part 2, Roman numeral 2. From October X4, Gas Nature has undertaken exemplary drilling to find gas, and up to 31st of August X5 costs of 5 million has been incurred. At 31st of August X5, the results to date indicate that it was probable that there was sufficient economic benefits to carry on drilling and there were no indicators of impairment. During September X5, additional drilling costs of 2 million were incurred and there was significant evidence that no commercial deposits existed and the drilling was abandoned. 5 marks. Required. Discuss with reference to international financial reporting standards how Gas Nature should account for the above agreement and contract and the issue raised by the directors. Right, answer 59, Gas Nature. Workbook references. IFRS 9, financial instruments, is covered in Chapter 8. IFRS 11, joint arrangements, is covered in Chapter 15. IAS 10, events after reporting date, is covered in Chapter 6. Top tips. Part A is a good example of applying mainstream syllabus topics, IAS 16, to an unusual situation, irrecoverable gas. Part B on own use contracts has come up before, and the case could be argued either way. There were marks available for dealing with fundamental principles of whether the contract is financial contract or an executory contract. If the arguments seem complex, the good news is that there are only 6 marks for this part of the question, and you can make up the marks in Part C, which is more mainstream. Easy marks. Part C is relatively straightforward, and you should by now be familiar with the IFRS 11 criteria for distinguishing joint ventures from joint operations. Part A, answer. Joint arrangements. The classification of a joint arrangement as a joint operation or joint venture depends upon the rights and obligations of the parties to the arrangement. IFRS 11, joint arrangements in brackets. A joint arrangement occurs where 2 or more parties have joint control. The contractually agreed sharing of control of an arrangement exists only when decisions about the relevant activities require the unanimous consent of parties sharing control. The structure and form of the arrangement determines the nature of the relationship. However, regardless of the purpose, structure, or form of the arrangement, the classification of joint arrangement depends upon the parties' rights and obligations arising from the arrangement. A joint arrangement which is not structured through a separate vehicle is a joint operation. In such cases, the contractual arrangement establishes the parties' rights and obligations. A joint operator accounts for the assets, liabilities, revenue, and expenses relating to its involvement in a joint operation in accordance with the relevant IFRSs. The arrangement with Go Gas is a joint operation as there is no separate vehicle involved, and they have agreed to share the services and costs with decisions regarding the platform required unanimous agreement of the parties. Gas Nature should recognise its share of the asset as property, plant and equipment. Under IAS 16, Property, Plant and Equipment, PPE, the cost of an item of property, plant and equipment includes the initial estimate of the present value of dismantling and removing the item and restoring the site on which it is located. IAS 37, Provisions, Contingent Liabilities and Contingent Assets, contains requirements on how to measure decommissioning, restoration and similar liabilities. Where the effect of time value of money is material, the amount of provision should be the present value of the expenditure expended to be required to settle the obligation. Thus, costs incurred by an entity is in respect of obligation for dismantling, removing and restoring the site on which an item of property, plant and equipment is located are recognised and measured in accordance with IAS 16 and IAS 37. Gas Nature should recognise 50% of the cost of decommissioning the underground storage facility. However, because Gas Nature is a joint operation, there is also a contingent liability for 45% of the decommissioning cost, and there is a possible obligation for the remainder of the cost depending on whether some uncertain future event occurs. That is, Gas Nature goes into liquidation and cannot fund the decommissioning cost. Therefore, Gas Nature should also disclose a contingent liability relating to Go Gas's share of the obligation to the extent that is contingently liable for Go Gas share. IAS 16 states that property, plant and equipment are tangible items which, Roman numeral 1, are held for use in production and supply of goods and services for rental and others, or for administration purposes. Roman numeral 2, are expected to be used during more than one period. Thus, Gas Nature should classify and account for its share of the irrecoverable gas as PPE. The irrecoverable gas is necessary for the storage facility to perform its function. It is therefore part of the storage facility and should be capitalised as a component of the storage facility asset. The irrecoverable gas should be depreciated to its residual value over the life of the storage facility. However, if the gas is recoverable in full, when the storage facility is decommissioned, the depreciation will be recorded against the irrecoverable gas component only if the estimated residual value of the gas decreases below cost during the life of the facility. When the storage facility is decommissioned and the cushion gas extracted and sold, the sale of the irrecoverable gas is accounted for as a disposal of the item of PPE in accordance with IAS 16, and the gain or loss recognised in profit or loss. The natural gas is in excess of the irrecoverable gas, which is injected into the facility, should be treated as an inventory in accordance with the IAS 2 inventories. Part B. Contract with ACCA. IFRS 9 financial instruments applies to those contracts to buy or sell a non-financial item, which can be settled net in cash, with the exception of contracts which are held for the purpose of receipt or delivery of a non-functional item in accordance with the entity's expected purchase, sale and usage requirements (brackets own use contract). In other words, it will result in physical delivery of the commodity, in this case the extra gas. Contracts which are for an entity's own use are exempt from the requirements of IFRS 9. Such a contract can be irrevocable such a contract can be irrevocably designated as measured at fair value through profit or loss when if it was entered into for the above purpose. Blimey, not a great sentence that is it? Such a contract can be irrevocably designated as measured at fair value through profit or loss, even if it was entered into for the above purpose. Difficult sentence, that one. It's just the structure of it. This designation is available only at inception of the contract and only if it eliminates or significantly reduces the recognition inconsistency, brackets sometimes referred to as an accounting mismatch, which would otherwise arise from not recognising that contract because it is excluded from the scope of IFRS 9. There are various ways in which a contract to buy or sell a non-financial item can be settled net in cash or another financial instrument or by exchanging financial instruments. These include the following. Roman numeral 1. When the terms of the contract permit either party to settle it net in cash. Roman numeral 2. When the ability to settle the net in cash is not explicit in the terms of the contract, but the entity has a practice of settling similar contracts net in cash. Roman numeral 3. When for similar contracts the entity has a practice of taking delivery of the underlying and selling it within a short period after delivery for the purpose of generating a profit. Roman numeral 4. When a non-financial item which is subject to the contract is readily convertible to cash. A written option to buy or sell non-financial item which can be settled net in cash is within the scope of IFRS 9. Such a contract cannot be entered into for the purposes of the receipt or delivery of non-financial item in accordance with the entity's expected purchase, sale or usage requirements. Contracts to buy or sell a non-financial item such as a commodity which can be settled net of cash or another financial instrument or by exchanging financial instruments are within the scope of IFRS 9. They are accounted for as derivatives. A level of judgment will be required in the area of net settlements caused by unique events beyond management control may not necessarily prevent the entity from applying the own use exemption to all similar contracts. The contract entered into by Gas Nature with ACCA seems to be an own use contract which falls outside IFRS 9 and therefore would be treated as an executory contract. However, it could be argued that the contract is net settled because the penalty mechanism requires ACCA to compensate Gas Nature at the current prevailing market price. Further, if natural gas is readily convertible into cash in the location where the delivery takes place, the contract could be considered net settled. Additionally, if there is a volume flexibility, then the contract could be regarded as a written option which falls within the scope of IFRS 9. However, the contract will probably still qualify as own use as long as it has been entered into and continues to be held for the expected counterparty's sales usage requirements. Additionally, the entity has not irrevocably designated the contract as measured at fair value through profit or loss, thus adding weight to the own use designation. Part C, Roman numeral 1. It is not acceptable to accrue the costs of the overhaul. The entity does not have a constructive obligation to undertake the overhaul. Under IFRS, costs relating to the major inspection and overhaul are recognised as part of the carrying amount of property, plant and equipment if they meet the asset recognised criteria in IAS 16 property, plant and equipment. The major overhaul components will then be depreciated on a straight line basis over its useful life, i.e. over the period of the next overhaul. That was in brackets, the i.e. bit. And any remaining carrying amount will be derecognised when the next overhaul is performed. Costs of the day-to-day servicing of the asset, brackets i.e. routine maintenance, are expensed as incurred. Therefore, the cost of the overhaul should be identified as a separate component of the refinery at initial recognition and depreciated over the period of 2 years. This will result in the same amount of expense being recognised in profit or loss over the same period as a proposal to create a provision. Part C, Roman numeral 2. Since there was no indicators of impairment at the period end, all costs incurred up to the 31st of August X5 amounting to 5 million should remain capitalised by the entity in the financial statements for the year ended on that date. However, if material disclosures should be provided in the financial statements of the additional activity during the subsequent period, which determine the exploratory drilling was unsuccessful. However, if material disclosure should be provided in the financial statements of the additional activity during the subsequent period for determining the exploratory drilling was unsuccessful. It's a strange sentence, that one. This represents a non-adjusting event as defined by IAS 10 events after the reporting period as an event which is indicative of a condition which arose after the end of the reporting period. The asset of 5 million and additional drilling costs of 2 million incurred subsequently would be expensed in the following year's financial statements. Question 60. Complexity. 49 minutes. Part A, adapted from P2 December 2009. Part A, complexity borrowed 47 million on the 1st of December X4 when the market and effective interest rate was 5%. On the 30th of November X5, the company borrowed an additional $45 million when the current market and effective interest rate was 7.4%. Both financial liabilities are repayable on the 30th of November X9 and are single payment notes, whereby interest and capital are repaid on that date. Complexity creditworthiness has been worsening. It has entered into an interest rate swap agreement which acts as a hedge against 2% bond issue, which matures on 31st of May X6. The directors of Complexity wish to know in which circumstances you can use hedge accounting. In particular, they need advice on hedge effectiveness and whether this can be calculated. Required. Roman numeral 1, discuss the accounting for financial liabilities under IFRS 9 under the amortised cost method and additionally using fair value method at the 30th of November X5, 6 marks. Roman numeral 2, advise Complexity's directors as the circumstances in which it can use hedge accounting and whether it can calculate hedge effectiveness, 9 marks. Part B, the type and value of financial instruments that Complexity holds has increased in recent years, which has resulted in increased disclosure regarding financial instruments in the financial statements. Complexity's reporting accountant is concerned that the users of the financial statements find financial instruments complicated and has argued that there is no point in providing detailed information in the area as users will not understand the disclosures. Required. Roman numeral 1. Discuss from the perspective of the users of financial statements how the measurement of financial instruments under IFRS can create confusion, 6 marks. Roman numeral 2. Discuss the reporting accountant's view that detailed disclosure in respect to financial instruments do not provide useful information to the user of financial statements, 4 marks. Nice short question. Here's the answer. Number 60, complexity. Workbook references, financial instruments are covered in Chapter 8. Top tips. This is largely discursive question relating to financial instruments, focusing on the perceived problems with accounting and financial instruments. It requires understanding of IFRS 9 and IFRS 13, as well as the awareness of current issues around financial instruments. Easy marks. The calculation is a good source of easy marks as it is straightforward. There are marks for bookwork, listing the problems of complexity and advantages of fair value. Marking scheme, Part A, Roman numeral 1, identical payment, carrying amount and fair value, 2 marks each. Roman numeral 2, hedge discussion and effectiveness discussion, 5 marks and 4 marks. Part B, Roman numeral 1, 1 mark per point, and Roman numeral 2, 1 mark per point. Part A, Roman numeral 1, answer. IFRS 9 financial instruments requires an entity to value its financial instruments at amortised cost with an option to designate them as measured at fair value through profit or loss if it reduces or eliminates an accounting mismatch or becomes a group of liabilities, or because a group of liabilities is managed and its performance evaluated on the fair value basis. The accounting treatment applied will impact on how the initial and new loans are measured and at what carrying amount they are presented within the financial statements. The carrying amount under the amortised cost and fair value method are calculated as follows. Amortised cost. Using amortised costs, both the initial loan and the new loan result in single payments that are almost identical on the 30th of November X9. Initial loan 47 million times 1.05 for 5 years equals 59.98 million. New loans 45 times 1.074 for 4 years equals 59.89 million. However, the carrying amount at the 30th of November X5 will be different. Initial loan 47 plus brackets 47 million times 105 equals 49.35 million. New loans 45 million. Fair value. If the two loans were carried at fair value, both the initial loan and the new loan would have the same carrying amount and be carried at 45 million at the 30th of November X5. This is because both loans result in single repayment of $59 million on the 30th of November X9 and so are effectively worth the same amount. As the second loan was obtained on the 30th of November X5, the fair value of a loan with repayment of 59 million on the 30th of November X9 must be the amount borrowed at the at the market rate on that date, i.e. 45 million. There would be a net profit of $2 million made up of interest expense of 47 million times 5% equals 2.35 million, and the unrealised gain of 49.35 million minus 45 million equals 4.35 million. Roman numeral 2, hedge accounting, part A, Roman numeral 2. IFRS 9 financial instruments allows hedge accounting, but only if all of the following conditions are met. This is Roman numeral 2, but it's sub Roman numeral 1, and these are the conditions. Sub Roman numeral 1. The hedging relationship consists only of eligibility hedging instruments and eligible hedging items. Sub Roman numeral 2. There must be formal documentation, brackets including identification of the hedging item, the hedging instrument, the nature of the risk that is to be hedged, and how the entity will assess the hedging instrument's effectiveness in offsetting the exposure to changes in hedging item, fair value or cash flows attributable to hedged risk, close brackets. Sub Roman numeral 3. The hedging relationship meets all of the IFRS 9 hedge effectiveness criteria. IFRS 9 defines hedge effectiveness as the degree to which changes in the fair value or cash flow of the hedged item attributable to a hedged risk are offset by changes in the fair value or cash flow of the hedging instrument. The directors of complexity have asked whether hedge effectiveness can be calculated. IFRS 9 uses an objective-based assessment for hedge effectiveness, under which the following criteria must be met. Sub Roman numeral point 1. There is an economic relationship between the hedged item and the hedging instrument, i.e. the hedging instrument and the hedged item have values that generally move in the opposite direction because of the same risk, which is the hedged risk. Sub Roman numeral 2. The effect of credit risk does not dominate the value. Changes that result from the economic relationship, i.e. the gain or loss from credit risk, does not frustrate the effect of changes in the underlying item on the value of the hedging instrument or the hedged item, even if those changes are significant. And sub Roman numeral 3, the hedge ratio of the hedging relationship, brackets, quantity of hedging instrument versus quantity of hedged item, close brackets, is the same as the resulting from quantity of the hedged item that the entity actually hedges and the quantity of the hedging instrument that the actually uses to hedge the quantity of the hedged item. Cool, that's confusing. Part B, Roman numeral 1. IFRS 9 financial instruments provides a model for the classification and measurement of the financial instrument that is based on principles and the entity's underlying business model. Many users find financial instruments to be complex, often due to the nature of financial instruments themselves and many different ways in which they can be measured. The measurement method depends on Arabic numeral 1, which is just normal numbers. This is part B, Roman numeral 1, sub point number 1. The applicable financial reporting standard. A variety of IFRS and IAS apply to the measurement of financial instruments. For example, financial assets may be measured using consolidation for subsidiaries, IFRS 10 in brackets, the equity method for associates and joint ventures, in brackets IAS 28 and IFRS 11, or IFRS 9 for most other financial assets. Arabic numeral 2. The categorization of financial instruments. IFRS 9 classifies financial assets as measured at amortized cost, fair value through profit or loss, or fair value through other comprehensive income. A financial asset may only be classified as measured at amortized cost if the object of the business model in which it is held is to collect contracted cash flows, and the contractual terms given rise to specified dates to cash flow that are solely payments of the principal and interest. Financial liabilities are generally accounted for at the amortized cost, but may be accounted for under the fair value model, as was shown in A Roman numeral 1. Arabic numeral 3, or number 3. Whether hedge accounting has been applied, as was discussed in A Roman numeral 2, hedge accounting is complex. For example, when cash flow hedge accounting is used, gains and losses may be split between profit or loss for the year and other comprehensive income, brackets, items that may subsequently be reclassified to profit or loss, close brackets. In addition, there may be mismatches when hedge accounting applies, reflecting the underlying mismatches under the non-hedging rules. That's the 3 points. Some measurement methods use an estimate of current value and other use historical cost. Some include impairment losses, others do not. The different measurement methods of financial instruments creates a number of problems for preparers and users of accounts. Number 1, these are the 4 methods, the four measurements. Different measurements for financial instruments creates a number of problems, so there's 4 problems. Number 1, the treatment of a particular instrument may not be the best, but may be determined by other factors. Number 2, gains or losses resulting from different measurement methods may be combined in the same line item in the statement of profit or loss and other comprehensive income. Comparability is therefore compromised. Number 3, comparability is also affected when it is not clear when measurement method may be used. Number 4, it is difficult to apply the criteria for deciding which instrument is to be measured in which way. As new types of instruments are created, the criteria may be applied in different ways that are not consistent. Part B, Roman numeral 2. The accountant's suggestion that information relating to financial instruments is too complex to disclose is not good enough reason to avoid making disclosures in the financial statements. IFRS 7, financial instruments, disclosure requirements, extensive disclosure that will enable the user of financial statements to better understand the quantitative effects of financial instruments, brackets, the number within the financial statements, and to elevate the nature and context of risks that arise from financial statements and how complexity manages those risks. That is not to say that all information related to financial instruments needs to be disclosed, and it is important that the accountant focuses on making material disclosures only. Practice Statement 2 classifies that the information provided by the disclosure could not reasonably be expected to influence the discussions users make based on the financial statements, then that disclosure need not be made. The assessment of materiality needs to be made from quantitative perspective first, and then any qualitative factors should be considered. The reporting accountant should not view the requirements of IFRS 7 as prescriptive list of items that must be disclosed. They must apply judgment to assess what requires disclosure and present it in a manner that will be of benefit to the user of the financial statements. And that's the end of question 60. Here we go. Question 61. Blackut, 49 minutes, P2, December 12, amended. Blackut is a local government organisation whose financial statements are prepared using international financial reporting standards. Part A. Blackut wishes to create a credible investment property portfolio with a view to determining if any property may be considered surplus to the functional objective and requirements of the local government organisation. The following portfolio of property is owned by Blackut. Blackut owns several plots of land. Some of the land is owned by Blackut for capital appreciation, and this may be sold at any time in the future. Other plots of land have no current purpose, as Blackut has not determined whether it will use land to provide services such as those provided by national parks or for short-term sale in ordinary course of operations. The local government organisation supplements its income by buying and selling property. The housing department regularly sells part of its housing inventory in the ordinary course of its operations as a result of the change in demographics. Part of the inventory, which is not held for sale, is to provide housing to low-income employees at below market rental. The rent paid by employees covers the cost of maintenance of the property, 8 marks. Part B. Blackut has outsourced its waste collection to the private sector provider called Waste & Co. and pays an annual amount to Waste & Co. for its services. Waste & Co. purchases the vehicles and uses them exclusively for Blackut's waste collection. The vehicles are painted with the Blackut local government organisation name and colours. Blackut can use the vehicles, and the vehicles are used for waste collection for nearly all of the asset's life. If a vehicle breaks down or no longer function, Waste & Co. must provide replacement vehicles fitted with the same waste disposal containers and equipment and painted with the local government organisation's name and colours, 6 marks. Part C. Blackut owns a warehouse. Chemco has leased the warehouse from Blackut and is using it as a storage facility for chemicals. The national government has announced its intention to enact environmental legislation requiring property owners to accept liability for environmental pollution. As a result, Blackut has introduced a hazardous chemical policy and has begun to apply the policy to its properties. Blackut has a report that the chemicals have contaminated the land surrounding the warehouse. Blackut has no resource against Chemco or its insurance company for the clean-up cost of the pollution. At 30th of November X6, it is virtually certain that draft legislation requires a clean-up of land already contaminated will be enacted shortly after the year end. 4 marks. Part D. On the 1st of December X0, Blackut opened a school at a cost of 5 million. The estimated useful life of the school was 25 years. On the 30th of November X6, the school was closed because numbers using the school declined unexpectedly. The school is to be converted for use as a library, and there is no expectation that the building will be reopened for the use as a school. The current replacement cost for the library of equivalent size to the school is 2.1 million. Because the nature of the non-current asset, value in use and net selling price are unrealistic estimates of the value of the school. The change in use would have no effect on the estimated life of the building. 7 marks. Required. Discuss how the above events should be accounted for in the financial statements of Blackut. 25 marks in total. Okay. Blackwood 61. Workbook references. Investment property and impairment are covered in Chapter 4. Leases are covered in Chapter 9 and provisions in Chapter 6. Top tips. The fact that this is a local government organisation affects the use to which the properties are put in Part A and Part D. Part A requires the basic understanding of IAS 16 and IAS 40 and requires application rather than just knowledge, but the issues are uncontroversial. Part B requires knowledge and application of IFRS 16 leases, focusing on whether an arrangement is or contains a lease. Part C dealt with a scenario that many accountants face in practice and should have been fairly straightforward. There are three elements to Part D of the question: knowledge of the standard, application of the standard, and completion of the calculations. The application of knowledge and reference to the question is essential. Easy marks. Part A on investment properties should be familiar to you from earlier studies. Part C is very straightforward, test of IAS 37. Right, here the marking scheme is 1 mark per point. Part A, investment property. IAS 40, investment property, applies to the accounting for property, brackets land and all buildings, close brackets, held to earn rentals or for capital appreciation or both. Examples of investment property given in the standard include, but are not limited to, Roman numeral 1, land held for long-term capital appreciation. Roman numeral 2, land held for undetermined future use. Assets which use IAS 40 assets which IAS 40 states are not investment property and which are therefore not covered by the standard include Roman numeral 1, property held for use in the production or supply of goods or services or for administrative purposes. Roman numeral 2, property held for sale in ordinary course of business or in the process of construction of development for such sale. Owner-occupied property being constructed on behalf of third parties and property leased to a third party under a finance lease are also specifically excluded by the IAS 40 definition. Brackets note that finance leases still exist for lessors, though not for lessees, close brackets. If the entity provides ancillary services to the occupant of the property held by the entity, the appropriateness of classification as investment property is determined by the significance of the service provided. If those services are relatively insignificant components of the arrangement as a whole, brackets, for instance, for the building owner supplies security and maintenance services to the lessees, close brackets, then the entity may treat the property as investment property. Where the services provided are more significant, brackets, such as in the case of the owner-managed hotel, end close brackets, the property should be classified as owner-occupied. Applying IAS 40 to Blackwood property, the land owned for capital appreciation and which may be sold any time in the future will qualify as investment property. Likewise, the land whose use has not yet been determined is also covered by IAS 40 definitions of investment property. As it has no current purpose, it is deemed to be held for capital appreciation. Investment property should be recognised as an asset where it is probable that the future economic benefits associated with the property will flow to the entity and the value can be measured reliably. IAS 40 permits an entity to choose between the cost model and the fair value model. Where the fair value model applies, property is valued in accordance with IFRS 13 fair value measurement. Gains or losses arising from changes in the fair value of investment property are recognised in profit or loss for the year. The houses routinely bought and sold by Blackwood in the ordinary course of its operations will not qualify as investment property, but will be treated under IAS 2 inventories. The part of the housing inventory not held for sale but used to provide housing to low-income employees does not qualify as investment property either. The properties are not held for capital appreciation, and because the rent is below market rate and only covers the maintenance costs, they cannot be said to be held for rentals. The rental income is incidental to the purpose purposes for which the property is held, which is to provide housing services. As with the example of owner-managed hotel above, the services are significant and the property should be classified as owner-occupied. Further indication that it's owner-occupied is provided by the fact that it is rented out to employees of the organisation. It will be accounted for under IAS 16 Property, Plant and Equipment. Part B, Lease. The issue here is whether the arrangement with the private sector provider Waste & Co is or contains a lease, even if it does not take the legal form of a lease. The substance of the arrangement should be considered in connection with IFRS 16 leases. Key factors to consider are as follows. Roman numeral 1. Is there an identifiable asset? Roman numeral 2. Does the customer have the right to obtain significantly all of the economic benefits from the use of the asset throughout the period of use? Roman numeral 3. Who has the right to direct how or for what purpose the asset is used? Roman numeral 4. Does the customer have the right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions? The answer in each case is yes. Roman numeral 1. The vans are an identifiable asset, although Waste & Co can substitute another vehicle if one of the existing vehicles needs repairing and no longer works. This substitution right is not substantive because of the significant costs involved in fitting out the vehicle for the use by Blackut. Roman numeral 2. Blackut can use the vehicle and use them exclusively for waste collection for nearly all of their life. It therefore has a right to obtain substantially all the economic benefits from the use of the asset. Roman numeral 3. Blackut controls the vehicles since it stipulates that they are appointed and ostensibly owns them because they must be painted with Blackut's name. It therefore has the right to direct how and for what purpose the asset is used. Roman numeral 4. As indicated in Roman numeral 2 above, Blackut has the right to operate the asset throughout the period of use, although it has outsourced the driving to Waste & Co. The arrangement is a lease. A right of use asset should be recorded and the lease liability set up equal to the present value of the future lease payment. The service element relating to the waste collection must be considered as a separate component and charged to profit and loss. Part C, Provision. Under IAS 37, Provisions, Contingent Liabilities and Contingent Assets. Provisions must be recognised in the following circumstances and must be recognised if they do not apply. Roman numeral 1. There is a legal or constructive obligation to transfer benefit as a result of past events. Roman numeral 2. It is probable that there's an outflow of economic resources will require to settle the obligation. Roman numeral 3. A reliable estimate of the amount required to settle the obligation can be made. A legal or constructive obligation is one created by an obligating event. Here, the obligating event is the contamination of the land because of the virtual certainty of the legislation requiring the clean-up. As Blackut has no resource against Chemco or its insurance company, this past event will certainly give rise to the transfer of economic benefits from Blackut. Consequently, Blackut must recognise a provision for the best estimate of the clean-up costs. It should not set up the corresponding receivable since no reimbursement may be obtained from Chemco or its insurance company. Part D. Impairment of building. The basic principle of IAS 36, impairment of asset, is that the asset should be carried at no more than its recoverable amount. That is, the amount to be recovered through use or sale of the asset. If an asset's value is higher than its recoverable amount, an impairment loss has occurred. The impairment loss should be written off against profit or loss for the year. Entities must determine at each reporting date whether there are any indications that impairment has occurred. In this case, impairment is indicated because the use of which the building is to be put has changed significantly, brackets from school to a library, close brackets, a situation which will continue for the foreseeable future. The recoverable amount is defined as the higher of the asset's fair value less the cost to sell and the asset's value in use. However, These values are unavailable because of the specialised nature of the asset, and only information available is depreciated replacement cost. Using a depreciated replacement cost approach, the impairment loss would be calculated as follows. And then there's a table. Asset, school, library, impairment loss, cost, accumulated depreciation and carrying amount. So the school, the cost and replacement cost is 5,000. Accumulated depreciation is brackets 1,200. Replacement cost would be 3,800. The library 2,100 cost, brackets 504. Accumulated depend 6/25. It says under accumulated depreciation, and the carrying amount / replacement cost would be brackets 1,596, which is a total of 2,204. Blackwood should therefore recognise the impairment loss of $2.204 million in profit or loss for the year. That's the end of that question. Right, question 62. Carl Soon. 49 minutes, P2, March and June 17 amended. Carl Soon Co. is a company which manufactures and retails motor vehicles. It also constructs premises for third parties. It has a year end of 28th of February X7. Part A. The entity enters into lease agreements with the public for motor vehicles. The agreements are normally for a 3-year period. The customer decides how to use the vehicles with certain contractual limitations. The maximum mileage per annum is specified at 10,000 miles without penalty. Carl Soon is responsible for the maintenance of the vehicle and insists that the vehicle cannot be modified in any way. At the end of the 3-year contract, the customer can purchase the vehicle at a price which will be above the market value, or alternatively hand it back to Carl Soon. If the vehicle is returned, Carl Soon will sell the vehicle to the public through one of its retail outlets. These sales of vehicles are treated as investing activities in the statement of cash flows. The directors of Carl Soon wish to know how the leased vehicle should be accounted for from commencement of the lease to the final sale of the vehicle in the financial statements, including the statement of cash flows. Part B. On the 1st of March X6, Carl Soon invested in a debt instrument with a fair value of 6 million and has assessed that the financial asset is aligned with the fair value through other comprehensive income business model. The instrument has an interest rate of 4% over the fixed period of 6 years. The effective interest rate is also 4%. On March the 1st, X6, the debt instrument is not impaired in any way. During the year to 28th of February X7, there is a change in interest rates and the fair value of the instrument seem to be affected. The instrument was quoted as in an active market at $5.3 million, but the price based upon an in-house model showed that the fair value of the instrument was 5.5 million. This valuation was based upon the average change in value of a range of instruments across the number of jurisdictions. The directors of Carl Soon felt the instrument should be valued at 5.5 million, and this should be shown as a level 1 measurement under IFRS 13 fair value measurements. There has not been a significant increase in credit risk since the 1st of March X6, and expected credit losses should be measured as at the amount equal to 12 months expected credit losses of 400,000. Carl Soon sold the debt instrument on the 1st of March X7 for 5.3 million. The directors of Carl Soon wish to know how to account for the debt instrument until its sale on the 1st of March X7, 8 marks. Part C. Carl Soon constructs retail vehicle outlets and enters into contracts with customers to construct buildings on their land. The contracts have standard term which include penalties payable by Carl Soon if the contract is delayed or payable by a customer, if Carsoon cannot gain access to the construction site. Due to poor weather, one of the projects was delayed. As a result, Carsoon faced additional costs and contractual penalties. As Carsoon could not gain access to the construction site, the directors decided to make a counterclaim against the customer for the penalties and additional costs which Carsoon faced. Carsoon felt that because a counterclaim had been made against the customer, the additional costs and penalties should be included in the contract cost, but show on the contingent liability. Carsoon has assessed a legal basis of the claim and feels it has enforceable rights. In the year ended 28th of February X7, Carsoon incurred general and administrative costs of 10 million and costs relating to wasted materials of 5 million. Additionally, during the year, Carsoon agreed to construct a storage facility on the same customer's land for 7 million at a cost of 5 million. The parties agreed to modify the contract to include the construction of storage facility, which was completed during the current financial year. All of the additional costs relating to the above were capitalised as assets in the financial statement. The directors of Carsoon wish to know how to account for the penalties, counterclaim and additional costs in accordance with IFRS revenue from contracts with customers. 8 marks. Required. Advise Carsoon on how the above transactions should be dealt with in the financial statements with reference to the relevant international financial reporting standards. Note, the mark allocation is given by each question. Answer 62. Carsoon. Workbook references. Leases are covered in Chapter 9, financial instruments are covered in Chapter 8, and revenue is in Chapter 3. Fair value is covered in Chapter 4. Top tips. Allocate your time appropriately across the 3-part question. The parts are independent of each other, so you should scan read all parts and attempt the one you feel most comfortable with first. The key to Part A is to understand that Carsoon is the lessor, not the lessee, and therefore the distinction between finance leases and operating leases applies. Part B asks you to advise on the measurement issue for the financial instrument. The calculation is straightforward if you haven't understood the principle. If not, you would be advised to briefly state the measurement principle of IFRS 13 as far as you can and move on quickly to another part of the question. Part C of the question on contractual revenue is challenging as it gets into the specific detail of IFRS 15, but it is a topical area you should be familiar with. Ensure you break down your response to cover each element. Easy marks. Part A contains generous marks for using information in the question to explain how to classify Carsoon's vehicle leases in the context of IFRS 16. Part B and C are more challenging, but Part C contains some easy marks if you know that the general admission costs and wasted materials costs should be expensed. Marking scheme. Part A, classification of lease as operating lease, not finance lease, accounting requirements for lease payments and assets and cash flow implications, 1 mark per point. Part B, type of financial asset, IFRS 13 requirements, account for finance assets, 1 mark per point. Part C, discuss each penalty, counterclaim and additional costs, 1 mark per point. Right, Part A. Under IFRS 16 leases, Carsoon is a lessor and must classify each lease as an operating or finance lease. A lease is classified as a finance lease if it transfers substantially all the risks and rewards incidental to ownership of the underlying asset. All other assets are classified as operating leases. Classification is made at the inception of the lease. Whether a lease is a finance lease or an operating lease depends on the substance of the transaction rather than the form. In this case, the leases are operating leases. The lease is unlikely to transfer ownership of the vehicle to the lessee by the end of the lease term, as the option to purchase the vehicle is at the price which is higher than fair value at the end of the lease term. The lease term is not for a major part of the economic life of the asset, as vehicles normally have a length of life more than 3 years and a maximum unpenalised mileage of 10,000 miles per annum. Additionally, the present value of the minimum lease payment is unlikely to be substantially all of the fair value of the leased asset, as a price which the customer can purchase the vehicle is above market value. Hence, the lessor does not appear to have received an acceptable return by the end of the lease. Carson also stipulates the maximum mileage and maintains the vehicles. This would appear to indicate that the risks and rewards remain with Carson. Carson should account for the leased vehicles as property, plant and equipment (PPE) under IAS 16 property, plant and equipment, and depreciate them, taking into account the expected residual value. The rental payment should go to profit or loss on a straight line basis over the lease term. Whereas an item of PPE ceases to be rental or becomes held for sale, it should be transferred to inventory at the carrying amount. The proceeds from the sale of such an asset should be recognised as revenue in accordance with IFRS 15 revenue from contracts with customers. IAS 7 statement of cash flow states that payments from operating activities are primarily derived from the principal revenue producing activities of the entity. Therefore, they generally result from the transaction and other events which enter into determination of the profit or loss. Therefore, cash receipts from the disposal of assets formerly held for the rental and subsequently held for sale should be treated as cash flow from operating activities and not investing activities. Part B. For finance assets, which are debt instruments measured at fair value through other comprehensive income, FVOCI, in brackets, both amortised cost and fair value information are relevant because debt instruments in this measurement category are held for both collection of contractual cash flow and realisation of fair values. Therefore, debt instruments measured at fair value through other comprehensive income are measured at fair value in the statement of financial position. In profit or loss, interest revenue is calculated using effective interest rate method. The fair value gains and losses on these financial assets are recognised in other comprehensive income, OCI. As a result, the difference between the total change in fair value and the amounts recognised in profit or loss are shown as other comprehensive income. When these financial assets are de-recognised, the cumulative gains and losses previously recognised in other comprehensive income are classified from equity to profit or loss. Expected credit losses, ECLs, do not reduce the carrying amount of the financial asset which remains at fair value. Instead, an amount equal to expected credit losses, ECL, allowance, which would arise if the asset were measured at amortised cost, is recognised in other comprehensive income. It gives you the letters here and I'm filling in the words to make it easier to listen to. The fair value of debt instruments therefore needs to be ascertained at 28th of February X7. IFRS 13 fair value measurement states that level 1 inputs are unadjusted quoted prices in active markets for identical assets or liabilities which the entity can access at the measurement date. In-house models are alternative pricing methods which do not rely exclusively on quoted prices. It would seem that level 1 input is available based upon activity in the markets and further that because of the active market there is no reason to use the in-house models to value the debt. Therefore, the accounting for the instrument should be as follows. Initial measurement. The bonds will be initially recorded at 6 million and interest of 0.24 million will be received and the credited to profit or loss. Subsequent measurement. At 28th of February X7, the bonds will be valued at 5.3 million, which recognises 12-month credit losses and other restrictions in fair value. The loss of $0.7 million will be charged as an impairment loss of 0.7 million to profit or loss, representing the 12-month expected credit losses and the 0.3 million to other comprehensive income. When the bond is sold for 5.3 million on the 1st of March X7, the financial asset is de-recognised and the loss in other comprehensive income, 0.3 million, is reclassified to profit or loss. Also, the fact that the bond is sold for 5.3 million on the 1st of X7 illustrates that this should have been the fair value on the 28th of February X7. Part C, IFRS 15. Revenue from contracts and customers specified how to account for costs incurred in fulfilling a contract which are not in the scope of another standard. Costs to fulfill a contract which is accounted for under IFRS 15 are divided into those which give rise to an asset and those which are expensed as incurred. Entities will recognise an asset when costs incurred to fulfill a contract meet certain criteria, one of which is that costs are expected to be recovered. For costs to meet the expected to be recovered criterion, they need to be either explicitly reimbursed under the contract or reflected through the pricing of the contract and recoverable through the margin. The penalty and additional costs attributable to the contract should be considered when they occur, and CARSOON should have included them in a total costs of the contract in the period in which they have been notified. As regards the counterclaim for compensation, CARSOON accounts for the claim as a contract modification in accordance with IFRS 15. The modification does not result in any additional goods and services being provided to the customer. In addition, all of the remaining goods and services after the modification are not distinct and form part of the single performance obligation. Consequently, CARSOON should account for the modification by updating the transaction price and the measure of progress towards complete satisfaction of the performance obligation. However, on the basis of information available, it is possible to consider that the counterclaim had not reached the advanced stage, so that the claim submitted to the client should not be included in the total revenues. When the contract is modified for the construction of the storage facility, an additional 7 million is added to the consideration which CARSOON will receive. The additional 7 million reflects the stand-alone selling price of the contract modification. The construction of the separate storage facility is a distinct performance obligation, and contract modification for the additional storage facility is accounted for as a new contract which does not affect the accounting for the existing contract. Therefore, the contract is a performance obligation which has been satisfied, as assets are only recognised in relation to satisfying future performance obligations. General and administrative costs cannot be capitalised unless these costs are specifically chargeable to the customer under the contract. Similarly, wasted material costs are expensed where they are not chargeable to the customer. Therefore, a total expense of 15 million will be charged to profit or loss and not shown as assets. Question 63, 49 minutes, called Lee, ACR June 07, amended. Part A, Lee's a public limited company, purchased the whole of a share capital of Hash, a limited company, on the 1st of June X6. The whole of the share capital of Hash was formerly owned by 5 directors of Hash, and under the terms of the purchase agreement, the 5 directors were to receive a total of 3 million ordinary shares of $1 of Lee on the 1st of June X6, brackets the market value $6 million, and a further 5,000 shares per director on 31st of May X7, if they were still employed by Lee on that date. All of the directors were still employed by Lee at the 31st of May X7. Lee granted and issued fully paid shares to its own employees on the 31st of May X7. Normally, share options issued to employees would vest over a 3-year period, but these shares were given as a bonus because of the company's exceptional performance over the period. The shares of Lee had a market value of 3 million, 1 million ordinary shares of $1 and $3 per share on the 31st of May X7, and the average fair value of 2.5 million, brackets 1 million ordinary shares of $1 at $2.50 per share for the year ended 31st of May X7. It is expected that Lee's share price will rise on to $6 per share over the next 3 years, 10 marks. Part B, on the 31st of May X7, Lee purchased property, plant and equipment for 4 million. The supplier has agreed to accept payment for the property, plant and equipment either as cash or shares. The supplier can either choose 1.5 million shares of Lee to be issued in 6 months' time, or to receive a cash payment of 3 million, cash payment in 3 months' time, equivalent to the market value of 1.3 million shares. It is estimated that the share price will be $3.5 in 3 months' time and $4 in 6 months' time. Additionally, at the 31st of May X7, one of the directors recently appointed to the board has been granted the right to choose either 500,000 shares of Lee or receive a cash payment equal to the current value of 40,000 shares at the settlement date. This right has been granted because of the performance of the directors during the year and is unconditional at 31st of May X7. The settlement date is the 1st of July X8, and the company estimates the fair value of the share alternative is $2.5 per share at the 31st of May X7. The share price of Lee at the 31st of May X7 is $3 per share, and if the directors choose the share alternative, they must keep for a period of 4 years, 9 marks. Part C. Lee acquired 30% of the ordinary share capital of Handy, a public limited company, on the 1st of April X6. The purchase consideration was 1 million ordinary shares of Lee, which had a market value of $2.5 per share at the date, and the fair value of the net assets of Handy was 9 million. The retained earnings of Handy were 4 million and other reserves of Handy were 3 million at that date. Lee appointed 2 directors to the board of Handy, and it intends to hold the investment for the significant period of time. Lee exerts significant influence over Handy. The summarised statement of financial position of Handy at the 31st of May X7 is as follows. Share capital of $1, 2 million. Other reserves, 3 million. Retained earnings, 5. Total of 10. Net assets, 10. There has been no new issue of shares by Handy since the acquisition of Lee, and the estimated recoverable amount of the net assets of Handy at 31st of May X7 was 11 million, 6 marks. Required, discuss the suitable computations, how the above shared-based transactions should be accounted for in the financial statements of Lee for the year ended 31st of May X7. Answer 63. Lee. Workbook references. Share-based payments are covered in Chapter 10. Associates are covered in Chapter 11. Top tips. This was a difficult question which dealt with several share-based payment transactions. However, not all such transactions were dealt with by a single accounting standard. Part A dealt with the cost of a business combination and the issue of shares and purchase consideration. It also dealt with shares given to employees and remuneration. The events dealt with under the separate accounting standards IFRS 2 and IFRS 3. The events are dealt with under separate accounting standards IFRS 2 and IFRS 3. Part B dealt with the purchase of property, plant and equipment and the grant of rights to director when there is a choice of settlement. This is part of the question. This part of the question was quite technically demanding. Part C dealt with the issue of shares to acquire an associate and the subsequent accounting for the associate. Easy marks. It is difficult to identify easy marks for this question. Marking scheme. Part A, hash, employees. Part B, property, plant and equipment, director. Part C, Handy. Part A, share issue to the directors. The $3 million $1 shares issued to the directors on the 1st of June X6 as part of the purchase consideration for hash is accounted for under IFRS 3 business combinations rather than under IFRS 2 share-based payments. This is because they are not remuneration or compensation, but simply part of the purchase price of the company. The cost of the business combination will be the total of the fair value of the consideration given by Lee plus any attributable costs. The total fair value here is $6 million, on which $3 million is the share capital and $3 million is the share premium. The contingent consideration, 5,000 shares per director, to be received on the 31st of May X7 if the directors are still employed by Lee, may, however, be seen as compensation and thus fall to be treated under IFRS 2. I think that should be fail, but it says fall. The fact that the additional payments of shares is linked to continuing employment suggests that it is compensation arrangement and therefore IFRS 2 will apply. Under IFRS 2, the fair value used is that at the grant date rather than when the shares vest. The market value of each share at that date is $2. Brackets 3 million shares are valued at $6 million. So the total value of the compensation is 5 times 5,000 times $2 equals 50,000. The 50,000 is charged to profit or loss with the corresponding increase in equity. Shares issued to employees. These shares are remuneration and are accounted for under IFRS 2. The fair value used is that at the date of issue, as the grant date and the issue date are the same, that is $3 per share. Because the shares are given as a bonus, they vest immediately and are presumed to be consideration for past services. The total of $3 million would be charged to profit or loss and included in equity. Part B, purchase of property, plant and equipment. Under IFRS 2, the purchase of property, plant and equipment would be treated as share-based payment in which the counterparty has a choice of settlement in shares or in cash. Such transactions are treated as cash settled to the extent that the entity has incurred a liability. It is treated as an issue of the compound financial instrument with a debt and equity settlement. Similar to IAS 32 financial instruments, presentation IFRS 2 requires the determination of the liability element and the equity element. The fair value of the equity element is the fair value of the goods or services, brackets in this case the property, less the fair value of the debt element of the instrument. The fair value of the property is $4 million per question. The share price of $3.5 is expected share price in 3 months' time, brackets assuming cash settlement. The fair value of the liability component at the 31st of May X7 is the present value, 1.3 million times $3 equals 3.9 million. The journal entries are debit property, plant and equipment 4 million, credit liability 3.9 million, credit equity 0.1 million. In 3 months' time, the debt component is measured to its fair value, assuming the estimate of the future share price was correct at $3.5. The liability at that date will be 1.3 million times 3.5 million equals 4.55 million. An adjustment must be made as follows. Debit expense 3.55 minus 3.9 equals 0.65 million. Credit liability 0.65 million. Choice of shares or cash settlement. The share-based payment to the new director, which offers a choice of cash or share settlement, is also treated as the issue of the compound instrument. In this case, the fair value of service is determined by the fair value of the equity instrument given. The fair value of the equity alternative is $2.5 times 50,000 equals 125,000. The cash alternative is valued at 40,000 times $3 equals $120,000. The difference between these two values, $5,000 minus, is deemed to be just $5,000 is deemed to be the fair value of the equity components. At the settlement date, the liability element would be measured at the fair value of the method of settlement chosen by the directors would determine the financial accounting treatment. At 31st of May X7, the accounting entries would be debit profit or loss, director's remuneration 125, credit liability 120,000, credit equity 5,000. In effect, the director surrenders the right to 120,000 cash in order to obtain equity worth 125,000. Part C, investment in Hardy. The investment in Hardy should be treated as an associate under IAS 28, investments in associates and joint ventures. Between 20% and 50% of the share capital has been acquired and the significant influence may be exercised through the right to appoint directors. Associates are accounted for as cost plus post-acquisition charges in net profit, generally cost plus share of post-acquisition retained earnings. The cost of fair value of the shares in Lee exchanged for shares of Hardy. However, negative goodwill arises because the fair value of the net assets of Hardy exceeds this. The negative goodwill must be added back to determine the cost to be used for carrying amount and following the reassessment credited to profit or loss. Debit cost 0.2, credit P&L 0.2. Cost 1 million times $2.5 is 2.5. Add back negative goodwill 2.5 plus brackets 9 times 70% NCI, close brackets, -9 equals 0.2, total of 2.7. Post-acquisition profits, 5 minus 4 times 30% equals 0.3. Carrying amount at 31st of May X7 is $3 million. Note, the 0.2 is not part of the post-acquisition retained earnings. It is an adjustment to the original cost to remove the negative goodwill. Because negative goodwill has arisen, the investment must be impairment tested. A comparison must be made with the estimated recoverable amount of Hardy's net assets. The investment must not be carried above the recoverable amount. Recoverable amount at 31st of May X7 is 11 million times 30 million. 30% equals 3.3 million. The recoverable amount is above the carrying amount, so the investment at 30th of May X7 will be shown at $3 million. Nice and short. Question 64. Yanong. 49 minutes P2 2015 amended. The directors of Yanong, a public limited company, would like to advise with reference to IFRS 13 fair value measurements on several transactions. Part A. Yanong owns several farms and also owns a division which sells agricultural vehicles. It is considered selling the agricultural retail division and wishes to measure the fair value of the inventory of vehicles for the purpose of the sale. 3 markets currently exist for the vehicles. Yanong has transacted regularly in all 3 markets. At 30th of April X5, Yanong wishes to find the fair value of 150 new vehicles, which are identical. The current volume and prices in the 3 markets are as follows. So there's a number of different columns. Market, sales price per vehicle, historical volume vehicles sold by Yanong, total volume of vehicles sold by market, transactions cost per vehicle, transaction cost to the market per vehicle. So the market is Europe, Asia and Africa. Sales price per vehicle is 40,000, 38,000 and 34,000. Historical volume vehicles sold by Yanong is 6,000, 2,500 and 1,500. Total volume of vehicles sold in market, 150,000, 750,000 and 100,000. Transaction cost per vehicle, 500, 400 and 300. And transport costs to the market per vehicle, 400, 700 and 600. Yanong wishes to value the vehicles at 39,100 per vehicle, as these are the highest net proceeds per vehicle. And Europe is the largest market for Yanong products. Yanong would like advice as to whether the valuation would be acceptable under IFRS 13 fair value measurement. 6 marks. Part B. The company uses quarterly reporting for its farms as they grow short-lived crops such as maize. Yanong planted the maize fields during the quarter of 31st of October X4 at an operating cost of 10 million. The fields originally cost 20 million. There is no active market for partly growing fields of maize, and therefore Yanong purposes to use a discount cash flow method to value the maize fields. At 31st of October X4, the following were cash flow projections relating to the maize fields. Cash inflows, cash outflows, notional rental charge for land usage, net cash flows. So there's 3 columns. 3 months to 31st of January X5, 3 months to 30th of April X5, and the total. I can't be bothered to read out all my figures. In the 3 months to 31st of January X5, the actual operating costs amounted to 8 million, and that date Yanong revised its future projections for the cash inflows to 76 million for the 3 months to the 5th to April X5. At the point of harvest at 31st of March X5, the maize was worth 82 million. And it was sold for 84 million, brackets net of cost to sell. On the 15th of April X5, in the measurement of fair value of the maize, Yanong included a notional cash flow expense for the rent of the land where it is self-owned. The directors of Yanong wish to know how they should have accounted for the above biological assets at 31st of October X4, 31st of January X5, 31st of January X, 31st of March X5, and when the produce was sold. Assume the discount rate of 2% per quarter as follows. Period 1, the discount factor is 0.98, and period 2, 0.961. 7 marks. That's quite a big one. Quite a long question. So part C. On the 1st of May, X2, Yanong granted 500 share appreciation rights, SARs, in brackets, to its 300 managers. All of the rights vested at 30th of April X4, but they can be exercised from the 1st of May X4 up to the 30th of April X6. At the grant date, the value of each SAR was $10, and it is estimated that 5% of the managers would leave during the vesting period. The fair value of SARs is as follows. 30th of April X3, fair value SAR 9, 30th of April X4, 11, and 30th of April X5, 12. At all of the managers who were expected to leave employment did leave the company as expected before 30th of April X4. On 30th of April X5, 60 managers exercised their options when the intrinsic value of the right was 10.5 and were paid in cash. Yanong is confused as to whether the accounting for SARs under IFRS 2 share-based payments and IFRS 13 fair value measurement, and would like advice on how the SARs, which is share appreciation rights, should have been accounted for from the grant date to 30th of April X5. 7 marks. Part D. Yanong uses the revelation model for its non-current assets. Yanong has several plots of farmland which are unproductive. The company feels that the land would have more value if it were used for residential purposes. There are several potential purchasers for the land, but planning permissions has not yet been granted for use to the land for residential purposes. However, preliminary inquiries, which with the regulatory authorities seem to have indicated that planning permission may be granted. Additionally, the government has recently indicated that more agricultural land should be used for residential purposes. Yanong has also been approached to sell the land for commercial development at a higher price than that for residential purposes. Yanong would like advice on how to measure the fair value of the land in its financial statements. 5 marks required. Advise Yanong on how the above transactions should be dealt with in the financial statements with reference to the relevant international financial reporting standards. Notes. 1. The mark allocation is shown above the question. 2. Ignore the deferred tax implications. Right, answer 64. Yanong. References. Agriculture is covered in Chapter 4. Fair value measurement is covered in Chapter 4. Share-based payment is covered in Chapter 10. Top tips. Part A requires an understanding of the market definitions given of IFRS 13. You're expected to be able to go beyond memorising the valuation inputs. The fair value measurement of the maize. Part B was challenging. However, valuation techniques are used extensively to corporate reporting, and therefore you must become accustomed to using such techniques in answering questions. Balancing this, the cash settled share-based payment, Part C, and the valuations of a non-financial asset, the farmland, Part D, were more straightforward. Easy marks. These could be gained by focusing on the parts of the question you were more familiar with, which is likely to be in Parts C and D. Part A. Fair value of agricultural vehicles. IFRS 13 says that the fair value is an exit price in the principal market, which is the market with the higher volume and level of activity. It is not determined based on the volume or level of activity of the reporting entity's transaction in particular market. Once the accessible markets are identified, market-based volume and activity determines the principal market. There is a presumption that the principal market is the one in which the entity would normally enter into transactions to sell the asset or transfer the liability, unless there is evidence to the contrary. In practice, an entity would first consider the markets it can access. In the absence of a principal market, it is presumed that the transactions would occur in the most advantageous market. This is the market which would maximise the amount which would be received to sell an asset, or minimise the amount which would be paid to transfer a liability, taking into consideration transport and transaction costs. Excuse me. In either case, the entity must have access to the market on the measurement date, although an entity must be able to access the market at the measurement date. IFRS 13 does not require that the entity to be able to sell the particular asset or transfer the particular liability on that date. If there is a principal market for the asset or liability, the fair value measurement represents the price in that market at the measurement date, regardless of whether the price is directly observable or estimated using another valuation technique, and even if the price in the different market is potentially more advantageous. The principal or most advantageous market price for the same asset or liability might be different for different entities, and therefore the principal or market most advantageous in brackets market is considered from the entity's perspective, which may result in different prices for the same asset. In Yanong's case, Asia would be the principal market, as this is the market in which the majority of transactions for the vehicle occur. As such, the fair value of the 150 vehicles would be 5.595 million, which is 38,000 minus 700 equals 37,300 times 150. Actual sales of the vehicle in either Europe or Asia would result in gain or loss to Yanong when compared with the fair value, i.e. 37,300. The most advantageous market would be Europe, where the net of the 39,100 brackets all after all costs would be gained by selling there, and the number of vehicles sold in this market by Yanong is at the highest. Yanong would therefore utilise the fair value calculated by reference to the Asian market, as this is the principal market. IFRS 13 makes it clear that the price used to measure the fair value must not be adjusted for transaction costs, but should consider transportation costs. Yanong are currently deducted transaction costs in its valuation of the vehicle. Transaction costs are not deemed to be a characteristic of an asset or liability, but they are specific to the transaction and will differ depending on how the entity enters into the transaction. Whilst not deducting the fair value, an entity considers transaction costs in the context of determining the most advantageous market, because the entity is seeking to determine the market which would maximise the net amount which would be received for the asset. Part B. Accounting for treatment of Maisie or Maze. Where reliable market-based prices or values are not available for biological assets in the present location or condition, fair value should not be measured using the valuation technique. Related observable inputs should be maximised, whilst unobservable inputs should be minimised. An appropriate valuation technique would be the present value of expected net cash flow for the asset, discounted at the current market-based rate. In the measurement of the fair value growing of crops, the notional cash flow expense should be included for the rent of the land where it is owned, in order that the value is comparable to an entity which rents its land. The fair value of the biological asset is separate from the value of the land on which it grows. Then there's a little table which is cash inflows, cash outflows, notional rental charge for land, net flows discounted at 2%. And then it's 3 months to 31st of Jan X5, 3 months to 30th of Jan X5, 3 months to 30th of April X5, and then total. I'm not going to read out all the figures. Thus, in the quarterly accounts at 31st of October X4, the maize fields, I said Maisie because I do know somebody called Maisie, so I just read it wrong. My mistake. It is maize. The maize fields should be recognised at 68.85 million, brackets 20 million land plus 48.85 million maize. A fair value gain of 48.85 million should be shown in the profit or loss, the operating cost of 10 million. At 30th of January, Yanong has revised its projections for the cash flow to 76 million, which means that the net cash flows at the date of the project were projected to be 76 minus 19 minus 1 million, i.e. 56 million. Discounted at 2%, this amounts to 54.9 million. Thus, the fair value gain of 54.9 million, 48.85 million, i.e. 6.05 million should be shown in the profit or loss together with the actual operating costs of 8 million. At the point of the harvest on 31st of March X5, the maize is valued at 82 million, which means that the fair value gain of 82 minus 54.9 million, i.e. 27.1 million, is recognised in the profit or loss, and the maize is classified as inventory. The actual operating cost for the quarter would also be shown in the profit or loss. When the maize is sold, a further profit of 84 minus 82 million, i.e. 2 million, is made on the sale. Part C. The share-based payment. IFRS 13 applies when another IFRS requires or permits fair value measurement or disclosure about fair value measurement, i.e. measurement, brackets, measurements, brackets, and measurements such as fair value less cost to sell based on fair value disclosure upon the measurement, close brackets. IFRS 13 specifically excludes transactions covered by certain other standards, including share-based payment transactions within the scope of IFRS 2 share-based payments. For cash-settled share-based payment transaction, the fair value of the liability is measured in accordance with IFRS 2 initially, at each reporting date and at the date of settlement using an option pricing model. The measurement reflects all conditions and outcomes on a weighted average basis, unlike equity settled transactions. Any changes in the fair value are recognised in profit or loss in the period. Therefore, the SARs would be accounted for as follows. Then there's another table, which I'm not going to read either. The columns are year, expense, liability, calculation, and then there's like a bit of narrative. So 30th of April X3, the expense liability calculation, there's all the figures, and it says time apportioned over vesting period using the estimate of 300 times 95, 285 managers. Then it's got year X4, 30th of April X4. Then it's got the column figures, expense liability calculation. Expense is difference between liabilities at 30th of April X4 and 30th of April X3. And then for the 30th of April X5, there's expense liability calculation figures. It says cash paid time is 60 times 500 times 10.5, i.e. 315,000. The liability is reduced by 217,500, and therefore the expense is the difference of 97,500. The fair value of the liability would be 1,350,000 at 30th of April X5, and the expense for the year will be 97,500. Part D, farmland. I never pay too much attention to the figures because this is more about reading the words, really. This is more the wordy parts of the questions. Part D, farmland. A fair value measurement of a non-financial asset takes into account a market participant's ability to generate economic benefits by using the asset in its highest and best use, or by selling it to another market participant who would use the asset in its highest or best use. The maximum value of non-financial assets might arise from its use in combination with other assets or by itself. IFRS 13 requires the entity to consider uses which are physically possible, legally permissible, or financially feasible. The use must not be legally prohibited. For example, if the land is protected in some way by law and the change of law is required, then it cannot be the highest and best use of the land. In this case, Yanong's land for residential development would only require approval from the regulatory authority and that approval seems to be possible, so this alternative use could be deemed to be legally permissible. Market participants would consider the probability, extent and timing of the approval, which may be required in assessing whether a change in a legal use or non-financial asset could be obtained. Yanong would need to have sufficient evidence to support its assumption about the potential for alternative use, particularly in light of IFRS 13 presumption that the highest and best use is an asset's current use. Yanong's belief that planning permission was possible, if unlikely to be sufficient evidence that the change of use is legally permissible. However, the fact that the government has indicated that more agricultural land should be released for residential purposes may provide additional evidence as to the likelihood that the land being measured should be based upon residential value. Yanong would need to prove that the market participants would consider residential use of the land to be legally permissible. Providing there is sufficient evidence to support these assertions, alternative uses, for example, commercial developments which would enable market participants to maximise value should be considered, but a search for potential alternative uses need not be exhaustive. In addition, any costs to transform the land, for example, obtaining planning permission or converting the land to its alternative use, and profit expectations from market participants' perspective should also be considered in the fair value measurement. If there are multiple types of market participants who would use the assets differently, these alternative scenarios must be considered before concluding the assets' highest and best use. It appears that Yanong is not certain about what constitutes the highest and best use, and therefore IFRS 13's presumption that the highest and best use is an asset's current use appears to be valid at this stage. Right, 65 Mehran, MEHRAN, 49 minutes, P2, March, June 16, amended. The directors of Mehran or Mehran, is it Mehran? We'll call it Mehran. A public limited company has seen many different ways of dealing with the measurement and disclosure of fair value of assets, liabilities, and equity instruments. They feel that this reduces comparability among different entities' financial statements. They would like to advise on how IFRS 13 fair value measurements should be applied to several transactions. Part A. Mehran has just acquired a company which comprises a farming and mining business. Mehran wishes advice on how to place a fair value on some of the assets acquired. One such asset is a piece of land which is currently used for farming. The fair value of the land used for farming is 5 million. If the land is used for farming purposes, a tax credit arises annually which is based upon the lower of 15% of the fair market value of the land of 500,000 at the current tax rate. The current tax rate The current tax rate in this jurisdiction is 20%. Mehran has determined that market participants would consider that land could have alternative use for residential purposes. The fair value of the land of residential purposes before associated costs is thought to be 7.4 million. In order to transform the land from farming to residential use, there would be legal costs of 200,000, a viability analysis cost of 300,000, and the costs of demolition of the farm building of 100,000. Additionally, permission for residential use has not been formally given by the legal authority, and because of this, market participants have indicated that the fair value of the land after the above costs would be discounted by 20% because of the risk of not obtaining planning permission. In addition, Mehran has acquired the brand name associated with the produce from the farm. Mehran has decided to discontinue the brand on the assumption that it will gain increased revenue from its own brands. Mehran has determined that if it ceases to use the brand, then the inherent benefits will be 20 million. If it continues to use the brand, then the direct benefit will be 17 million. 7 marks for that question, for that part A. Part B. Miran wishes to place a fair value on the inventory of the entity acquired. There are 3 different markets for the produce, which are mainly vegetables. The first is local domestic market, which Miran can sell direct to retailers of the produce. The second domestic market is one where Miran sells directly to manufacturers of canned vegetables. There are no restrictions on the sale of produce in either of the domestic markets, other than the demand of the retailers of the retailers and manufacturers. The final market is the export market, but the government limits the amount of produce which can be exported. Miran needs a license from the government to export its produce. Farmers tend to sell all of the produce that they can in the export market, and when they do not have any further authorization to export, they sell the remaining produce in the 2 domestic markets. It is difficult to obtain information on the volume of trade in the domestic market where the produce is sold locally direct to retailers, but Miran feels that the market is at least as large as the domestic market. The directors of Miran, as large as the domestic market, direct to manufacturers. That's weird. I didn't read that properly. I'm going to read that again. It is difficult to obtain information on the volume of trade in the domestic market where the produce is sold locally direct to retailers by Miran. But Miran feels that the market is at least as large as the domestic market direct to manufacturers. The volume of sales quoted below has been taken from trade journals. So we've got a table: volume annual, volume sales per month, price per tonne, transport costs per tonne, selling agent fees per tonne, and then the 3 columns: domestic market to retailers, domestic market direct to manufacturers, and then export market. So volume annual is unknown. So domestic market, I can't be bothered to read I'm not going to read the tables. Part C. Miran owns a non-controlling equity instrument in Eram, a private company, and wishes to measure the interest at its fair value at the financial year end and of the 31st of March X6. Miran acquires the ordinary share interest in Eram or Erham, depending on how you pronounce it, on the 1st of April X4. During the current financial year, Erham has issued further equity capital through the issue of preference shares to venture capital fund. As a result of the preferred share issue, the venture capital fund now holds a controlling interest in Erham. The terms of the preferred shares included in voting rights are similar to those of the ordinary shares, except the preferred shares have a cumulative fixed dividend entitlement for a period of 4 years, and the preferred shares rank ahead of the ordinary shares upon the liquidation of Erham. The transaction price for the preferred shares was $15 per share. Miran wishes to know the factors which should be taken into account in measuring the fair value of the holding in the ordinary shares of Erham at 31st of March X6 using the market-based approach. Required. Discuss the way in which Miran should measure the fair value the above assets with reference to the principles of IFRS 13 fair value measurement. Mark allocations are on each part of the question. Right, here's the answer. 65 Miran. Workbook references. IFRS 13 is covered in Chapter 4. IFRS 9 is covered in Chapter 8. Top tips. Most of the question is on IFRS 13 fair value measurements, as well as the fair value hierarchy. It is important to be familiar the principles, I think that should be with the principles behind the standard, particularly the highest and best use principle, and that of the principal and most advantageous market, and that of most principal and most advantageous market. You are expected to understand the nature of the valuation hierarchy and not just quote the requirements. Although financial instruments can be tricky, you can use similar thought processes to more common items. For example, if the fair value were to be placed on a motor car and the market price for a similar car would be used and adjusted if the mileage of the car was significantly different. The same principle applies to shares. Easy marks. Working out the most advantageous market is quite straightforward. The numbers are given to you for a reason. And the marking scheme is 1 mark per point. Right, so part A, land and brand name. IFRS 13 fair value measurement requires the fair value of the non-financial asset to be measured based on its highest and best use from a market participant's perspective. This requirement does not apply to financial instruments, liabilities and equity. The highest and best use takes into account the use of the asset which is physically possible, legally permissible and financially feasible. The highest and best use of the non-financial asset is determined by the reference to its use and not its classification, and it's determined from the perspective of market participants. It does not matter whether the entity intends to use the asset differently. IFRS 13 allows management to presume that the current use of the asset is the highest and the best use unless the market and other factors suggest otherwise. In this case, the agricultural land appears to have alternative use as market participants have considered its use for residential purposes. If the land zoned for agricultural uses is currently used for farming, the fair value should reflect the cost structure to continue operating the land for farming, including any tax credits which could be realised by market participants. Thus, the fair value of the land is used for farming would be $5 plus brackets 20% of 0.5 million, i.e. 5.1 million. If used for residual purposes, the value should include all costs associated with changing the land to the market participants' intended use. In addition, demolition and other costs associated with preparing the land for a different use should be included in the valuation. These costs would include the uncertainty related to whether the approval needed for changing the usage would be obtained, because fair market participants would take that into account when pricing value of the land if it had a different use. Thus, the fair value of the land, if used for residual purposes, would be 7.4 minus 0.2 minus 0.3 minus 0.1 brackets million times 80%, i.e. 5.44 million. Therefore, the value of the land would be 5.44 million on the highest and best use basis. In this situation, the presumption that the current use is the highest and best use of the land has been overridden by the market factors which indicate the residual development in the highest and best use. The use of the asset need not be legal at the measurement date, but it must not be legally prohibited in the jurisdiction. In the absence of any evidence to the contrary, Miran should value the brand on the basis of the highest and best use. The fair value is determined from the perspective of the market participant and is not influenced by the Miran's decision to discontinue the brand. Therefore, the fair value of the brand is 17 million. Part B, fair value of inventory. IFRS 13 sets out the concepts of principal market and most advantageous market. Transactions take place in either the principal market, which is the market with the greatest volume and level of activity for the inventory, or the absence of the principal market, the most advantageous market. The most advantageous market is the market which maximises the amount which should be received to sell the inventory after taking into account transactions costs and transportation costs. The price used to measure the inventory fair value is not the adjusted for transaction cost, although it is adjusted for transport costs. The principal market is not necessarily the market with the greatest volume of activity for the particular reporting entity. The principal is based upon the importance of the market from the participant's perspective. However, the principal market is presumed to be the market in which the reporting entity transacts, unless there is evidence to the contrary. In evaluating the principal or most advantageous market, IFRS 13 restricts the eligible markets to only those which can be assessed as a measurement at the measurement date. If there is a principal market for the asset or liability, IFRS 13 states the fair value should be based on the price in that market, even if the price in a different market is higher. It is only the absence of principal market that the most advantageous market should be used. An entity does not have to undertake an exhaustive search of all possible markets in order to identify the principal and most advantageous market. It should take into account all information which is readily available. There is a presumption in the standard that the market in which the entity normally transacts to sell the asset or transfer the liability in the principal and most advantageous market unless there is evidence to the contrary. In this case, the greatest volume of transactions is conducted in the domestic market direct to manufacturers. There is no problem with obtaining the data from the trade journals, but the problem for Miran is that there is no data to substantiate the volume of activity in the domestic market. Direct to retailers, even though Miran feels that it is at least 20,000 tonnes per annum, the most advantageous market is the export market, where after transport and transaction costs, the price per tonne is 1094. So then there's a table: price per tonne, transport costs per tonne, selling agents fee per tonne, net price per tonne. And then 3 columns: domestic market direct to retailers, domestic market direct to manufacturers, and export markets. Price per tonne is 1,000, then domestic market is direct to manufacturers 800, and then export market is 1,200. Transport cost 50, 70, and 100, and then selling fees nothing, 4 and 6, which is net price per tonne of 950, 726, and 1094. It is difficult to determine the principal market because the lack of information. It could be argued that the domestic market direct to manufacturers has the highest value for the produce, and that there is a principal market by which Miran should determine fair value of 730, 800 minus 70. However, because of the lack of information surrounding the domestic market direct to retailers, the principal or most advantageous market will be presumed to be the market in which Miran would normally enter into a transaction, which would be the export market. Therefore, the fair value would be 1,200 minus 100 per tonne. Part C, investment in Irham. Measuring the fair value of individual unquoted equity instruments, which constitutes a non-controlling interest in the private company, falls within the scope of IFRS 9 financial instruments in accordance with the principles set out in IFRS 13. There is a range of commonly used validation techniques for measuring the fair value of unquoted equity instruments, and the income approaches, as well as the adjusted net method, are acceptable. IFRS 13 states that fair value is a market-based measurement, although it acknowledges that in some cases observable market transactions and other market information might not be available. IFRS 13 does not contain a hierarchy of valuation techniques, nor does it prescribe the use of specific valuation techniques for meeting the objective of fair value measurement. However, IFRS 13 acknowledges that, given specific circumstances, one valuation technique might be more appropriate than another. The market approach takes the transaction price paid for the identical or similar instrument in an investee and adjusts the resultant valuation. The transaction price paid recently for an investment in an equity instrument in an investee, which is similar but not identical to the investor's unquoted equity instrument in the same investee, would be reasonable starting point for estimating the fair value of the unquoted equity instrument. Miran would take the transaction price for the preferred share and adjust it to reflect certain differences between the preferred share and the ordinary shares. There would be an adjustment to reflect the priority of the preferred share upon liquidation. Miran should acknowledge the benefit associated with control. This adjustment relates to the fact that Miran's individual ordinary shares represent a non-controlling interest, whereas the preferred shares issue reflected a controlling interest. There is an adjustment for the lack of liquidity of the investment, which reflects the lesser ability of the ordinary shareholder to initiate the sale of Aaron related to the preferred shareholder. Further, there will be an adjustment for the cumulative dividend entitlement of the preferred shares. This would be calculated as a present value of the expected future dividend receipt on the preferred share less the present value of any expected dividend receipt on the ordinary shares. The discount rate used should be consistent with the uncertainties associated with the relevant dividend streams. Miran should review the circumstances of the issue of the preferred shares to ensure that the price was a valid benchmark. Miran must, however, use the information about the performance and obligation of ERAM, which becomes reasonably available to it after the date of initial recognition of the ordinary shares up to the measurement date. Such information can have an effect on the fair value of the unquoted equity instrument at 31st of March X6. In addition, Miran should consider the existence of factors such as whether the environment in which ERAM operates is dynamic, or whether there have been changes in the market conditions between the issue of the preferred share and the measurement date. Right, question 66, Canto, 49s, P2, March, June 17, amended. Canto Co. is a company which manufactures industrial machinery and has a year end of 28th of February X7. The director of Canto requires advice on the following issues. Part A, on the 1st of March X4, Canto acquires a property for 15 million, which was used as an office building. Canto measures the property on a cost basis in property, plant and equipment. The useful life of the building was estimated at 30 years from the 1st of March X4 with no residual value. Depreciation is charged on a straight line basis over its useful life. At acquisition, the value of the land content of the property was thought to be immaterial. During the financial year to 28th of February X7, the planning authorities approved the land to build industrial units and retail outlets on the site. During X7, Canto ceased using the property as an office and converted the property to an industrial unit. Canto also built retail units on the land during the year to 28th of February X7. At 28th of February X7, Canto wishes to transfer the property at fair value to reinvestment property at $20 million. The valuation was based upon other similar properties owned by Canto. However, if the whole site were sold, including the retail outlets, it is estimated that the value of the industrial units would be 25 million because of the synergies and complementary cash flows. The directors of Canto wish to know whether the fair value of the investment property is in line with the international financial reporting standards and how to account for the change in use of the property in the financial statement at the 28th of February X7. 9 marks. Part B, on 28th of February X7, Canto acquires all of the share capital of Bin Lorry, a company which manufactures and supplies industrial vehicles. At the acquisition date, Bin Lorry has an order backlog which relates to contract between itself and a customer for 10 industrial vehicles to be delivered in the next 2 years. In addition, Bin Lorry requires the extensive use of water in the manufacturing process and can take a predetermined quality of water from water source for industrial use. Bin Lorry cannot manufacture vehicles without the use of the water rights. Bin Lorry was the first entity to use the water from the source and acquired this legal right at no cost several years ago. Bin Lorry has the right to continue to use the quantity of water for manufacturing purposes, but any used water cannot be sold separately. These rights can be lost over time if no use of the water source is demonstrated or if the water has not been used for a certain number of years. Bin Lorry feels that the valuation of the rights is quite subjective and difficult to achieve. The directors of Canto wish to know how to account for the above intangible assets on the acquisition of Bin Lorry. 8 marks. Part C. Canto acquired a cash generating unit, CGU, several years ago, but at the 28th of February X7, the directors of Canto were concerned that the value of the CGU has declined because of the reduction in sales due to the new competitors entering the market. At 28th of February X7, the carrying amount of the assets in the CGU before any impairment testing were goodwill 3 million, property, plant and equipment 10 million, other assets 19 million, and total 32 million. The fair value of property, plant and equipment and other assets at the 28th of February X7 were 10 million and 17 million respectively, not retrospectively, and their costs to sell were $100,000 and $300,000 respectively. The CGU's cash flow, the cash generated units cash flow forecast for the next 5 years is as follows. Year end dated, and this is 28th of February, and it's 28th of February for each one, and then it's got column pre-tax flow and post-tax cash flow, pre-tax cash flow and post-tax cash flow. So X8 pre-tax is 8, post-tax is 5, X9 7, pre-tax 5, post-tax, X10 X10 Y0, which means 20, it's like 2010 really. Y0 is pre-tax 5, post-tax 3, Y1 is 3, pre-tax 3, post-tax 1.5, and Y2 13 and 10. The pre-tax discount rate for cash generating unit is 8%, and the post-tax discount rate is 6%. Canto has no plans to extend the capacity of the cash generating unit and believes that reorganisation would bring cost savings, but as yet no plan has been approved. The directors of Canto need advice as to whether the cash generating unit value is impaired. The following extract from the table of present value factors has been provided, and it gives you a discount. Year 1 to 5, discount rate 6%, a discount rate at 8%, and it gives you a table of values, which I'm not going to read out. That's 8 marks. Required. Advise the directors of Canto on how the above transactions should be dealt with in the financial statements and with reference to relevant international financial reporting standards. The mark allocation is next to each part. Right, 66 Canto answer. Workbook references, property, plant and equipment, investment properties, intangible assets and impairment of assets are all covered in Chapter 3. Basic grips are covered in Chapter 10. Top tips. Split your time fairly. Fat chance. Split your time fairly over each part of the 3-part question to maximise the marks you gain from the time spent. Part A and Part B both require discussion of multiple standards to gain the most marks. Part C focuses on IAS 36 and the impairment of a cash generating unit. It is most involved with the selection of appropriate discount rates and the allocation of impairment, but it is not a complicated scenario assuming you have revised IAS 36. Easy marks. Part A has a generous marking available for the discussion and application of IFRS 13, IAS 16 and IAS 14 knowledge. There also are marks for straightforward calculations of Part C. The marking scheme is 1 mark per point. Part A, fair value. IFRS 13 fair value measurement defines fair value as the price which would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date in respect of property. And there's 3 bullet points. Bullet point 1. The fair value measurement is a non-financial asset such as property takes into account the entity's ability to generate economic benefits by using the asset in its highest and best use or by selling it to another market participant who would use the asset in its highest and best use. Bullet point 2. The highest and best use of property takes into account the use of the asset which is physically possible, legally permissible and financially feasible. Bullet point 3. There are 3 levels in IFRS 13 fair value hierarchy based on the valuation technique used. Due to the lack of an action market for identical assets, it would be rare for property to be classified in level 1 of the fair value hierarchy. In market conditions where property is actively purchased and sold, the fair value measurement might be classified in level 2. However, the determination will depend on the facts and circumstances, including the significance of adjustments to observable data. In this regard, IFRS 13 provides a property-specific example, stating that the level 2 input would be the price derived from observed transactions involving similar property interests in similar locations. Accordingly, in active or transparent markets, property valuations may be classified as level 2, provided that no significant adjustment has been made to the observable data. If significant adjustments to observable data are required, the fair value measurement may fall into a level 3. PPE to investment property. PPE is property, plant and equipment, not the other one to do with coronavirus. So property, plant, equipment to investment property. IAS 40 investment property permits entities to choose between the fair value model and a cost model. One method must be adapted for all of the entities' investment property. A change is permitted only if this results in more appropriate presentation. IAS 40 notes that this makes it highly unlikely for a change from fair value model to cost model to occur. Transfer to or from investment property should only be made when there is a change in use, which is evidence of by the end of owner occupation, which has occurred in this case. For a transfer from pre-owned occupied property to investment property carried at fair value, IAS 16 property, plant and equipment (PPE) should be applied but up to the date of reclassification. Any differences arising between the carrying amount under IAS 16 and the date and fair value is dealt with as revaluation under IAS 16. The aggregate fair value of the site, include the industrial and retail outlets, is higher to market participants than the sum of the fair value of the individual property interests because of synergies and complementary cash flows. Consequently, the fair value of the site as a whole would be maximised as a group of assets. The fair value is determined for the whole site even if the asset is disaggregated when applying IAS 40. Thus, provided that the above criteria have been met, Canto may value the property at $25 million. Canto will recognise a depreciation expense of $0.5 million in the profit or loss in the year of the 28th of February X7, whilst the property is accounted for using the cost model under IAS 16 at 28th of February X7. Canto will transfer the property from PPE to investment property. The investment property will be recognised at the fair value of $25 million. The carrying amount of property, plant and equipment of $13.5 million, brackets $50 million minus accumulated depreciation of $1.5 million, close brackets, will be derecognised, and an increase of $11.5 million will be a revaluation surplus. Part B. IFRS 3 business combination states that an acquirer should recognise separately from goodwill the identifiable assets acquired in a business combination. As asset is identifiable, if it meets either the separability and contractual legal criteria in IAS 38 intangible assets. Customer relationship intangible assets may be either contractual or non-contractual. Roman numeral 1, contractual customer relationships are normally recognised separately from goodwill as they meet the contractual legal criterion. Roman numeral 2, however, non-contractual customer relationships are recognised separately from goodwill only if they meet the separable criterion. Consequently, determining whether a relationship is contractual or critical to identifying and measuring both separately recognised customer relationship intangible assets and goodwill and different conclusions could lead to substantially different accounting outcomes. Order backlog. The order backlog should be treated as an intangible asset on the acquisition. The fair value of the order backlog is estimated based on the expected revenue to be received less the costs to deliver the product or service. Water acquisition rights. The rights are variable as Bin Lauri cannot manufacture vehicles without them. The rights were acquired at no cost and the renewal is certain to little or no cost. The rights cannot be sold other than as part of the sale of the business as a whole, so there exists no secondary market in the rights. If Bin Lauri does not use the water, then it will lose the rights. In this case, the legal rights cannot be measured separately from the business as a whole or transferred from goodwill. Therefore, the legal rights should be accounted for as a separate intangible asset acquired in the business combination because the fair value cannot be measured reliably as the legal rights cannot be separated from goodwill. Part C. IAS 36 impairment of assets requires that assets be carried at no more than their carrying amount. Therefore, entities should test all assets within the scope of the standard if indicators of impairment exist. If the recoverable amount (brackets), which is the higher of fair value less costs of disposal and value in use (close brackets), is more than the carrying amount, the asset is not impaired. It further says that in measuring value in use, the discount rate used should be pre-tax rate, which reflects the current market asset of the time value of money and the risk specific to the asset. The discount rate should not reflect risks for which future cash flows have been adjusted and should equal the rate of return which investors would require if they were to choose an investment which would generate cash flows equivalent to those expected from the asset. Therefore, pre-tax cash flow and pre-tax discount rate should be used to calculate value in use. Then it gives a table: date year ended 28th of February X8, pre-tax cash flow and discounted rate at 8%. So February X8 is pre-tax is 8 million, discounted at 7.41. X9 pre-tax 7 million, discounted at 6. X10, no, it's going to be Y0, which means X10 really. 5 is 3.97, X11 is 3 equals 2.21, and 12 is 13, 8.85, which is a total of 28.44. The CGU is impaired by the amount by which the carrying amount of the cash generating unit exceeds its recoverable amount. Recoverable amount. The fair value less cost to sell brackets 26.6 million is lower than the value in use 28.44 million. The recoverable amount is therefore 28.44 million. Impairment. The carrying amount is 32 million and therefore the impairment is 3.56 million. Allocating impairment losses. Cantor will allocate the impairment losses first to the goodwill and then to the other asset of the unit, pro rata on the basis of the carrying amount of each asset in the cash generating unit. When allocating the impairment, the carrying amount of the asset cannot be reduced below its fair value less cost to sell. Consequently, the entity will allocate 3 million to goodwill and then allocate 0.1 million on a pro rata basis to PPE brackets to reduce it to its fair value less cost to sell of 9.9 million and other assets 0.46 million to the other asset. This would mean that the carrying amount would be 9.9 million and 18.54 million respectively. 67. Question 67. Ethan. I've got a mate called Ethan. 49 minutes, P2, December 2012, amended. Ethan, a public limited company, develops, operates and sells investment properties. Part A. Ethan focuses mainly on acquiring properties where it foresees growth potential through rental income as well as value appreciation. The acquisition of investment property is usually realised through the acquisition of the entity which holds the property. In Ethan's consolidated financial statements, investment properties acquired through business combinations are recognised at fair value using the discounted cash flow model as approximation of fair value. There is currently an active market for this type of property. The difference between the fair value of the investment property as determined under the accounting policy and the value of the investment property for tax purposes results in the deferred tax liability. Goodwill arising on business combinations is determined using the measurement principle for the investment property as outlined above. Goodwill is only considered impaired if and when the deferred tax liability is reduced below the amount at which it was first recognised. This reduction can be caused both by reduction in the value of real estate or a change in the local tax regulations. As long as the deferred tax liability is equal to or larger than the prior year, no impairment is charged to goodwill. Ethan explained explained its accounting treatment by confirming that almost all of the goodwill is due to the deferred tax liability, and it is normal in the industry to account for goodwill in this way. Since 20x0, Ethan has incurred substantial annual losses except for the year ended 31st of May X3, when it was made a small profit before tax. In the year ended 31st of May X3, most of the profit consisted of income recognised on re-evaluation of investment properties. Ethan had announced early in the financial year ended 31st of May X4 that the anticipated substantial growth and profit that it anticipated substantial growth and profit. Later in the year, however, Ethan announced that the expected profit would not be achieved and that instead a substantial loss would be incurred. Ethan had a history of reporting considerable negative variances from its budgeted results. Ethan recognised deferred tax assets have been increased year on year, despite the deferred tax liabilities recognised in business combinations. Recognised on business combinations. Ethan deferred tax asset consists primarily of the unused tax losses that can be carried forward, which are unlikely to be offset against the anticipated future taxable profits. 13 marks. Part B. Ethan wishes to apply for fair value option rules of IFRS 9 financial instruments to debt issued to finance its investment properties. Ethan argued for applying the fair value option is based upon the fact that the recognition of gains and losses on its investment properties and the related debt would otherwise be inconsistent. Ethan argued that there is a specific financial correlation between the factors such as interest rates and form the basis for determining the fair value of both Ethan's investment properties and related debt. 7 marks. Part C. Ethan has an operating subsidiary which has in issue A and B shares, both of which have voting rights. Ethan holds 70% of the A and B shares, and the remainder are held by the shareholding external to the group. The subsidiary is obliged to pay an annual dividend of 5% on the B shares. The dividend payment is cumulative, even if the subsidiary does not have sufficient legal disputable profit at the time the payment is due. In Ethan's consolidated statement of financial position, the B shares of the subsidiary were accounted for in the same way as equity instruments would be, with the B shares owned by external parties reported at the non-controlling interest. 5 marks. Required. Discuss how the above transactions and events should be recognised in the consolidated financial statements of Ethan. Answer 67 then. Ethan. Workbook references. Deferred tax is covered in Chapter 7. Investment property and impairment are covered in Chapter 4. Financial instruments in Chapter 8 and fair value in Chapter 4. Top tips. In Part A, you should focus on IFRS 13. In Part B, requires the application of the fair value option in IFRS 9 financial instruments. The option is used where such application would eliminate or significantly reduce the measurement or recognition inconsistency between the debt liabilities and the investment properties to which they are related in the question. In Part C, candidates needed to recognise that in classifying the B shares as equity rather than liability, the equity had not complied with IAS 32 financial instruments presentation. There were pointers to the shares being classified as a liability, in particular the fact that the entity was obliged to pay an annual cumulative dividend on the B shares and did not have to discern over the distribution of such dividend. Easy marks. There are no obvious easy marks. Marking scheme. Part A, fair value of investment properties, 13 marks. Part B, fair value option for IFRS 9, 7 marks. And C, B shares of subsidiary, 5 marks. Part A. Fair value of investment properties. The fair value of an asset is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. IFRS 13, fair value measurement. Standard definition, I can never remember it still. But IFRS 13 states that valuation techniques must be those which are appropriate and for which sufficient data are available. Entities should maximise the use of relevant observable inputs and minimise the use of unobservable outputs. and minimise the use of unobservable inputs. The standard establishes a 3-level hierarchy for the inputs that valuation techniques used to measure fair value. Level 1, quoted prices (brackets unadjusted) in active markets for identical assets or liabilities that the reporting entity can access at the measurement date. Level 2, inputs other than quoted prices included within Level 1 that are observable for the asset or liability either directly or indirectly, e.g. quoted prices for similar assets in active markets or for identical or similar assets in non-active markets, or use of quoted interest rates for valuation purposes. Level 3, unobservable inputs for the asset or liability, i.e. using the entity's own assumptions about market exit value. Although an active market exists for Ethan investment properties, Ethan uses a discounted cash flow model to measure fair value. This is not in accordance with IFRS 13, as the fair value hierarchy suggests IFRS 13 favours level 1 inputs that are market-based measures over unobservable level 3 inputs such as discount cash flows. Goodwill and deferred tax. If the fair value of the investment properties is not measured correctly in accordance with IFRS 13, this means that deferred tax liability on investment properties may also be incorrect. In addition, as goodwill is calculated as consideration transferred less fair value of net assets, goodwill may be incorrect. This is because deferred tax is calculated on the difference between the carrying amount of the asset and its tax base. So if the carrying amount is incorrect, the deferred tax will be incorrect. The goodwill calculation uses the fair value of all net assets, not just the investment property and the related deferred tax liability. So it is incorrect to use the increase in deferred tax liability as a basis for assuming whether goodwill is impaired. The reasoning behind Ethan's approach is that deferred tax liability decreases, the fair value of net assets increases, thereby decreasing goodwill. However, this method of determining whether goodwill is impaired does not accord with IAS 36, impairment of assets. IAS 36 requires that goodwill should be reviewed for impairment annually, or any indicators of impairment, which may be internal or external, are not confined to the changes in the deferred tax liability. Where it is not possible to measure impairment for individual assets, the loss should be measured for a cash generating unit. The recoverable amount is defined as the higher of Roman numeral 1, the asset's fair value less cost to sell. This is the price that would be received to sell an asset in an ordinary transaction between market participants at the measurement date under current market conditions, net of costs of disposal. Roman numeral 2, the asset's value in use. This is the present value of estimated future cash flows, brackets inflows minus outflows, generated by the asset, included its estimated net disposal value, brackets if any, at the end of its useful life. If an asset's carrying amount is higher than the recoverable amount, an impairment loss has occurred. The impairment loss should be written off against profit or loss for the year, and the corresponding credit, brackets write-off, applied first to goodwill, then to the investment properties, then to other assets pro rata. Deferred tax asset on losses. In theory, unused tax losses give rise to deferred tax assets. However, IAS 12 income taxes states that deferred tax assets should only be recognised to the extent that they are regarded as recoverable. They should be regarded as recoverable to the extent that, on the basis that all evidence available, it is probable that there will be a suitable taxable profit against which the losses can be recovered. It is unlikely that future taxable profits of Ethan will be sufficient to realise all of the tax losses because Roman numeral 1, the announcement that the substantial loss will be incurred this year instead of the expected profit. Roman numeral 2, considerable negative variances against budget in the past. Consequently, Ethan should not recognise the deferred tax asset. Part B, IFRS 9 fair value option. Generally, under IFRS 9 financial instruments, the debt issue to finance its investment properties would be accounted for using amortised cost, whilst the properties themselves are at fair value. This is an accounting mismatch that that is the recognition or measurement inconsistency between the debt liability and the asset to which it relates. The asset and the liability and the gains and losses arising on them would be measured on different bases. The IFRS 9 fair value option allows an entity to designate a liability at initial recognition as being at fair value through profit or loss. If using this option would eliminate or significantly reduce an accounting mismatch. Ethan has argued that the basis of measurement of the debt and the investment properties is similar, particularly as regards interest rates. This argument holds good in respect to the interest, and so the fair value option would be allowed. However, IFRS 9 stipulates that if a liability is designated as being fair value through profit or loss, changes in the fair value that are due to changes in liability credit risk must be recognised directly in other comprehensive income rather than profit or loss. Such changes may not be reclassified to profit or loss in subsequent years, although a reserves transfer is permitted from other components of equity to retained earnings. On the other hand, if changes in fair value attributable to the credit risk of the liability create or enlarge an accounting mismatch in the profit or loss, then the fair value movement are recognised in profit or loss. Part C. B shares of subsidiary. Ethan's accounting treatment of B shares (and equity instruments) as equity instruments close brackets, does not comply with IAS 32 financial instruments presentation. The IAS 32 definition of a financial liability includes any liability that is a contractual obligation to deliver cash or another financial asset to another entity. A financial instrument may only be classified as an equity instrument rather than a liability if the instrument does not include the obligation to deliver cash or other financial assets to another entity or to exchange financial instruments with another entity under conditions that are potentially unfavourable. In the subsidiaries books, the B shares would be treated as financial liability. They contain the obligation to deliver cash in the form of fixed dividend. The dividend is cumulative and must be paid whether or not the subsidiary has sufficient legal distributable profits when it is due, and the subsidiary cannot avoid this obligation. In the consolidated financial statements, the B shares would also be treated as a financial liability. The intergroup element of the liability, 70%, would cancel against the investment in B shares in the parents, Ethan's, statement of financial position. The shares owned by external parties would not cancel, they would remain a financial liability. It is correct to treat them as non-controlling interest because they are not equity. Question 58, Whiteberg, 43 minutes, P2, December 2010 amended. Part A. The main argument for separate accounting standards for small and medium-sized entities is the undue cost burden of reporting, which is proportionately heavier than smaller firms. For smaller firms. Required. Discuss the main differences and modifications to IFRS which the IASB made when it published the IFRS for small and medium-sized entities, IFRS for SMEs. Giving specific examples where possible and include in your discussion how the board has dealt with the problem for defining on an SME, 11 marks. Part B. White-Burke has met a definition of an SME in its jurisdiction and wishes to comply with the IFRS for SME. The entity wishes to seek advice on how it will deal with the following accounting issues. In the financial statements for the year ended 30th of November X2, the entity already prepares its financial statements under a full IFRS. Roman numeral 1. White-Burke purchased 90% of Close, an SME, on 1st of December X1. The purchase consideration was 5.7 million and the value of the close identifiable assets was 6 million. The value of the non-controlling interest at the 1st of December X1 was measured at 0.7 million. White-Burke has used the full goodwill method to account for business combinations, and the life of goodwill cannot be estimated with any accuracy. Whitebird wishes to know how to account for goodwill under the IFRS for SME. Roman numeral 2. Whitebird has incurred $1 million of research expenditure to develop a new product in the year to 30th of November X2. Additionally, it incurred $500,000 of development expenditure to bring another product to a stage where it is ready to be marketed and sold. Roman numeral 3. Whitebird purchased some properties for $1.7 million on the 1st of December X1 and designated them as an investment property under the cost model. No depreciation was charged as a real estate agent valued the properties at $1.9 million at the year end. Roman numeral 4. Whitebird has an intangible asset valued at $1 million on the 1st of December X1. The asset has an indefinite useful life, and in previous years had been reviewed for impairment. At 30th of November X2, there is no indication that the asset is impaired. Required, discuss how the above transactions should be dealt with in the financial statements of Whitebird with reference to IFRS for SMEs. 11 marks, 22 marks in total. Right, Whitebird. Answer 68. Workbook references. Small and medium-sized entities are covered in Chapter 18 of your workbook. Top tips. Part A on the main differences between IFRS for SMEs and full IFRS was reasonably straightforward. Part B requires you to apply the standard to specific areas: goodwill, research and development expenditure, investment property, and impairment. Remember not to use full IFRS. Easy marks. This was a rich source of easy marks for the well-prepared candidate. Make sure that your arguments are well structured in order to earn those 2 marks for clarity and quality of discussion. Marking scheme. Part A, subjective assessment including professional. Part B, Roman numeral 1, business combination. Roman numeral 2, research and development expenditure. Roman numeral 3, investment property. Roman numeral 4, intangible assets. That was the marking scheme. Part A, modification to reduce the burden of reporting for SMEs. The IFRS for SMEs has simplifications that reflect the need of users of SMEs' financial statements and cost-benefit considerations. It is designed to facilitate financial reporting by small and medium entities in a number of ways. Roman numerals 1 to 6. Roman numeral 1. It provides significantly less guidance than full IFRS. A great deal of guidance in full IFRS would not be relevant to the needs of smaller entities. Roman numeral 2. Many of the principles for recognising and measuring assets, liabilities, income and expenses in full IFRS are simplified. For example, goodwill and intangible assets are always amortised over their estimated useful life (brackets) or 10 years if it cannot be estimated. Research and development costs must be expensed. With defined benefit pension plans, all actuarial gains and losses are to be recognised immediately in other comprehensive income. All past services costs are to be recognised immediately in profit or loss. To measure the defined benefit obligation, the projected unit credit method must be used. Roman numeral 3. Where full IFRSs allow accounting policy choices, the IFRS for SMEs allows only the easier option. Examples of alternatives not allowed in the IFRS for SMEs include revaluation model for intangible assets and property, plant and equipment, proportionate consolidation for investment in jointly controlled entities, and choice between cost and fair value models for investment properties. Brackets measurement depends on the circumstances. Roman numeral 4. Topics not relevant to SMEs are omitted. Earnings per share, interim financial reporting, segment reporting, insurance and assets held for sale. Roman numeral 5. Significantly fewer disclosures are required. Roman numeral 6, which is quite lengthy. The standard has been written in clear language that can easily be translated. Sorry. It's actually quite short. Then this closing paragraph. The above represents a considerable reduction in reporting requirements, perhaps as much as 90% compared with listed entities. Entities will naturally wish to use the IFRS for SMEs if they can, but its use is restricted. The restrictions are not related to size. There are several disadvantages of basing the definition of size limits alone. Size limits are arbitrary, and different limits are likely to be appropriate in different countries. Many people believe that SMEs are not simply smaller versions of listed entities, but differ from them in more fundamental ways. The most important way in which SMEs differ from other entities is that they are not usually publicly accountable. Accordingly, there is no quantitative threshold for qualification as a SME. Instead, the scope of the IFRS is determined by the test of public accountability. The IFRS is suitable for all entities except those whose securities are publicly traded and financial institutions such as banks and insurance companies. Another way in which the use of IFRS for SMEs is restricted is that users cannot cherry pick from the IFRS and full IFRS. If an entity adopts the IFRS for SME, it must adopt it in its entirety. Part B, Roman numeral 1, business combinations. IFRS 3 business combinations allows an entity to adopt the full or partial goodwill method in its consolidated financial statements. The IFRS for SME only allows the partial goodwill method. This avoids the need for SMEs to determine the fair value of the non-controlling interest not purchased when undertaking a business combination. In addition, IFRS 3 requires goodwill to be tested annually for impairment. The IFRS for SMEs requires goodwill to be amortised instead. This is a much simpler approach, and the IFRS for SMEs specifies that if an entity is required to make a reliable estimate of the useful life, it is presumed that to be 10 years, simplifying things even further. Goodwill on White-Berk's acquisition of Close will be calculated as consideration transferred 5,700, non-controlling interest 10% at times 6 million is 600, total of 6,300. This is millions in millions in thousands of dollars. So less fair value of identifiable net assets acquired, bracket 6,000, goodwill is 300. This goodwill of 0.3 million will be amortised over 10 years, that is 30,000 per annum. Roman numeral 2, research and development expenditure. The IFRS for SME requires all internally generated research and development expenditure to be expensed through profit or loss. This is simpler than the full IFRS. IAS 38 intangible assets requires internally generated assets to be capitalised if certain criteria, brackets proving future economic benefits, close brackets, are met, and it is often difficult to determine whether or not they have been met. White-Berk total expenditure on research 0.5 million and development 1 million must be written off to the profit or loss for the year, giving a charge of 1.5 million. Roman numeral 3, investment property. Investment properties must be held at fair value through profit or loss under the IFRS for SME, where their fair value can be measured without undue cost or effort, which appears to be the case here, given that the estimate agent valuation is available. Consequently, a gain of 0.2 million, 1.9 million minus 1.7 million, will be reported in White-Berk's profit or loss for the year. Roman numeral 4, intangible assets. IAS 36 impairment of assets requires annual impairment tests for indefinite life intangibles not yet available for use, and goodwill. This is a complex, time-consuming and expensive test. The IFRS for SME only requires impairment tests where there are indicators of impairment. In the case of White-Berk's intangible, there are no indicators of impairment, and so an impairment test is not required. In addition, IAS 38 intangible assets does not require intangible assets with an indefinite useful life to be amortised. In contrast, under IFRS for SME, all intangible assets must be amortised. If the useful life cannot be established reliably, it must not exceed 10 years. White, but oh no, I've done that one. Sorry. 69 Lucky Dairy, 49 minutes. ACCA June 2002 amended. The Lucky Dairy, a public limited company, produces milk for supply for to various customers. It is responsible for producing 25% of the country's milk consumption. The company owns 150 farms and 7,000 cows and 35,000 heifers, which are being raised to produce milk in the future. The farms produce 2.5 million kilograms of milk per annum and normally holds an inventory of 50,000 kilograms of milk. Extracts from the draft accounts of milk brackets extracts from the draft accounts to 31st of May X2. The herds comprise at 31st of May X2 70,000 3-year-old cows brackets all purchased on or before the 1st of June X1, 25,000 heifers brackets average age 1.5 years old purchased 1st of December X1, 10,000 heifers average age 2 years purchased 1st of June X1. There were no animals born or sold in the year. The per unit values less estimated points of sale costs were as follows: 2-year-old animal at the 1st of June X1, $50. First 1-year-old animal at the 1st of June X1 and December X1, $40. 3-year-old animal at the 31st of May X2, $60. 1.5-year-old animal at the 31st of May X2, $46. 2-year-old animal at the 31st of May X2, $55. 1-year-old animal at 31st of May X2, $42. The company has had a difficult year in financial and operating terms. The cows had contracted a disease at the beginning of the financial year, which had been passed on in the food chain to a small number of consumers. The publicity surrounding the event has caused a drop in the consumption of milk, and as a result, the dairy was holding 500 kilograms of milk in storage. The government had stated on the 1st of April X2 that it was prepared to compensate farmers for the drop in the price of consumption of milk. An official government letter was received on the 6th of June X2 stating that 1.5 million will be paid to Lucky on the 1st of August X2. Additionally, on the 1st of May X2, Lucky had received a letter from its lawyer saying that the legal proceedings had been started against the company by the persons affected by the disease. The company's lawyers have advised them that they feel that it is probable that they will be found liable and that the costs involved may reach 2 million. The lawyers, however, feel that the company may receive additional compensation from government fund if certain quality control procedures had been carried out by the company. However, the lawyers will only state that the compensation payable is possible. The company's activities are controlled in the 3 geographical locations: Dale, Shire and Ham. The only region affected by the disease was Dale, and the government has decided that it has restricted the milk production of that region significantly. Lucky estimates that the discounted future cash income from the present herds of cattle in the region amounts to 1.2 million, taking into account the government's restricted order. Lucky was not sure that the fair value of the cow in the region could be measured reliably at the date of purchase because of the problem with the diseased cattle. The cows in the region amounted to 20,000 in number and the heifers 10,000 in number. All of the animals were purchased on the 1st of June X1. Lucky had an offer of 1 million for all the animals in the Dale region, net of point of sale costs, in brackets that was, and 2 million for the sale of the farms in the region. However, there was a minority of directors who opposed the planning sale, and it was decided to defer the public announcement of sale pending the outcome of the possible receipt of the government compensation. The board had decided that the potential sale plan was highly confidential, but the national newspaper had published an article saying that the sale may occur and that there would be many people who would lose their employment. The board approved the planning sale of Dale formed on the 31st of May X2. The directors of Lucky have approached your firm for professional advice on the above matters. Required. Advise the directors on how the biological assets and produce of Lucky should be accounted for under IAS 41 Agriculture and discuss the implications of the publishing of the published financial statements of the above events. Note: candidates should produce a table which shows the changes in value of the cattle for the year 31st of May X2 due to price changes and the physical change excluding the Dale region, and the value of the herd of the Dale region at 31st of May X2. Ignore the effects of taxation. Heifers are young female cows, whilst cattle refers to both cows and heifers. Right, here's the answer. Lucky Dairy, 69. Workbook references. IAS 41 is covered in Chapter 3 of your workbook. IAS 37 is covered in Chapter 5. And IFRS 5 is covered in Chapter 13. Top tips. In the question, you are required to deal with a scenario that had as its main theme IAS 41. Agriculture. You should not, however, make the mistake of thinking that this question is about IAS 41, as it requires knowledge of several other standards, including IAS 37 and IFRS 5. Right, the dairy herd. That question was a lot longer than the answer, strangely enough. Right, dairy herd. The dairy herd is a biological asset as defined by IAS 41 Agriculture. IAS 41 states that the biological asset should be measured at fair value less estimated point of costs, unless its fair value cannot be measured reliably. Gains and losses arising from the change in the fair value should be included in profit or loss for the period. In this case, fair value is based on market price at the point of sale. Costs are the costs of transporting the cattle to the market. Cattle in the Ham and Shire regions is valued on this basis. IAS 41 encourages companies to analyse the change in fair value between the movement due to physical changes and the movement due to price changes. Brackets, see the table below. It also encourages companies to provide a qualified description of each group of biological assets. Therefore, the value of the cows and the value of the heifers should be disclosed separately in the statement of financial position. Valuing the dairy herd for the Dale region is less straightforward, as its fair value cannot be measured reliably at the date of purchase. In this situation, IAS 41 requires that the herd be valued at cost less any impairment losses. The standard also requires companies to provide an explanation of why fair value cannot be measured reliably and the range of estimates within which fair value is likely to fall. Valuation of cattle excluding Dale region. There's 3 columns: cows, heifers and total. Fair value held at the 1st of June X1, 50,000 times 50, 2,500 cows. Purchase at the 1st of December X1, 25,000 times 40 is 1,000 heifers. Costs to price change, 50,000 times 55 minus 50 divided by 25,000 times 42 minus 40 equals 250 cows and 50 heifers. Increase in fair value less estimated point of sale costs due to the physical change, 50,000 times 60 minus 55 divided by 25,000 times 46 minus 42. Fair value less estimated point of sale costs at 31st of May X2 is 50,000 times 60 divided by 25,000 times 46. Valuation of cattle in Dale region. Cost at the 1st of June X1. Cows 20,000 times 50 equals 1,000. Heifers 10,000 times 40 equals 400. That's a total of 1,400. Less impairment losses, brackets 200, which is a total of 1,200. That's actually 1,200,000 because there's the thousands above it, but you get the gist. Note: the herd is impaired because its recoverable amount is 1.2 million. This is the higher of fair value less cost to sell of 1 million. Brackets, the amount that the Lucky Dairy has been offered, end brackets, and valuing use of 1.2 million brackets discounted value of the milk to be produced. Estimated fair value at 31st of May X2 for disclosure only. Cows 20,000 times 60 is 1,200, or it's 1.2 million really. But you get the gist. Heifers 10,000 times 55. 55 equals 550, and it's a total of 1750. Milk. The milk is agricultural produce as defined by IS 41 and should normally be measured at fair value less estimated point of sale costs at the time of milking. In the case of the company, in this case, the company is holding 10 times the amount of inventory that it would normally hold, and that is probable that much of the milk is unfit for consumption. The company should estimate the amount of milk that will not be sold and written down the inventory accordingly. The written down should be disclosed separately in the income statement as required by IAS 1 presentation of financial statements. Government grant. Under IAS 41, the government grant should be recognised as income when it becomes receivable. As it was only on the 6th of June X2 that the company received official confirmation of the amount to be paid, the income should not be recognised in the current year. The amount may be sufficiently material to justify disclosure as non-adjusting event after the balance sheet date. Legal proceedings and additional compensation. The lawyers have indicated that the company will probably be found liable for passing on the disease to customers. There is a present obligation as a result of past obligating events, and therefore the provision of 2 million should be recognised, and the required by IS 37 provisions contingent liabilities and contingent assets. IS 37 states that reimbursement should only be recognised when it is virtually certain to be received. It is only possible that the company will receive compensation for the legal costs, and therefore this cannot be recognised. However, the compensation should be disclosed as a contingent asset in the financial statements. Planned sale of Dale Farms. The Board of Directors has approved the planned closure, but there has not yet been a public announcement. Despite the fact that the local newspaper has published the article on the possible sale, the company has not credited a valid expectation that the sale will take place, and in fact it is not certain that the sale will occur. Therefore, there is no constructive obligation, and under IAS 37, no provision should be made for redundancy or any other costs connected with the planned sale. Under IFRS 5, non-current assets held for sale and discontinued operations, Dale must be treated as a continuing operation for the year ended 31st of May X2, as the sale has not taken place. The management are not yet fully committed to the sale. Neither the operation as a whole nor any of the separate assets of Dale can be classified as held for sale. ACCA Strategic Business Reporting International Mock Exam 1. Time allowed 3 hours 15 minutes. The question paper is divided into 2 sections. Section A, both questions are compulsory and must be attempted. Section B, both are compulsory. Do not open this paper until ready to start under exams conditions. So, Section A, both questions are compulsory and must be attempted. Part A, Joey. A public limited company operates in the media sector. Joey has investments in 2 companies, Margie and Hulti. The draft statements of financial position at 30th of November X4 are as follows. So we've got a statement of financial position, 3 columns, Joey, Margie and Hulti. And so we've got assets, net current assets, property, plant and equipment, investment in subsidiaries, Margie and Hulti, current assets, total assets, equity and liabilities, share capital, retained earnings, other components of equity, total liabilities, total equity and liabilities. The following information is relevant, so there's figures in each of the columns. The following information is relevant to the preparation of the consolidated financial statements. Number 1. On the 1st of December X1, Joey acquired 30% of the ordinary shares of Margie for a cash consideration of 600 million, when the fair value of Margie's identifiable net assets was 1,840 million. Joey has equity accounted for Margie up to the 30th of November X3. Joey's share of Margie's undistributed profits amounted to 90 million, and its share of the revalued gain amounted to 10 million for the period of 1st of December X1 to the 30th of November X3. On the 1st of December X3, Joey acquired a further 40% of the ordinary shares of Margie for a cash consideration of 975 million and granted control of the company. The cash consideration paid has been added to the equity accounted balance for Margie at the 1st of December X3 to give a carrying amount at the 30th of November X4. At the 1st of December X3, the fair value of Margie's identifiable net assets were 2,250 million. At the 1st of December X3, the fair value of the equity interest in Margie held by Joey before the business combination was 2,205 million, and the fair value of the non-controlling interest was 30%, was assessed to be 620 million. The retained earnings and the other comprehensive income of equity Margie at the 1st of December X3 were 900 million and 70 million respectively. In the group policy of measures non-controlling interest at fair value. Number 2, at the time of the business combination with Margie, the 1st of December X3, Joey included in the fair value of Margie's identifiable assets an unrecognised contingent liability with fair value of 6 million in respect of the warranty claim in progress against Margie, considered to have been measured reliably. In March X4, there was a revision of the estimate of liability to 5 million, and the amount has met the criteria to be recognised as a provision in current liabilities and financial statements of Margie, and the revision of the estimation is deemed to be measurement period adjustment. Number 3. Buildings with a carrying amount of 200 million has been included in the fair value of Margie's identifiable net assets of the 1st of December X3. The buildings have a remaining useful life of 20 years at 1st of December X3 and are depreciated on the straight line basis. However, Joey has commissioned an independent valuation of the buildings of Margie, which are not complete at the 1st of December X3 and therefore not considered in the fair value of identifiable net assets at the acquisition date. The valuation received on the 1st of April X4 and resulted in a decrease of 40 million in the fair value of the property, plant and equipment at the date of acquisition. The decrease does not affect the fair value of non-controlling interest at acquisition and has not been entered into the financial statement of Margie. The excess of the fair value of net assets over their carrying amount at 1st of December X3 is due to an increase in the value of non-depreciable land and contingent liability. On the 1st of December X3, Joey acquired 80% of the equity interest of Hulti, a private entity, in exchange for cash of 700 million, gaining control of Hulti from that date because the former owner of Hulti needed to dispose of investment quickly. They did not have sufficient time to market the investment to many potential buyers. The fair value of the identifiable net assets are 960 million. Joey determined that the fair value of the 20% non-controlling interest in Hulti at the date of 250 million. Joey reviewed the procedures used to identify and measure the assets acquired and the liabilities assumed in the measurement of fair value of both non-controlling interest and the consideration transferred. After that review, Hulti determined that the procedures and the resulting measure were appropriate. The retained earnings and other components of equity of Hulti at the 1st of December X3 were 300 million and 40 million respectively. The excess of fair value is due to an unrecognised franchise right, which Joey had granted Hulti on the 1st of December X2 for 5 years. At the time of the acquisition, the franchise right could be sold for its market price. It is group policy to measure the non-controlling interest at fair value. All goodwill arising on acquisition has been impaired tested with no impairment being required. Number 5. From the 30th of November X3, Joey carried a property in its statement of financial position and its revalued amount of 14 million in accordance with IAS 16 plant and equipment. Depreciation is charged at 300 million per year on a straight line basis. In March X4, the management decided to sell the property and it's advertised for sale. On 31st of March X4, the sale was considered to be highly probable and the criteria for IFRS 5 non-current assets held for sale and discontinued operations were met. At that date, the property fair value was 15.4 million and the value in use was 15.8 million. Costs to sell the property were estimated at 300,000. On 30th of November X4, the property was sold for 15.6 million. The transactions regarding the property are deemed to be material and no entries have been made in the financial statements regarding the property since the 30th of November X3, as the cash receipts from the sale were not received until December X4. Required. Explain showing relevant calculations with reference to IFRS 3 business combinations how the goodwill balance in Joey's consolidated financial statements at the 30th of November X4 should be calculated. That was part AI. Part A, Roman numeral II. Explain how the transaction described in Note 5 should be accounted for in Joey's consolidated financial statements at 30th of November X4. And Roman numeral III. Prepare showing required calculations an extract from Joey's consolidated statement of financial position showing the group-related earnings at 30th of November X4. Part B. The Joey Group wishes to expand its operations as part of this expansion. It has granted to employees of Margie and Hulty, some of whom have considered key management personnel, options over its shares at 7th of December X4. The options vest immediately. Joey is not proposing to make the change to subsidiaries for these options. Joey does not know how to account for this transaction. Required. Explain. Oh, this is part B. Explain to Joey how the above transactions should be dealt with and within the subsidiary's financial statements and Joey's consolidated financial statements, and advise on any disclosures that may be required to ensure external stakeholders are aware of the transaction. So that was the long-winded question, and now here is the answer. Section A, Joey. Workbook references. Basic groups of and the principles in IFRS 3 are covered in Chapter 11. Step acquisitions are covered in Chapter 12. IFRS 5 are covered in Chapter 14. Share-based payments are covered in Chapter 10. Top tips. For step acquisitions, it is important to understand the transactions. Here you have an associate becoming a subsidiary. So goodwill calculation for Margie needs to be include the fair value of the previously held investment. Remember to discuss the principle rather than just working through the calculations. The examiner has stated that the candidate will not be able to pass the SBR exam on numerical elements alone. The other goodwill calculation is very straightforward. The only unusual aspect being that the gain on a bargain purchase. Don't skimp on part B. There are 5 marks available. Easy marks. There are some easy marks available for part A. For the standard parts, the calculation of goodwill and required earnings. Marks. Goodwill calculation discussion part A, 1 mark per point, up to a maximum. Part A2. Assets held for sale calculation and discussion, 1 mark per maximum point. And part A3, retained earnings, 4 marks. Part B, subjective assessment of discussion, 1 mark per valid point, 5 marks. Right. Part A1, Roman numeral 1, goodwill. IFRS 3 business combinations require goodwill to be recognised in the business combination. A business combination takes place when one entity, the acquirer, obtains control over another entity, the acquiree. IFRS 3 requires goodwill to be calculated and recorded at the acquisition date. Goodwill is the difference between the consideration transferred by the acquirer and the amount of any non-controlling interest and the fair value of the net assets of the acquiree at the acquisition date. When the business combination is achieved in stages, as is the case for Margie. The previously held interest is interest in the now subsidiary must be remeasured as to its fair value. Applying principles of goodwill on the acquisition of Hulty and Margie should be calculated as follows. So it's got the consideration transferred, non-controlling interest at fair value of previously held equity interest, note 1, less fair value of the assets at acquisition, share capital, retained earnings, other components of equity, fair value adjustments, land, note 2 and working 1, contingent liability, note 3, franchise right, working 1, gain on bargain purchase, note 4, measurement period adjustment, add decrease in fair value of buildings, note 5, contingent liability 6 million minus 5 million, note 3, and goodwill. Notes 1. Margie is a business combination achieved in stages. Here, moving from 30% owned associate to 70% owned subsidiary on the 1st of December X3. Substance over form ditches the accounting treatment. Substance over form dictates the accounting treatment, as in substance an associate has been disposed of and subsidiary has been purchased. From the 1st of December X3, Margie is accounted for as a subsidiary of Joey, and goodwill on acquisition is calculated at this date. IFRS 3 requires that the previously held investment is remeasured to fair value and included in the goodwill calculation as shown above. Any gain or loss on remeasurement to fair value is reported in consolidated profit and loss. Notes Part 2. IFRS 3 requires that net assets acquired to be measured at fair value at the acquisition date. The increase in fair value of Margie's net assets (brackets) that are not a result of specific factors covered in note 3 and 5 below, close brackets, is attributed to non-depreciable land. Note 3. In accordance with IFRS 3, contingent liabilities should be recognised on acquisition of subsidiary where they are present obligation arising as a result of past events and their fair value can be measured reliably, brackets, as is the case for a warranty claims, close brackets, even if their settlement is not probable. Contingent liabilities after initial recognition must be measured at the higher of the amount that would be recognised under IAS 37, provisions, contingent liabilities and contingent assets, and the amount initially recognised under IFRS 3. Note 4. As the goodwill calculation for the acquisition of Hulty's results in a negative value, this is a gain on bargain purchase and should be recorded in the profit and loss for the year attributable to the parent. Before doing so, Joey must review the goodwill calculation to ensure that he's correctly identified all the assets acquired and all the liabilities assumed, along with verifying that it's remeasured of the consideration transferred and the non-controlling interest is appropriate. Joey has completed this exercise and thus it is appropriate to record the negative goodwill and related profit. 5. As a result of the independent property valuation becoming available during the measurement period, the carrying amount of the property, plant and equipment as the 30th of November X4 is decreased by 40 million, less excess depreciation charged at 2 million. 40 million divided by 20 years, i.e. 38 million. This will increase carrying amount of goodwill by 40 million as IFRS 3 allows the retrospective adjustment of provisional figures used in the calculation of goodwill at the acquisition date when new information has become available about the circumstances that existed at the acquisition date. Depreciation expense for X4 is decreased by 2 million. Workings: Hutley fair value adjustment at acquisition, movement and year end. Margie fair value adjustment at acquisition, movement and year end. Part A, number 2. Assets held for sale. At 31st of March X4, the criteria for in IFRS 5, non-current assets held for sale, discontinued operations have been met, and the property should be classified as held for sale. In accordance with IFRS 5, an asset held for sale should be measured at the lower of its carrying amount and fair value less cost to sell. Immediately before classification of the asset, as held for sale, the entity must recognise any impairment in accordance with the applicable IFRS. Any impairment loss is genuinely recognised in profit or loss. The steps are as follows. Step 1. Calculate the carrying amount under applicable IFRS and IAS 16 property, plants and equipment. At 31st of March X4, the date of classification is held for sale. Depreciation to date is calculated 300,000 times 4 divided by 12 equals 100,000. The carry amount are therefore 13.9 million. The journal entries are debit profit and loss, credit property, plants and equipment, PPE. The difference between the carry amount and the fair value at 31st of X4 is material, so the property is revalued and the fair value of 15.4 million under IAS 16 revaluation model. Debit PPE 1.5 million, credit other comprehensive income 1.5 million. I'm just looking at what I've got to do. Right. So step 2, consider whether the property is impaired by comparing its carrying amount, the fair value of 15.4 million, with the recoverable amount. The recoverable amount is the higher of the value in use given as 15.8 million and the fair value less the cost to sell. The property is not impaired because the recoverable amount, i.e. value in use, is higher than the carrying amount, fair value. No impairment loss is recognised. Step 3. Classify as held for sale and cease depreciation under IFRS 5. Compared in the carrying amount, 15.4 million, the fair value less cost to sell. Measure at the lower of carrying amount and fair value less cost to sell, giving an initial write-down of 300 million. Debit profit and loss, credit PPE, property, plant and equipment. Step 4. On 30th of November X4, the property is sold for 15.6 million, which after deducting costs to sell, 0.3 million, gives a profit of 0.2 million. Debit receivables, credit PPE, credit profit and loss. Retained earnings, part A, Roman numeral 3. Joey Group, consolidated statement of financial position at the 30th of November X4, extract. Retained earnings, working 1. Working 1 group retained earnings. So then there's a column with Joey, Hulty and Margie. At the year end, fair value adjustment, depreciation reduction, part A. Fair value adjustment, franchise amortisation, liability adjustment, gains on bargain purchase, profit on derecognition of associate, assets held for sale at acquisition, group share, Hulty and Margie. The warranty claimed provision of 5 million in Margie's financial statements must be reversed on consolidation to avoid double counting. This is because the contingent liability for the warranty claim was recognised in the consolidated financial statements of acquisition of Margie. Working 2, profit on derecognition of 30% associate, fair value of previously held equity interest to at date control obtained per question, carrying amount of associate 600 cost plus 90 equals a profit of 5. Part B, share-based payment. This arrangement will be governed by IFRS 2, share-based payment, which includes within its scope transferring of equity instruments of an entity's parent in return for goods or services. Clear guidance is given in the standard as to when to treat group share-based payment transactions as equity settled and when to treat them as cash settled. To determine the accounting treatment, the group entity receives the goods and services must consider its own rights and obligations as well as awards granted. The amounts recognised by the group entity receiving the goods and services will not necessarily be consistent with the amounts recognised in the consolidated financial statements. Group share-based payment transactions must be treated as equity settled if either of the following apply. 1. The equity grant rights to have its own equity instruments. 2. The entity grants rights to have its own equity instruments. 2. The entity has no obligation to settle the share-based payment transaction. Treatment in consolidated financial statements. Because the group receives all the services in consideration for the group's entity instruments. Because the group receives all of the services in consideration for the group's equity instruments, the transaction is treated as equity settled. The fair value of the share-based payment at the grant date is charged to profit or loss over the vesting period with the corresponding credit to equity. In this case, the options vest immediately on the grant date, and the employees not being required to complete the specific period of service, and the service therefore being presumed to have been received, the fair value will be taken by reference to the market value of the shares, because it is deemed not normally possible to measure directly the fair value at the employee's service received. Treatment in subsidiaries' financial statements. The subsidiaries do not have obligation to settle the awards, so the grant is treated as an equity settled transaction. The fair value of the share-based payment of the grant date is charged to profit and loss of the vested period with the corresponding credit to equity. The parent, Joey, is compensating the employees of the subsidiary, Margie and Hulty, with no expense to the subsidiaries, and therefore a credit in equity is treated as capital contribution. Because the shares vest immediately, the expense recognised in Margie and Hulty's statement of profit and loss will be full cost of the fair value at grant date. IAS 24 disclosures. Some of the employees are considered key management personnel, and therefore IAS 24 related party disclosures should be applied. IAS 24 requires disclosures of the related parties, the transactions, and any outstanding balances of the year end date. Such disclosures are required in order to provide sufficient information to the user of the financial statements about the potential impact of related party transactions on an entity's profit or loss and financial position. IAS 24 requires that the entity discloses key management personnel compensation in total for several categories, of which the share-based payment is one. IFRS Practice Statement 2 makes materiality judgment, confirms that disclosures required in IFRS need only to be made in the information provided by the disclosure is material. If the information provided by the disclosure is material. Some related party transactions may be assessed as immaterial and therefore not disclosed. That said, the remuneration of key management personnel is of great interest to the investors, and it's not difficult to see how it could be considered material. Immaterial. Okay, part C to the question, Joey. Okay, this is an extra part C section. Here we go. Joey took out foreign currency loan of 5 million dinars at a fixed interest rate of 8% on the 1st of December 2000x3. The interest is paid at the end of the year. The loan will be repaid after 2 years on 30th November x5. The interest rate is the current market rate for similar 2-year fixed interest loans. Joey is unsure how to account for the loan and related interest. The average currency exchange rate for the year is not materially different from the actual rate. Exchange rates, and then there's 1st of December x3, 30th of November x4. Average exchange rate for the year ended 30th of November x4. So in dinars, 1st of December x3 is 5 dinars, 30th of November x4 is 6, and average exchange rate for the year ended 30th of November is 5.6. Required. Explain to Joey how to account for the loan and interest in the financial statements for the year ended 30th of November x4. So that's the question, part C, and here is the answer. When I turn to it in a second. Part C. Okay, here we go. Foreign currency loan. On the 1st of December x3, on initial recognition, brackets at the 1st of December x3, the loan is measured at the transactional price translated into functional currency, brackets the dollar, because the interest is at the market value for the similar 2-year loan. The loan is translated at the rate ruling on 1st December x3. Debit cash 5 million divided by 5, 1 million. And credit financial liability brackets loan payable, credit 1 million, being recognition of loan. Year ended 30th of November X4. Because there are no transaction costs, the effective rate is 8% interest on the loan. The effective interest rate is 8%. Interest on the loan is translated at the average rate because this is an approximation for the actual rate. Debit profit and loss brackets finance cost 5 million times 8% divided by 5.6 equals 71,429. Credit the financial liability brackets loan payable 71,429. Being recognition of financial costs for the year ended 30th of November X4. On 30th of November X4, the interest is paid and the following entry is made using the rate on the date of payment of $1 to 6 dinars. Debit financial liability loan payable 5 million times 8% divided by 6 equals 66,667. Credit cash 66,667, being recognition of interest payable for the year ended 30th of November X4. In addition, as a momentary item, in addition, as a monetary item, the loan balance at the year end is translated at the spot rate at the year end. 5 dinars divided by 6 equals 833,333. This gives rise to the exchange gain of 1 million minus 833,333 equals 166,667. The exchange gain on the interest paid of 71,429 minus 66,667 equals 4762 is added to the exchange gain on retranslation of the loan of 166,667. This gives a total exchange gain of 4762 plus 166,667 equals 171,429. Okay, SBR Kit Mock 1, Part A, Question 2. Ramsbury. The directors of Ramsbury, a public limited company which manufactures industrial cleaning products, are preparing the consolidated financial statements for the year ended 30th of June X7. In your capacity as advisor to the company, you become aware of the following issues. In the draft consolidated statements of financial position, the directors have included in cash and cash equivalents a loan provided to the directors of $1 million. The loan has no specific repayment date on it, but is repayable on demand. The directors feel that there is no problem with the presentation, as International Financial Reporting Standards, IFRS, allow companies to make accounting policy choices, and that showing the loan as a cash equivalent is the choice of accounting policy. On the 1st of July X6, there was an amendment to Ramsbury's defined benefit pension scheme, whereby the promised pension entitlement was increased from 10% of final salary to 15%. A bonus is paid to the directors each year, which is based upon the operating profit margin. The operating profit margin of Ramsbury. The directors of Ramsbury are unhappy that there is an inconsistency on the presentation of gains and losses in the relation to the pension scheme within the consolidated financial statements. Additionally, they believe that as a pension scheme is not an integral part of the operating activities of Ramsbury, it is misleading to include the gains and losses in profit and loss. They therefore propose to change their accounting policy so that the gains and losses on the pension scheme are recognised in other comprehensive income. They believe that this will make the financial statements more consistent, more understandable, and can be justified on the grounds of fair presentation. Ramsbury pension scheme is currently in deficit. Required. Discuss the ethical and accounting implications of the above situation with reference, where appropriate, to international financial reporting standards. 18 marks. Professional marks will be awarded in the question for the application of ethical principles. 2 marks. Total question, 20 marks. So that's the question. Here's the answer. Workbook reference: the conceptual framework is covered in Chapter 1 and ethics is covered in Chapter 2. Employee benefits are covered in Chapter 5. Top tips: as with all questions, ensure that you apply knowledge to the scenario, provided that your answer is in context. It is not enough simply to discuss the accounting requirement. You must draw out the ethical issues. Where relevant, you should identify any threats to the fundamental principles in ACCA's Code of Ethics and Conduct. So market scheme, accounting issues, 1 mark per point. Ethical issues, 1 mark per point. So 9, and 2 professional marks. Treatment of loan to director. The directors have included the loan made to the director as part of the cash and cash equivalents balance. It may be that the directors have misunderstood the definition of cash and cash equivalents, believing that the loan to be a cash equivalent. IAS 7 Statement of Cash Flows defines cash equivalents as short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insufficient risk of changes in value. However, the loan is not in place to enable Ramsbury to manage the short-term cash commitments. It has no fixed repayment date, and the likelihood of the director defaulting is not known. The classification as a cash equivalent is therefore inappropriate. It is likely that the loan should be treated as a financial asset under IFRS 9 financial instruments. Further information would be needed. For example, is the $1 million the fair value? A case could even be made that since the loan may never be repaid, it is in fact part of the director's remuneration, and if so, should be treated as an expense and disclosed accordingly. In addition, since the director is likely to fall into the category of key management personnel, related party disclosures under IAS 24 related party disclosures are likely to be necessary. The treatment of the loan as a cash equivalent is in breach of 2 fundamental qualitative characteristics prescribed in the IASB's conceptual framework for financial reporting, namely Roman numeral 1, relevance. The information should be disclosed separately as it is relevant to the user, or as to relevant to users. Roman numeral 2, faithful representation. Information must be complete, neutral, and free from error. Clearly, this is not the case if the loan to the director is shown in cash. The treatment is also in breach of the conceptual framework key enhancing qualitative characteristics. Roman numeral 1, understandability. If the loan is shown in cash, it hides the true nature of the practices of the company, making the financial statements less understandable to users. Number 2, verifiability. Verifiability helps assure users that information faithfully represents the economic phenomena it purports to represent. It means that different knowledgeable and independent observers could reach consensus that a particular depiction is a faithful representation. The treatment does not meet the benchmark, as it reflects the subjective bias of the directors. Turn the page. Roman numeral 3, comparability. For financial statements to be comparable year on year and with other companies, transactions must be correctly classified, which is not the case here. If the cash balance one year includes a loan to a director and next year it does not, then you are not comparing like with like. In some countries, loans to directors are illegal, with directors being personally liable. Even if it is not the case, there is a potential conflict of interest between that of the director and that of the company, which is why separate disclosures is required as a minimum. Directors are responsible for the financial statements required by statute, and thus it is their responsibility to put right any errors. That means that mean that the financial statements do not comply with IFRS, there is generally a legal requirement to maintain proper accounting records, and recording a loan as cash conflicts with this requirement. In obscuring the nature of the transaction, it is possible that the directors are motivated by personal interest and are thus failing in their duty to act honestly and ethically. There is potentially a self-interest threat in the fundamental principles of the ACCA Code of Ethics and Conduct. If one transaction is misleading, it casts doubt on the credibility of the financial statements as a whole. In conclusion, the treatment is problematic and should be rectified. Heading: Ethical implications of change of accounting policy. IAS 8 accounting policies, changes in accounting estimates and errors, only permits a change in accounting policy if the change is Roman numeral 1, required by IFRS, or Roman numeral 2, results in the financial statements provided reliable and more relevant information about the effective transactions, other events or conditions on the entity's financial position, financial performance, or cash flow. A representative adjustment is required unless the change arises from the new accounting policy, with transitional arrangements to account for the change. It is possible to depart from the requirements of IFRS, but only in the extremely rare circumstances where compliance would be so misleading that it would conflict with the overall objectives of the financial statements. Practically, this override is rarely, if ever, invoked. IAS 19 employee benefits requires all gains and losses on the defined benefit pension scheme to be recognised in profit and loss, except for the remeasurement component relating to the assets and the liabilities of the plan, which must be recognised in other comprehensive income. So current service costs, past service costs, and net interest costs on a net defined benefit liability must all be recognised in profit and loss. There is no alternative treatment available to the directors, which under IAS 8, a change in accounting policy might be applied to Ramsbury 2, applied to move Ramsbury 2. A change in accounting policy might be applied to move Ramsbury 2. That's TO, not TOO. The directors' proposals cannot be justified on the grounds of fair presentation. The directors have an ethical responsibility to prepare financial statements which are true representation of the entity's performance and comply with all accounting standards. There is a clear self-interest threat arising from the bonus scheme. The directors' change in policy appears to be motivated by an intention to overstate operating profit to maximise their bonus potential. The amendment to the pension scheme is a past service cost which must be expensed to the profit or loss during the period the plan amendment has occurred, i.e. immediately. This would therefore be determined to the operating profits of Ramsbury and depress any potential bonus. Additionally, it appears that the directors will wish to manipulate other aspects of the pension scheme, such as the current service cost, and since the scheme is in deficit, the net finance cost. The directors are deliberately manipulating the presentation of these items by recording them in equity rather than in profit and loss. The financial statements would be compliant with IFRS. The financial statements would not be compliant with IFRS, would not give a reliable picture of the true costs of the company to the company of operating a pension scheme, and this treatment would make the financial statements less comparable with other entities correctly applying IAS 19. Such treatment is against ACCA's Code of Ethics and Conduct, fundamental principles of objectivity, integrity, and professional behaviour. The directors should be reminded of their ethical responsibility and must be dissuaded from implementing the proper change in policy. The director should be encouraged to utilise other tools within the financial statements to explain the company's results, such as drawing users' attention towards the cash flow, where the cash generated from operations measure will exclude the non-cash pension expense and if necessary, alternative performance measures such as EBITDA could be disclosed, where non-cash items may be consistently stripped out for the comparison purposes. Mock exam 1, section B, question 3, Clancet. Workbook reference. Segment reporting is covered in Chapter 18, Intangible Assets. Covered in Chapter 4, Financial Instruments are covered in Chapter 8, IFRS Practice Statement 2, Making Materiality Judgments is covered in Chapter 20. Top tips. In Part A1, on segment reporting, the key was to argue that the second laboratory met the definition of an operating segment, whilst the first one did not. In Part A2, you should consider why segmental information is used to investors. Why would they want this information? What makes this information particularly useful to investors? Part A3 requires awareness of current issues in financial reporting. In this case, IFRS Practice Statement 2, Making Materiality Judgments. It is crucial that if you read widely while studying SBR, as questions on current issues will definitely feature in your exam. In Part B, the key issue was whether the costs could be capitalised as development expenditure, which was the case for the latter but not the former. Easy marks. They are available for discussing the principles and quantitative thresholds of IFRS 8 in Part A. Marking scheme. Requirements of IFRS 8, 1 mark per point. Usefulness of IFRS 8 and materiality. Notes for presentation, Part B, total 25 marks. So, Part A, segmental. Oh, hang on. let's read the question first. That'd help, wouldn't it? So section B, both questions must be answered. So question 3, Clancet. Clancet is a public limited company operating in the pharmaceutical sector. The company is seeking advice on several financial reporting issues. Part A. Clancet produces and sells its range of drugs through these separate divisions. In addition, it has 2 laboratories which carry out research and development activities. In the first laboratory, the research and development activity is funded initially and centrally for each of the 3 divisions. It does not carry out research and development activities for other entities. Each of these 3 divisions is given a budget allocation which is used to purchase research and development activities from laboratory. The laboratory is directly accountable to the division heads for this expenditure. The second laboratory performs contract investments activities for other laboratories and pharmaceutical companies. The laboratory earns 75% of its revenue from external customers, and these external revenues present 18% of the organisation's total revenue. The performance of the second laboratory's activities and of these 3 separate divisions is regularly reviewed by the Chief Operating Decision Maker, CODM. In addition to the heads of the divisions, there is a head of the second laboratory. The head of the second laboratory is directly accountable to the CODM, the Chief Operating Decision Maker, and they discuss the operating activities, allocating of resources and financial results of the laboratory. The Managing Director does not think IFRS 8 provides information that is useful to investors. He feels that it just adds more pages to financial statements that are already very lengthy. The Financial Director particularly agrees with the Managing Director and believes that the IASB's practice statement on materiality confirms this opinion. that not all of the disclosure requirements in IFRS 8 are necessary. Required. Advise the Managing Director with reference to IFRS 8 operating segments whether the research and development laboratories should be reported as two separate segments. Part Roman numeral 2, that's Roman numeral 1. Roman numeral 2. Discuss the Managing Director's view of IFRS 8 does not provide useful information to investors. Roman numeral 3. Discuss whether the Finance Director is correct in his opinion about IFRS 8, identifying any ethical concerns you may have. You should briefly refer to Practice Statement 2, making materiality judgments in your answer. Part B. Clancet is collaborating with Reto, a third party, to develop two existing drugs owned by Clancet. Project 1. In the case of the first drug, Reto is simply developing a drug for Clancet without taking any risks during the development phase, and will have no further involvement in regulatory approval if regulatory approval is given. Regulatory approval has been refused for this drug in the past. Clancet will retain ownership of patient rights attached to the drug. Reto is not involved in the marketing and production of the drug. Clancet has agreed to make non-refundable payments to Reto of $4 million in the signing of the agreement and $6 million on the successful completion of the development. Clancet and Reto have entered into a second collaboration agreement in which Clancet will pay Reto for developing and manufacturing an existing drug. The existing drug already has regulatory approval. The new drug being developed by Reto for Clancet will not differ substantially from the existing drug. Clancet will have exclusive marketing rights to the drug if the regulatory authorities approve it. Historically, in this jurisdiction, new drugs receive approval if they do not differ substantially from the existing approved drug. The contract terms required Clancet to pay an upfront payment on signing of the contract, a payment on the securing financial regulatory approval, and the unit payment of $10 per unit, which equals the estimated cost plus profit margin. Once commercial production begins, the cost-profit margin is consistent with Clancet's other recently negotiated supply arrangement for similar drugs. Required. Prepare notes for the presentation of the managing director of Clancet as to how to account for the above contract with Reto in accordance with the IFRSs. Professional marks will be awarded in Part A for clarity and quality of presentation. Right, so that's Clancet, the question, number 3. And here comes the answer. Part A, Roman numeral 1, segment reporting. IFRS 8 operating segments states that an operating segment is a component of an entity which engages in business activities from which it may earn revenues and incur costs. In addition, discrete financial information should be available for the segment of these, and these results should be regularly reviewed by the entity's chief operating decision maker, CODM, when making decisions about resource allocation to a segment and assessing its performance. Other factors should be taken into account, including the nature of the business activities of each component, the existence of management's responsibilities for them, and information presented to the board of directors. According to IFRS 8, an operating segment is one which meets any of the following qualitative thresholds. Roman numeral 1. Its reporting revenue is 10% or more of the combined revenue of all the operating segments. Roman numeral 2. The absolute amount of the reporting profit and loss is 10% or more of the greater in absolute amount of, number 1, the combined reporting profit of the operating segment which did not report a loss, or number 2, the combined reporting loss of an operating segment which reported a loss. Roman numeral 3. Its assets are 10% or more of the combined assets of all the operating segments. As a result of the application of the above criteria, the first laboratory will not be reported as a separate operating segment. The divisions have heads directly accountable to and maintaining regular contact with the CODM to discuss all aspects of the others of their division's performance. The divisions seem to be consistent with the core principle of IFRS 8 and should be reported as separate segments. The laboratory does not have a separate segment manager, and the existence of a segment manager is normally an important factor in determining operating segments. Instead, the laboratory is responsible to the divisions themselves, which would seem to indicate that it is simply supporting the existing divisions and not a separate segment. Additionally, there does not seem to be any discrete performance information for the segment, which is reviewed by the CODM. The second laboratory should be reported as the separate segment. It meets the qualitative threshold for percentage of total revenue, and it meets the criteria for an operating segment. It engages in activities which earn revenues and incur costs. Its operating results are reviewed by CODM, and discrete information is available for the laboratory's activities. Finally, it has a separate segment manager. Roman numeral 2. And that's part 2 of the question. Contrary to the managing director's views, IFRS 8 provides information that makes the financial statement more relevant and more useful to investors. IFRS financial statements are highly aggregated and may prevent investors from understanding the many different business areas and activities that an entity is engaged in. IFRS 8 requires information to be disclosed that is not readily available elsewhere in the financial statements. Therefore, it provides additional information which aids the investor's understanding of how the business operates and it's managed. IFRS 8 uses a management approach to report information on the entity's segments and results from the point of view of the decision maker of the entity. This allows investors to examine an entity through the eyes of the management to see the business in a way in which the managers who run the business on behalf see it. This provides investors with more discrete information on the business segment, allowing them to better assess the return being earned from those business segments, the risks that are associated with those segments, and how the risks are managed. The more detailed information provides investors with more insight into an entity's longer-term performance. The requirements to disclose information that is actually used in internal decision making is an important feature of IFRS 8, but it is also one of the main criticisms. The fact that the reporting does not need to be based on IFRS makes it difficult to make comparisons with the information that was reported in prior periods and with the company in the sector. The flexibility in reporting can make it easier to manipulate what is reported. IFRS 8 disclosures are often most useful if used in conjunction with the narratives disclosure prepared by the director of the company, and such as the strategic review in the UK. Roman numeral 3. The finance director's opinion that not all the disclosures in IFRS 8 is necessary could be interpreted to mean that he believes that he could pick and choose which disclosures he feels are necessary and which he believes are not. This is not correct. IAS 1 presentation of financial statements requires all standards to be applied in fair presentation to be achieved. Directors cannot choose which parts of the standard they do not want to apply. However, as confirmed by Practice Statement 2, if the information provided by the disclosure is immaterial and therefore cannot reasonably be expected to influence the decision of the primary user of the financial statement, then that disclosure does not need to be made. If the finance director is suggesting that the information provided about Clanset by some of the disclosure requirements of IFRS 8 are not material, then assuming that the information is indeed immaterial, he would be correct in stating that the disclosures are not necessary. The directors should apply the principle given in Practice Statement 2 to review how they have made materiality judgments in their financial reporting. It may be that their current financial report is very lengthy because they include information that is not material. Both directors appear reluctant to give disclosures required by IFRS 8. This raises concern. If the finance director is not aware that he cannot pick and choose which requirements the IFRS is, then his professional competence may be called into question. If he is aware of this and the assessment of whether disclosures and material has not been done and has not been done inappropriately, then it may be that the directors are trying to hide an issue. This should be considered in more detail. Part B, development of drugs. Notes for presentation to the managing director. Number 1, criteria for recognising as an asset. IAS 38 intangible assets requires an entity to recognise an intangible asset, whether purchased or self-created at cost, if and only if it is probable that the future economic benefits which are attributable to the asset will flow to the entity and the cost of the asset can be measured reliably. Number 2, internally generated intangible assets. The recognition required of IFRS 38 applies to whether an intangible asset is acquired externally or generated internally. IAS 38 includes additional recognition criteria for internally generated intangible assets. Development costs are capitalised only after technical and commercial feasibility of the asset for sale or use has been established. This means that an entity must intend and be able to complete the intangible asset and either use it to sell it and be able to demonstrate how an asset will generate future economic benefit in keeping with the recognition criteria. If an entity cannot distinguish the research phase from the development phase of an internal project to create an intangible asset, the entity treats the expenditure from the project as if it were incurred in the research phase only. The price which an entity pays to acquire an intangible asset reflects its expectations about the probability that the expected future economic benefits in the asset will flow to the entity. Number 3, Project 1. Clancet owns the potential new drug and Reto is carrying out the development of the drug on its behalf. The risks and rewards of ownership remain with Clancet. By paying the initial fee and the subsequent payment to Reto, Clancet does not acquire a separate intangible asset. The payment represents research and development by a third party, which needs to be expensed over the development period, provided that the recognition criteria for internally generated tangible assets has been met. Development costs are capitalised only after technical and commercial feasibility of the asset for sale or use have been established. This means that the entity must intend and be able to complete the intangible asset and either use it to sell it or be able to demonstrate how the asset will be generated until generate future economic benefits. At present, this criterion does not appear to have been met, and the regulatory authority for the use of the drug has not been given, and in fact approval has been refused in the past. Number 4, Project 2. In the case of the second project, the drug has already been discovered and therefore the cost for which the development and manufacture of the drug and its slight modification. There is no indication that the agreed prices for the various elements are not at fair value. In particular, the terms for product supply at cost plus profit are consistent with Clancet's other supply agreements. Therefore, Clancet should capitalise the upfront costs of the drug and subsequent payments as incurred and consider impairment at each financial reporting date. Regulatory approval has already been attained for the existing drug, and therefore there is no reason to expect that this will not be given for the new drug. Amortization should begin once regulatory approval has been obtained. Costs for the products have been accounted for in the inventory using IAS 2 inventories and then expensed as costs of goods sold as incurred. That's the end of that question. Mock exam 1, question part B, section B, part 4, JH or JH? JAC, we'll call it for the purposes of this. JAC, a public limited company, carries an asset that is traded in different markets. The asset has to be valued at fair value under international financial reporting standards. JAC currently only buys and sells the asset in the Australasian market. The data relating to the assets are set out below. Year to the 30th of November, X2. Volume in units per price. Cost of entering the market, transaction costs. In the Asia market, 4 million. And then in the European market 2 million, and in the Australasian market 1 million, and then different dollar prices. Additional, JAC and had acquired an entity at the 30th of November X2 and is required to fair value a decommissioning liability. The entity has to commission a mine at the end of the useful life, which is in 3 years' time. JAC has determined that it will be use a valuation technique to measure the fair value of the liability. If JAC were allowed to transfer the liability to another market participant, then the following data would be used. Input, 2 columns, input and amount. Input, labour and materials cost 2 million, overheads 30% of the labour and materials costs, annual inflation rate 5%, risk assessment uncertainty relating to cash flow 6%, risk-free rate of government bonds 4%, entity non-performance risk 2%. Required, discuss the relevant computations how JAC should measure the fair value of the above asset and liability under IFRS 13. JAC has recently employed a new managing director. The managing director has convinced the board that an investment in a new cryptocurrency, iCoin, would generate an excellent capital gain. Consequently, JAC purchased 50 units of the iCoin for 250 grand on 250,000 on the 20th of December X1. The finance director has expressed concern about how to report his investment in JAC 31st December X1 financial statement, given the lack of an accounting standard for such investment. He sees no alternative but to include it as a cash equivalent. As the amount invested is less than the quantitative threshold JAC has used to assess materiality, he's not planning to provide any further information about the investment in the financial statements. Required, Roman numeral 1. In the absence of a specific accounting standard on cryptocurrency, discuss how JAC could determine how to account for an investment in iCoin under IFRS. 4 marks. Point Roman numeral 2. Discuss the finance director's decision not to provide any further disclosure about the investment in the financial statements, making reference to the IFRS practice statement 2, marketing materiality judgments. The directors of JAC have received an email from its majority shareholder. Part C. That was Part C. The directors of JAC have received an email from its majority shareholder. To the director of JAC from a shareholder, measurement. I have recently seen an article in the financial press discussing the mixed measurement approach that is used by lots of companies. I hope this isn't the case at JAC, because mixed seems to imply inconsistent. Surely it would be better to measure everything in the same way. I would appreciate it if you would provide further information at the next annual general meeting on measurement basis. covering what approach is taken at JAC and why, and the potential effect on investors trying to analyse the financial statements. Required, prepare notes for the directors of JAC which discuss the issues raised in the shareholders' email. You should refer to the conceptual framework where appropriate in your answers. So let's go through to the answer. I wish we can read it. Right, JAC. Answer number 4. Workbook references. Fair value measurement under IFRS 13 is covered in Chapter 4. The conceptual framework is covered in Chapter 1. IS 2 in Chapter 2 and Practice Statement 2 in Chapter 20. Top tips. Fair value measurement affects any aspect of financial reporting. Part A requires the application of IFRS 13 to valuation of assets and liabilities. Ensure that you provide explanations to support your workings. Part B. Look at the investment in cryptocurrency for which there is no specific accounting standard. Don't panic if you see such a question in your exam. Sensible points which applies the principle of IAS 8 and the conceptual framework will gain marks. Part C, consider the topic of measurement from a wider perspective. Make sure that you relate your answer to the email given in the question. Remember that the examiner has recommended that you read widely, including technical articles and real finance reports to support your learning. Easy marks. Credit will be given for textbook knowledge in Part A. The marking, 1 mark per point, 1 mark per point, up to a maximum of 4 marks. Yeah, right. Fair value of the asset. So we've got 3 pages of this. So Part A, fair value of the asset. Year to the 30th of November X2, and there's a table here. Volume of market units. Asian market, European market, and Australasian market. Price, cost of entering the market, potential fair value, transaction cost, and net profit. And then there's figures in each. Note, because JAC currently buys and sells the assets in the Australasian market, the cost of entering that market are not incurred and therefore not relevant. Number 2, fair value is not adjusted for transaction costs. Under IFRS 13, these are not a feature of the asset or liability, but may be taken into account when determining the most advantageous market. Number 3, the Asian market is the principal market for the asset because it is the market with the greatest volume of level of activity for the assets. If information about the Asian market is available and JAC can assess the market, then JAC should base its fair value on this market. Based on the Asian market, the fair value of the asset would be $17 measured at the price that would be received in the market, $19 less the cost of entering the market, $2 and ignoring transaction costs. Number 4, if information about the Asian market is not available, or if JAC cannot access the market, JAC must measure the fair value of the asset using the price in the most advantageous way, in the most advantageous market. The most advantageous market is the market that maximises the amount that would be received to sell the asset, after taking into account both transaction costs and usually also costs of the entity, which is the net asset that would be received in the respective markets. The most advantageous market here is therefore the Australasian market. As explained above, costs of the entity are not relevant here, and so based on the market, the fair value would be $22. It is assumed that the market participants are independent of each other and knowledgeable and able and willing to enter into transactions. Fair value of decommissioning liability. Because this is a business combination, JAC must measure the liability at the fair value in accordance with IFRS 13. Rather than using the best estimate measure required at IAS 37, provision of contingent liabilities and contingent assets. In most cases, there will be no observable market to provide pricing information. If this is the case, here, JAC will use the expected present value technique to measure the fair value of the decommissioning liability. If JAC were contractually committed to the transfer in decommissioning liability at the market participant, it would conclude that the market participant would use the inputs as follows, arriving at the fair value of 32,215,000. Input: labour and materials cost 2,000. Overheads. Labour and materials cost. Overheads 30% times 2,000. Third party makeup industry average 2,600 times 20%. That's 2,000 plus 600 plus 520 equals 3,120. Inflation adjusted total 5% compounded over 3 years. 3,120 times 1.05 to the power of 3. Risk adjustment uncertainty relating to cash flows 3,612 times 6%. Discount at the risk-free rate plus entity's non-performance risk 4% plus 2% equals 6. Part B, Roman numeral 1. It isn't appropriate for JAC to classify the investment in cash equivalent purely because it is unsure of how else to account for it. If the absence of the IFRS covering investment in cryptocurrencies, the director of JAS should use judgment to develop an appropriate accounting policy. In developing the policy, IAS 8, Accounting Policies, Accounting Estimates and Errors, requires that the directors consider 1. IFRS is dealing with similar issues. For example, the specific fact and circumstances could lead JAS to conclude that the investment is an intangible asset accounted for under IAS 38 intangible assets. 2. The conceptual framework. The investment appears to meet the definition of an asset at present economic resource controlled by an entity as a result of a past event. Consideration should be given to the recognition criteria and the other issues such as the measurement basis to apply and how measurement uncertainty may affect the choice given the volatility of cryptocurrencies. Number 3. The most recent pronouncement of their original gap based on similar conceptual framework and accounting industry practice. This is sparse. The Australian Accounting Standards Board have concluded that standard setting activity on cryptocurrency should be undertaken by the IASB. Fundamentally, the directors need to account for the investment in a way that provides useful information to the primary users of its financial statements. This means the information provided by the accounting treatment should be relevant and should faithfully represent the investment. Roman numeral 2. This part B. This is the second part of part B. The finance director's decision is not provide. To not provide the finance the finance director's decision to not provide any further disclosure about the investment in iCoin is questionable. The objective of JAC's financial report is to provide financial information which is useful to its primary users in making decisions about providing resources to JAC. Practice Statement 2 reaffirms the principle of IFRS that information that is not material does not need to be disclosed in the financial statements. However, whether this information is material should be properly assessed. Practice Statement 2 recommends that assessment of materiality should be performed with reference to both quantitative factors and qualitative factors. So far, the finance director has only considered quantitative factors, but qualitative factors should be considered. For example, the fact that the investment not the usual type of investment made by JAC is qualitative factor. The presence of a quantitative factor lowers the qualitative factor threshold below what would otherwise be used. So in this case, the investment could be material. Furthermore, the investment is risky because cryptocurrencies are highly volatile. If it is JAS's plan to invest in more cryptocurrencies in the future and even to accept cryptocurrencies as payment, then the investors are likely to consider this important. Depending on their risk appetite, investors may consider the investment too risky and therefore inappropriate and may be concerned about the potential future impact should JAS decide to invest more in such currencies. Part of the decision making that primary users make on the basis of financial statements involves assessing management's stewardship of JAS's resources. Some investors may consider that this is not good stewardship given the risk involved. Part C. A mixed measurement. approach means that the company selects a different measure basis, e.g. historical cost and current value, for its various assets and liabilities. Rather than using a single measurement basis for all items, the measurement basis selected should reflect the type of entity and sector in which they operate and the business model that the entity adopts. Some investors have criticised the mixed measure approach because they think that if the different measures bases are used for assets and liabilities, the resulting totals can have little meaning or lack relevance. However, a single measurement basis may not provide the most relevant information for users. A particular measure basis may be easier to understand, more verifiable and less costly to implement. Therefore, a mixed measurement approach is not inconsistent, but can actually prove more relevant information for stakeholders. The conceptual framework confirms that the IASB uses a mixed measurement approach in developing standards. The measurement method includes the standards that are those which the IASB believes provide the most relevant information and which most faithfully represent the underlying transactions in the event. It seems that most investors feel that this approach is consistent with how they analyse financial statements. The problem of mixed measurement appears to be outweighed by the greater relevance achieved. JAC prepares its financial statements under IFRSs and therefore applies the measurement basis permitted in IFRSs. IFRS adopts a mixed measurement basis which includes current value, fair value, value in use, fulfillment value, and current cost and historical cost. When an IFRS allows a choice of measurement basis, the directors of JAC must exercise judgment as to which basis will provide the most useful information for the primary users. Furthermore, when selecting a measurement basis, the directors should consider measurement uncertainty. The conceptual framework states that for some estimates, a higher level of measurement uncertainty may outweigh other factors, to which the extent that the resulting information may have little use. I think that's the end of that. Right. ACCA Mock Exam 2, Strategic Business Reporting. Section A. Both questions must be answered or attempted. Cutchin. The following group financial statements relate to Cutchin Group, which comprised Cutchin, House and Mac, all public limited companies. Group statement of financial position at 31st of December X6. Assets. Non-current assets. Property, plant and equipment 365 million. Goodwill nothing. Intangible assets 23. Total of 388. Current assets 133. Total assets is 521. Equity and liability, share capital at $1 each. Retained earnings, other components of equity, non-controlling interest, non-current liabilities, current liabilities, trade payables, total liabilities, total equity and liabilities. At the time of the internal review of the group financial statements, the following issues were discovered. Number 1. On the 1st of June X6, Cutchin acquired 70% of the equity interest of House. The purchase consideration comprised 20 million shares of $1 of Cutchin at the acquisition date and a further 5 million shares 31st of December X7 if House profits for the year were at least 4 million for the year ending at that date. The market price of Cutchin shares on the 1st of June X6 was $2 per share, and that of House shares was $4.20 per share. It is felt that there is 20% chance of the profit target being met. In accordance with the acquisition of House, the finance director did not take into account the non-controlling interest in the goodwill calculation. He determined that the bargain purchase of 8 million arose on the acquisition of House, being the purchase consideration of 40 million less the fair value of the identifiable net assets of House acquired on the 1st of June X6 of 48 million. This valuation was included in the group financial statements above. After the directors of Cutchin discovered the error, they decided to measure the NCI at fair value at the date of acquisition. The fair value of NCI in House has based upon the quoted market price of acquisition. House had issued share capital of $1 each, totaling 30 million at the 1st of June X6, and there has been no change in this amount since acquisition. On the 1st of January X6, Cutchin acquired 80% of the equity interests of MAC, or Match, a privately owned entity, for a consideration of 57 million. The consideration comprises of cash at 52 million and the transfer of non-depreciable land with a fair value of 5 million. The carrying amount of the land at the acquisition date was 3 million, and the land was only recently being transferred to the seller of the shares in MAC and is still carried at 3 million in the group financial statement at 31st of December X6. At the date of acquisition, the identifiable net assets of MAC had a fair value of 55 million. MAC had made a profit for the year attributable to ordinary shareholders of 3.6 million for the year to 31st of December X5. The directors of Cutchin wished to measure the non-controlling interest at fair value at the date of acquisition, but had again omitted NCI from the goodwill calculation. The NCI is to be measured at the fair value using the public entity market multiple method. The directors of Cutchin measured at fair value using public entity market multiple method. The directors of Cutchin has identified two companies who are comparable to MAC and have traded at the average price of earnings ratio, PE ratio of 21. The directors have adjusted the PE ratio to 19 for difference between entities and MAC for the purpose of fair valuing the NCR. The finance director had determined that the bargain purchase of 3 million arose on the acquisition of MAC, being the cash consideration of 52 million, less the fair value of net assets of MAC of 55 million. This gain on the bargain purchase had been included in the group financial statement above. Cutchin had purchased 80% interest in Niche. This is number 3. Cutchin had purchased an 80% interest in Niche for 40 million on the 1st of January X6, when the fair value of the identifiable net assets was 44 million. The partial goodwill method has been used to calculate the goodwill, and an impairment of 2 million has arisen on the year ended the 31st of December X6. The holding in Niche was sold for 50 million on the 31st of December. The carrying amount of Niche identifiable net assets other than goodwill was 60 million at the date of sale. Cutchin had carried the investment in Niche at cost. The finance director calculated that the gain arose of 2 million on the sale of Niche in the group financial statements, being sale proceeds of 50 million, less 48 million being their share of the identifiable net assets at the date of sale, brackets 80% of 60 million, close brackets. This is credited to retained earnings. Number 4, Cutchin has decided to restructure one of its business segments. The plan has agreed by the board of directors on the 1st of October X6 and affects employees in 2 locations. In the first location, half of the factories units were closed on the 1st of December X6 and affected employee pension benefits have been frozen. Any new employees will not be eligible to join the defined benefit plan. After the restructuring, the present value of the defined benefit obligation is the location of 8 million. The following table relates to location 1. Value before restructuring, location 1. Present value of defined benefit obligation minus 10 million. Fair value of plan asset 7. Net pension liability minus 3. In the second location, all activities have been discontinued. It has been agreed that the employees will receive a payment of 4 million in exchange for the pension liability of 2.4 million in the unfunded pension scheme. Cutchin estimates that the costs of the above restructuring, excluded pension costs, will be 6 million. Cutchin has not accounted for the effects of the restructuring in the financial statements because it is planning a rights issue and does not wish to depress the share price. Therefore, there has been no formal announcement of the restructuring. Required. Part A, Roman numeral I. Explain to the directors of Cutchin that with the suitable workings how goodwill should have been calculated on the acquisition of House and Mac, showing the adjustments which need to be made to the consolidated financial statements to correct any errors by the financing director. Roman numeral 2. Explain with suitable calculations how the gain and loss on the sale of Niche would have been recorded in the group financial statements. Roman numeral 3. Discuss with suitable workings how the pension scheme should be dealt with after the restructuring of the business segment and whether the provision for restructuring should have been made in the financial statements at the year ended 31st of December X6. Note, marks will be allocated in A for a suitable discussion of the principles involved as well as the accounting treatment. Part B. When Cutchin acquires the majority shareholding in March, there was an option on the remaining non-controlling interest which could be exercised at any time up to the 31st of March X7. On 31st of January X7, Cutchin acquired the remaining NCI in MAC, and the payment for the NCI was structured so that it contained a fixed initial payment and a series of contingent amounts payable over the following 2 years. The contingent payment were to be based on the future profits of MAC up to a maximum amount. Cutchin felt that the fixed initial payment was equity transaction. Additionally, Cutchin was unsure of whether the contingent payments were either equity, financial liabilities, or contingent liabilities. After a broad discussion, which contained disagreement as to the accounting treatment, Cutchin is prepared to disclose the contingent payment in accordance with IAS 37 provisions, contingent liabilities and contingent assets. The disclosure will include the estimate timing of payments and the director's estimate of the amounts to be settled. Required. Advise Cutchin on the difference between equity and liabilities and that the proposed accounting treatments of the contingent payments on acquisition of the NCIs of MAC. So that long-winded thing was a question. So here is the answer. Blimey. Which is 1, 2, 3, 4. Quite a few pages. Right. Here we go. Section A, Cutchin. So it's just marking scheme. Discussion 1, max 1 point per mark, etc. Part A, Roman numeral 1. Goodwill on the acquisition of House and Mac should have been calculated as follows. House, fair value of consideration for 70% interest, 42 million. Fair value of non-controlling interest, 16.38 and 58 million. Fair value of identifiable net assets acquired, minus 48. Goodwill is 10.38. Contingency consideration should be valued at fair value and will have to be taken into account the various milestones set under the agreement. The expected value is 20% times 5 million shares. 1 million shares at $2 equals to, i.e. $2 million. There will be no remeasurement of fair value in subsequent periods because the amount is settled in equity. If this were a liability, there would be remeasurement. The contingent consideration will be shown in OCE. The fair value of the consideration is therefore 20 million shares at $2 plus 2 million above, i.e. 42 million. The fair value of NCI is 30% and times 30 million and 4.2 equals 16.38 million. The finance director has not taken into account the fair value of the NCI in the valuation of goodwill for the contingent consideration. If the difference between the fair value of consideration, NCI, and the identifiable net assets is negative, the resulting gain is the bargain purchase in profit or loss, which may arise in circumstances such as forced selling acting under compulsion. However, before any bargain purchase gain is recognised in profit or loss, and hence in retained earnings in the group statement of financial position, the finance director should have undertaken a review to ensure the identification of assets and liabilities is complete and that the measurement appropriately reflects consideration of all available information. The adjustment to the financial statements would be as follows. Debit goodwill, 10.38 million. Debit profit or loss, 8 million. Credit NCI, 16.38 million. Credit OCE, other comprehensive income, 2 million. MAC. Net profits of MAC at the year end 31st of December X5 is 3.6 million. The PE ratio, brackets adjusted, is 19. Therefore, the fair value of MAC is 19 times 3.6 million, i.e. 68.4 million. The NCI has a 20% holding. Therefore, the fair value of NCI is 13.68 million. Fair value of consideration for 80% interest, 52 plus 5 million is 57. Fair value of non-controlling interest, 13.68, which is a total of 70.68. And the fair value of identifiable net assets acquired is minus 55, which is goodwill of 15.68. The land transferred as part of the purchase consideration should be valued at its acquired date for fair value of 5 million and included in the goodwill calculation. Therefore, the increase of 2 million over the carrying amount would be shown in the retained earnings. Debit PPE 2 million, credit retained earnings 2 million. The adjustment to the group financial statements would be as follows: debit goodwill 15.68, debit retained earnings 3 million, credit NCI 13.68 million, credit PPE 5 million. Total goodwill, therefore, is 15.68 plus 10.38 million, i.e. 26.06 million. Roman numeral 2, niche. The finance director has calculated the gain of 2 million on the sale of niche and the group financial statements being the sale proceeds of 50 million less 48 million, which is their share of the identifiable net assets of the date, 80% of 60 million. However, the calculation of the gain or loss on sale should have been the difference between the carrying amount of the net assets in brackets included any unimpaired goodwill, close brackets, disposed of and any proceeds received. The calculation of net assets will include the appropriate proportion of cumulative exchange differences and other amounts recognised in other comprehensive income and accumulated in equity. Additionally, the loss on sale should have been reported as a loss in profit or loss attributable to the parent. The gain on sale of niche should have been recorded as gain / brackets loss in the group financial statements of sales of niche, sale proceeds less shares of identifiable assets at date of disposal, 80% times 60 million, goodwill 40 million less 80% of 44 million minus the impairment is 2.8, and then loss of sale of niche recognised in the group profit or loss is minus 0.8 million. Roman numeral 3. After restructuring, the present value of the pension liabilities in location 1 is reduced to 8 million. Thus there will be a negative past service cost in this location of 10 minus 8 million, i.e. 2 million as regards location 2. There is a settlement and a curtailment as all liability will be extinguished by the payment of 4 million. Therefore, there is a loss of 2.4 minus 4 million, i.e. 1.6 million. The changes of the pension scheme is locations 1 and 2 both affect profit or loss as follows. Location 1, debit pension obligation 2 million, credit retained earnings 2 million. Location 2, debit pension obligation 2.4 million, debit retained earnings 1.6 million, credit current liabilities 4 million. The 2018 amendments of IAS 19 require that when a plan amendment, curtailment or settlement takes place, the updated accrual assumption, the updated actuarial assumption used to remeasure the net defined benefit / asset should also be used to determine the current service cost and net interest in the remainder of the reporting period. As such, the updated actuarial assumption should be applied from 1st December X6, then calculated on amounts recognised in profit and loss. Profit of loss. In profit of loss. I think it should be profit or loss. No. IAS 37 provisions, contingent liabilities and contingent assets states that the provision for restructuring should be made only when the detailed formal plan is in place and the entity has started to implement the plan or announce its main feature to those affected. A board decision is insufficient even though there has been no formal announcement of the restructuring. Cutchin has started implementing it and therefore must account for it under IAS 37. The provision of 6 million should also be made at the year end. Part B. The conceptual framework defines a liability as a present obligation to transfer economic resource as a result of a past event. IAS 32 financial instruments presentation establishes principle for presenting financial instruments as liabilities or equity. IAS 32 does not classify a financial instrument as equity or financial liability on the basis of its legal form, but on the substance of the transaction. The key feature of the financial liability is the issuer is obliged to deliver either cash or another financial asset to the holder. An obligation may arise from a requirement to repay principal or interest or dividend. In contrast, equity has a residual interest in the entity's asset after deducting all of the liabilities. An equity instrument includes no obligation to deliver cash or another financial asset to another entity. A contract which will be settled by the entities receiving and delivering a fixed number of its own equity instruments is exchanged for a fixed amount of cash or another financial asset in the equity instrument. However, if there is any variability in the amount of cash or own equity instruments which will be delivered or received, then such a contract is a financial asset or liability as applicable. The contingent payment should not be treated as contingent liability, but they should be recognised as financial liability and measured at the fair value at initial recognition. IAS 37, Provision Contingent Liabilities and Contingent Assets, excludes that the scope contracts which are executory in nature and therefore present the recognition of a liability. Additionally, there is no onerous contract in this scenario. Contingent consideration for a business must be recognised at the time of the acquisition in accordance with IFRS 3 business combinations. However, IFRS does not contain any guidance when accounting for contingent consideration for the acquisition of NCI in a subsidiary. The contract for contingent payments does meet the definition of financial liability under IAS 32. Cutchin has an obligation to pay cash to the vendor of NCI under the terms of contract. It is not within Cutchin's control to be able to avoid the obligation. The amount of the contingent payment depends on the profitability of MAC, which itself depends on the number of factors which are uncontrollable. IAS 32 states that contingent obligation to pay cash which is outside the control of both parties to the contract meets the definition of a financial liability, which will be initially measured at fair value. Since the contingent payment relates to the acquisition of NCI, the offsetting entry would be recognised directly in equity. Mock exam 2, part A, question 2, Abbey. Abbey is a company which conducts business in several parts of the world. The accountant has discovered that Abbey has purchased goods from a company, R-Right, which its financial director jointly owns with his wife. The accountant believes that the purchase should be disclosed. However, the director refuses to disclose the transaction, as in his opinion, it is an arm's length transaction. He feels that the transaction is disclosed, it will be harmful to the business, and feels that the information asymmetry caused by such non-disclosure is irrelevant, as most entities undertake relevant party transactions without disclosing them. Similarly, the director felt that the competitive harm would occur if the disclosure of the operating segment of the profit and loss was made. As a result, the entity only disclosed a measurement of total assets and total liabilities for each reportable segment. When preparing for the financial statements for the recent year end, the accountant noticed that R-Right had not paid an invoice for several $1 million, and is significantly overdue for payment. It appears that the entity has liquidity problems and is unlikely that R-Right will pay. The accountant believes that the loss allowance for the trade receivable is required. The finance director has refused to make such an allowance and is told that the accountant that the issue will not be discussed with anyone within the trade because of the possible repercussions of the creditworthiness of R-Right. Additionally, when completing the consolidated financial statements, the finance director has suggested that there should be no positive fair value adjustment for the recently acquired subsidiary, and that he stated that the accountant's current position is dependent upon following these instructions. The fair value of the subsidiary is $50 million above the carrying amount in the financial records. The reason given for not fair valuing the subsidiary's net assets is the goodwill is the arbitrary calculation which is meaningless in the context of the performance evaluation of an entity. Finally, when preparing the annual impairment tests of goodwill arising on the other subsidiaries, the finance director has suggested that the accountant is flexible and the assumption used in calculating the future expected cash flows that no impairment goodwill arises, and that the accountant should use use a discount rate which reflects risk for which the future cash flow have been adjusted. He has indicated that he will support a salary increase for the accountant if he follows his suggestions. Required. Discuss the ethical and accounting implications of the above situation from the perspective of the reporting accountant. Professional marks will be awarded in question 2 for the application of ethical principles. Right, so let's go through to that answer. The answer. So, question 2, Abby, answer. Marking scheme, accounting issues, 1 mark per point. Ethical issues, 1 mark per point. Related parties. The objective... Yeah, okay, right. So, related party. The objectives of ISS 24, related party disclosure, is to ensure that an entity's financial statements contain the disclosures necessary to draw attention to the possibility that the financial position and the profit or loss may have been affected by the existence of related parties and by transactions and outstanding balances with such parties. If there have been transactions between related parties, there should be disclosure of the nature of the related party relationship, as well as the information about the transaction and outstanding balances necessary for an understanding of the potential effect of the relationship to the financial statements. The finance director is a member of the key management personnel of the reporting entity, and the entity from which the goods were purchased is jointly controlled by that director. Therefore, a related party relationship exists. Abby should assess whether the information provided by disclosure of the transaction is material, i.e. could be reasonably expected to influence the decisions of primary users of Abby's financial statements. If yes, then the relevant disclosures under IAS 24 should be made. Operating segments. IFRS 8 operating segments requires that entities to report financial and descriptive information about the reporting segments. Reportable segments are operating segments and aggregation of operating segments which meet specific criteria. IFRS 8 does not contain a competitive harm exemption and requires entities to disclose the financial information which is provided by the Chief Operating Decision Maker, CODM. The management accountant reviewed by the CODM may contain commercially sensitive information, and IFRS 8 might require that information be disclosed externally. Under IFRS 8, firms should provide financial segments disclosures which enables investors to assess the different sources of risk and income as management does. This sensitive information would be available for competitors. The potential competitive harm may encourage firms to withhold segment information. However, this is contrary to IFRS 8, which requires information about the profit or loss for each reportable segment, including certain specified revenues and expenses, such as revenue from external customers and from transactions with other segments, interest revenue and expense, depreciation and amortization, income tax expense and income and material non-cash items. Impairment of financial assets. Heading. Areas such as impairment of financial assets often involve the application of professional judgment. The director may have received additional information which has allowed him to form a different opinion to that of the accountant. The matter should be discussed with the director to ascertain why no provision is required and to ask whether there is an additional information available. However, suspicion is raised by the fact that the accountant has been told not to discuss the matter. Whilst there may be a valid reason for this, it appears again that the related party relationship is affecting the judgment of the director. Fair value adjustments. Positive fair value adjustments increases the asset of the acquired company, and as such reduces the goodwill recognised on consolidation. However, the majority of positive fair value adjustments usually relate to items of property, plant and equipment. As a result, extra depreciation based on the net fair value adjustment reduces the post-acquisition profits of the subsidiary. This has a negative impact on important financial performance measures such as EPS. Therefore, by reducing fair value adjustments, it will improve the apparent performance of new acquisitions and the consolidated financial statements. Accountants should act ethically and ignore undue pressure to undertake creative accounting in preparing such adjustments. Guidance such as IFRS 3 business combinations and IFRS 13 fair value measurement should be used in preparing adjustments, and professional value should be engaged where necessary. Impairment tests. In measuring value in use, the discount rate used should be pre-tax rate, which reflects current market assessment of the time value of money and the risks specific to the asset. The discount rate should not reflect risks for which the future cash flows have been adjusted and should equal the rate of return which investors would require if they chose an investment which would generate cash flows equivalent to those expected from the asset. Reducing the impairment would have a positive impact on the financial statements. The offer of a salary increase is inappropriate and no action would be taken until the situation is clarified. Inappropriate financial reporting raises issues and risks for those involved and others associated with the company. Whilst financial reporting involves judgment, it would appear that the situation is not related to judgment. Ethical issues. There are several potential breaches of accounting standards and unethical practices being used by the director. The director is trying to coerce the accountant into acting unethically. IAS 1 presentation of financial statement requires all IFRSs to be applied to the fair presentation. If fair presentation is to be obtained, directors cannot choose which standards they do and do not apply. It is important that the accountants identify issues of unethical practice and act appropriately in accordance with ACCA's Code of Ethics. The accountant should discuss the matters with the director. The technical issues should be explained and risk of non-compliance explained to the director. If the director refuses to comply with the accounting standards, then it would be appropriate to discuss the matter with others affected, such as other directors, and seek professional advice from ACCA. Legal advice should be considered if necessary. An accountant who comes under pressure from senior colleagues to make inappropriate valuations and disclosures should discuss the matter with the person suggesting this. The discussion should try to confirm the facts and reporting guidance which needs to be followed. Financial reporting does involve judgment, but the cases above seem to be more than just difference of opinion. The accountant should keep a record of conversations and actions and discuss the matter with others affected by the decision, such as directors. Additionally, resignation should be considered if the matter cannot be satisfactorily resolved. Section B, Mock 2, question 3, Africant. Part A. Africant owns several farms and also owns a division which sells agricultural vehicles. It is considering selling this agricultural retail division and wishes to measure the fair value of the inventory of vehicles for the purpose of the sale. 3 markets currently exist for the vehicles. Africant has transacted regularly in 3 markets. At 31st of December X5, Africant wishes to find the fair value of 150 new vehicles which are identical. The current value and prices in the 3 markets are as follows. Then there's a number of columns: market, sales per vehicle, historical volume, vehicles sold by Africant, total volume of vehicles sold in the market, transaction cost per vehicle, transport cost to market, market per vehicle. And then there's 3 divisions: Europe, Asia and Africa. Africant, and there's figures in each which I can't be bothered to read. Africant wishes to value the vehicles at 39,100 per vehicle, as these are the highest net proceeds per vehicle, and Europe is the largest market for Africant's products. Roman numeral 1. Africant wishes to understand the principles behind the valuation of the new vehicles and also whether the valuation would be acceptable under IFRS 13 fair value measurement, 8 marks. Roman numeral 2, Africant uses the valuation model for its non-current assets. Africant has several plots of farmland which are unproductive. The company feels that the land would be more value if it were used for residential purposes. There are several potential purchases for the land, but planning permission has not yet been granted for the use of the land for residential purposes. However, preliminary inquiries which regulatory authorities seem to indicate that planning permission may be granted. Additionally, the government has recently indicated that more agricultural land should be used for the residential purposes. Africant has also been approached to sell the land for commercial development at a higher price than the land of residual purposes, and understanding that fair value measurement of non-financial assets takes into account the market perspective. Africant would like an explanation of what is meant by the market perspective and advice on how to measure the fair value of the land in the financial statements. Required. Advise Africant on the matters set above in I and in Roman numeral 1 and 2 with reference to relevant international financial reporting standards. Note the mark allocation is shown against each of the 2 issues. Yeah, the one's 8 marks, the other's 7. Part B. Africant is about to hold its annual general meeting with shareholders and the directors wish to prepare for any potential questions which may be raised at the meeting. There have been discussions in the media over the fact that most relevant measurement method should be selected for each category of assets and liabilities. This mixed measurement approach is used by many entities when preparing financial statements. There have been no comments in the media about the impact of measurement uncertainty and price volatility can have on the quality of financial information. Required. Discuss the impact which the above matters have an analysis of the financial statements by investment in Africant. Professional marks will be awarded in Part B for clarity and quality of presentation. Right, so let's read the answer to Africant, which is now 3 pages. Here we go. IFRS 13 fair value measurement states that fair value is an exit price for the principal market, which is the market with the highest volume of level of activity. It is not determined based on the volume of level of activity of reporting entities' transactions in a particular market. Once the accessible markets are identified, market-based volume and activity determines the principal market. There is a presumption that the principal market is the one in which the entity would normally enter the transaction to sell the asset or transfer a liability unless there is evidence to the contrary. In practice, an entity would first consider the markets it can access. In the absence of the principal market, it is assumed that the transaction would occur in the most advantageous market. This is the market which would maximise the amount that would be received to sell the asset, or minimise the amount which would be paid to transfer the liability, taking into consideration transport and transaction costs. In either case, the entity must have access to the market on measurement date, although an entity must be able to access the market at the measurement date. IFRS 13 does not require an entity to be able to sell the particular assets or transfer the particular liability on that date. If there is a principal market for the asset or liability and the fair value measurement represents the price in that market at the measurement date, regardless of whether that price is directly observable or estimated using another valuation technique, and even if the price is different in the market, is potentially more advantageous. The principal (brackets or most advantageous) close brackets market price for the same asset or liability might be different for different entities, and therefore the principal (brackets or most advantageous) market is considered for the entity's perspective, which may result in different prices for the same asset. In Africant's case, the principal market is Asia, as this is the market in which the majority of transactions for the vehicles occur. As such, the fair value of vehicles would be 5,595,000. 38,000 minus 700 equals 37,300 times 150. Actual sales are the vehicles in either Europe or Africa would result in a gain or loss of the African wood compared with the fair value, i.e. 37,300. Second bullet point, which I didn't tell you that was the first bullet point. The most advantageous market would be Europe, where the net price of 39,100,000 after all costs in brackets would have gained by selling there, and the number of vehicles sold in the market is at its highest. African would therefore utilise the fair value calculation by reference to the Asian market, as this is the principal market. The ISB decided to prioritise the price in the most liquid market, i.e. the principal market, as the market provides the most reliable price to determine the fair value and also serves to increase consistency among reporting entities. IFRS 13 makes it clear that the price used to measure the fair value must not be adjusted for transaction costs but should consider transportation costs. African has currently deducted transaction costs in its valuation of the vehicles. Transaction costs are not deemed to be characteristic of an asset or a liability, but they are specific to a transaction and will differ depending on how the entity enters into a transaction. Whilst not deducted from the fair value and entity consideration transaction cost in the context of determining the most advantageous market, because its entity is seeking to determine the market which would maximise the net amount which would be received for the market received for the asset. Roman numeral 2. Not reading this very well, am I? A fair value measurement of non-financial assets takes into account the market participant's ability to generate an economic benefits by using the asset in its highest and best use by selling it to another market participant who would use the asset in its highest or best use. The maximum value of the non-financial asset may arise from its use in a combination with other assets or by itself. IFRS 13 requires the entity to consider uses which are physically possible, legally permissible, and financially feasible. The use must be legally prohibited. For example, if the land is protected in some way by law and the change of law is required, then it cannot be the highest and best use of the land. In this case, African's land for residual development would only require approval for the regulatory authority, and that the approval seems to be possible when this alternative use could be deemed to be legally permissible. Market participants would consider the possibility, extent and timing of the approval which may be required in assessing whether the changes in the legal use of the non-fictional asset would be obtained. African would need to have sufficient evidence to support the assumption about the potential for alternative use, particularly in light of IFRS 13 presumption that the highest and the best use of the asset's current use. African's belief that the planning permission was possible is unlikely to be sufficient evidence that the change in use is legally permissible. However, the fact that the government has indicated that more agricultural land should be released for residential purposes may provide additional evidence as the likelihood that the land is being measured and should be based on the residual value. Africans would need to prove that the market participant would consider residential use of the land to be legally permissible. Providing there is sufficient evidence to support these assertions, alternative uses, for the example commercial development, which would enable market participants to maximise value, should be considered, but the search for potential alternative uses need not be exhaustive. In addition, any cost to transform the land, for example obtaining planning permission or converting the land to its alternative use, and profit expectations from a market participant perspective should also be considered in the fair value measurement. If there are any multiple types of market participants who would use the asset differently, these alternative scenarios must be considered before concluding on the asset's highest and best use. If no, it appears that Africans is not certain about what constitutes the highest and best use, and therefore IFRS 13's presumption that the highest and best use of the asset's current use appears to be valid at this stage. Part B. A measurement basis must be selected for each element recognised in the financial statements. The conceptual framework describes the characteristics of historical cost and current value, including the fair value measurement basis, and when it may be appropriate to use each basis. Some investors may be in favour of single measurement basis for all recognised assets and liabilities, arguing that the resulting totals and subtotals can have little meaning in different measurement methods are used. Similarly, they may argue that profit or loss may lack relevance if it reflects a combination of flow based on historical cost and the value changes for items measured on the current value basis. However, the majority of investors would tend to prefer that the most relevant measurement method is selected for each category of asset and liability. This is known as mixed measurement approach and is consistent with how investors analyse financial statements. The conceptual framework requires a selection of measurement bases that provides that the most useful information to primary users, subject to the cost constraint. Therefore, it supports a mixture of measurement bases as consideration of the qualitative characteristics of useful information. Cost constraint is likely to result in the selection of different measurement bases for different items. The problems of mixed measurements are outweighed by the greater relevance achieved. In most relevant measurement bases, if the most it doesn't sound right, does it? The problem of mixed measurement are outweighed by the greater relevance achieved if the most relevant measurement basis. The problems of mixed measurement are outweighed by the greater relevance achieved if the most relevant measurement basis is used for each class of asset and liabilities. The mixed measurement approach is reflected in recently issued standards. For example, IFRS 9 financial instruments requires that the use of cost in some cases and fair value in other cases, whilst IFRS 15 revenue from contracts and customers essentially applies cost allocation. Most accounting measures of assets and liabilities are uncertain and require estimation, while some measures of historical cost are straightforward as the amount paid or received. There are many occasions when the measurement of cost can be uncertain, in particular recoverable cost, for which impairment and depreciation estimates are required. In a similar vein, when some measurements of fair value can be easily observed because of the availability of the prices in an actively traded market, brackets so-called level 1 fair value, other inevitably rely on management estimates and judgments level 2 and level 3. High measurements uncertainty may mean that the measurement basis selected does not produce the faithful representation of entity's financial position and financial performance. In such cases, selecting a slightly less relevant measure basis but with less measurement uncertainty may provide more useful information to investors. If a relevant measure of an asset or liability value is volatile, this should not be hidden from investors. To conceal its volatility would decrease the usefulness of the financial statements. Of course, such volatile gains and losses do need to be clearly presented and disclosed because their prospective value may differ from that provided by other components of performance. That was a tough one. Mock exam 2, question 4, part B, section B. The directors, this is called rationale, with an E on the end, so it could be rationale or rationale. I'm going to go with rationale. The directors of rationale are reviewing the published financial statements of the group. The following is an extract of information to be found in the financial statements year ended 31st of December X6 and 31st of December X5. Net profit or loss before taxation after items set out below, 5 and 38 respectively. brackets 5. Net interest expense 10 and 4. Depreciation 9 and 8. Amortisation of intangible assets 3 and 2. Impairment of property 10. Insurance proceeds minus 7 is a net value of 3. Debt issue costs 2 and nothing. Share-based payment 3 and 1. Restructuring charge 4 and 0. Impairment of acquired intangible assets 6 and 8. The directors use underlying profits to comment on the financial performance. Underlying profit is a measure normally based on the earnings before interest and tax and depreciation and amortisation, EBITDA. The interest earnings before interest, tax, depreciation and amortisation, EBITDA. However, the effects of the events which are not part of the usual business activity and also excludes when evaluating performance. However, the effects of events are not part of the usual business activity and also exclude when evaluating performance. Are excluded. The following items were excluded from the net profit to arrive at the underlying profit. In 20x6, the entity had to write off a property due to subsidence and insurance proceeds recovered for this property was recorded but not approved until X. Can I start again? The following items were excluded from net profit. By the way, this isn't my fault. This is the blooming the sentence structure of them. The following items were excluded from net profit to arrive at the underlying profit. In 20x6, the entity had to write off a property due to subsidence and the insurance proceeds recovered for the property was recovered but not approved until X7. When the company insurer concluded that the claim was valid, when the company's insurer concluded that when the claim was valid. Right. In X6, the entity considered issuing loan notes to finance an asset purchase. However, the purchase did not go ahead. The entity incurred costs associated with the potential issue, and so these costs were expensed as part of the profit before taxation. The entity felt that the share-based payment was not a cash expense and that the value of the options was subjective. Therefore, the director wishes to exclude the item from underlying profit. Similarly, the director wished to exclude restructuring charges incurred in the year and impairments of acquired intangible assets. Required. Part A, Roman numeral 1. Discuss the possible concerns where the entity may wish to disclose additional information in the financial statements and whether the conceptual framework and IFRS practice statement 2 makes materiality judgment help to determine the boundaries for disclosure. Roman numeral 2. Discuss the use and the limitations of the proposed calculation of underlying profit by rationale. Note, your answer should include a comparative calculation of underlying profit for the years ended 31st of December X5 and X6. The directors of Rationale are confused over the nature of reclassification adjustment. This is part B. Part B. The directors of Rationale are confused over the nature of reclassification adjustment. Required. Discuss with examples the nature of the reclassification adjustment and arguments for and against allowing reclassification of items to profit or loss. Note, a brief reference should be made in your answer to the conceptual framework. Right, so answer to rationale, number 4. Part A, Roman numeral 1. IFRS requires an entity to disclose additional information which is relevant to an understanding of an entity's financial position and financial performance. A company may disclose additional information where it is felt that the entity's performance may not be apparent from its financial statements prepared under IFRS. Additional information can help users understand management's view of what is important to the entity and the nature of the management's decisions. However, there are concerns relating to the disclosure of additional information and a number of bullet points. Point 1. Such information may not readily be derived and or reconciled back to the financial statements. There may be point two. There may be difficulty comparing information across periods and between entities because of the lack of standardised approach. Point three. The presentation of additional information may be inconsistent with the defined or specified with that defined or specified in IFRS, and the entity may present an excessively optimistic picture of an entity's financial performance. Point four. Non-IFRS information may make it difficult to identify the complete set of financial statements, including whether the information is audited or not. Point five. Non-IFRS information may be given undue prominence or credibility merely because of the location within the financial statements. Although disclosure boundaries are not specifically defined in IFRS, guidance can be found in the conceptual framework and in IFRS Practice Statement 2. The conceptual framework states that the objective of financial statements is to provide financial information about the entity's assets, liabilities, equity, income, expenses, which is useful to users of financial statements in assessing the prospects of future net economic resources. I acknowledge that it would be impossible to meet the information needs of all financial statements and limits the range of addresses in the primary users (brackets existing or potential investors, lenders and other creditors, close brackets). IFRS Practice Statement 2 further clarifies that the financial statements cannot provide all the information primary users need. Instead, the entity should aim to meet the common information needs, highlighted in bold, of the primary users. It future states that the information is given that is not required by an IFRS, that information must not be obscure information that is material according to IFRS. Roman numeral 2. The directors of Rationale are utilising an alternative performance measure for evaluating the company's performance. Depreciation and amortisation are non-cash expenditure relating to the assets which have already been purchased, and they are expenses which are subject to judgments or estimates based on experience and projections. The company, by using EBITDA, is attempting to show operating cash flow since the non-cash expenses are added back. EBITDA can often be misused and manipulated. For example, depreciation schedules can be extended in order to increase profits, with the consequential impact of the ratio on this ratio. It can also be argued that because the estimation of depreciation, amortisation and other non-cash items is vulnerable to judgment error, the profit before can be distorted, but by focusing on profits before these elements are deducted, a truer estimation of cash flow can be given. However, the substitution of EBITDA for conventional profit fails to take into account the need for investment in fixed capital items. There can be argued for excluding non-recurring items for the net profit figure. Therefore, it is understandable that the deduction for the impairment of property, the insurance recovery and the debt issue cost are made to arrive at underlying profit. However, IAS 1, Presentation of Financial Statements, states that the entity shall present additional line items, headings and subtotals in the statement presenting profit and loss and other comprehensive income when the presentation is relevant to an understanding of the entity's financial performance. Paragraph 55. This paragraph should not be used to justify presentation of underlying adjustments and pre-exceptional measures of performance on the face of the statement of profit or loss. The measure proposed are entity specific and could obscure performance and poor management. Share-based compensation may not represent cash, but if an entity chooses to pay equity to an employee, that affects the value of equity, no matter what that payment is in, and therefore it should be charged as employee compensation. It is an outlay in the form of equity. There are therefore little justification in excluding the expense from the net profit. Recurring charges are a feature of the entity's business and that can be volatile. They should not be excluded from net profit because they are a part of the corporate life. In the case of rationale, they are occurred in consecutive years and certainly could not be considered one-off. Severance costs and legal fees are not cash items, are non-cash items. Impairment of acquired intangible assets usually reflect a weaker outlook for the acquisition business than the expected at the time of the acquisition and could be considered to be non-recurring. However, the impairment charges are a useful way of holding management accountable for its acquisitions. In this case, it seems as though rationale has not purchased wisely in 20x6. It appears as though rationale wishes to disguise a weak performance in X6 by adding back the series of extensive items. EBITDA, although reduced significantly from X5, is now a positive figure and there is an underlying profit ceased as opposed to loss. However, users will be faced with a significant decline in profit which measures is disclosed in rationale. The logic for the increase in profit is flawed in many cases, but there is a lack of authority guidance in the area. Many companies adopt non-financial measures without articulating the relationship between the measure and the financial statement. So year ended X6 and X5. There's a P&L here. Net profit or loss before taxation and the items set out below, -5 and 38 respectively. Net interest expense 10 and 4. Depreciation 9 and 8. Amortization of intangible assets 3 and 2, which is an EBITDA of 17 and 52. Impairment of property 10. Debt issues -7. EBITDA after non-recurring items 2, which is EBITDA after non-recurring items 22 and 52. Share-based payment 3 and 1. Restructuring charges 4. Impairment of the acquisition intangible assets 6 and 8, which is an underlying profit of 35 and 61 respectively. That was in millions, by the way. Part B. Reclassification adjustments are amounts recycled to profit and loss in the current period of which the recognition of OCI in the current or previous periods. An example of items recognised in OCI which may be reclassified to profit and loss are foreign currency gains on the disposal of foreign operations and realised gains and losses on cash flow hedges. Those items which may be reclassified are changes in the revaluation surplus under IAS 16 property, plant and equipment, and actuarial gains and losses on a defined benefit plan under IAS 19 employee benefits. There are several arguments for and against reclassification. If reclassification ceased, then there would be no need to redefine profit and loss or in any other total or subtotal of profit and loss, and any presentation decisions can be left to specific IFRSs. It is argued that the reclassification protects the integrity of profit and or loss and provides users with relevant information about the transaction which occurs in the period. Additionally, it can improve comparability where IFRS permits similar items to be recognised in either profit or loss or OCI. The gain reclassification argue that the recycled amount add to the complexity of the financial reporting, may lead to earnings management, and reclassification adjustments may not meet the definitions of income and expenditure in the period as the change in assets or liability may have occurred in a previous period. The lack of consistent basis for determining how items should be presented has led to an inconsistent use of OCI in IFRS. Opinions vary, but there is a feeling that OCI has become a home of anything controversial because of lack of clear definition of what should be incurred in the statement. Many users are thought to ignore OCI as the change reporting are not caused by the operating cash flow and used for predictive purposes. The revised conceptual framework 2018 identifies the statement of profit or loss as the primary source of information about the entity's performance and states that in principle, therefore, all income and expenses are included in it. However, It goes on to say that developing IFRS and IASB may include income or expenses arising from changes in current value of an asset or liability, as OCI when they determine it provides more relevant information and more faithful representation. In principle, OCI is recycled to profit and loss in the future periods. When doing so, results in the provision of more relevant information and more faithful representation of the entity's statement's performance for the future period. So, although there is more guidance on what constitutes OCI and when it should be recycled, the conceptual basis for it is still not clear. Right, ACCA kit, practice and revision kit for exams up to June 21. And ACCA strategic business reporting SBR mock exam 3. Question letter A. Both sections are compulsory and must be attempted. Question 1, carbis or carbis. So for the purpose of this, we're going to call it carbis. Background. Carbis is a parent company of an international group which has a presentation and functional currency of the dollar. The group operates within the manufacturing sector. On the 1st of April 2000 X2, Carbis acquired 80% of the equity share capital of Bikelight, an overseas subsidiary. The acquisition enabled Carbis to access new international markets. Carbis transferred surplus work in progress to Bikelight, which is then completed and sold in various locations. The acquisition was not so successful as anticipated, and on the 30th of September X6, Carbis disposed of all the holdings of Bikelight. The current year end is the 31st of December X6. Bikelight trading information. Bikelight is based overseas, where the domestic currency is the dinar. Staff costs and overhead expenses are all paid in dinars. However, Bikelight also has a range of transactions in a number of other currencies. Approximately 40% of its raw material purchased in the dinar and 50% in the yen. The remaining 10% are in dollars, of which approximately half were purchased of material from Carbis. The ratio continued even after Carbis disposed of the shares in Bikelight. Revenue is invoiced in equal proportion between dinars, yen and dollar. To protect itself from the exchange rate risk, Bikelight retains cash in all three currencies. No dividend has been paid by Bikelight for several years. At the start of X6, Bikelight sought additional debt finance as Carbis was already looking to divest. Funds were raised from the issue of bonds in dinars, none of which were acquired by Carbis. Acquisition of Bikelight. Carbis paid dinar 100 million for 80% of the ordinary share capital of Bikelight on the 1st of January X2. The net assets of Bikelight at the date was a carrying amount of dinar 60 million. The only fair value adjustment deemed necessary was in relation to the building, which has a fair value of dinars 20 million above its carrying amount and a remaining useful life of 20 years on the acquisition date. Carbis measures non-controlling interest (NCI) at fair value for all acquisitions, and the fair value of the 20% interest was estimated to be dinars 22 million at acquisition. Due to the relatively poor performance of Bikelight, it was decided to impair goodwill by dinar 6 million during the year ended 31st of December X5. Rates of exchange between the dollar and dinar are given as follows. 1st of Jan X2, 1 to 0.5 to 0.5 dinars. Average rate for year ended 31st of December X5, 1 to 0.4 dinars. 31st of December X5, 1 to 0.38 dinars. That's $1 to 0.38 dinars. 30th of September X6, $1 to 0.35 dinars. Average rate for the 9-month period ended 30th of September X6, 1 to 0.37 dinars. $1 to 0.37 dinars. Disposal of Bikelight. Carbuy sold its entire equity shareholding in Bikelight on the 30th of September X6 for $150 million. Further details relating to the disposal are as follows. Carrying amounts of Bikelight net assets at the 1st of January X6, dinars 48 million. Bikelight loss for the year ended 31st of December X6, dinar 8 million. Cumulative exchange gains on Bikelight at the 1st of January X6, $74.1 million. Non-controlling interest at Bikelight at the 1st of January X6, $47.8 million. Required. Prepare an explanatory note for the directors of Carbuy which addresses the following issues. Roman numeral 1. What is meant by an entity's preparation and functional currency? What is meant by an entity's presentation and functional currency? Explain your answer with reference to how the presentation and functional currency of Bikelight should be determined. 7 marks. Roman numeral 2. A calculation of goodwill on acquisition of Bikelight and what the balance would be at 30th of September X6 immediately before the disposal of the shares. Your answer should include a calculation of the exchange difference on goodwill for the period from the 1st of January X6 to the 30th of September X6. Roman numeral 3, an explanation of your calculation of goodwill and the treatment of exchange differences on goodwill in the consolidated financial statements. You do not need to discuss how the disposal will affect the exchange differences. Note, any workings can either be shown in the main body of the explanatory note or in the appendix to the explanatory note. Part B, 7 marks. Explain why exchange differences will arise on the net assets and profit and loss of Bikelight each year and how they would be presented within the consolidated financial statements. Your answer should include a calculation of the exchange differences which would arise on the translation of Bikelight (brackets excluding goodwill) in the light of 31st of December. In the year ended 31st of December X6, not in the light of. Part C, Roman numeral 1. Calculate the group profit and loss on the disposal of Bikelight. 3 marks. Roman numeral 2. Briefly explain how Bikelight should be treated and presented in the consolidated financial statements of Carbuy for the year ended 31st of December X6. So here, that was the question, and this is the answer. Carbuy. Answer. First of all, there's the box. Workbook reference. The underlying principle of IFRS 3 are covered in Chapter 11. Disposals of interests in investments are covered in Chapter 14. Foreign transactions and foreign entities are covered in Chapter 16. Top tips. In Part A, you must make sure that you apply your knowledge to the scenario given. The examiner's report stated that weaker answers in this question tended to list the factors determining the functional currency, with little application to the scenario. Remember that there are very few marks available for stating knowledge. You must apply your knowledge to the scenario to gain the majority of the marks available. In questions like this, where complex calculations are required, the examiner has advised you to produce your calculation on one sheet of paper and simultaneously explain the calculations on another sheet of paper. This way, producing an answer will help you to explain each part of the calculation as you perform it, enabling you to generate as many marks as possible. And then there's the marking scheme. Part A, discussion and presentation of the functional currency, application of the above discussion to the scenario. Part A2, calculation of goodwill, calculation of the exchange difference on goodwill. Part 3, explanation of goodwill, calculation and application to the scenario, explanation of exchange gain and application to the scenario. Part B, explanation of Bikelight exchange differences, calculation of Bikelight exchange differences year end X6, translation split between parent and NCI. Part C, calculation of group profit or loss on disposal. Part C2, explanation of accounting treatment of bike light. That was the marking scheme. I didn't tell you the marks. Right, and explanatory note to directors of carbuys. Subject: foreign subsidiary bike light. Roman numeral 1. The presentation currency is the currency in which the financial statements are presented. IAS 21, the effects of changes in foreign exchange rates, permits an entity to present its individual financial statements in any currency. It would therefore be up to the directors of Bike Light to choose a presentation currency for its individual financial statements. Factors which could be considered include the currency used by majority shareholders and the currency in which the debt finance is primarily raised. The functional currency is the currency of the primary economic environment in which the entity operates. Since transactions are initially recorded in an entity's functional currency, the results and financial position would need to be retranslated where the difference to the presentation currency, where this differed to the presentational currency. When determining the presentation and functional currency of Bike Light, consideration should first be given to whether the functional currency of Bike Light should be the same as carbuys, at least whilst under the control of carbuys. It appears that Bike Light has considerable autonomy over its activities. Despite being acquired to make more efficient use of the surplus inventory of carbuys, purchased from carbuys were only 5% of Bike Light's total purchases. Revenue is invoiced in a range of currencies, suggesting a geographical diverse range of customers, which, although this allows carbuys access to new international markets, it's unlikely to be classified as an extension of the parent's operations. The volume of the transaction involved between carbuys and Bike Light would seem to be far too low to come to this conclusion. Bike Light also appears free to retain cash in its range of currencies and is not obliged to remit the cash to carbuys in the form of dividends. Nor does Bike Light appear to be dependent on financing from carbuys, with other investors taking up the bond issue at the start of X6. The functional currency of Bike Light does not need to be the same as carbuys. In choosing its functional currency, Bike Light would consider the following primary factors: the currency, which mainly influences the sale price of their goods, and the currency in the country whose competitive forces and regulations determine the sales price, and also the currency which influences labour, materials and overhead costs. The key determination here is the currency which the majority of the transactions are settled in. Bike Light invoices and invoiced in a large range of currencies, and so it would not be immediately clear as to the appropriate functional currency, nor is there detail about whether there is a currency in which competitive forces and regulations could be important. We do not know, for example, what currency Bike Light's major competitors invoice in. Secondary factors, including the currency in which financing activities are obtained and currency in which receipts from operating activities are retained, can help guide the entity where it is not immediately clear. In relation to Bike Light, a significant volume of their sales are invoiced in dinars, and the majority of their expenses too. Given that the wages and overheads are also paid in dinars, funds are raised in dinars from the bonds issued, and so it would appear that the dinar should probably be the functional currency for Bike Light. It is also possible that Bike Light may use the autonomy of carbuys' sale of their shares, which could be implications for the determination of the functional currency. Number 2, Roman numeral 2. Goodwill in dinars on the acquisition of Bike Light would be 42 million, calculated as follows. Dinars in millions. Consideration 100. Fair value of NCI to 22. Less net assets of acquisition 60 plus 20 equals minus 80. Goodwill at acquisition is then 42. On acquisition, the goodwill in dollars would be dinar 42 to 0.5, 84 million. Goodwill at the 30th of September X6 would be goodwill at the 1st of X2, 42 million dinars, rate 0.5, which is $84 million. Impairment year ended 31st X5, minus 6 million dinars at 0.4, which is minus $15 million. Goodwill at the 31st of December X5, 36 million dinars, 0.38, $94.7. Currency year exchange gain 8.2, which is the balancing figure. Goodwill at the 30th of September X6, 36 dinars, 0.35 exchange rate, which is $102.9. Workings. Dinar impairment of 6 million is translated the average rate of $1 to 0.4 dinars equals 15 million. Goodwill at the 31st of December X5 would be translated at last year's closing rate of $1 to 0.38 dinars equals $94.7 million. Goodwill at 31st of September X6 will be translated at $1 to 0.35 dinars, which is $102.9 million. Roman numeral 3. On a business combination, goodwill is calculated by comparing the fair value of the consideration plus non-controlling interest at acquisition with the fair value of the identifiable net assets at acquisition. Carbice measures NCI using the fair value method. This means that the goodwill attributable to NCI is included within the overall calculation of goodwill. An adjustment of dinars 20 million is required to the property of Bakelite to ensure that the net assets at acquisition are properly included in their fair value. At each year end, all assets, brackets and liabilities, are translated using the closing rate of exchange. Exchange differences arising on the retranslation are recorded within equity. Since the non-controlling interest is measured under the fair value method, the exchange difference would be apportioned 80-20% between the owners of Carbice and the non-controlling interest. Only the current year's exchange difference would initially be recorded within the other comprehensive income for the year ended 31st December X6, whereas cumulative exchange differences on goodwill at the 30th of September X6 would be recorded within equity. Part B. The net assets of Bakelite would have been retranslated each year at the closing rate of exchange. There is therefore an exchange difference arising on the year by comparison. The opening net assets at the beginning rate. No, start again. Sorry, I'm going to start that again. Part B. The net assets of Bakelite would have been retranslated each year at the closing rate of exchange. There is therefore an exchange difference arising each year by comparing the opening net assets at the opening rate of exchange with the opening net assets at the closing rate of exchange. An additional exchange difference arises through the profit or loss of Bakelite each year being translated at a different rate of exchange in the consolidated statement of comprehensive income. The profit and loss will increase and decrease the net assets of Bakelite respectively, which, as is indicated above, will be translated at the closing rate of exchange within the consolidated statement of financial position. As with goodwill, the exchange differences are included within equity, with 80% attributable to shareholders of Carbice and 20% to the NCI. Cumulative exchange differences will be included within the consolidated statement of financial position, with just current year differences recorded within other comprehensive income. The carrying amount of the net assets of Bakelite on the 1st of January X6 was dinars 48 million. The fair value of the opening net assets therefore would be dinar 64 million, brackets dinar 48 plus 16 over 20 times dinar 20 million, close brackets. Bakelite would only be consolidated for the first 9 months of the year, since Carbice loses control at the 30th of September X6. Losses loses control. That's right. Losses per the individual accounts per the year ended 31st of December X6, where dinar 8 million, so only dinar 6 million would be consolidated. Additional depreciation of dinar 0.75 million brackets dinar 20 million over 20 times 9 twelfths would be charged for the first 9 months of the year. Net assets at disposal of dinar would therefore be dinar 57.25 million brackets dinar 64 minus dinar 6.75. The exchange difference arises in the statement of comprehensive income for the year 31st of December X6 would be 13.4 million, calculated as follows. Operating net assets at opening rate, dinar 64 over 0.38 is 168.4. Loss for 9 months at average rate, dinar 6.75 at 0.37 is minus 18.2. Current exchange gain balance 13.4. Net assets at 30th of September, dinar 57.25 over 0.35, which is 163.6. 10.7 million of the exchange difference are attributable to shareholders of Carbide. I think that should be Carbide. It does say Carbide. 80% times 13.4 and 2.7 million to the NCI. Part C, Roman numeral 1. Group profit and loss on disposal of Bike Light. Proceeds 150 million. Net assets at disposal 163.6 is brackets. Goodwill at disposal 102.9 in brackets. NCI at disposal 48.5. Exchange gains recycled to profit and loss 76.6. Group profit on disposal 8.6. Workings. Exchange gains at 1st of January X6 per question are 74.1 million. Current year exchange difference on goodwill are 8.2 million CBI, and on the net assets are 13.4 million CB. Cumulative exchange gains at 30th of September X6 are therefore 95.7 million. On disposal of parents' shares brackets 80% equals 76.6 million should be recycled to the profit and loss. NCI at disposal are calculated as follows. NCI 1st of Jan X6 per question 47.8. NCI shares of loss 30th of Jan X6 20% times dinar 6.75 million, which is 3.6. NCI shares exchange gains for 9 months to the 30th of September X6 20% times 13.4 plus 8.2 is 4.3. And NCI at 30th of September X6 is 48.5. That was a long-winded calculation. And Part C, Roman numeral 2. For the year ending 31st of December X6, Carbide will consolidate Bike Light for the first 9 months of the year ended up to the date of disposal of the shares and subsequent loss of control. NCI will be calculated at the first 9 months of losses. Exchange differences on translation of the net assets, profit and goodwill in relation to the 9 months to the 30th of September X6 will initially be recognised in other comprehensive income classified as gains, which will be reclassified subsequently to profit or loss. On the 30th of September X6, a consolidated profit and loss on disposal will be calculated in the consolidated financial statement of Carbide. In effect, the proceeds are compared to the net assets and unimpaired goodwill not attributable to the non-controlling interest at the disposal date. The cumulative exchange difference on the translation of Bike Light would be reclassified to profit or loss. Consolidation should be given as to whether the disposal of Bike Light would constitute a discontinued operation. For Bike Light to be classified as discontinued operation, it would need to represent a separate major line of business or geographical area of operations. Since Bike Light was initially acquired by Carbide to gain easier access to international markets, it is likely that the criterion would be met. I think that is the end of the question. Mock Exam 3, ACCA SBR kit, Mock Exam 3, Question 2, Hudson. Background. Hudson has a year ended the 31st of December X2 and operates a defined benefit scheme for all employees. In addition, the directors of Hudson are paid an annual bonus depending upon the earnings before interest, tax, depreciation and amortisation, also known as EBITDA, of Hudson. Hudson has been experiencing losses for a number of years, and its draft financial statements reflect a small loss for the current year of $10 million. On the 1st of May, X2, Hudson announces that it's restructuring and that it is going to close down Division Y, Y being WYE. A number of redundancies were confirmed as part of the closure, with some staff being reallocated to different divisions within Hudson. The directors have approved the restructuring in a formal directors meeting. Hudson is highly geared, and much of its debts is secured on covenants, which stipulate that minimal level of net assets should be maintained. The directors are concerned that compliance with International Financial Reporting Standards, IFRS standards, could be significant implications for the bonus and debt covenants. Redundancy and settlement costs. Hudson still requires a number of staff to operate Division Y, WYE, until its final expected closure in early X3. As a consequence, Hudson offers its staff two settlement packages in relation to the curtailment of the defined benefit scheme. A basic settlement was offered for all staff who leave before the final closure of Division Y. An additional pension contribution was offered for staff who remained in employment until the final closure of Division 1. The directors of Hudson have only included an adjustment in the financial statements for those staff who left prior to the 31st of December X2. The directors have included this adjustment within the remeasurement component of the defined benefit scheme. They do not wish to provide any other settlement contributions until employment is finally terminated, arguing that the obligation would only arise once the staff were made redundant. On final termination, the directors intend to include the remaining basic settlement and the additional pension contribution within the remeasurement component. The directors and accountant are aware that the proposed treatment does not conform to IFRS standards. The directors believe that the proposed treatment is justified as it will end Hudson. It will help Hudson maintain its debt covenant obligations and will therefore be in the best interest of the shareholders, who are the primary stakeholders. The directors have indicated that should the accountant not agree with their accounting treatment, then he will be replaced. Tax losses. The directors of Hudson wish to recognise a material deferred tax asset in relation to $250 million of unused trading losses, which have accumulated at the 31st of December X2. Hudson has budgeted profits for $80 million for the year ended 31st of December X3. The directors have forecast that profits will grow by 20% each year for the next 4 years. The market is currently depressed and sales orders are at a low level for the first quarter of X3 than they were for the same period in any of the previous 5 years. Hudson operates under a tax jurisdiction which allows for trading losses to be only carried forward for a maximum of 2 years. Required. Part A. Explain why the directors of Hudson are wrong to classify the basic settlement and additional pension contributions as part of remeasurement component, including an explanation of the correct treatment for each of these items. Also explain how any other restructuring costs should be accounted for. 8 marks. Part B. Explain whether deferred tax asset can be recognised in the financial statements of Hudson in the year ended 31st December X2. 5 marks. And Part C. Identify any ethical issues which arise from the director's proposed accounting treatment and behaviour. Your answer should also consider the implications for the accountant arising from the director's behaviour. Professional marks will be awarded in C for quality of discussion. 2 marks. So that's the question, and here is the answer. Hudson answer. Workbook references and tips box. Workbook references. Ethics are covered in Chapter 2. Employee benefits and pension are covered in Chapter 5. Deferred tax is covered in Chapter 7. Top tips. Question 2 of the exam will always feature a discussion of ethical issue and will have 2 marks available for the application of ethical principles. In this question, Part A and Part B related to the accounting treatment of the issue in the scenario given, and Part C requires a discussion of the ethical issues arising, including actions that the accountant should take. In this type of question, remember that ethical issues are likely to be interwoven throughout the scenario. You need to be able to spot them. Remember also that you must apply ethical principles to the scenario. Listing out ethical requirements is unlikely to gain you many marks. I'm not going to read the marking scheme. It's no point. Part A. The remeasurement component is taken to other comprehensive income and comprises of point 1. Actuarial gains and losses, such as the return on plant assets, which differs from the expected return on assets included within the net interest figure. And point 2, changes in the asset ceiling not included within the net interest calculation. Actuarial gains and losses are sometimes referred to as experience adjustments and arise due to the differences between actuarial assumptions and which actually occur during the period. These will arise in instances such as unexpected movements on interest rates, unexpectedly high or low rates of employee turnover, or unexpected increase or decrease in wage growth. The redundancies will create an unusually high level of staff turnover, but this should not be treated as part of the remeasurement component. The redundancy will cause the present value of the obligation arising from the defined benefit to decrease. This is classified as a curtailment rather than an experience adjustment to be included within other comprehensive income. A distinction needs to be made between the basic settlement and the additional pension contribution. The basic settlement is an obligation which Hudson has to pay as compensation for terminating the employee's services, regardless of when the employee leaves the entity. IAS 19 employee benefits requires such payments to be recognised at the earlier of when the plan of termination is announced and when the entity recognises the associated restructuring costs associated with the closure of Y. Hudson should therefore have provided in full for the cost of the basic settlement, regardless of whether the staff have left or not. This should be recognised as part of the past service cost in the profit or loss of Hudson for the year ended 31st of December X2. The additional pension contributions is only paid to employees who complete service up to the closure of Division Y. Since this is expected in early X3, these should be accounted for a short-term benefit. In effect, the contributions are in exchange for the period of service until redundancy. Hudson should estimate the number of employees who will remain with Hudson until the closure of Y. The cost of the payment should then be spread over the period of service. Since this should be included within the current service cost, this would have an adverse effect on the profit and loss in X2, X3. In line with the criteria for recognise any provision as set out in IAS 37, provisions, contingent liabilities and contingent assets, an obligating event must have risen for the restructuring provision and for the associated restructuring cost to be recognised. Furthermore, specific conditions must exist for such an obligating event to have arisen in relation to a restructuring provision. In point 1, a detailed formal plan for the restructuring is in place, identifying certain criteria required by the accounting standard. And point 2, a valid expectation has been created in those affected that the restructuring will be carried out either by starting to implement the plan and or publicly announcing its main features. In the case of Hudson, a valid expectation has been created because the restructuring has been announced, the redundancies have been confirmed, and the directors have approved the restructuring in the formal directors meeting. IAS 37 specifically sets out that a provision cannot be made when only a management or board decision to restructure has been taken, as it is not considered that this in itself gives rise to an obligation to restructure. IAS 37 also specifies that only the direct expenditure which is necessary as a result of restructuring can be included in the restructuring provision. This includes costs of making employees redundant and the cost of terminating certain leases and other contracts directly as a result of restructuring. However, it specifically excludes costs of retraining or relocating staff, marketing or investment in new systems and distribution networks, as these costs relate to future operations and so do not fall under the definition of a provision. Thus, the costs of ongoing activities such as relocation activities cannot be provided for. Part B. Deferred taxes represents the amount of income taxes payable or recoverable in future periods in respect of temporary differences. Temporary differences are differences between the carrying amount of an asset or liability and its tax base. A deferred taxed asset arises where the tax base is an asset exceeds the carrying amount. A deferred taxed asset can also occur when the tax base of its liability differs from its carrying amount. The eventual settlement of the liability represents a future tax deduction. In relation to unused trading losses, the carrying amount is zero since the losses have yet been recognised in the financial statements of Hudson. A potential deferred taxed asset does arrive, but the determination of the tax base is more problematic. The tax base is an asset. The tax base of an asset is the amount which will be deductible against taxable economic benefits from recovering the carrying amount of the asset. Where recovery of an asset will have no tax consequences, the tax base is equal to the carrying amount. Hudson operates under a tax jurisdiction which only allows losses to be carried forward for 2 years. The maximum the tax base could be is therefore equal to the amount of unused losses for X1 and X2, since these only are available to be deducted from the future profits. The tax base, though, needs to be restricted to the extent that there is a probability of sufficient future profits to offset the trading losses. The directors of Hudson should base their forecast on the future profitability on reasonable and sustainable assumptions. There appears to be evidence that this is not the case. Hudson has a recent history of trading losses, and there is little evidence that there will be an improvement in trading results within the next couple of years. The market is depressed, and sales orders for the first quarter of X3 are below the levels in any of the previous 5 years. It is also likely that Hudson will incur various costs in relation to the restructuring, which would increase losses into X3 and possibly X4. Only directly attributable expenses such as redundancies should be included within the provision and expensed in X2, which would increase the current year loss. Ongoing expenses may be incurred, such as retraining and relocating costs, but these should only be expensed from X3. The forecast profitability for X3 and subsequent growth rate therefore appears to be unrealistically optimistic. Given that the losses can only be carried forward for a maximum of 2 years, it is unlikely that any deferred tax assets should be recognised. And Part C. The directors of Hudson are paid a bonus based upon earnings, interest and tax, depreciation and amortisation (EBITDA). It is possible, therefore, despite the losses, that once these items are adjusted for, the directors may receive a bonus. A self-interested threat will arise. The directors have an incentive to manipulate the financial statements in order to try to minimise the losses and maximise profits. Directors have an ethical responsibility to produce financial statements which are fair, objective, and transparent record are a transparent record of the entity's affairs. This is evidence that the directors are willing to manipulate the financial statements in a way directly contrary to the ethical principles of integrity and objectivity. It is likely that a net expense should be recognised for the termination payments on the assumption that they would exceed the reduction in present value of the obligation from the curtailment. The directors are wishing to recognise this within other comprehensive income rather than the profit or loss, despite knowing that it is contrary to international accounting standards. This would improve profitability, although it would not impact upon the net assets due to the corresponding degree in equity. The directors also have not recognised a restructuring provision, despite the terms being communicated to staff. It is possible that this would be treated as an exceptional cost and therefore would not impact on the bonus. It would therefore be useful to examine the precise terms of the contracts in order to assess the potential impact of the bonus. The treatment does, however, at least in short term, help Hudson to improve their net assets position. The deferred tax asset is based upon forecasts for too long a period and also based on unrealistic assumptions. Earnings before interest, tax, depreciation, amortisation will be overstated as a direct consequence. Net assets will also be overstated, helping Hudson to meet its debts covenant obligation. The directors' explanation of their proposed treatment are not justified. Directors are appointed to run the business on behalf of the company shareholders, who are the primary stakeholders. It will be in the stakeholders' interest for the company to be profitable and to maintain net assets within the debt covenant stipulations. However, this should not be at the expense of the credibility and transparency of the financial statements. Deliberate manipulation of financial statements will reduce stakeholders' confidence in the reliability of the financial statements and the accuracy profession as a whole. Deliberate manipulation of the financial statements will reduce stakeholders' confidence in the reliability of the financial statements and the accountancy profession as a whole. The directors are deliberately flouting international financial reporting standards, IFRSs, to improve their bonus and maintain debt covenant obligations. The directors' action with regard to the accountant are contrary to the ethical principles of professional behaviour. It appears that the directors have put the accountant under undue pressure to falsify the financial statements to meet their own needs. An immediate threat arises from the directors implying that the accountant should lose their job should they not comply with the director's instructions. The accountant should also be bound by the ACCA Code of Ethics and must adhere to the same ethical principles. They must not therefore comply with the director's instructions. The accountant should remind the director of their obligation to comply with the Code of Ethics. Should the accountant feel unable to approach the directors directly, they could consider talking to those charged with governance and, in particular, non-executive directors to explain the situation. The accountant could also seek help from the ACCA ethical helpline and take legal advice. Ultimately, if the situation cannot be resolved, the accountant should consider resigning and seeking employment elsewhere. And that's not going to feed his wife and kids, but he should do. ACCA Kit SBR. Mock Exam 3, Section B. Both questions are compulsory and must be attempted. Question 3, Crypto. Part A, Roman numeral 1. Blimey, that's a lot. Crypto operates in the power industry and owns 45% of the voting shares of Curran. Curran has 4 other investors which own the remaining 55% of the voting shares, and property developer and purchase property for its renovation potential and subsequent disposal. Crypto has no expertise in this area and is not involved in the renovation or disposal of the property. The board of directors of Curran make all the major decisions, but Crypto can nominate up to 4 of the 8 board members. Each of the remaining 4 board members are nominated by each of the other investors. Any major decisions require all board members to vote and for there to be a clear majority. Thus, Crypto has effectively the power of veto on any major decision. There is no shareholder agreement as to how Curran should be operated or who will make the operating decision for Curran. The directors of Crypto believe that Crypto has joint control over Curran because it is the major shareholder and holds the power of veto over major decisions. The directors of Crypto would like advice as to whether or not they should account for Curran under IFRS 11 joint arrangements. Roman numeral 2. On the 1st of April X7, Crypto, which has a functional currency of the dollar, entered into a contract to purchase a fixed quantity of electricity at the 31st of December X8 for €20 million. At that date, the spot rate was $1.25 to the euro. The electricity will be used in Crypto's production processes. Crypto has separated out the foreign currency embedded derivative from the electricity contract and measured it at the fair value through the comprehensive income. That's FVTOCI. FVTOCI. However, on the 31st of December 2020 X7, there was a contractual modification such that the contract is now an executory contract denominated in dollars. At this date, Crypto calculated that the embedded derivative had a negative fair value of €2 million. The directors of Crypto would like advice as to whether they should have separated out the foreign currency derivative and measured it at FVTOCI, which was the fair value through other comprehensive income, and how to treat the modification in the contract. Required, advise the directors of Crypto as to how the above issue should be accounted for with reference to relevant IFRS standards. Note, the split of the mark allocation is shown against each of the 2 issues above, 6 marks and 5 marks. Part B. Previous leasing standards have been criticised about the lack of information they require to be disclosed in leasing transactions. These concerns were usually expressed by investors, and so IFRS 16 leases was issued in response to these criticisms. Required, Roman numeral 1. Discuss some of the key changes to financial statements which investors will see when companies apply the lessee accounting requirement in IFRS 16, 6 marks. Roman numeral 2. For a company with significant off-balance sheet leases, discuss the likely impact that IFRS 16 will have generally on accounting ratios and particularly on point 1. Earnings before interest and tax to interest expense interest cover. Point 2. Earnings before interest and tax to capital employed, brackets return on capital employed. Point 3. Debt to earnings before interest, tax, depreciation and amortisation, EBITDA, which is the earnings before interest, tax and depreciation and amortisation. Professional marks will be awarded in B for clarity and quality of discussion, 2 marks. Total 25 marks. That was the question, and here is the answer to Crypto. So answer 3, Crypto. Work in the box of tips and workbook references. Workbook references. IFRS 16 leases is covered in Chapter 9. IFRS 10 is covered in Chapter 11. IFRS 11 is covered in Chapter 15. And IFRS 9, financial instruments, is covered in Chapter 8. Top tips. There are 2 professional marks available in this question for clarity and quality of discussion in Part B. This will be the case for 1 question in Section B of every exam. 2 professional marks will be available in the question that requires analysis from the perspective of stakeholders. Part A, Roman numeral 1, requires advice on the treatment of an investment. The examiner's report stated that many answers to this question were weak, with many candidates focusing only on IFRS 11 rather than first looking at the issue of control under IFRS 10. Part A, Roman numeral 2, was extremely challenging and required advice on the treatment of embedded derivatives contract, which was then modified into an executory contract. Part B, Roman numeral 1, required a discussion on the key changes from an investor perspective of the application of the lessee accounting requirements in IFRS 16. Remember, in this part of your answer, to consider the investor and not just state the accounting adjustment required. Part B, Roman numeral 2, requires a discussion on how IFRS 16 would impact on 3 accounting ratios and more generally from the financial statement now that previously reported off-balance sheet leases are now on balance sheet. Ensure you link the impact on the ratio to the change in accounting treatment required under IFRS 16. Right. Answer Part A, I. Before assessing whether an entity has a joint... Start again. Before assessing whether an entity has a joint control over an arrangement, an entity must first assess whether the parties control the arrangement in accordance with the definition of control in IFRS 10 consolidated financial statements. If not, an entity must determine whether it has joint control of an arrangement. IFRS 11, joint arrangements, defines joint control as the contractually agreed sharing of control of an arrangement which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. This means an assessment as to whether any party can prevent any of the other parties from making unilateral decisions without its consent. It must be clear which combination of parties is required to agree unanimously to decisions about the relevant activities of the arrangement. In the case of Curran, there is more than one combination of parties possible to reach the required majority. As a result, crypto does not have joint control. In addition to the above, crypto does not control Curran because IFRS 10 states that control requires power over the investee, which gives the investor the ability to direct the relevant activities. Crypto does not have the ability to direct the relevant activities as it can only block decisions and cannot make decisions by itself. Also, there is no shareholder agreement which sets out shareholders' voting rights and obligations, and thus the other shareholders can act together to prevent crypto from making decisions in its own interest. Crypto does not have joint control as agreement between itself and other board members has to occur for a decision to be made. Therefore, it appears that Curran is an associate of crypto and would apply IFRS 28 investments in associates and joint ventures. Roman numeral 2. IFRS 9 financial instruments states that any embedded derivatives included in a contract for the sale or purchase of a non-financial item that it's denominated in a foreign currency shall be separated when its economic characteristics and risks are not closely related to those of the host contract. Thus, in contrast to the treatment for hybrid contract with financial asset hosts, derivatives embedded with a financial liability will often be separately accounted for. That is, they must be separated if they are not closely related to the host contract. They meet the definition of the derivative, and the hybrid contract is not measured at fair value through profit or loss, FVTPL. The contract is a hybrid contract containing a host contract which is an executory contract to purchase electricity at a price of 20 million euros and a non-closely related embedded foreign currency derivative with an initial fair value of 0 to buy 20 million euros, sell $25 million. However, the derivative should have been valued at FVTPL and not fair value through other comprehensive income. At the date of the modification of the contract to the functional currency of crypto, there is a significant change to the contract which will trigger a reassessment of its position under IFRS 9. As the contract no longer has a non-closely related embedded derivative, the entire arrangement will be accounted for prospectively as an executory contract, which is outside the scope of IFRS 9. The embedded derivative will be de-recognised, and it is likely that crypto will have to pay the counterparty 2 million euros in compensation. Part B, Roman numeral 1 answer. IFRS 16 leases introduces a single lessee accounting model and should reduce the number of off-balance sheet leases. Upon lease commencement, a lessee recognises a right of use asset and a lease liability. After lease commencement, a lessee measures the right of use asset using a cost model, less accumulated depreciation and accumulated impairment. The lease liability is initially measured at the present value of the lease payment payable over the lease term, discounted at the rate implicit in the lease, if that can be readily determined. Lease liabilities include only economic, unavoidable payments. Investors should bear in mind that some sectors and some companies will be more affected than others. As a result, companies with previous material off-balance sheet leases will report higher assets and financial liabilities. The standard will reduce complexity in financial statements, as it should allow comparisons to be made between those companies who lease assets and those who borrow to buy assets. Investors will no longer have to estimate the assets and liabilities resulting from off-balance sheet leases when calculating ratios, as there should be fewer off-balance sheet leases. IFRS 16 will result in more information about leases both on the statement of financial position and in the notes, and will provide a more accurate reflection of the economics of leases. The carrying amount of lease assets will typically reduce more quickly than the carrying amount of lease liabilities. This will result in a reduction in the reported equity for companies with previous material off-balance sheet leases. IFRS 16 requires a lessee to disclose lease liabilities separately from other liabilities as to a separate line item, or together with other similar liabilities in the manner which is relevant to understanding the lessee's financial position. A lessee will also split lease liabilities into current and non-current positions based on the timing of payments. Roman numeral 2. The recognition of an asset which was previously unrecognised will result in a higher asset base, which will affect ratios such as asset turnover. The recognition of a liability which was previously unrecognised will result in a higher financial liability, which will affect gearing. The recognition of depreciation and interest instead of operating lease expense will result in a higher operating profit, because interest is typically excluded from operating expenses and will affect performance ratios. Similarly, profit measures will exclude interest and depreciation, but previously included operating lease expenses such as EBITDA will be higher under IFRS 16. Interest cover. There will be an increase in the earnings measure, EBITDA, i.e. EBITDA, earnings before interest, tax, depreciation and amortization, which will not be proportionate to the increase in interest. The change in the ratio will depend on the characteristics of the lease portfolio. Return on capital employed is likely that ROCA, return on capital employed, will be lower under the IFRS 16 because the increase in operating profit is likely to be proportionate to the increase in capital employed. Debt to EBITDA ratio of debt to EBITDA is likely to be higher because debt will increase more than the increase in earnings. Debt will increase because of the fact that lease liabilities will be recognised on the statement of financial position. For companies which have material off-balance sheet leases, IFRS 16 is expected to result in higher profit before interest because a company presents the implicit interest in lease payments for former off-balance sheet leases as part of the finance costs. Previously, the entire expense related to off-balance sheet leases was included as part of the operating expenses. The size of the increase of operating profit and the finance cost will depend on the significance of leasing activities to the company. SBR kit mock 3, question 4, Willow. The International Accounting Standards Board, IASB, has been undertaking a number of projects to explore how disclosure of IFRS financial reporting can be improved. In 2017, the IASB issued IFRS Practice Statement 2, Making Materiality Judgments, to provide guidance on the application of materiality of financial statements, and in 2018 the IASB amended the definition of materiality to include the obscuring of information. Materiality is a matter which has been debated extensively in context of many forms of reporting, including the International Integrated Reporting Framework. There are difficulties in applying the concept of materiality in practice when preparing the financial statements, and it is thought that these difficulties contribute to a disclosure problem, namely that there is too much irrelevant information in financial statements which often makes it difficult to focus on the relevant information. Required. Part A, Roman numeral 1. Discuss the definition of materiality, how the application of the concept of materiality has led to concerns regarding the clarity and understandability of financial statements, and briefly discuss the guidance issued in IFRS Practice Statement 2, Making Materiality Judgments, to address these issues. 7 marks. Part A, Roman numeral 2. Outline the proposals in Ed exposure draft, I presume that is, 2019/6, disclosure of accounting policies, and explain how these amendments are expected to help with the disclosure problem. 4 marks. Roman numeral 3, discuss how the concept of materiality would be used in applying the International Integrated Reporting Framework. 4 marks. Part B, Willow is a public limited company and would like to advise in relation to the following transactions. Roman numeral 1. Willow leased its head office during the current accounting period and the agreement terminates in 6 years' time. There is a clause in the lease relating to the internal condition. There is a clause in the lease relating to the internal condition of the property at the termination of the lease. The clause states that internal condition of the property should be identical to that at the outset of the lease. Willow has improved the building by adding another floor to part of the building during the current accounting period. There is also a clause which enables the landlord to recharge Willow for the costs relating to the general disrepair of the building at the end of the lease. In addition, the landlord can recharge any costs of repairing the roof immediately. The landlord intends to replace part of the roof of the building during the current period. 5 marks. Part B, Roman numeral 2. Willow often sponsors professional tennis players in an attempt to promote its brand. At the moment, it has a 3-year agreement with a tennis player who is currently ranked in the world's top 10 players. The agreement is that the player receives a signing bonus of $20,000 and earns an annual amount of $50,000 paid at the end of each year for 3 years, provided that the player has competed in all the specific tournaments for each year. If the player wins a major tournament, she receives a bonus of 20% of the prize money won at the tournament. In return, the player is required to wear advertising logos of tennis apparel play a specified number of tournaments, and attend photo film sessions for advertising purposes. The different payments are not interrelated. 5 marks. Required. Discuss how the above items should be dealt with in the financial statements of Willow. Note the mark allocation is shown against each of the issues above. Total 25 marks. So that is the question, and here is the answer. This is the workbook references, top tips and easy marks box of Willow. Workbook references: materiality, IFRS practice statement 2 and exposure draft 2019/6 are covered in chapter 20. Integrated reporting is covered in chapter 18. Intangible assets and property, plant and equipment are covered in chapter 4. Top tips: the question dealt with materiality at the current issue in part A and covered 2 reporting issues in part B. The definition of materiality in part A, Roman numeral 1, is straightforward, but the consideration of how it could lead to reduction in clarity and understandability needs more thought. Credit will be given for a valid argument. Integrated reporting has been tested in a number of contexts. Here is the context of materiality. You needed to consider how materiality is relevant to the objective of the International Integrated Reporting Framework. In part B, the key is to draw out the relevant rules or principles for the standard and apply them to the scenario. Without discussion of the principle and application, you will not score enough marks to pass the question. Easy marks. The definition of materiality, part A, Roman numeral 1, was a good way to earn marks. You could also pick up some easy marks by knowing the context of IFRS practice statement 2 and exposure draft 2019/6 if you had revised these. In part B, Roman numeral 1, easier marks are available for applying the accruals concept when determining the correct point at which to recognise the expense. The easier marks in part B2 related to trying to identify whether an obligation exists and whether a provision should be recognised. So here's the answer to the question. Right, part A, Roman numeral 1. Definition of materiality and application of the concept. Information is material if omitting, misstating or obscuring it would reasonably be expected to influence decisions that primary users make on the basis of financial information about a specific reporting entity. Materiality is an entity-specific aspect of relevance based on the nature and/or magnitude of the items in which it relates and the context of the entity's financial report. It is therefore difficult to specify a uniform quantitative threshold for materiality and predetermine what could be material in a particular situation. Materiality should ensure that relevant information is not omitted or misstated. In 2018, the ISB amended the definition of materiality to clarify that relevant information should not be obscured by information that is not useful to primary users of financial statements, addressing the issue that too much information can be just as problematic as the omission of information. The conceptual framework describes materiality as an application by a particular entity of the fundamental qualitative characteristics of relevance. When an entity is assessing materiality, it is assessing whether the information is relevant to the primary user of its own financial statements. Information relevant for one entity might not be as relevant for another entity. Although preparers may understand the concept of materiality, they may be less certain about how it should be applied. Preparers may be reluctant to filter out information which is not relevant to users as auditors and regulators may challenge their reason for omissions, particularly where the disclosure is required by IFRS. IFRS Practice Statement 2, Making Materiality Judgments. IFRS Practice Statement 2 is non-mandatory guidance. The guidance confirms the general requirement in IAS 1 that an entity need not provide information which is not material. Bullet point 1, which is not material, and then colon, bullet point 1, the recognition of measurement criteria in an IFRS standard only need to be applied when the effect of the applying them when the effect of applying them is material. And bullet point 2, an entity does not need to make certain disclosure even if that disclosure is part of a list of minimum required disclosures in an IFRS standard if the information provided by that disclosure requirement is not material. The guidance includes a suggested 4-step process to making materiality judgments, which includes identifying potentially material information and assessing whether that information is material. To assess whether the information is material, preparers should assess whether the information could reasonably be expected to influence primary users. This requires the consideration of both quantitative and qualitative factors. Quantitative factors consider the size and effect of the transaction. These can be assessed with the help of threshold, e.g. 5% of profit. Qualitative factors are characteristics that make information more likely to influence the decision of primary users. They can be internal or external. It is usually more efficient to assess items for quantitative perspective first if an item exceeds the quantitative threshold. It is material and no further assessment is required. As the final part of the 4-step process, the entity should review a complete set of draft financial statements, considering whether all material information has been identified and whether materiality has been considered from a wide perspective and in aggregate. Roman numeral 2. Exposure draft 2019/6. Disclosure of accounting policies. IASB research resulted in feedback from the users of financial statements that accounting policy disclosure given by entities in the financial statements are rarely useful. This is because the disclosure given is often a long list of all accounting policies the entity uses, including those which are prescribed by IFRS and for which no judgment is involved. This problem may partly arise because the wording of IAS 1 requires significant accounting policies to be disclosed but does not specifically define significant. To be useful to users, disclosures about accounting policies should provide insight into how the entity has exercised judgment in selecting and applying accounting policies. This means that boilerplate disclosure of accounting policies, which just regurgitates the requirements of accounting standards, are not useful. In fact, including this information may obscure information that is relevant to users. To try and improve the usefulness of accounting policy disclosure, the IASB purposes to amend IAS 1 so that the entity must disclose its material accounting policies. The proposed amendments to IAS 1 paragraph 117 states that bullet point 1, accounting policies that relate to immaterial transactions /events conditions are immaterial. Bullet point 2, an accounting policy is material if information about it is required to understand other material information in the financial statements. Point 3, just because an accounting policy relates to a material transaction /event condition does not mean that the accounting policy itself is material. Bullet point 4, information on accounting policies is more likely to be useful to primary users if it is entity specific, e.g. describes how the entity has applied the recognition and measurement requirements of the IFRS to the entity's own circumstances. Exposure draft 2019/6 also proposes additions to IFRS Practice Statement 2, which includes specific guidance and illustrative examples to help an entity determine whether an accounting policy is material. Roman numeral 3, Part A. Part A, Roman numeral 3. Materiality and the International Integrated Reporting Framework. Integrated Reporting, IR for short, makes a broader view of business reporting, emphasising the need for entities to provide information to help investors assess the sustainability of their business model. Integrated reporting is a process that results in communication through the integrated report about value creation over time. An integrated report is a concise communication about how an organisation's strategy, governance, performance, and prospects lead to the creation of value over the short, medium, and long term. The materiality definition for integrated reporting purposes would consider that material matters are those which are of such relevance and importance that they could substantively influence the assessment of the intended report user. In the case of integrated reporting, relevant matters are those which affect or have potential to affect the organisation's ability to create value over time. For financial reporting, the nature or extent of an omission or misstatement in the organisation's financial statements determines relevance. Matters which are considered material for financial reporting purposes or for other forms of reporting may also be material for integrated reporting purposes. If they are of such relevance and importance that they could change the assessments of providers of financial capital with regard to the organisation's ability to create value. Another feature of materiality for integrated reporting purposes is that the definition emphasises the involvement of senior management and those charged with governance in the materiality determination process in order that the organisation to determine how best to disclose its value creation development in a meaningful and transparent way. Part B, Roman numeral 1, Head Office, Additional Floor. IAS 16, Property, Plant and Equipment, is a relevant standard here. The standard requires that Willow should capitalise the costs of the extra floor, which is an improvement to the building, and amortise those costs over a 6-year lease period. IAS 16 states that initial cost of an asset should include the initial estimate of the costs of dismantling and removing the item and restoring the site, where the entity has the obligation to do so. This is the case here. Willow has an obligation to remove the floor at the end of the lease because the clause in the lease requiring the building's condition to be identical at the end of the lease to its condition at the beginning of the lease. The present obligation exists as defined by IAS 37, Provisions, Contingent Liabilities and Contingent Assets, and therefore the entity should also recognise a provision for that amount. The provision should be discounted to its present value, and unwinding of the discount recognised in the profit and loss. This arrangement is, in substance, a decommissioning liability. The asset recognised for the cost of removal should be amortised over the 6-year period of the lease. Willow may recover the cost from the benefit generated by the new floor over the remainder of the lease. General repair of the building. A present obligation arises for the repair cost under IAS 37 because the lease agreement stated that the landlord can rearrange these costs to Willow. The obligating event is the wear and tear to the building, which arises gradually over the period of the lease and which will result in the outflow of economic benefits. The estimated cost should be spread over the 6-year lease period. A reliable estimate of the yearly organisation can be made, although this may not necessarily be 1/6 per year. For example, if exceptional wear and tear arises in any given year. Roof repair. The lease states clearly that the landlord can recharge any costs of repairing the roof immediately. Accordingly, an obligation exists and a provision needs to be made for the whole of the roof repair work on the date on which the requirement was identified. Part B, Roman numeral 2, Promotional Expenditure. There are 3 types of payment involved in the arrangement with the tennis player. The question states that the payments are not interrelated, so that the interactions between them do not need to be examined, and the expense recognised pattern may be different for each. Signing bonus. The contract is for advertising and promotional expenditure to improve Willow's brand image. IAS 38, Intangible Assets, requires that these costs must be expensed when the services are received. The signing bonus is paid in advance of the service being received. Those services being wearing Willow's logo, taking part in specified numbers of tournaments, and attending photo film sessions for advertising. The signing bonus is $20,000. The bonus of $20,000 is paid to the player at the start of the contract, but relates to the full 3-year contract term. It must therefore be treated as a prepayment at the start of the contract and extended on a straight line basis over the 3-year contract period. If the contract is terminated before the end of the 3-year period, Willow should expense immediately any amount not received from the player. It has been assumed that in specifying the above treatment that separate services cannot be identified. However, if the terms of the contract allow separate services to be identified and measured reliably, then Willow should recognise the expense once the separate service is rendered. Annual retainer. Willow has also contracted to pay the player an annual retainer of $50,000, provided that she has competed in all the specific tournaments for the year. IFRS 9 Financial Instruments requires this arrangement to be treated as a financial liability because Willow has contractual obligation to deliver cash to the player. The financial liability is recognised at the present value of the expected cash flows. Willow incurs this obligation on the date when the player has competed in all the specific tournaments, and it is at this point that the liability should be recognised. Performance bonus. Willow must also pay a performance bonus to the player whenever she wins a tournament. These payments are related to specific events and therefore they are treated as executory contracts. Brackets, an executory contract is a contract in which something remains to be done and by one or both parties. Close brackets. They are accrued and expensed when the player has won a tournament. And that's the end of question 4. Right, ACCA SBR Mock 4 kit Mock 4, and it's section A, and the question is number 1, Looploid. Background. Looploid Company is a parent company of a group undergoing rapid expansion through the acquisition. Looploid Company has acquired 2 subsidiaries in recent years, Collison Company and Hammond Company. The current financial year end is 30th of June 2008. Acquisition of Collison Co. Looploid Co. acquired 80% of the 5 million equity shares, $1 each, of Collison Co. on the 1st of July X4 and the cash of 90 million, for cash of 90 million. The fair value of non-controlling interest, NCI, at acquisition was 22 million. The fair value of identifiable net assets at acquisition was 65 million, excluding the following asset. Collison Co. purchased a factory site several years prior to the date of acquisition. Land and property prices in the area had increased significantly in years immediately prior to the 1st of July X4. Nearby sites had been acquired and converted into residential use. It is felt that should the Collison Co. site also be converted into residential use, the factory site would have market value of 24 million. $1 million of costs are estimated to required to demolish the factory and to obtain planning permission for the conversion. Collison Co. was not intended to convert the site at the acquisition date and had not sought planning permission at that date. The depreciation replacement cost of the factory at the 1st of July X4 had been correctly calculated at 17.4 million. Impairment of Collis & Co. Collis & Co. incurred losses during the year ended 30th of June X8 and an impairment review was performed. The recoverable amount of Collis & Co. assets was estimated to be 100 million. Included in this assessment was the only building owned by Collis & Co. which had been damaged in a storm and impaired to the extent of 4 million. The carrying amount of the net assets of Collis & Co. at 30th of June X8, including fair value adjustments on acquisition but excluding goodwill, are as follows. Land and buildings 60 million, other plant and machinery 15, intangibles other than goodwill 9, current assets recoverable amount 22, total 106. None of the assets of Collis & Co. included goodwill have been impaired previously. Collis does not have a policy of revaluing its assets. Acquisition of Hammond Co. Luploid Co. acquired 60% of the 10 million equity shares of Hammond Co. on the 1st of July X7. Two Luploid Co. shares are to be issued for every 5 shares acquired in Hammond Co. These shares will be issued on the 1st of July X8. The fair value of Luploid Co. share was $30 million at the 1st of July X7. Hammond Co. had previously granted a share-based payment to its employees with the 3-year vesting period. At the 1st of July X7, the employees had completed their service period but had not yet exercised their options. The fair value of the option granted at the 1st of July X7 was 15 million. As part of the acquisition, Luploid Co. is obliged to replace the share-based payment scheme of Hammond Co. with a scheme of its own, which has the following details. Luploid Co. issued 100 options to each of Hammond Co.'s 110,000 employees on the 1st of July X7. The shares are conditional on the employees completing a further 2 years of service. Additionally, the scheme required that the market price of Luploid Co. share had to increase by 10% from its value of $30 per share at the acquisition date over the vesting period. It was anticipated at the 1st of July X7 that 10% of staff would leave over the vesting period, but this was revised to 4% by 30th of June X8. The fair value of each option at the grant date was $20. The share price of Luploid Co. at 30th of June X8 was $32 and is anticipated to grow at a similar rate in the year ended 30th of June X9. Required. Draft an explanatory note to the directors of Luploid Co. addressing the following. Part A, Roman numeral 1. How the fair value of the factory site should be determined at 1st of July X4 and why the depreciated replacement cost of 17.4 million is unlikely to be a reasonable estimate of fair value. 7 marks. Number 2. A calculation of goodwill arising on acquisition of Collis & Co., measuring the non-controlling interest at fair value and proportionate share of the net assets. 3 marks. Part B. Discuss the calculation and allocation of Collis & Co.'s impairment loss at 30th of June X8 and why the impairment loss of Collis & Co. would differ depending on how the non-controlling interests are measured. Your answer should include the calculation and an explanation of how the impairment would impact upon the consolidated financial statements of Luploid Co. 11 marks. C. Roman numeral 1. How the consolidation for the acquisition of Hammond Co. should be measured on the 1st of July X7. Your answer should include the calculation of the consideration and the discussion of why only some of the cost of the replacement share-based payment scheme should be included within the consideration. How much of an expense for the share-based payment scheme should be recognised in the consolidated profit or loss of Luploid Co. for the year ended 30th of June X8. Your answer should include a brief discussion of how the vesting conditions impact upon the calculation. Note, any workings can either be shown in the main body of the explanatory note or in the appendix to the explanatory note. That's the question. Here is the answer notes. Here's the answer. Workbook references. Fair value under IFRS 13 and IAS 36 impairment of assets are both covered in Chapter 4. The underlying principles of acquisition accounting given in IFRS 3 business combinations are covered in Chapter 11. Share-based payment is covered in Chapter 10. Top tips. Question 1 of the real exam will always test group accounting as well as other financial reporting issues. In this question, Part A, Roman numeral 1, requires an explanation of how the fair value of the factory site is determined as part of the acquisition of the subsidiary. This requires knowledge of IFRS 13. Part A2 requires a calculation of goodwill on acquisition, measuring the non-controlling interest NCI under both fair value and proportionate share of net assets. The examiner commented that no explanation was needed to support these goodwill calculations, but that some candidates provided an explanation anyway. The explanation would have not gained any marks as it was not required by the question. Make sure you read the question requirements carefully and only provide explanation for the calculation it specified. Part B. Required a discussion and calculation of its impairment loss relating to a subsidiary, including an explanation of how the impairment would differ depending on the measurement of non-controlling interest. The examiner commented that very few candidates explain the need for grossing up goodwill when NCI is measured at the proportionate share of net assets. Make sure you review the suggested solution below carefully if you are unsure of the need to gross up goodwill in this way. Part C.I. Regarding the share-based payment was tricky, but you should have been able to pick up some marks in this part of the question for discussing the share exchange. With questions like this, if you are unsure, you should have a go at this part of the question, but make sure that you don't spend more than allocated time of 1.95 minutes per mark. Part C, Roman numeral 2. Asked for the resulting share-based expense and the discussion of the vesting conditions. The examiner's commented that this was not well answered. If you are unsure about the share-based payment, go back to the workbook chapter 10 to revise. Yeah, and also because you didn't have bloody time to answer it. That's why it wasn't well answered. Here we go. So here's the answer. Roman numeral A, Part A, Roman numeral 1. IFRS 13 fair value measurement permits the range of valuation methods to estimate fair value, including market-based income estimates and cost-based approach. However, the characteristics of each asset should be considered when determining the most appropriate methodology. Fair value is determined as the price which would be received to sell the asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Fair value is therefore not supposed to be entity specific, but rather to be market focused. The estimate consequently should consider what the market would be prepared to pay for the asset. The market would consider all alternative uses for the assessment of the price which they would be willing to pay. Fair value should therefore be measured by consideration of the highest and best use of the asset. There is a presumption that the current use would be the highest and best use. The highest and best use of the asset would appear to be as residual property and not the current industrial use. The intentions of Collis & Co. are not relevant as fair value and not entity specific. The alternative use would need to be based upon the fair and reasonable assumptions. In particular, it would be necessary to ensure the planning permission to demolish the factory and convert into residential properties would be likely. Since several nearby sites have been given such permission, this would appear to be the case. The fair value of the factory site should be valued as if converted into residual use. Since this cannot be determined on a standalone basis, the combined value of the land and building is calculated. The $1 million demolition and planning costs should be deducted from the market value of $24 million. The fair value of the land and building should be $23 million. The fair value of identifiable net assets at acquisition are $88 million, 65 plus $23 million. Depreciation replacement costs should only be considered as a possible method for estimating the fair value of the asset when other more suitable methods are not available. This may be the case when the asset is highly specialised and market data is therefore limited or unavoidable. This is not the case with the factory site. In most cases, the rise in value of land and properties, particularly for residential use, would mean that to use depreciation replacement cost would undervalue the asset. The exit value for the asset, whether it was based on the principal or more advantageous market, would need to be the same as the entry price. Depreciation may not also be an accurate reflection of all forms of the obsolescence, including physical deterioration. The estimate would need to be acquired for such factors even when the industrial use remains the best of the asset. Goodwill, Part A, Roman numeral 2. Goodwill should be calculated as follows. Fair value method and proportional method, 2 columns. Consideration, non-controlling interest at acquisition, net assets at acquisition, and goodwill. So consideration on the fair value method, consideration 90, NCI 22, minus net assets at acquisition 88, and goodwill of 24. Proportional method, consideration of 90, NCI of 17.6 minus 88 is goodwill of 19.6. NCI at acquisition under proportional method is $17.6 million, 20% times 88 million. The fair value of the net assets at acquisition is 88 million as per the Part A, Roman numeral 1, 65 plus 23. Tutorial note. Goodwill under the proportional method could be calculated as consideration 90 million less fair value at net assets acquired 80% times 88 million, 70.4 million. Goodwill on acquisition 19.6 million. Part B. That's going to be a long one. Part B. An impairment arises when the carrying amount of the net assets exceeds the recoverable amount. Where there is a clear indication of impairment, this asset should be reduced to the recoverable amount. Where the cash flows cannot be independently determined for individual assets, they should be assessed as a cash generating unit, that the smallest group of assets will independently generate cash flows. Impairment of cash generating units are allocated first to goodwill and then prorated to the other assets. It should be noted that no asset should be reduced below its recoverable amount. Fair value method. The overall impairment of Collis & Co. is 30 million, 106 million plus goodwill, 24 million minus 100 million. The damaged building should be impaired by 4 million with a corresponding charge to profit and loss. Since 4 million has already been allocated to the land and buildings, 26 million remains. The goodwill should therefore be written off and expensed in the consolidated statement of profit and loss. Of the remaining 2 million, $1.25 million will be allocated to the plant and machinery, 15 divided by 15 plus 9 times 2 million. And 0.75 million will be allocated to the remaining intangible, 9 divided by 9 plus 15 times 2 million. As no assets have been previously valued and the impairment are charged to the profit and loss, 24 million, 80% times 30 million, will be attributable to the owners of Luploid Co. and 6 million to the NCI of the consolidated statement of comprehensive income. The allocation of the impairment is summarised in the table. Land and buildings, plant and machinery, intangible and other goodwill. Goodwill cost current assets. I'm not reading all that out. You'll have to buy the book if you want the figures. Proportionate method. The basic proportion and value for impairment is the same as the fair value method, and so 4 million will again first be written off against the land and buildings. The problem arises when performing the impairment review as a cash generating unit. When NCI is measured using proportional share of net assets, no goodwill is attributable to the NCI, since goodwill is not included within the individual net assets of the subsidiary. This means that the goodwill needs to be grossed up when the impairment review is performed so that it is incomparable with the recoverable amount. Under the fair value method, the NCI fully represents any premium the shareholders would be prepared to pay for the net assets, and so goodwill does not need to be grossed up. The goodwill of 19.6 million is grossed up by 100 over 80 to the value of $24.5 million. This extra 4.9 million is known as notional goodwill. The overall impairment is now 30.5 million, 106 plus 24.5 minus 100 million, of which 4 million has already been allocated. Since the remaining impairment of 26.5 million exceeds the value of goodwill, the goodwill is written down to zero. However, as only 19.6 million goodwill is recognised within the consolidated accounts, and the impairment attributable to the notional goodwill is not recognised. Only 19.66 million is deducted in full from the owners of Luploid Co.'s share of the profits, since there is no goodwill attributable to the NCI. The remaining 2 million impairment is allocated between plant machinery and intangibles other than goodwill. NCI will be allocated 20% of 6 million, 4 plus 2, i.e. 1.2 million. Consolidated retained earnings will be charged with 80% of 6 million, i.e. 4.8 million, plus 19.6 million goodwill impairment, i.e. 24.4 million in total. The allocation of the impairment is summarised in this table. Tutorial note: notional goodwill and impairment of notional goodwill does not impact on the consolidated financial statements. And there's a table: land and buildings, plant and machinery, intangible other goodwill, notional goodwill, current assets at recoverable amount, 3 columns, original carrying amount, impairment, and revised carrying amount. And then there's figures in each column. Part C, Roman numeral 1. IFRS 3 business combinations requires all consideration to be measured at fair value on the acquisition of a subsidiary. This will include the deferred shares, since Luploid Co. is obligated to replace the share-based scheme of Ham & Co. on acquisition. The replacement scheme should also be included as consideration. There is, however, a post-combination service period, which means that the portion of the replacement scheme attributable to pre-combination service is the market value of the acquiree award multiplied by the ratio of the portion of the vesting period completed to the greater of the total vesting period or the original vesting period of the acquired award. The vesting period of the acquiree award has vested and was 3 years. As there is a 2-year post-combination vesting period, the total vesting period is 5 years. Therefore, the amount attributable to the pre-combination period, and therefore added to the cost of the investment, should be 15 million times 3 divided by 5 equals 9 million. Deferred shares should be measured at the fair value at the acquisition date, with subsequent changes in the fair value ignored. Luploid Co. will issue 2.4 million, 60% times 10 times 2/5 shares as consideration. The market price at the date of acquisition was 30 million, so fair value was 72 million. The total consideration should be valued at 81 million, 72 plus 9. Roman numeral 2, Part C. The fair value of the replacement scheme of the grant date is 18 million, 100 times 10,000 times 90% times $20. Since 9 million has been allocated to the cost of investment, the remaining 9 million should be treated as a part of the post-combination remuneration package for the employees and measured in accordance with IFRS 2 share-based payment. The fair value at the grant date of the share-based scheme should be expensed to profit or loss over the 2-year vesting period. Subsequent changes to the fair value of the shares are ignored. Luploid Co. will need to consider the impact of the market and non-market based vesting conditions. The conditions relating to the share base of Luploid is a market-based vesting condition. These are adjusted for in the calculation of fair value at the grant date of the option. An expense is therefore recorded and consolidated and recorded in the consolidated profit or loss of Luploid Co., irrespective of whether the market-based vesting conditions is met or not. A corresponding credit should be included within equity. And that was a very long-winded question 1. Right, SBR, ACCA SBR kits, mock exam. Which one are we on? 3? So, mock exam 4. Question 2, Stent. Here's the question. Background. Stent Co. is a consumer electronics company which has faced a challenging year due to increased competition. Stent Co. had a year end of 30th of September X9 and the unaudited draft financial statements report an operating loss. In addition to this, debt covenant limit based on gearing are close to being breached and the company is approaching its overdraft limit. Cash advance for Budster Co. On the 27th of September X9, Stent Co.'s financial director asked the accountant to record a cash advance of 3 million received from the customer. Budster Co., as a reduction in trade on 27th of September, Stent Co.'s financial director asked the accountant to record a cash advance of 3 million received from the customer, Budster Co., as a reduction in trade receivables. There you go, that's better. Budster Co. is solely owned by Stent Co.'s financial director. The accountant has seen an agreement signed by both companies stating that the 3 million will be repaid to Budster Co. in 4 months' time. The finance director argues that the proposed accounting treatment is acceptable because the payment has been made in advance in case Budster Co. wishes to order goods in the next 4 months. However, the accountant has seen no evidence of any intent for Budster Co. to place orders with Stent Co. 4 marks. It's a bit of creative accounting there. Preference shares. On the 1st of October X8, the CEO and financial director each paid 2 million cash in exchange for preference shares from Stent Co., which provide cumulative dividends of 7% per annum. These preference shares can either be converted into a fixed number of ordinary shares in 2 years' time, or redeemed at par on the same date at the choice of the holder. The financial director suggests to the accountant that the preference shares should be classified as equity because the conversion is into a fixed number of ordinary shares on a fixed date, fixed for fixed. The conversion is certainly given the current market value of the ordinary shares. The conversion is certain. Fixed for fixed. The conversion is certain given the current value of the market value of ordinary shares. 4 marks. Deferred tax assets. Stent Co. includes a deferred tax asset in its statement of financial position based on losses incurred in the current and the previous 2 years. The finance director has asked the accountant to include a deferred tax asset in full. He has suggested this on the basis that Stent Co. will return to profitability once the funding issues are resolved. 3 marks. Required. Required Part A. Discuss appropriate accounting treatments which Stent Co. should adopt for all issues identified above and their impact upon gearing. Note, the mark allocation is shown against each issue above. Right. Part B. The accountant has been in her position for only a few months, and the finance director has recently commented that all the accounting treatments must be made exactly as I suggest to ensure the growth of the business and the security of all the jobs. Both finance director and accountant are ACCA qualified accountants. Required. Discuss the ethical issue arising from the scenario, including any actions which the accountant should take to resolve the issue. 7 marks. Professional marks will be awarded in question 2 for the application of ethical principles. 2 marks. So that's the question, and here is the answer to stent. So firstly, stent workbook references and top tips box. Workbook references. The conceptual framework and IAS 1 are covered in Chapter 1. Ethics and related party transactions are covered in Chapter 2. Financial instruments are covered in Chapter 8. Top tips. Question 2 of the exam will always feature and discuss the ethical issues and will have 2 marks available for the application of ethical principles. In this question, Part A relates to the accounting treatment of the issue of the scenario in the scenario given, as well as the impact on gearing of the accounting treatment. The examiner commented that a surprising number of candidates did not discuss the impact on gearing and therefore missed out on some marks. Make sure you answer each part of the requirement to the maximum to maximise your score in each question. Part B required a discussion of the ethical issues arising from the scenario. In SBR, ethical issues are likely to go beyond basic accounting errors and could involve personal relationships and pressures that those relationships create, as seen in the question. Be sure to read the question carefully in order to spot these kinds of issues. Right. Cash advance from Budster Co. Stenco's finance director also controls Budster Co, the company which has paid a cash advance in Stenco's a cash advance to Stenco. International Accounting Standards IAS 24 related party disclosures requires an entity's financial statement to contain disclosure necessary to draw attention to the possibility that its financial statements may have been affected by the existence of related party and by transactions and outstanding balances with such parties. Included in the definition of the related party is a person that identifies as holding significant influence over the entity or which a member of the key management personnel of the entity. The finance director, key management personnel of Stent, is a related party. In this case, Stentco must disclose the nature of the related party relationship as well as the information about all transactions and outstanding balances between Stentco and Budster Co. Brackets, owned and controlled by the finance director, close brackets, necessary for users to understand the potential effect of the relationship of the financial statements. The advance from Budster Co meets the conceptual framework definition of a liability. Stentco has a present obligation, brackets, legally enforceable as a consequence of a binding contract, close brackets, the settlement of which involves Stentco giving up resources embodying economic benefits in order to satisfy the claim. IAS 1, presentation of financial statements, states that the entity shall not offset assets and liabilities unless required or permitted by an international financial reporting standard, IFRS. The financial director wants to include the recipient as a credit balance in the trade receivables, netting off any amounts owed by Budster Co from trading, with what appears to be a short-term loan. This would result in a misclassification of a current liability under current assets. Offsetting of financial assets and financial liability is permitted according to IAS 32 financial instruments. Presentation when and only when an entity has a legally enforceable right to set off the recognised amount and intends either to settle on a net basis or to realise the asset and settle the liability simultaneously. No such agreement is evidence in this case, and so Stentco should report separately both assets and liabilities, except when it reflects the substance of a transaction or other event. Offsetting detracts from the ability of the user both to understand the transactions, other events and conditions which have occurred, and to assess the entity's future cash flows. Stentco would be showing a lower current asset figure and concealing the liability, which is, if disclosed as a current liability, could be included in the debt element of the gearing calculation. Gearing would therefore increase. Convertible redeemable preference shares. IAS 32 defines an equity instrument as a contract which evidences a residual interest in the asset of an entity after deducting all of its liabilities. An equity instrument has no contractual obligation to deliver cash or another financial asset, or to exchange financial assets or financial liabilities under the potentially unfavourable conditions. If settled by the issuer's own equity instruments, an equity instrument has no contractual obligation to deliver a variable number, or is settled only by exchanging a fixed amount of cash or another financial asset for a fixed number of its own equity instruments. Preference shares which are required to be converted into a fixed number of ordinary shares on a fixed date should be classified as equity (this is known as a fixed for fixed requirement to which the finance director refers). However, a critical feature of differentiating a financial liability from an equity instrument is the existence of a contractual obligation of an issuer either to deliver cash or another financial asset to the holder, or to exchange financial assets or financial liabilities with the holder under conditions which are potentially unfavourable to the issuer. In this case, Stentco has issued convertible redeemable preference shares, which makes little commercial sense from the company's perspective, as they offer the holder the benefit of conversion into ordinary shares if share price rise, and the security of redemption (at the choice of the holder if the share price fall). IAS 32 notes that substance of financial instruments rather than its legal form governs its classification of the entity's statement of financial position. A preference share which provides for mandatory redemption for a fixed and or determinable amount at a fixed or determinable future date, or gives the holder the right to require the issuer to redeem the instrument at a particular date for a fixed or determinable amount, is a financial liability. Because the preference shares offer the holder the choice of conversion into ordinary shares as well as redemption in 2 years' time, the term of the financial instrument should be evaluated to determine whether it contains both liability or equity components. Such components are classified separately as compound financial instruments, recognising separately the components of the financial instrument which creates both the financial liability of the entity (a contractual arrangement to deliver cash or another financial asset) and the equity instrument (a call option granting the holder the right for the specified period of time to convert it into a fixed number of ordinary shares of the entity). In accordance with IFRS 9 financial instruments, when the initial carrying amount of a compound financial instrument is allocated to its equity and liability components, the equity component is assigned the residual amount after deducting from the fair value of its instruments as a whole the amount separately determined for the liability component. Stentco would measure the fair value of its consideration in respect to the liability component based on the fair value of a similar liability without any associated equity conversion option. The equity component is assigned the residual amount. Gearing would increase if the draft financial statements had included a preference shares within equity. The connection would increase non-current debt, the present value of the future obligations, and decrease equity. Deferred taxed asset. In accordance with IAS 12 income taxes, the deferred taxed asset shall be recognised for the carrying forward of the unused tax losses to the extent that it is probable that future taxable profit will be available against what the unused tax losses can be utilised. However, the existence of unused tax losses is strong evidence that the future taxable profit may not be available. Therefore, when an entity has a history of recent losses, the entity recognises a deferred tax asset arising from unused tax losses only to the extent that it has convincing evidence that sufficient taxable profit will be available against which the unused tax losses can be utilised. In such circumstances, the amount of the deferred tax asset and the nature of the evidence supporting its recognition must be disclosed. The directors of Stentco could consider whether it is probable that Stentco will have a taxable profit before the unused tax losses or unused tax credits expire, whether the unused tax losses result from identifiable causes which are unlikely to recur, and whether tax planned opportunities are available to the entity which will create taxable profit in the period in which the unused tax losses or unused tax credits can be utilised. To the extent that it is not probable that taxable profit will be available against which the unused tax losses or unused tax credits can be utilised, the deferred tax asset should not be recognised. The removal of the deferred tax asset would reduce net assets and equity. Gearing would therefore increase. Equity aspects. The ACCA rulebook contains the bylaws, regulations and code of ethics of conduct which every ACCA member should follow. The accountant may feel pressure by the finance director's comments on job security, even the accountant has only been in a position for a few months. The accountant should comply with the fundamental ethical principles set out with the ACCA rulebook. To act with integrity, objectivity, professional competence and due care, confidentiality and professional behaviour. The accountant should be mindful of any threats to the fundamental ethical principles. In doing so, the accountant should consider the relevant facts, the ethical issues involved, the fundamental principles which are threatened, whether internal procedures exist which mitigate the threats, and what alternative courses of action could be taken. In this case, all fundamental ethical principles, with the exception of confidentiality, appear under threat. The financial director appears to be for allowing bias and undue influence from the pressures imposed by debt covenant gearing and overdraft limits into the choice of accounting treatment, rather than following accounting standards. The company is in a precarious position reporting losses in the year. The financial director should act professionally in accordance with applicable technical and professional standards, complying with relevant laws and regulations, and avoid any action which discredits the profession. The finance director faces an advocacy threat by promoting accounting treatments which compromise objectivity. The accountant faces an intimidation threat, giving the comments from the financial director, who presumably has influence over the career prospects. Assuming that the accountant wishes to keep her job, this intimidation threat is also linked to one of self-interest. Before acting, the accountant should speak with the financial director to try and confirm the facts and discuss the treatment with the finance director and explain the risks of non-compliance. The safeguard of accounting regulations and the sanctions imposed on those professional accountants who do not comply may resolve the issue. A record of conversations and actions should be kept. Stentco may also have international procedures which mitigate these threats. It may be that the finance director is not technically up to date, in which case a safeguard would be to undergo continuing professional development. If the finance director refused to comply with accounting standards, then it would be appropriate to discuss the matter with other directors or an audit committee if applicable. To seek a solution, then seek professional advice from ACCA and consider legal advice if necessary. A final consideration for the accountant, if matters cannot be resolved, would be resignation. Right, mock number 4, mock number 4, yeah, section B, question 3, DigiWire. Background. DigiWire has developed a new business model whereby it sells music license to other companies which deliver digital music to consumers. Revenue, sale of a 3-year license is the heading. DigiWire Co. has agreed to sell Clam Music Co., an unlisted technology startup company, a 3-year license to sell DigiWire Co.'s catalogue of classical music to the public. This catalogue contains a large selection of classical music which DigiWire Co. will regularly update over the 3-year period. As revenue for the 3-year license, Clam Music Co. has issued shares to DigiWire Co. equivalent to a 7% shareholding. Voting rights are attached to these shares. DigiWire Co. received the shares in Clam Music Co. on the 1st of January X6, which is the first day of the license term. DigiWire Co. will also receive a royalty of 5% of future revenue sales of Clam Music Co. as revenue for the license. Clam Music Co. valuation and revenue is the heading. On the 1st of January 20X6, Clam Music Co. was valued between $4 to $5 million by a professional valuer who used a market-based approach. The valuation was based on the share price of the controlling interest in a comparable listed company. For the financial year end 31st of December X6, sales of classical music were $1 million. At 31st of December X6, a further share valuation report had been produced by the same professional valuer, which indicated that Clam Music Co. was valued in the region of $6 to $7 million. Investment in 4D Co. DigiWire Co. has agreed to work with Tech Game Co. to develop a new music platform. On 31st of December X6, the company has created a new entity, 4D Co., with equal shareholdings and share of profit. DigiWire Co. has contributed to its own intellectual property in the form of employee expertise. Cryptocurrency with a carrying amount of $3 million, fair value of $4 million, and an office building which is a carrying amount of $6 million with a brackets of fair value of $10 million. The cryptocurrency has been recorded at cost in DigiWire Co.'s financial statements. Tech Game Co. has contributed the technology and marketing expertise. Tech Game Co. has contributed the technology and marketing expertise. The board of 4D Co. will comprise of the directors. The board of 4D Co. will comprise directors appointed equally by DigiWire Co. and Tech Game Co. Decisions are made by unanimous vote. Pension plan. DigiWire Co. provides a pension plan for its employees. From the 1st of September X6, DigiWire Co. decided to curtail the plan and to limit the number of participants. The employees were paid compensation from the plan assets, and some received termination benefits due to redundancy. Due to the curtailment, the current monthly service cost changed from $9 million to $6 million. The relevant financial information related to the plan is as follows. Date, net defined liability, discount rate. So the date is 1st of Jan X6, then 1st of September X6 and 31st of December X6. The net defined liability is 30 million, 36 million and 39 million, and the discount rate is 3%, 3.5% and 3.7%. Required. Part A. Advise the directors of DigiWire Co. on the recognition and measurement of the Roman numeral 1. Clam Music Co. shares received as revenue for sale of the 3-year licence and how they should be accounted for in the financial statements for the year ended 31st of December X6. And Roman numeral 2. Royalties which Clam Music Co. has agreed to pay as revenue for the sale of the 3-year licence in the financial statements for the year ended 31st of December X6. Your answer to A, Roman numeral 2, should demonstrate how it's supported by the Revised Conceptual Framework for Financial Reporting 2018, 9 marks. Part B, based on International Financial Reporting Standards, IFRS, advise the directors on the following. Roman numeral 1. The classification of the investment which DigiWire has for 4D Co. Roman numeral 2. The derecognition of assets exchanged for the investment in 4D Co. and any resulting gain or loss on disposal in the financial statements of DigiWire Co. at 31st of December X6. Roman numeral 3. Whether the cryptocurrency should be classified as a financial asset or intangible asset. Your answer should also briefly consider whether fair value movements on cryptocurrency should be recorded in profit or loss. 9 marks. Part C, Roman numeral 1. Explain the reasons behind the issue of the amendment to IAS 19 plan amendment, curtailment or settlement, and discuss why the changes to the calculation of net assets and current service costs were considered necessary. 3 marks. Roman numeral 2. Advise the directors of DigiWire Co. on the impact of the amendment of IAS 19 on the calculation of net assets and current service costs for the year ending 31st of December X6. 4 marks. So there's the question. Right, answer 3, DigiWire, reference, workbook references and top tips. Workbook references. IFRS 15 on revenue is covered in Chapter 3. IFRS 13 fair value measurement is covered in Chapter 4. IFRS 9 financial instruments is covered in Chapter 8. Pensions and amendments to IAS 19 are covered in Chapter 5. Top tips. The question is set in the context of the digital business. Something that the examiner has highlighted could be a feature of a question in SBR. The company in the question, DigiWire, sold music license to other companies who then provided digital music to customers. Part A. Part A concerned revenue recognition. In Part A, Roman numeral 2, you were asked to show how the accounting treatment was supported by the revised 2018 conceptual framework. The principles in the conceptual framework are crucial to SBR and are likely to feature in every exam in some way. Therefore, you need to make sure that you know the principles in the conceptual framework and be able to show how those principles support accounting standards, or in some cases are at odds with the accounting standards. Part B. Included in discussion of whether cryptocurrency can be classified as financial asset or intangible asset, the examiner's report expects surprise that the answer to these questions were generally weak, given that there is a technical article on cryptocurrency available on the ACCA website. This highlights the importance of reading the technical articles available. See an exam research section of ACCA website. Part C. Included in the discussion of the amendments to IAS 19, a current issue which is specifically listed in the current issue section of the syllabus. There are not very much current issues highlighted on the syllabus, so you must make sure you have taken the time to study each of them, as a current issue will be examined in every exam. In this case, the examiner commented candidates who were unaware of the amendment should at least have been in a position to critically describe the previous method by which each cost was calculated. Appropriate discussion would have been awarded marks. And then there's the marking scheme, which I'm not going to read. Right, then Part A, Roman numeral 1 answer. Revenue recognition, Clam Music Co. shares. IFRS 15, revenue from contracts with customers, requires that non-cash consideration received should be measured at fair value of the consideration received. If fair value cannot be reasonably estimated, the consideration should be measured by reference to the stand-alone selling price of the goods or service promised in the contract. The fair value of non-cash consideration may vary. If the non-cash consideration varies for reasons other than the form of consideration entity, the fair value of non-cash consideration may vary. If the non-cash consideration varies for reasons other than the form of the consideration, entities will apply the guidelines in IFRS 15 related to constraining variable consideration. However, If fair value varies only due to the form, the variable constraint guidance in IFRS would not apply. In this case, the fair value varies due to the form of the consideration, which is equity shares, and therefore the variable constraint guidance in IFRS 15 does not apply. The fair value of shares in the unlisted startup company is problematic. However, IFRS 13 fair value measurement gives advice on how to measure unlisted shares. It sets out three approaches. Roman numeral 1, market approach, such as transaction price paid for identical or similar instruments of the investee. Roman numeral 2, the income approach, for example using discounted cash flow. And Roman numeral 3, the adjusted net asset approach. In this case, the market approach has been used and a range of fair value is significantly based upon the professional valuation report. The range of fair value for the 7% holding of the shares would be $280,000 to $350,000, 7% of $4 to $5 million. At the date of the contract, $420,000 to $490,000, 7% of $5 to $6 million. At the year, turn the page. At the year end. As the fair value is based upon a similar listed company and is based upon the controlling interest, a discount on the valuation of shares should be applied to reflect the lack of liquidity and inability to participate in Digiwire's Co's policy decisions. Thus, the estimated value of the shares can be made which take into account the above facts. This could be the midpoint of 350,000, 280,000 plus 350,000 divided by 2, at the date of the contract, and 455,000 being 420,000 plus 490,000 divided by 2 at the year end. Digiwire Co would therefore recognise revenue of 315,000 for the receipt of shares from Cloud Music, as the fair value of non-cash consideration is measured at the contract inception date of the 1st of January X6. This revenue would not be recognised at the point of time, but would be recognised over the period of licence, which is 3 years. Cloud Music Co share valuation at 31st of December X6. The share will be recognised at 455,420 plus 490 divided by 2 at 31st of December X6. All equity investments in scope of IFRS 9 financial instruments should be measured at fair value in the statement of financial position, and the value changes being recognised in profit and loss. If the equity instrument is not held for trading, an equity can make an irrevocable election at initial recognition to measure it at fair value through other comprehensive income, FVTOCI, for TOCI, which with only dividend income recognised in profit or loss. If Digiwire Co elects to present the remeasurement through other comprehensive income, OCI, gains are never recycled through profit or loss. This means that if the investment in Cloud Music is successful, when the investment is sold, there will be no profit or loss effect, since all gains will already have been recognised in OCI. Thus, at the year end, the gain of 140,000, 455 minus 315, will be recognised in profit or loss, or OCI, dependent upon any election being made. Roman numeral 2, Part A. Part A, Roman numeral 2, Revenue Royalties. As Digiwire Co retains an active role in updating and maintaining of sold licence to ensure its continuing value to the client, revenue would be recognised over the expected length of the contract and related client relationship. An entity must be expected to undertake activities which significantly affect the licence to conclude that revenue is recognised over time. However, reliable measurement of future royalties is not available, see below. Thus, in this case, the revenue would be recognised over the 3-year licence based upon the licence agreement. At the year end, however, revenue from royalties can be calculated based upon the sales for the period, and it would be 50,000, 5% of 1 million. The conceptual framework support. The International Accounting Standards Board has changed the definition of income and expense in the revised conceptual framework, to align with the revised definitions of the asset and the liability. The definition of income encompasses both revenue and gains. Revenue arises in the course of ordinary activities of an entity and is referred to by a variety of different names, including sales, fees, interest, dividends, loyalty, and rent. Gains represented other items which meet the definition of income and may or may not arise in the course of ordinary activities of an entity. Gains represent increases in economic benefits and, as such, are no different in nature from revenue. Hence, they are not regarded as constituting a separate element in the IFRS framework. The revised framework also states that an item which meets the definition of an element should be recognised if A. It is probable that any future economic benefit associated with the item will flow to or from the entity, and B. The item has a cost value or which can be measured with reliability. Thus, in this case, the loyalties cannot be measured with any certainty in the future and should not be recognised until certain. The definitions of a framework relating to revenue, recognition and gains are therefore consistent with the approach taken by DigiWire Co. Part B, Roman numeral I. It seems that DigiWire Co. and Tech Game jointly control 4D Co. and it appears as though the arrangement is a joint venture, IFRS 11 joint arrangements. As the parties have joint control of the arrangement and have rights to the net assets of the arrangement, joint control is the contractually agreed sharing of the control of an arrangement, which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. This is the case for 4D Co. A joint venture recognises its interest in a joint venture as an investment and accounts for that investment using the equity method in accordance with IAS 28, investments in associate and joint ventures, unless the entity is exempted. Part B, Roman numeral 2. DigiWire Co. has exchanged non-monetary assets for its investment in 4D Co. and thus needed to de-recognise the asset in contributing to 4D Co. The carrying amount of 6 million in the property is de-recognised, but the intellectual property of DigiWire Co. has been generated internally and does not have the carrying amount. The cryptocurrency is recorded as an asset in the financial statements of DigiWire Co. at 3 million, but was valued at 4 million, its fair value in the financial statements of 4D Co. Accordingly, when a joint venturer contributes a non-monetary asset to a joint venture in exchange for equity interest in the joint venture venturer recognises a portion of the gain or loss on disposal, which is attributable to other parties to the joint venture, except when the contribution lacks commercial substance. Essentially, DigiWire Co. is required by IAS 28 to limit the profit on disposal of a non-monetary asset of 50%. Effectively, DigiWire has only disposed of 50% of the asset contributed to the joint venture. Thus, the carrying amount of the joint venture in DigiWire's financial statements at the 31st of December X6 will be 11.5 million, 6 plus $3 carrying amount, de-recognised for property and cryptocurrency, plus 4 minus 3 divided by 2, plus 10 minus 6 divided by 2. A gain of 2.5 million will be recorded in the profit or loss. Roman numeral 3. If the cryptocurrency meets the definition of financial asset, it is possible to measure it at fair value. However, cryptocurrency is not cash or cash equivalents, as its value is exposed to significant changes in market value and there is no contractual right to receive either cash or cash equivalents. Therefore, cryptocurrency fails the definition of financial asset. If the cryptocurrency is to be recognised as the intangible asset, then the default position would be to measure it at cost. However, there may be an argument to say that there is an active market for cryptocurrency, in which case it would be possible for it to be measured at fair value. In this case, movement in that fair value would be recognised through other comprehensive income, and the gain would be recycled through profit and loss when the cryptocurrency is realised. The best way to account for cryptocurrency would be the fair value, as that is the value of which the entity will realise their investment or transact in exchange for goods and services. Accounting for cryptocurrency at fair value with movements reflecting in profit and loss would provide the most useful information to investors, but existing accounting requirements do not appear to permit this. Part C, Roman numeral 1. Therefore, an amendment IAS 19 employee benefits did not before the amendment IAS 19 employee benefits did not require entities to revise the assumption for the calculation of current service cost and net interest during the accounting period. Even if an entity remeasures the net defined benefit liability or asset in the event of a planned amendment, curtailment or settlement, the calculations were based on the actuarial assumptions as to the start of the financial year. However, the International Accounting Standards Board felt that it was inappropriate to ignore any updated assumptions when determining current service cost and net interest for the period. Therefore, an amendment to IAS 19 states that when a plan amendment, curtailment or settlement occurs during the annual reporting period, an entity must, bullet point 1, determine current service cost for the remainder of the period after the planned amendment, curtailment or settlement using an actuarial assumption used to remeasure the net defined benefit liability asset reflected the benefit offered under the plan and the plan asset after that event. Or Roman numeral 2, determine net interest for the remainder of the period after the planned amendment, curtailment or settlement using Roman numeral 1, the net defined benefit liability asset reflecting the benefit occurred under a plan and the plan asset after that event, and Roman numeral 2, the discount rate used to measure that net defined benefit liability / asset. Roman numeral 2 of the part C. If DigiWire Co had not applied the revised IAS 19, then the current service cost would have been 108 million, 12 months times $9 million. On the application of the revised standard, the current service cost would be $96 million, 8 months times $9 million, plus 4 months times $6 million. Thus, there will be a reduction in the current service cost of $12 million. Similarly, the net interest component before the amendment would have been $900,000, 3% of 30 million. After the amendment, it would be 1,020,000, which is 900,000 times 8 twelfths plus 3.5% times 36 million times 4 twelfths. Therefore, there will be a change in the net interest element of $120,000, which is 1,020,000 minus 900,000. The net effects will be to change the remeasurement component by 11,888,000. That is a very long question 3. Mock exam 4, question 4, guidance. Background. Guidance Co. is considering the financial results for the year ended 31st of December X6. The industry places great reliance on the return on capital, the return on equity, ROE, as an indicator of how well a company uses shareholders' funds to generate a profit. Return on equity, ROE. Guidance Co analyses ROE in order to understand the fundamental drivers of value creation of value creation in the company. ROE is calculated as return on equity equals net profit before tax over sales times sales over assets times assets over equity. Guidance Co. uses year-end equity and assets to calculate ROE, a return on equity. The following information in Table 1 relates to Guidance Co. for the last 2 years. And then there's 2 columns, X5 and X6. Net profit before tax, sales, assets, equity at 31st of December. And for X5, it's 30 million, 200 million, 250 million, and 175 million. And then on X6 is 38 million, 220 million, 210 million, and $100 million. That was net profit before tax, sales, assets, and equity. Special Purpose Entity, SPE. During the year ended 31st of December X6, Guidance Co. stated that it had recognised its assets and set up SPE. Guidance Co. transfers property to SPE at the carrying amount of 50 million, but had incorrectly charged revaluation reserves with this amount rather than showing the transfer as an investment in SPE. The property was SPE's only asset. However, Guidance Co. still managed the property, and any profit or loss relating to the asset of the entity was remitted directly to Guidance Co. Guidance Co. has no intention of consolidating the SPE. Miscellaneous transactions. Guidance Co. has bought back 25 million shares of $1 to $1.20 per share during the year ended 31st of December X6 for cash and cancelled the shares. The transaction was deemed to be illegal. Guidance Co. also raised loan capital for the first time during the year ended 31st of December X6 of $20 million in order to help with the buyback of the company's shares. Guidance Co. has purchased 25% interest in the associate company on the 1st of July X6 for cash. The investment had cost 15 million and the associate had made profits of 32 million in the year to 31st of December X6. Guidance Co. accounted for the purchase of the associate correctly. All these miscellaneous transactions have been accounted for in the financial information for the year ended 31st of December X6 in Table 1. Part A. Management's intent and motivation will often influence accounting information. However, the corporate financial statements necessarily depend on the estimates and judgment. Financial statements are intended to be comparable, but their analysis may not be the most accurate way to judge the performance of any particular company. This lack of comparability may be due to the different accounting policy choices or deliberate manipulation required. Discuss the reasons why an entity may choose a particular accounting policy where international financial reporting standards allows the accounting policy choice and whether faithful representation and comparability are affected by such choices. Part B, Roman numeral 1. Discuss the usefulness to investors of the ROE ratio and the component parts provided above and calculate these ratios for the year ended 31st of December X5 and X6. These calculations should be based upon the information provided in Table 1. 5 marks. Roman numeral 2. Discuss the impact that the setting up of the SPE and miscellaneous transactions have on the ROE and its component parts. Given these considerations, adjust Table 1 and recalculate the ROE for X6, thereby making it more comparable to the ROE of X5. 12 marks. Professional marks will be awarded in question 4B, Roman numeral 1, for clarity and quantity and quality of discussion. So this is the answer of guidance. So the workbook references and top tips box. Workbook references. The conceptual framework is covered in Chapter 1. Analysis is covered in Chapter 18. IFRS 10 consolidated financial statements is covered in Chapter 11. Top tips. There are 2 professional marks available in the question for clarity and quality of the discussion in Part B. This will be the case for one question in Section B of every exam. 2 professional marks will be available in the question that requires analysis from the perspective of stakeholder. Part A requires a discussion of why a reporting entity may choose a particular accounting policy where IFRS allows a choice, and the impact of faithful representation and comparability on the choice. You need to know that faithful representation and comparability are qualitative characteristics of useful information, as described in the conceptual framework. The conceptual framework is fundamental to SBR. You must make sure you are familiar with it. Part B, Roman numeral 1, requires calculation of the return on equity ratio, ROE, and discussion of the usefulness to investors of the ratio and its component parts. The examiner commented that some candidates didn't include discussion of the component parts of our ROE, despite this being clearly stated in the requirements. Make sure you read the requirements carefully and ensure you answer each part of each requirement. And Part B, Roman numeral 2, asks for a discussion of the impact of the accounting transactions in the scenario on the ROE ratio and its components, and a recalculation of more comparable ROE between the 2 years. The examiner commented, better answers include a description of the impact of each component as well as the ROE, meaning the question's whole requirement, in brackets, and provide a table in which the original accounting data is adjusted for each transaction. Remember that laying out your answers clearly helps the marker to see what you have done, enabling them to award you marks more easily. Part A. So this is the answer. Where an IFRS standard allows an entity to an accounting choice, then the financial statements will be influenced and affected by that choice. Management's intent and motivation will influence accounting information. The accounting policy chosen can be driven by self-interest, by a wish to maximise the interests of shareholders, or by a wish to provide information. Where there are flexibility when applying the IFRS standard, the financial statement can become less comparable. Entities may use the financial choices to increase earnings and manipulate accounting figures in order to influence contractual outcomes which depend on the accounting figures reported. Accounting choices exist to provide companies which operate under different business models with an option to utilising an accounting method which best represents their operations. Any accounting choice in IFRS standards should still result in a financial statement being fully represented. A faithful representation means that to the maximum extent possible, the financial statements are complete, neutral and free from error. A faithful representation is affected by the level of measurement uncertainty in the financial statements. Comparability is one of the 4 qualitative characteristics which enhances the usefulness of information. Thus, accounting information should be more useful if it can be compared with similar information from other entities or from the same entity. However, it is extremely difficult for entities to have comparable financial information. Comparability is crucial to improving financial reporting quality, but it can be argued that comparability is more difficult by the fact that the board allows entities to choose between alternative measurement bases. Environmental, economic, political, cultural, operational differences could be solved with the existence of accounting choices in the standards. But these choices could be at the cost of comparability, especially if there is an intent or external factors influencing the reliable disclosure of an item. A faithful representation might lead to comparability because it should reflect on the characteristics of the asset or liability. Part B, Roman numeral 1, the return on equity, ROE ratio measurement. The ROE ratio measures the rate of return which the owners of issued shares of a company receive on their shareholdings in terms of profitability. ROE signifies how good the company is in generating profit to the investment it receives from its shareholders. This metric is especially important from the investor's perspective, as it can be used to judge how effectively the firm will be able to use its shareholders' investment to generate additional revenues. The net profit margin, net profit over sales, tells how much profit a company makes on every dollar of sales. Asset turnover, sales over assets, ratio measures the value of a company's sales or revenue generated relative to the carrying amount of its assets. The asset turnover ratio can often be used as an indicator of the efficiency with which a company is deploying its assets in generating revenue. The equity ratio indicates the relative proportion that equity is used to finance a company's asset. The equity ratio is a good indicator of the level of leverage used by a company by measuring the proportion of the total assets which are financed by shareholders as opposed to creditors. So net profit margin, asset turnover, equity ratio, return on equity. X5, net profit margins 15%, asset turnover 0.8, equity ratio 1.43, return on equity 17%. X6, net profit margin 17.3, asset turnover 1.05, equity ratio 2.1, return on equity 38%. Roman numeral 2. This is part B, Roman numeral 2. Setting up of a special purpose entity, an SPE. IFRS 10 consolidated financial statements states that an investor controls the SPE when it is exposed or has the rights to variable returns from its involvement with the SPE, the special purpose entity, and has the ability to affect those returns through its power over the special purpose entity. This revised definition of control focuses on the need to have both power and variable returns before control is present. Power is the current ability to direct the activity which significantly influences returns. Guidance Co obtains the rewards from the assets transferred and is exposed to the risks. By transferring their assets to the special purpose entity, the asset turnover ratio will be significantly larger. However, the special purpose entity should be consolidated by Guidance Co in its group financial statements and property included in assets and the charge eliminated from revaluation reserves in its single entity financial statements. The latter will increase shareholder equity. Miscellaneous transactions. A major concern about using return on equity is the company buys back its shares. It decreases the equity on the statement of financial position, and in the case of Guidance Co, its cash and its cash and consequently its total assets. As a result, the performance metrics, asset turnover and return on equity. It is return on equity, isn't it? Yeah, return on equity. Will be so. As a result, the performance metrics, asset turnover and return on equity will be affected. The return on equity figure could produce a misleading indicator as how well a company is being managed. As the equity portion of return on equity shrinks, the return on equity metric gets larger. The return on equity calculation can become meaningless if a company regularly buys back its shares, and thus, as a result, there may be a better metrics for investors to use, such as PE ratio, price earnings ratio. Guidance Co has raised loan capital of 20 million during the period, and the amount will not be indicated in the return on equity calculation because return on equity is based on the assets as opposed to net assets. One company may have a higher return on equity than another company simply because its finances and business through loan capital rather than raising equity capital. It can be argued that return on equity is not a meaningful measure of performance as it takes no account of the amount of debt involved in creating profits. Therefore, return on capital employed may be a better current measure for Guidance Co. Guidance Co has included the profit from the purchase of an associate in the company year's figures. If the shares of the results of the associates were excluded, this will allow Guidance Co profitability to result exclusively from Guidance Co's asset base. It could be argued that the full value of the company's reporting profit, including the associate, could distort the analysis of Guidance Co's performance as compared to the last financial year. There is no need to adjust for the original 15 million investment in the associate because one asset is merely being replaced by another, but the total assets remain the same. Adjusted amounts. So there's a table here: net profit before tax, sales, assets and equity, and SPE property column, shared cancels column, associates and total column. I'm not reading all that out. Adjusted calculation: net profit before net profit margin, asset turnover, equity ratio, ROE ratio, and it's for X5, X6 adjusted and X6 unadjusted. And there's another table. It can be seen that if the impact of the transactions in the period were eliminated, then there's been a significant reduction in ROE and its component parts. The buyback of shares and the purchase of associates were legitimate transactions, but they were eliminated in order to determine comparative metrics. The raising of the loan capital was also legitimate, but was not adjusted for because of return on equity. Let's start again. The raising of the loan capital was also legitimate, but was not adjusted for because return on equity is based on assets, not net assets. The transfer of assets to a SPE. What was the SPE? A special purpose entity. The transfer of assets to a special purpose entity was controlled by IFRS 10 and would have been revised in any event. Although financial metrics are intended to enable comparisons between companies, the relative performance of any particular company can be affected by transactions both acceptable and unacceptable under accounting standards. And that was the answer to part B.